achieve our guidance, we need possibly another 80,000 crores of orders in quarter 4. Historically, quarter 4 has been a very rewarding quarter for us. So our sense is that we are well positioned to do better than what we have guided on the order inflow, but very difficult to pinpoint a certain percentage because the size of the orders are big. As far as the rest of the guidance is concerned, I think we had guided around 15% revenue growth. We are at the moment keeping pace with that revenue growth. So with a few more months to go, I think that guidance looks safe. We had guided for stable margins as we had reported for the last year. And so far, once again, the margins have been on the same trajectory. And we do hope that we should be able to meet those guidances as well.
Moving on, the Parliament budget session will begin today with President Draupadi Murmu to address a joint sitting of both houses of the Parliament in the Lok Sabha chamber. Prior to this, Prime Minister Narendra Modi will address the media. Finance Minister Nirmala Sitharaman will also present the economic survey that is prepared by the Chief Economic Advisor Anantha Nageswaran today. Okay, let's also listen into what corporate India expects from the Finance Minister when she delivers the budget tomorrow.
I think there are three themes around which the budget, I think, needs to be, probably would be addressing. One is, I think, the public investment has to continue. So I think the infra investment. Second, I would say some effort needed on creating consumption surplus for consumption in the hands of the common person. So that will be areas like taxes and income tax, GST and things like that. And the third, I would say, is how to get private investment back in, some measures to drive confidence of the business houses and businessmen to invest more.
There are going to be disruptions because of the US tariffs, whatever we may call their initiatives. The economy also needs to pick up in terms of employment. So I think government should do something which is pro-business, which can drive growth.
The Indian economy has, of course, been the fastest growing economy for a long period of time. And anything that's fast, like a Formula One car, needs both an accelerator and a brake. So fiscal prudence is, of course, the brake, but then ambitious schemes are the accelerator. So I think what I'll be looking for is a combination of the two things. We need both. Fiscal prudence is what will set the framework for things in the long term. But at the same time, I think we need some focus on the short term to make sure that, this dramatic slowdown that we have seen in the last couple of quarters gets arrested. And of course, we need some ambitious, reforms to kickstart the economy as well. So I think it's a combination of the two things.
Okay, on that note, we're going to step into a very short break. But after the break, we'll get to what is happening in the world of commodities this morning. So stay tuned for that.
Will be able to do on the Indian servers so that it becomes slightly more comprehensive. But the second and perhaps a larger concern that the government has is that the government doesn't want you sipping tea from the Chinese cup of tea, as that will leave your imprint, and by your imprint I mean your data with the Chinese servers. What the Indian government is essentially saying, let it come here and have a cup of tea from the Indian cup of tea, the Indian server, so that your imprint, your data stays safe within Indian shores. So this Chai Pe Charcha is the long and short of why the Indian government is bringing DeepSeek on Indian servers to Indian shores.
Welcome back. You're watching Power Breakfast on CNBC-TV18. Now let's go across to Manisha Gupta, who's waiting by to tell us what's happening in the world of commodities this morning. Good morning, Manisha. What are we watching out for today?
Well, we're definitely looking at the gold prices, Vinny, because we're trading at record highs onto this one. Yesterday, the New York session saw very strong gains, and the Indian markets also are trading at all-time highs when it comes to gold. When it comes to silver, we're trading at a 6-week highs onto this one as well, as the Silver Institute report yesterday suggested that the silver in the global markets is headed for a deficit for a 5th straight year for 2025. The metal prices also have seen some support. There is some short covering for copper. There is supply concerns on global mines for zinc. The zinc output has declined for a 3rd year as well. And aluminum prices in any way have been supported because of supply disruption concerns in the global markets. And it's not just precious metals and base metals. You have the crude oil prices, which also gained after U.S. said that they could exempt crude from levies and tariffs. Crude is headed for a 2nd monthly gain. The markets will now watch out for the OPEC and allies meeting that is on 3rd of Feb. And not just crude, natural gas is trading at a 15-month highs as well because of the coal demand. So everything in commodities today in Asia has started on a positive note.
Okay, Manisha, thank you so much for that. But with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV18. Thank you so much for tuning in. Up next, Bazaar Morning Call.
India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Okay, I can't say it is finally Friday because tomorrow is working. Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 News studios. And it's, of course, the day before the budget, so it is a day before the budget. And I think that'll be the dominant talking point, expectations and all of that. You know, we have got the global stuff to track as well. And I think there are some comments coming in from US President Trump on tariffs, etc., which the markets, at least for now, are taking seriously. I'm Prashant. With me, my colleague Surabhi and Reema is with us today on the show. Guys, hi, morning.
Hi, morning. So, working Saturday, Sunday we're off?
I don't know.
Just checking. Didn't want to rub that in, but yeah, possibilities.
Too early to say, I would say, right? Depends on what comes in the budget. Reema, I think, is working.
No,
both the days.
I think that'll be for me.
No, but I guess, I mean, overnight we've got some interesting headlines as usual, but the market's been in a mood to at least put a floor to the almost endless slide, right? And maybe the bulls will hope that that can continue today.
You know, I was wondering, every day President Trump holds a press conference and it goes on for about 1.5 hours. You know, sometimes he's rambling on. And, but it goes every day. So, you know, you got to, you know, there's a lot of speak and maybe there will be action as well. But just take it from the beginning. And I'll start with what Trump once again said. And he confirmed, President Trump confirmed that he will implement 25% tariffs on Canada and Mexico on the 1st of February. You know, we should put the confirmed bit in maybe, you know, semicolons. But basically, you've got, it's a confirmation, but he's confirmed before as well. And he also, by the way, said that he'll implement China tariffs. It's unclear by when, how much, etc. He didn't say very much. Now, his comments could be simply threats, but markets traded them at face value. And why do I say that? You look at currencies, essentially. You look at the dollar first up. And all these comments came towards the end of the US session. The dollar index rose above, the broad dollar that is, rose against most currencies, above 108. And we are holding this morning at about 108.14. But look at the Canadian currency, 1.46. The Mexican currency rallied, the USD Mexican cross basically rallied to about from 20.4 to 20.75. And the CNH is basically once again broken above the 7.28 levels. So that's the broad, and by the way, these levels are holding, largely speaking. So we'll have to kind of see whether there is more to it. By the way, 1st of February, at least in case of Mexico and Canada, is tomorrow. So will we see something over the weekend in terms of those tariffs? I think markets will wait. And if that does happen, I think there perhaps is a little more dollar upside, dollar strength here. But markets will wait for the actual announcement. Now, overnight equities, S&P 0.5%, NASDAQ about 0.25%. Gold made a record high. I think that's the only other. I mean, look at yields unchanged. Dollar I already mentioned. Gold, I think, is the only one which has made new record highs. But, you know, gold also is looking a little overstretched here. So if you're looking to buy, don't chase because there could be a pullback around the corner because just momentum-wise, it looks extremely hot right now. You know, almost 2,800, but it's been great for gold this year. Apple reported numbers and the stock was up about 2.5%. Actually, iPhone sales were a little poor, but the second quarter forecast, so stock anyway, post-market was up a little bit. Now, Nifty, just to circle back to the levels here, the Nifty has basically had 3 days of positive close. Yesterday, we hit the 20-day moving average and then basically gave up some gains, but it was still about 0.4% in gains. So the 20 days, the resistance, 23,330 is that level. And then the 40-day exponential moving average comes into focus, which is 23,580 on the upside. On the way down, broadly, I mean, you could look at the recent low, or the better thing to do is to just look at this band, 22,900 to 23,000, which should act as a bit of a support zone right here. Now, the Bank Nifty has crossed the 20-day moving average. I mean, it closed above it, and it's now inching towards, I should say, to the 50,440 level, which is the 40-day exponential. And beyond that, you look at the daily Bollinger Band. On the upside, that is 50,523. And support comes in at the 40-hourly exponential, which is at 48,922. The Gift Nifty will indicate what the start is looking like. But remember, it is the budget tomorrow, and no one knows. I mean, there are always expectations. Maybe this time it's a little less than, what markets thought. But zero people know what is going to come. So just be mindful of exactly that, because, we can all convince ourselves about various things, but, we'll know tomorrow. And as I always say, keep expectations low ahead of these kind of events. I mean, if something comes, great. I mean, and you'll be able to trade it, but you don't want to be caught on the opposite side, because that's happened more than once over the last few years now. So 16, 17 points higher on the GIFT Nifty at this point. Surabhi.
Prashant, very philosophical this morning, right? Keep expectations low. That could be said for, almost all things in life, right? The success or the happiness.
I always say that.
Keep expectations low, all right. Applies to the budget as well. But, just a couple of points. By the way, US futures are building on gains. NASDAQ futures are up a little over 0.5% right now because of the positive tech earnings that have come through. If we talk about, this whole issue of tariffs, I picked up some specifics in what Mr. Trump was saying overnight. First of all, the numbers. Now, if you look at the value of trade, and this is data up till November of 2024, so 11 months of data, the value of the US-Canada trade is just under $700 billion, and it's about little lower than $800 billion with Mexico. So this is what's at stake. There are a couple of outlier issues still remaining. For instance, what is he going to do with oil? Will he allow, Canadian oil imports to come in or not? What will he do with lumber? So on this, I just want to pick up the one statement that really sort of caught attention. He says, with Canada, that is, on the Canada tariff piece, he says, we don't need the products they have. We have all the oil you need. We have all the trees you need. So that's oil and lumber. On China, he also sort of, again, made some noises. And he goes on to say, I'm also thinking about something because they're sending fentanyl into our country. And because of that, they're causing hundreds and thousands of deaths. So China is going to end up paying a tariff also for that. And we're in the process of doing that. Now, he didn't specify new numbers, but he's been saying 10% to start with, maybe going up to 60% or higher. So let's see, how much of this is just rhetoric and how much he will actually follow through on. But Canada and Mexico seems to be real. There was a little bit of reaction even in the oil markets. First there was a little bit of a spike in oil, but then oil is lower because the larger issues there are going to be resolved with the OPEC meeting, which is the 3rd of February. And remember the US president has been telling OPEC as well that the world in general needs more oil. So basically, you've got some green on the screen once again. In Asia, trade is mixed. Some of the markets are now coming back from the Lunar New Year holiday. For instance, South Korean markets have opened up after 4 days of a gap. But the focus point is all the data that we're getting out of Japan, and it's fairly mixed. CPI continues to inch higher, 2.5% in January versus 2.4% in December. And we know that's why the BOJ has been increasing rates. They did that in the last meeting. The unemployment data is also looking better. Unemployment is at 2.4% versus 2.5% in the previous print. The retail sales data is really, really amazing. 3.7%, 6-month high for Japan retail sales. So Japanese are really going out there shopping. And like I said, some of the other markets are kind of coming back in. So whatever little cues we have, largely positive across Asia. For us this week, it's been a challenging week. The bulls have decided to fight back, but the mid-cap and the small-cap market, that's still hurting. Nifty's up 0.7%. The mid-cap index is down 1%. The small-cap index is still down about 2% for this week. So let's see if we'll see more of this recovery play out today or not. In results, I've only picked out L&T because there's so many and we'll go over the list in our top 10 segment. But L&T is interesting and it's a mixed bag. Now, the big headline was this order inflow number, 1.16 lakh crores. That's the highest ever order inflow and it's surged over 50-odd%. That's great. But the margins issue with L&T is always, the market's issue with L&T always has been margins. And that's where there's a bit of a disappointment because EBITDA and the margin number have missed estimates. So let's see what the approach is going to be. Slightly mixed on, on the numbers. Finally, all eyes on budget. And while Prashant is saying keep expectations low, the market will hear none of it, right? Because, Prashant, I don't know if you've been hearing this or not. I've started to hear a lot of chatter around STT now, saying that since you've hiked capital gains to, 12.5%, and since STT collections have been soaring, last number is about 44,500 crores of STT. Maybe do you want to sort of go a little slow? And the fact that the F&O market rules have also changed because they hiked the STT on F&O in the July budget. But again, I think this is more market hope than anything. And Prashant is saying, keep hopes low.
Somebody called me, I think the day before yesterday, said, well, it's capital gains being cut. So it's as you go into the budget, there's always, hope, right? It's just human nature. But I think if you're trading and you're putting money on the line, and trading, not investing, trading, I mean, then you've got to be...
Then you can't trade on a hope.
You've got to preserve, first, and then look to make money. So,
that's true.
Absolutely. Rima.
Well, I just wanted to do a complete roundup of the mega tech earnings, considering the heightened selling that we had earlier this week and over the last 2 weeks, perhaps. So first, Microsoft. Microsoft ended with a cut of more than 6%, as despite the heavy investments made in AI in general, their AI, cloud revenue, spending, etc. disappointed the street. Tesla, on the other hand, ended with a gain of nearly 3%. The earnings were a miss, but the company has promised to return to growth in 2025, and particularly the street was enthused by their plans to launch cheaper models, and even they're planning to start autonomous ride-hailing service in the month of June. Meta also gained up close to about 1.5% revenue beat for Meta in the quarter gone by, and Zuckerberg has promised this year to be a really big year. IBM had its best day since 2000 with a rally of nearly about 13%, and Apple, we spoke. The numbers came post-market hours, and currently in after-hour trade, Apple shares are up close to about 3%. And considering the heightened scrutiny around whether AI-related Capex and infrastructure spending will continue in light of Deep Through's breakthrough, well, at least the top tech CEOs continue to reaffirm that Capex will be intact. So Meta is talking about a $65 billion spend this year in infrastructure, Microsoft $80 billion in building data centers, and Zuckerberg, when he was asked particularly about whether the Capex spend will slow related to AI infrastructure, and he said that even if less computer infrastructure is needed for training, based on what we've seen from DeepSeek, he says an increase in AI usage will require basically the current level. This level of investment is what he said. So in a way, reaffirming that Capex spend will remain intact. But there's so much to track today. And before that, let's just quickly get to the flows picture, because yesterday, despite the markets closing up with a little bit of a gain, the FIs selling was huge. Nearly 4,500 crores sold by the FIs in the cash market. The DIIs bought about 2,100 crore. But one day before the budget, guys, is also the economic survey.
Yes.
And that will be tabled at 12:30. So that's going to be watched. In the US, we've got PCE, back home, core sector, fiscal deficit data will come post-market hours. And talking about micros, Marico and Nestle. These numbers will be released.
Does not feel like a Friday at all. This could be as good as a Monday, actually. Forget Friday, given the kind of data flow and the events that are lined up ahead. But let's get started with the equity call of the morning. And we have one that's coming in from Jefferies. Now, what are they saying? Mahesh Nadurkar of Jefferies says the long-awaited market correction is now underway for the last 126 days, making it the second longest of the last 10 corrections that we've seen in a 10-year period. He says at 15%, the current correction is in line with the average corrections. He adds that the Nifty should bottom out before the 7th of February, assuming no tax surprises in the budget and a pro-growth RBI meet. He says rate sensitives should do well in the expected near term. He says that the 12-month outlook depends on FPI flows. A strong equity supply offsets domestic flows.
Okay, well, let's quickly tell you what's lined up here in terms of interactions. So at 8:35, it'll be an interesting conversation with the management of PB Fintech. They'll join in for their third quarter earnings check. 9 o'clock, you'll be hearing from the Dr. Lal PathLabs management. 9:20, Samir Arora of Helios Capital, market master of the day. 9:30 this morning, Tata Consumer Products will be with us for their third quarter sort of performance and update. Max Healthcare will be speaking with us at 9:40. Prestige Group, Prestige Estates reported numbers, and you'll have Irfan Razak as always come in and talk about those numbers. And 9:55, we'll talk tax and what can we expect. So two tax specialists fill us in terms of tax expectations from the budget. And Lata, then at 10:15, we'll be speaking with the Bank of Baroda management on their third quarter earnings. Okay, well, we'll take a quick commercial break here. We'll come back with our research team in terms of the stocks, the top 10 stocks to watch out for this morning.
इसके लागू होने से प्रदेश में सच्चे अर्थों में सशक्तिकरण भी होगा, सुरक्षा भी होगी। इसके द्वारा जो कुछ कुरीतियां हैं, अब हलाला, इद्दत, बहुविवाह, बाल विवाह, 3 तलाक आदि जो कुप्रथाएं हैं, उन पर पूरी तरह से रोक लगाई जा सकेगी।
Welcome back. Lots of earnings and lots of news flow to go over. And we have our team standing by with a CNBC-TV18 list of top stocks to watch. Well, guys, happy Friday to all of you. Can't say thank God it's Friday today, but we can still be happy this Friday. Let's start off with L&T. Vivek, what do you make of it? The announcements on the order inflow are stupendous. But what about the rest of it?
Well, that's right. Good morning. So L&T will remain in focus. Remember, largest capital goods infra company as far as the entire Indian capital goods sector is concerned. Remember, what's actually transpired over here is that execution has been quite strong. Core margins continue to remain quite unhealthy at this point of time. So revenues are up by a little over 17%, much above the CNBC-TV18 poll. However, the core EBITDA came in at close to 6,255, below the poll of close to 6,600 crore. Margins, the consolidated margins, the one that we're talking about, 9.7%, well below the poll of 10.4%, and profitability also below the poll. Now, the core operating margin in the E&C business, that business that which the management had guided for a margin band in the range of 8.2 to 8.25, that has come in only at 7.6%, which is a significant miss, and this is something that the street has been awaiting in terms of a margin recovery. Q3 order inflow, that is the strong point of this particular results. This stands at 1.16 lakh crore, well above even the highest estimate that the street had. Order prospects continue to remain quite healthy. 5 lakh crore is the order prospect that the company has as far as Q4 is concerned. Now, the good part in the call is that the management has maintained guidance across all of the key parameters, including the core margin guidance of 8.2%. Now, the company has also said that there is an upside risk to the order inflow guidance of 10% that the company had guided on a base of 3 lakh crore last year. So remember, order inflow guidance could be up, revenue guidance also could be up. Core margin guidance that is maintained, but the Q4 ask rate is quite steep. Expect the stock to open in the red, but could see some recovery on the strong order inflow.
Thank you very much for that. It's over to Vinny now for Tata Consumer. Vinny.
So in terms of numbers that have come in for Tata Consumers, largely in line with estimates that we're seeing overall results. But India margin, that's a bit of a concern that's coming in there. Due to the steep rise in tea prices, we've seen India margin see a bit of a decline. On the international margin front, they've seen an expansion coming in. And overall also, that is supporting the EBITDA margins of the company. So yes, EBITDA margins for the company have come in at 12.7%. Our poll was also 12.7%. But overall, year-on-year basis, the margins have seen a contraction of around 230 basis points. What other key concerns that come in for the company is in terms of the growth of the India business and core business over there was just 14%, where they were expecting a growth of around 20%. Tata Sampann revenue growth was just at around 23% versus 30% was what was guided by the company. So yes, keep an eye out on Tata Consumers. Maybe a bit of a muted start is what one could expect, or a bit on the red side is what we're watching out for, and then maybe move on to the green.
All right, Vinny, thank you very much for that. In fact, you'll hear from the manager of Tata Consumer at 9:30 this morning. So stay tuned for that. Well, let's talk about cement and Shree Cement's numbers in focus. Vivek is here. I was going to recap those numbers for us. Vivek, back to you.
Well, that's right. So Shree Cement, a good set of numbers, a sharp recovery on a sequential basis, largely aided by the fact that petcoke prices sequentially have dipped. Now, looking at the numbers themselves, remember, volumes have dipped 1% on a year-on-year basis. Revenues coming close to 4,235 crore versus the poll of 4,490 crore. The core EBITDA coming in at 947, compares very favorably versus the poll of 880 crore. Margins at 22.37 versus the poll of 19.6%. The EBITDA per ton has improved strongly on a sequential basis at 1,080 rupees a ton versus last quarter at just around 780 rupees a ton. Power and fuel costs, like we mentioned, down 28% on a year-on-year basis, and the management has indicated that it is on track to commission close to 15 million tons of annum per capacity. This is in the first quarter of FY26. Expect green on Shree Cement today.
Thank you. And what about JSPL, Vivek?
Well, on the other hand, JSPL results don't look so good compared to what the poll was as far as CNBC-TV18 was concerned. The revenue has come in close to 11,750 crore versus the poll slightly higher, 11,673 crore. The core EBITDA has come in at 2,184 crore versus the poll of 2,285 crore. Standalone EBITDA per ton has come in at 10,668 rupees per ton versus the poll of 11,230 rupees a ton. So operationally a miss, expect some green. Now, along with that, debt has inched up sequentially. The company is in the midst of an expansion plan looking to raise its capacity from 9.6 metric tons to 15.9 million tons. Now, the other key worry that analysts have pointed out is the fact that the company has gone ahead and given another Capex. Now, the Capex framework from FY25 to FY26 stands at 23,400 crore, and this is something that the street is looking for in terms of more clarity. So expect some red from JSPL in today's trading session.
I mean, for steel players, of course, I mean, the bigger news flow is going to be, apart from specific results, is the safeguard duties. And, the clamor has been rising that something should be done sooner rather than later. Well, Bank of Baroda is the next one. Abhishek is here with details of this one. Abhishek, morning.
Morning, Prashant. So operationally, a very weak quarter for Bank of Baroda, especially in the light of the fact that their asset quality has improved. Despite that, the net interest margin on a global basis is at 13-quarter low of 2.94% versus 3.1% in the previous quarter, which suggests that higher cost of borrowing or cost of deposits or the money coming into the balance sheet is at elevated interest rate. So domestic net interest margin is at 10-quarter low of 3.1% versus 3.3% in the previous quarter. Even their international net interest margin has declined to about 1.83%, which is an 8-quarter low versus 2% in the previous quarter. CASA ratio across industry, you are witnessing a decline in CASA ratio. For Bank of Baroda, it's at 18-quarter low. Quarterly annualized credit cost is at 7-quarter low, which is heartening to see because slippages have reduced on a sequential basis, that is quarter on quarter. So gross NPA ratio, one of the best that you are seeing in last 10 years or even more, 2.43% versus 2.5% in the previous quarter. However, return ratios don't look so good. So return on equity is at 10-quarter low of 17% versus 19% in the previous quarter. Their PNL with respect to NII is below our poll. However, thanks to lower provision, their PAT is ahead of our poll. Back to you.
Okay, all right, got it. Abhishek, thank you for that. So not a very good quarter. We'll in fact connect with the management of Bank of Baroda and discuss the trends and the outlook from here on. Let's now talk about Kalyan Jewellers, a stock that's been in news for all kinds of reasons beyond earnings. But yesterday it was earnings that came through. Vinny, how do they look?
So earnings this time are looking good, that given the Q3 update, which also showed strong earnings coming in for the company, and that is what they've delivered, 39.5% growth in terms of revenue. Margins at around 6% this time versus 7.1%. So just keep an eye out on that one. Overall, in terms of profits of the company, that has also seen a growth. Now, in terms of internals, the SSSG growth, that has come in at 24%. In that, South revenue is around 35%, non-South is around 48%. Started ratio at 29.5%. So numbers are not looking bad. We're on the back of numbers. It's surely a strong performance because the stock has also fallen around 45% from its highs. So keep an eye out on the move coming in for the stock. But do not forget, another important announcement that they made is that now they've reappointed Anish Kumar Saraf as who's the managing director of Warburg Pincus and as a non-executive director on the board of the company. Again, it's a reappointment coming in. Previously, also, he was a part of this non-executive director list. So this could be interesting to watch out for, and we could expect a bit of a green coming in for Kalyan Jewellers today.
Thank you very much for that. 795 was the high on Kalyan Jewellers just at the start of the month, and the stock closed yesterday at 440. Big fall. Vivek is now back with us for OneSource Pharma. Vivek.
Well, that's right. An important development here as far as OneSource Specialty Pharma is concerned. We accessed the term sheet. What we understand is that there's a block deal likely in today's trading session. The total size of this particular block is close to 6.8% of the total equity, indicating that the size of the deal is close to 1,200 crore. The floor price is at a close to 4.5% discount to yesterday's close, so 1,545 rupees a share. Who are the sellers? Two promoter entities and a TPG affiliate, Tenshi Pharmaceutical, Pronoms Ventures, and a TPG affiliate of Medela Holding. There is a lockup on further sale of shares on all three of these entities. Expect some red to begin with today.
Okay, all right. So keep an eye out on that one as it opens up. Let's talk about Navin Fluorine. I think the numbers came yesterday in the afternoon. Upasana has got more details on this one. Upasana.
Well, the company has reported an upbeat performance mainly aided by the margin expansion. Revenue was in line while PAT and EBITDA margin stood above our poll. Now, Q3 revenue growth for HPP stood at 22%, specialty stood at 26%, while CDMO reported a revenue growth of just about 8%. Now, coming to the numbers, revenue stood at 606 crore with an uptick of 21% on a one-year basis. Margins saw an expansion of 920 basis points at 24.3%, and PAT stood at 84 crore with an uptick of 7%. Now, company in its con call highlights has given an outlook for 2025. It says that it remains confident of ending the year with 25% plus EBITDA margins, and it also says that scale up across the newly commissioned projects will be driving growth from FY26 onwards. It has also updated that additional R32 capacity at a capex of 84 crore is progressing on schedule to be commissioned by Feb 2025. So overall, upbeat numbers. I expect the stock to open in green.
Okay, all right, Upasana, got it. We'll watch out for Naveen Fluorine. More numbers. PB Fintech also reported yesterday. We've got Yash with the details. Yash, how are the numbers?
Well, Surabhi, PB Fintech has managed to deliver another strong quarter, and this has happened over a strong base which they had to work on. The premium which they generate for insurance companies, that grew by 46% at about 6,135 crore rupees. The revenue which they derive in terms of commission and other income, that grew by about 48% at about 1,292 crore rupees. Contribution was up 27% at 330 crore rupees, though contribution margin came down by about 400 basis points at about 26%. Adjusted EBITDA, that has doubled in the quarter at about 79 crore rupees versus 39 crore rupees. Adjusted EBITDA margin, that was up 200 basis points at 6% versus 4%. And PAT, that also grew at about 95%, coming in at about 72 crore rupees. Importantly, the annual run rate has also increased by about 46% at 665 crore rupees. So it's a strong quarter for PB Fintech. The stock has corrected about 21% in this month itself. It'll be interesting to watch how the stock performs today.
Okay, and the PB Fintech management also joins us shortly, as we outlined earlier. Yash, thank you very much for all those details. Biocon is the next one. Vinny's back with more. Vinny, morning.
So in terms of numbers that's coming in for Biocon this time, it's a bit of a miss versus the estimates. But before I start off and give the details in terms of numbers, do not forget that Q3 FY24, there was this branded formulation India business which was included as a part of revenue. Now that time, on a like-for-like basis, it's not a comparison that we could make on a year-on-year basis. So yes, it's an adjusted number that we're watching out for. Yes, versus estimates, it's a bit of a miss coming in terms of the margins as well as the revenue front. But like-for-like basis overall, we're seeing a 7% growth in terms of revenues. 3,856 crores is what the revenue is at. Margins came in at 20%, while the EBITDA is also seen a growth of 16%. In terms of segment revenues, biosimilars has done quite well, 14% growth versus research, which is seeing an 11% growth. A bit of a subduedness that came in just on the generic side of the business. Now, do not forget, there is a bit of a miss on the margin front, but the company has gotten clearance for two of its important facilities in the biosimilar front, the Bangalore as well as Malaysia facility. That is going to be a key growth driver for the company going forward. So maybe the stock could open up in the red and then move to the green side. So let's watch out for Biocon.
Thank you very much for that, Vinny. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Shree Cement, PB Fintech, Naveen Fluorine, Kalyan Jewellers. Stocks with negative news flow this morning are Tata Consumer, L&T, Biocon, JSPL, Bank of Baroda, and OneSource Specialty. But from stocks, let's get to commodities. Manisha is now joining in with a complete roundup. Manisha, the big headline-grabbing story is gold, and gold is now above 82,000 rupees in India.
Oh, well, yes, it is. And, the gold is trading at an all-time high in the international markets as well. We've seen $2,800 an ounce for this one, as yes, the Indian markets have seen 82,000 rupees, and this is just on MCX. So when you go out to buy gold, you're paying much higher than that. Not just gold, silver is trading at a 6-week highs after Silver Institute came with a report saying that silver is headed for a deficit in global markets for a 5th straight year in 2025. And then you have seen many of the metal prices continue to gain as well. Copper is up on short covering. Zinc is gained because we are looking at a global mine output decline for 3rd year. and aluminum supply disruption concerns are supporting that one as well. And then it's not just about metals. The crude oil prices have seen some rebound also. This is the crude is headed for a second monthly gain. The U.S. says that they could exempt crude from levies, tariffs, and that has been supportive. Markets also will watch out for OPEC and allies meeting. That's on 3rd of Feb. So ahead all of this, we're looking at strength come back in case of commodities in the Asian markets right now.
And tomorrow for gold, Manisha, something could happen. I mean, import duty change, I think, is widely expected, right?
Oh, yes, absolutely. And that's the reason in the Indian markets, we are looking at a discount of $30 to $40 an ounce because a lot of people are trying to sell their gold ahead of that duty change. So, well, yes, buyers aside, dealers selling gold, it's quite a crazy market in India right now.
All right, Manisha, thank you very much for that. So, as commodities, we'll take a quick commercial break here. We come back with our first management of the day, PB Fintech, after their third quarter numbers. Yashish Dahiya, Chairman and Group CEO of PB Fintech, joins us in just a bit. Okay, welcome back. There's 30 minutes to go for the pre-open session. We have our first management ready. With us, PB Fintech is the company. Stocks come off from the highs, high-quality name. It's very strong revenue growth for a couple of years now. And this quarter is no different. So revenues were up 48%, but contribution margins were under a bit of pressure. We have Yashish Dahiya, Chairman and Group CEO at PB Fintech, with us now to sort of take some questions and run us through the outlook. Yashish, good morning. Great to have you with us here. It's always a pleasure. Prashant this side. Now, let's just start with premium growth if we can. So, it was running at 60% if you look at the first half of FY25. Actually, even in Q2, it was, north of 60%. It's come off a little bit to about 40% now in the third quarter, October to December. Could you run us through what this was on account of and what kind of normalization should we see, from here on over the next 2 or 3 quarters?
Yeah, so see, growth stays our priority and will do so. This quarter on the savings side, we did not see the same growth that we saw on the previous quarters. So if you look at Q2, we had our savings business grew much faster than in Q3. So I think that had an impact, and of course, savings is a largish part. I think what continued to do very well was health. But even there, earlier we were growing at about, 65, 67. Now it's more like 59. So clearly there is a little bit of, and of course our base is also increasing. See, long term, we say it's very good if we are able to grow at 30% on our core business. So anything north of 30%, I'm very happy with. 46 is quite an exceptional growth. Of course, I do agree that in Q2, it was higher at 60+%.
So, will we get to, Yashish, are we closer to this, getting to this normalized long-term 30% kind of growth rate? No.
See, no one can predict more than 2 quarters in terms of growth. Right now it seems like we are good. And we will be well ahead of, that particular average for maybe the next few quarters. But, long term, this is the hardest thing to predict in any business, at least in our business, like in consumer business. I can't predict exactly by the year how much the growth would be. And what we can predict very well is what our profits will be. That is very easy for us to predict because that largely comes from the renewal base, and the renewal base grows at a particular rate. But what is impossible to predict is whether the growth will be 20% or 30% or 40% or 50%. And that's why we say that we are very happy with a 30% number. I think we will do better than that for some time.
Okay, so FY26, I mean, again, I'm not asking you for specifics, just to kind of give a ballpark. Should be not sort of 40% plus kind of growth for 26?
No clue. Nobody can say. If I had any clue, I would have told you. It's not like I can tell you that our profits will double next year. But what I cannot tell you is whether we will grow or not. Yes, our effort will be to grow. See, we have things that we can control and things we can't control.
Sure.
Growth is very difficult to control because there are too many factors in it. Profit is very easy to control and predict.
Okay, so profits to double next year. Yashish, hi, Rima here. So health insurance has been a key driver for you. How much did health insurance contribute to your premium generated and revenues in Q3? What was the growth here? And what could the share be, to growth going forward in FY26? Is it possible to put a number to it?
See, the great news is health, which is the most critical thing that consumers require. So if you think about it, middle class people, if you ask them which is the most important product to them, that's health insurance. So growth there, and specifically when the industry has been at about 10, 12, 15%, growing at the rates we are growing, which is about 4 times faster than the rest of the industry, is very good. In terms of proportion, I think our health business would be almost a little more than 30% of our overall business in terms of premium. Of course, when you think of it from a net present value perspective, which means the lifetime value, it ends up being a little more than 60% of our business. And that's why I focus enormously on the health business, because I am the management, because it is the long-term driver of value for the company.
Got it. No, and I think that's very, very well put. So 60% of NPV, 30% of premiums, right? On the health side.
Broadly.
So that remains.
Yeah.
Your ESOP charge has come down to 51 crores in the third quarter, Yashish. Where do you see this moving, and how will this sort of play out at an operating level?
I think now onwards, the ESOP charge will be largely stable. It'll be at about this number for a long time.
Okay. Your contribution margin in the third quarter has fallen about 400 basis points on a year-on-year basis. Could you talk to us about this?
Listen, whenever you grow, the way the rest of our businesses and our health business works slightly differently. And it's very important for anybody who's serious about our company to appreciate that. In most of our business, we make enough money in the first year to create a good contribution. In health, we do not. Health is a much more... So let me put it this way, right? If you wanted to take the net present value of health insurance, that would be almost equal to, let's say, X. And in the first year, you only make about 20% of that. So only 20% of your net present value comes through in the first year in health, while in every other business is between 70 to 90%. And what that means is while you take on a bulk of your cost, your acquisition cost, your marketing cost, your sales cost, your customer service cost upfront, most of your revenue is backdated. And so the way the health insurance business works is that you actually make a bit of a loss on the first year, and then you make profits for the rest of your life. And Thus, from a net present value, it's the best business, but from a margin perspective, it's the worst business to grow. And this, it's pretty basic. So I think we are very happy about the fact that our margins gone down because it's been driven by the faster growth of health business. And that's a phenomenal place to be in because that just bodes so well for multiple years in the future.
Yashish, last quarter you mentioned that you will strategize a plan for Paisabazaar.
Yes.
So what will be the strategy for it and what would your aspirations be?
I think Paisabazaar, we are getting quite clear about what we want to achieve there. So far, we work off the credit score program. It is going to be credit score and account aggregator. So you're going to see it evolve into some kind of a personal finance tool, which does not do just credit. So it's going to be unsecured credit, but also savings, investments that is going to come into Paisabazaar. But more importantly, I think we are headed towards a strategy where there'll be much greater integration between Policybazaar and Paisabazaar. So you think about it. Today I sell a two-wheeler, I make 50 rupees. I sell a credit card, I can make up to 2,000 rupees. Now, how difficult is it to attach a few credit cards onto your two-wheeler sales, one way or the other, right? And similarly, the other way around, loans on insurance policies, etc., and insurance policies for loans. So I think there's a lot of integration. That's why banks sell so much insurance, right? So I think you will see that integration come through very seriously. Just give us like maybe a month or so to detail that out to you.
Although banks will now sell less insurance if these changes come through. But that's another conversation. But fantastically explained, Yashish, and the earlier point also on the health side and contribution. Just a quick word on the cash in the books, which is now about 5,500 crores. What do you plan to do with it? Are you looking at acquisition activity?
We don't have any concrete plans there. We don't have any concrete plans there. It's good for a business like ours, which is high growth and high impact on society, to be very safe and have a very healthy balance sheet. So we are happy with our position. We have no immediate intention of reducing our cash balance. I think cash balance will grow. I would say next year we should add about 700 crores or so to our cash balance. So we will, by the end of next year, we would have crossed 6,000 crores. And I think that's a good place to be. It just means that for the investors, this is increasingly a very stable company, which has a lot of cash flows and cash in it. But it's also at the same time a very young company. Think of it this way, right? Think of an 18-year-old making a lot of money. It's that way, because an 18-year-old is not supposed to be making money. They should be just investing. So we're a very young company, high growth, and at the same time, cash generative already.
A special dividend or something at some point?
I don't think that way. Yeah, we are let's say too young at this stage.
You want to hold on to the cash for no, absolutely.
I think we may have some uses coming up, and I don't want to be in a position when we've kind of just done dividends and sort of are looking around. And we don't time things, etc. So it's not like if there's some buyback or anything of that sort. I don't think that's how we operate.
Just one last sort of question. You own about 4%. The CFO owns about 1.5% stake. Would you stay at this level, or would you look?
I own about 5%, and Alok has about 1.68 on a fully diluted basis. Sometimes because of what you are seeing, you're not able to see all of it. But minus 5% and Alok is 1.68. I think we should stay at similar levels because we keep receiving ESOPs, and as we receive ESOPs, there will also be some dilution. Both me and Alok may also have to invest something in the health venture. So I think in many ways, it should stay at about this level. I hope. I don't know.
And you're looking for investors in PB Health. At what stage is that at? You plan to hold about 25%, right?
We cannot be very specific. All I can say is I think PB Fintech is at this point struggling to get shares there. There's a lot of pressure on from other investors for PB Fintech to hold a little less than. So there's a lot of demand. There is a lot of demand. There's no doubt about that. I would say the demand is more than 2 times or 3 times the capital that we require. And so we're really selecting. We have selected the best investors. But see, I was authorized by the board do these negotiations, I think, on the 3rd of December. We are about 2 months into those negotiations. Just give me another 45 days or so, 30 days, 45 days, and I think we should have enough to announce. And at that time, what percentage PB Fintech has, what percentage other investors has should be quite clear.
And the overall value, I mean, what's the valuation? Would you be able to share that?
It's just a cash raise, right? So I think it's a bit flexible, but the capital raise should be between $150 to $200 million at the first level.
From outside investors. From outside investors.
Yeah, but overall, that's the capital raise for the thing, right? But there's a bit of flexibility there, right? So it could be less, it could be more.
Okay, got it.
And I'm sure it's not the only round. I think we will have a round 2.
You'll have more. Yes, absolutely.
Very soon after, and we'll have a round 3 very soon after. So I think this is the initial capital raise. I think at this point it seems like PB Fintech maybe less than 20%.
Maybe less than 20%. Got it.
At this point, it seems like that. So it's not even an associate company.
Okay. Got it. And we'll chat more when you are able to disclose more, as you said, maybe another 40-45 days. And we'll do that. Thank you very much, Yashish, for joining us with all of that. Really a great conversation, and look forward to our next one. That's PB Fintech for you, 1650 or so. And the commentary coming in from the promoter, Yashish Daya. So we have Siddharth Khemka with us. There's about 15 minutes to go for the pre-open session. Siddharth, thanks for waiting. Apologies. I trust you heard some of that conversation with PB Fintech. Any thoughts?
Yeah, I think if you look at on an overall basis, company has been showing a steady growth. Unfortunately, we don't have an official coverage on the stock to give you a finer details, but I think at the space, if you see the digital economy, that is growing very fast, and in insurance, PB Fintech is doing I think it's doing a good job. In terms of absolute numbers, I think strong operational performance for the third quarter. And as we heard the management in terms of forward outlook and growth in some of the other segments, newer segments that they are getting in, I think market should be quite enthusiastic by that.
Siddharth, hi, good morning. Wanted to get your thoughts in on SRF. The stock reacted positively, was up 6%, and after many disappointing quarters, Q3 was finally a good quarter for the company. There was a conference call post-market hours. What did you make of it? Because I believe there is an upgrade here by you.
Yeah, good morning. So definitely, I think the chemical business, the fluorochemicals, as well as the specialty chemical business have started to witness recovery. And going forward, also, we are seeing demand recovery, pricing improvement, and with the company talking about better product pipelines, we are seeing strong traction in the domestic market, and exports ramp up also being witnessed. Apart from that, the packaging business, that is also showing improvement, and the technical textile business that has been continuing to do well, and we believe that the current momentum would continue. The segment was not doing well. We also saw results from Navin Fluorine coming in late yesterday. That also came out with very strong numbers. And overall, we believe that considering the healthy business outlook across segments, we are factoring in a strong growth, 20% revenue growth, and back of improvement in margins, almost 50% PAT CAGR over the next 2 years. And hence, we believe that the current valuation looks attractive given the improvement in outlook as well as growth. So we have upgraded the stock to buy. We had a neutral rating earlier, and we have set a target price of 3,540.
Sid, a couple of stocks quickly, if you can cover. Loris usually has disappointed, but yesterday was a big move on the upside. Any thoughts here? Hitachi, I don't know about valuations, but it was locked up 20%. We had the management with us yesterday. And on the other side, Voltas, I mean, big volumes and almost a 13-14% sell-off yesterday.
Yeah, so if you look at Loris, I think clearly the negative news flows with regards to the US aid with the ARV, which is your anti-AIDS drugs, that was becoming a big negative. And a clarification came in where the US said that they are going to give a waiver for this kind of drug. So basically, the AIDS would flow back for these kind of drugs. So that becomes positive. If you see on the overall results perspective, that has been coming out pretty decent. We are not seeing much of impact there in terms of the overall business, and hence I think looks comparatively better. Hitachi, we don't have a coverage, to be honest. Told us pretty bad numbers especially from the UPC business, and margins were kind of weak, and that led to a sharp disappointment. Compared to that, if you look at Blue Star, that has been consistently reporting strong numbers. Even for Voltas in the RAC business, the room AC business, margins, the market share loss, that is also quite concerning. So overall, I think with these kind of numbers and especially the margin contraction in the UCP segment, the market share dip, I think it's a negative outlook at least for the next few quarters.
Yeah, it's a hyper-competitive AC market, and Voltas has been struggling because of that. Cost of leadership, as some say, down 13% yesterday. Siddharth, do stay on. We need to slip into a very short break. On the other side, we'll invite Mitesh Thakkar and Shrikant Chauhan on the show.
I think the biggest disconnect for most market participants in India is, for the first time, India has gone completely off track as a market. And you have the world staying very, very strong and in a bull market, whether you look at the US markets or the European markets or the Asian markets. I believe that this is still a correction within the larger bull market, because I think we saw a massive run-up for about 18 months. And in that context, I think this fall is still quite normal, even though a lot of people might not want to believe the same. The real damage has really been in the broader markets, because the average decline, the whole of NSE is about 28%, whereas if you look at the Nifty itself, it's fallen about 12%. I do believe we've come to a point where sentimentally we are oversold, technically we are oversold, and based on bread data, we are very, very oversold. So a deeper cut from current levels looks unlikely. It seems as if the market is stabilizing. 22,800 was and remains a very important support. We've seen some stability from that number in the last 2 days. And if the Nifty can build up from here and possibly get past 23,350, 23,500, I think all can be well very soon. And because all of our problems have been homegrown, I think what happens on the 1st of February, I think will be very
Okay, welcome back. There's 8 minutes to go for the pre-open session to kick off, and we have Mitesh Thakkar now joining in with what he'd want you to do in terms of individual trades. I mean, and of course, the setup as well. Mitesh, morning. How to approach things? We've had a decent 400-point bounce from Tuesday lows. What's next?
Morning, Prashant. The bounce has been good. Now the key question is whether it was just a bounce or whether it is a sign of some kind of a reversal. We have a big event coming up, so that kind of makes things slightly difficult. But just on the price action basis, if you were to look at it, the Nifty needs to at least get past 23,350, 370 and close above it. Or till then, I think as a trader, you might just want to sit back and observe how things are unfolding. In case we fail to do so, getting past 23,350, 370 zones immediately, then I think you might get a dip, which could be, as low as about 23,040, levels. And we might get a reversal from there. That will complete some kind of a pattern formation on the downside. But for the time being, till we are getting past 23,350, I think I am, slightly off the markets. We have an event coming up. We have had a rally. We've had some good profits on the long side of the trade. Sit back and watch. If there's any positive event, then I think that could lead to a positive trigger, could lead to getting past 23,350. That's when the next bigger trade comes in.
Mitesh, hi, good morning. What about stocks this Friday morning?
On the stock side, I have I have more of, buy calls. I have a buy on Hero Motors. Disclaimer, we have some minor positions on the call option side there. It was a recommendation yesterday as well. It did well. So today now can be bought afresh with a stop at 41.10 for targets of 43.20. A buy on Naveen Fluorine with a stop at 38.30 for targets of 40.50. A buy on IRFC. That was also a call yesterday. It did very well. The stock was up 4.5%, and today is showing signs of continuation. So buy there again. Now with a revised stop loss at 145 for a target of 154.5, and one sell call. That's on BSC. On a mild pullback of 10-20 points around 52.55, 52.60 zones. Take a short position with a stop at 53.40 for targets of 50.70.
Thank you. On Naveen Fluorine that Mitesh likes, there are lots of fundamental calls backing the stock. So UBS and Citi have raised the target price on Naveen Fluorine post the numbers. For UBS, it stands at 48.50. Citi has raised it to 4,500. And MK today has upgraded the stock to an add rating post the numbers. We'll get into a break. On the other side, we'll get the pre-opening rates. We'll also be joined by Shankha Banerjee of Dr. Lal PathLabs for their Q3 performance. Stay tuned.
Trend of the market. So I would be optimistic. I think from a risk reward perspective, the downside from here is very limited, but as an investor, I think the upside potential is quite large. So I would be constructive from here. I think the downside is limited. For the last 4 years, since the time we started rallying from the COVID lows, every time there has been a correction, we've seen a V-shaped recovery. I wouldn't be surprised if something similar happens. It's not that we've not seen corrections in the past. I remember late 2022, we had an 18% fall on the Nifty. Everybody questioned the bull market, questioned the fact that India is going to underperform, and then we came back very strongly. I think something similar can happen because I think India will have to be aligned with the rest of the world. So I think the upside potential is very large. Again, if I look at the markets from an 18-month perspective, I think there is potential 20% upside from where we are right now. And the reason I say this is because the weekly, monthly charts are all in great shape. We needed a cool off. We saw a bit of a madness, the SME space, the small cap space last August, September. All of that has cooled off. You can buy stocks at your prices, which you never got in the last 18 months. So I think from a charts perspective, your maximum downside is about 2 to 4% from here, and upside is about 20%. So as an investor, I want to plan for the same. I think at current levels, we are pretty much at average valuations. And therefore, if there is one pocket that can really surprise on the upside, it's the financial services. I think there is a financial services index, which has banks, NBFCs, and insurance companies. I think we like that entire pocket. Bajaj Finance, as you all know, has been a favorite for a while now, and happy to see what it's doing today. And I think it's going to get better from here. And some of the top banks like SBI, SDFC Bank, ICICI remain at long-term support. So I don't see much damage coming in there. And if these three big boys were to start doing well from here, I think the Bank Nifty and the Nifty will do well. So the broader financial...
Welcome back. One of the stocks to watch today would be JSPL, because the company announced an expanded Capex program. So they've announced incremental Capex of about 15,000 crore rupees, and that has spooked some investors because of the kind of return you will be able to generate from that. We're still in conversation with Siddharth. Siddharth, come in on JSPL, and how would you read this Capex announcement?
Yeah, I think definitely that is something that has taken the market by surprise, and a lot of this Capex that will go on could again lead to a increase in debt and lower returns in the near term. And if you look at the overall announcement, I think that has been two-pronged new Capex on the cost efficiencies. That will be definitely positive. That is something that market will take positively. But the crude expansion, that is something, again, in this environment, I think will not be that positive. So market will take that a little negative. Q3 results definitely has seen a weak volume growth. but the overall outlook for JSPL remains positive on back of the overall growth margins. We await further clarity as to the new Capex plans to access the specific implications. So we definitely need to understand the details of the Capex that the company is going to do.
Siddharth, do stay on. We've got a management waiting by to chat with us. Dr. Lal PathLabs. For Q3, the company's top-line growth was purely driven by volumes. Margins were slightly under pressure. We have Shankar Banerjee, CEO at the company, now joining in. Thank you very much for joining in. First, if you could guide on the volume growth, will the company continue to focus on volumes? Is that going to be the driving force for you? What could the volume growth look like going forward?
Right. Thank you for having me on the show. Firstly, for us, volume measures, there are two of them that we look at quite closely. One is the patient volume growth and another is the sample volume growth. So this quarter, our sample volume growth is 10.3%, which is more or less in line with our overall revenue of 10.7%. And our patient number volume growth is at about 3.8%. Which is, and at a YTD level, we are at a 4.4% on patient volume. So I think our sample volume growth is really doing well. In terms of patient volume, pre-COVID, we used to have numbers in the range of 7 to 8% patient volume growth. And that's a number that we are definitely have in our sights to reach, in the future.
What about on margins? Because in the past, we've even seen margins of 29-30% for you. In the current quarter, it's down to about 26%, or even in the prior few quarters. What is the outlook on margins for Q4? And would you maintain your EBITDA margin guidance of 27% for FY25?
So Q3 has always been a structurally, what would I say, a slow quarter. And typically our H1 margins have been better than our H2 margin because a lot of our investments and other costs kind of start getting built up during the second half of the year. But even if you look at our YTD margin numbers, at YTD level, the first 3 quarters put together, we are at about 28%. So, margins are still quite healthy. And, the guidance that we have given between 27 and 28% for the year, I think for the overall year, we should be in that range.
Okay, so 27 to 28% margins for the full year. But are you focusing a bit more on volumes over pricing? Is that going to be the strategy? And what about price hikes? Because your peers have taken some hikes in the prior quarter, but you've been a bit hesitant to announce increases.
So, yes, our focus is definitely, for a sustainable growth, we would like to see, volumes also rise along with our revenue numbers. And therefore, it's been a conscious choice to, not take price increases. We are aware that in the market, there are other players who are taking price increases. But given our strategy of, looking at, a sustainable volume, really, underlying our revenue growth, we are still not looking at price increase in the near future. However, we keep reviewing the position. So it's not as if it's never. I think we will keep reviewing every 3 to 6 months. We review our position and then we decide accordingly. But we don't have an intention to take any price increase in the near future.
Do you fear that if you take price hikes, you won't be able to maintain a volume growth of about 10-11%? Is that is that the market dynamic right now?
So it is not about whether we'll be able to maintain or not. I think, like I said, for a longer sustainable growth, we want to see our volumes inch up a bit more further. And then, as per our strategy, where, we are expanding quite aggressively into our tier 3, tier 4 markets, where a lot of competition is from the local labs. Pricing also plays an important factor in trying to get conversions and, growing the business in those markets. Therefore, we are consciously not taking price increases now, but we keep reviewing our position and we'll see, when we think that the need is there, we will also look at price increases.
Yeah, absolutely. Mr. Banerjee, good morning. Prashant here. Did we get through to what your expectations are for revenue growth in FY26?
So, this year we have said that we want to go better than last year. And last year we were 10.4%. Right now, I think we are at about 10.7% on a YTD basis. So more or less in the range of, say 11%, 10.5 to 11%, which we've been saying, for this year. So our next year aspiration would be to obviously better this number. And let's kind of we'll be targeting a revenue growth which is better than what we will achieve in this financial year.
By small margin, big margin, is there a possibility for big delta there? Say closer to 15%? I mean, obviously everyone aspires, but is it looking like it could be in that vicinity?
So you see, revenue growth has multiple contributors. There is volume led, there is a mix change, there is a price, angle, and also there could be possible M&A angle. So right now, I think what I am talking about is pure organic growth without looking too many or considering too much of a price increase. So volume and mix improvement, we would like to do that better than what we end up this year.
And do you think next year you will be able to maintain margins within the 27-28% band?
You see, our long-term margin profile has been in the range of 26 to 27%. And, we are, I think we also spoke about adding, new infrastructure. So, opening 15 to 20 labs this financial year, which we are more or less, we are actually on track for doing that. And similarly, we may have a similar plan for next year in the same range of opening new labs. So overall, I think we would be looking at a range of between 26 to 27% EBITDA margins going forward on a sustainable basis.
Got that. Now, what you mentioned, right? The guidance aspiration is all based on organic, but there's always obviously the inorganic angle as well. You've spoken about this in the past. You closer to it? Closer to doing anything?
So, we've said that for us, South is a market where we are really trying to build our maybe base through inorganic opportunities. So South and West are the geographies which we continue to look at. There is, some activity happening on that side, but as of now, there isn't anything that we are in a position to really speak about.
I see. So maybe South, right? I mean, West, you obviously did one acquisition earlier, but these are the two geographies largely.
Largely West and South, South and West, because South contribution to our overall business is still in single digits. Very low. Yeah. So, that's one area where, and South in itself is a very large geography. You've got 4 large states, 5 large states now. So South is also not homogeneous. So, there are, geographies within that we are looking at currently. That's really a main focus.
The large market, because generally the perception is that primary healthcare, etc., is much better in that sense. Or that doesn't make a difference.
So yes, the healthcare establishments and the organized play there is better than maybe what we see overall in North. But still, I think the opportunity for M&A, etc., will be there, and we are looking at opportunities. And it's not as if retail pathology does not exist there. There is enough scope for doing retail pathology there as well. So that's what we are focused on.
Thank you, Mr. Banerjee, for joining in. Wish you all the very best. Thank you. It's been a good conversation. Let's get back to the stocks you should have on your radar in today's trading session. Upasna is joining in for more on Navin Fluorine and SRF. Upasna.
Good morning. First up, let me start with SRF. The company reported good set of numbers, which was mainly supported by growth in company's chemical business. Now, management commentary in the earning conference call remains quite upbeat, in which company says that the chemical business is witnessing a revival and is expected to improve further in Q4 FY25 due to sustained demand momentum from agrochemical customers. It also expects improved performance in Q4 from its fluorochem business, which will be supported by stronger volumes and better realizations, is what the company is guided. In terms of specialty chemicals, company says that the growth will be led by healthy launch pipeline of active ingredients, and it has also said that specialty chemical is seeing demand recovery, pricing improvement, and even better product pipeline. Now coming to Navin Fluorine, company reported upbeat numbers which were aided by margin expansion, and in its con call highlight, company has guided that it remains confident of achieving 25% plus EBITDA margin by Q4 FY25, and it has also said that the scale up across newly commissioned projects will be driving growth for FY26. Now it says that EBITDA margin expansion was mainly due to various factors such as higher utilization of the Dahej and Surat plant and operational efficiencies. Now, company's 3Q HPP performance was driven by better price realizations, product mix, while higher capacity utilization aided growth in company's specialty and CDMO business. Company has said that the couple of projects are in the pipeline and it expects some announcement in H1 FY26. And lastly, company has guided that it expects strong growth in its CDMO business in FY26.
Thank you very much for that. So now that we spoke about SRF, the upgrade there by you, what about Navin Fluorine? Numbers look good.
Yeah, I think overall the fluorochemical business has been seen a strong improvement. For Navin, the HPP segment as well as the specialty chemical segment both have seen strong improvement in this quarter, and there has been a beat in terms of expectations. As we are seeing the ramp up in the Dahej and Surat specialty chemicals are likely to drive higher contribution in the coming quarters. Plus, if you look at the new Fermion contract, that is set to contribute about 30% of the exports 100 million target that the company has set, and we are expected to see an approval by April-May of this year. So overall, I think the tone is definitely positive. However, what we are seeing is that there is some moderation in terms of overall, despite the robust earnings growth, we are rationalizing our earnings expectation to some extent. We have cut the estimates by about 6%, and the stock is already trading at about 48-50 times 1 year forward earnings. So we see a positive momentum in the near term, but from a long-term perspective, we have still not upgraded. We have a neutral rating on Navin Fluorine. Would prefer an SRF where the earnings growth momentum is much better and sharper for the next 2 years.
Okay. All right, Siddharth. Thank you very much for weighing in on all of the stock advice today. You have a good day, and we'll connect again soon. 9:10 right now, and the market has settled in the pre-open with about a 47% gain on the Nifty. And L&T is actually the leader on the index, up about 2.5% after its numbers. Let's go across to Mitesh and take a look at the 9:10 call. Mitesh, which one will it be?
I had Navin Fluorine as my recommendation, and I think, that's the stock which is opening extremely higher. So not sure whether we can recommend that, but then let's look at IRFC as a buy for targets of 154 now.
Okay, Navin indeed is surging. Pre-open suggests almost 7% higher. Got it, Mitesh. Thank you very much. But L&T is also all set to open higher at least. Let's just revisit the numbers and the street view on the stock post Q3. Vivek?
Well, that's right. Like you mentioned, the numbers were a miss. Core margins coming in very disappointing. But what the street like clearly is the fact that order inflows have come in much above even what the highest street estimate was. Along with that, the company, remember, has maintained guidance across all key of its parameters. So order inflow guidance of 10%. The company hopeful of actually beating that, given the fact that both order prospect pipeline as well as the ask rate for Q4 is very limited. Now, along with that, the company, which had given a core margin guidance of 8.2%, the company has retained that guidance despite clocking in only around 7.6% on the core margins in the quarter gone by. The ask rate is quite steep as far as margins are concerned, but the company is confident of delivering that in Q4. Now, along with that, when you're talking about the order inflow, 1.16 lakh crore is the actual number that the company has delivered on a consolidated basis, which is the highest ever order inflow. And the order book consolidated stands at 5.46 lakh crore, indicating that there is significant order visibility as well as revenue visibility. Our top line growth guidance of 15%, the company again over here says that if the execution is on track, should be able to surpass that. So muted margins, but strong order inflow, as well as hopefulness as far as increasing both top-line guidance as well as beating the order inflow is something that the street likes.
Right, let's just look at the stock in terms of what L&T is doing in the pre-open. At the end of the pre-open, there's a minute to go, minute and a half to go for the market open. 2.5 higher on L&T. Look at Tata Consumer if we can quickly. You'll hear from the management as well at about 9:30. About a third higher. Shree Cement's next. Biocon, JSPL. I mean, just the stocks, the top 10 stock list that we had. Shree is up about 1. Biocon will come up on your screen. JSPL, Bank of Baroda, some of the others. And maybe a Kalyan Jewelers as well, right? Which is actually, JSPL is down 6.5 as we indicated earlier. Vivek was talking about more details required on that expansion number that were put out. Kalyan is up about 4.5% at about 460 odd. And PB Fintech, right? We had that detailed chat with the CEO, the promoter basically, Yashish Dahiya, 1.5% higher on PB Fintech. And Naveen Fluorine, of course, I think we highlighted, which was starting up. Polycab, I think, is another one which we should just briefly look at. I think GST searches at their premises. Polycab is not new to this, right? I mean, remember that big swoon that Polycab as a stock saw, I think about 2 years back. It was a big correction and then it came right back. I think it was IT search at that point, if I remember correctly. But we'll address all of that and more in a bit. Look at the indices first. We've got the first rate starting to come up on our screens anytime now. 47 higher in the Nifty. The Sensex is up about 130 odd points. Midcap index is up about a quarter. And so the Nifty Bank is already slightly lower at this point in time. The Nifty heat map, I mean, just the 50 stock sort of picture, one snapshot view in terms of how many up and down will come up anytime now on your screens. But it's kind of slow and it's a slow start, let's put it that way. Okay, it's more up than down, definitely. And some of the gainers and losers are on your screens now. So 50 odd points on the Nifty 23, just under 23,300. Sribi.
Okay, well, let's look at what's happening on individual movers and shakers. L&T, the market is actually looking through this margin issue because I guess the company's been guiding that it's going to, sort itself out over the next couple of quarters. The order book intake is the one that the market is focused on, 3% higher on that stock. Tata Consumer's numbers are also being well received, almost 3% up there. There's some buying on Titan, up about 2%. Then some tech names come in. Wipro, Infosys, Tech Mahindra, these are stocks on the upside this morning. A little bit of pharma as well in the mix. Cipla, Dr. Reddy's having a good start to trade today. So that's largely on the upside of things. On the downside, the Bank Nifty, by the way, is decidedly lower already, 200 points lower on the Bank Nifty. Let's see what the individual constituents are doing. ICICI Bank about 0.5% lower, HDFC Bank 0.3% down, IndusInd, Kotak Mahindra, all of them down, but basically between 0.25% to about 0.5%. Other stocks that are lower are some of the metal and material stocks, JSW Steel, Tata Steel, Coal India. These are names on the lower side, even ONGC for that matter. So basically commodities are out of favor. Banks are looking slightly weak. It's consumer stocks all the way. Tata Consumer has now dethroned L&T to be the Nifty winner, 5% surge on Tata Consumer. But I guess even more earnings reactions and pretty big ones playing out in the mid-cap market, Rima.
Indeed. By the way, for Wipro, they won a multi-million-dollar deal from Etihad for IT transformation over a 5-year period, and that's pushing the stock up. But let's get to the mid-cap movers. On the way up, it's Naveen Fluorine all the way, 7.5%. Early volumes are very, very high. Parag Milk, 4% up. There is a margin expansion for Parag Milk. And some of the other stock gainers include an Astral, again, earnings reaction. Biocon, the street was a bit disappointed with the margin performance, but the stock has opened up with strength. Ajanta Pharma, even Kalyan Jewelers, it's down 40% so far this year, but on the back of its numbers. And the company is also talking about debt repayment in the upcoming quarter. And Kalyan Jewelers has had a good start to the trading session. On the way down, you've got Concor under pressure. Again, here, margins have declined for the company. The overall EBITDA is down 10%. So Concor has down nearly 5%. So that's a big loser today. And Prestige Estates, we should get that stock up for you on your screen, 5% down. Bank of Baroda, Abhishek was telling us that it's been a subdued quarter. NIMs have contracted. Bank of Baroda is down nearly 3.5%. And OneSource Specialty, where there is an expected block deal of about 1,200 crore rupees, some supply pressure, perhaps. So one source is down nearly 2.5%. Some of the others, Waaree Energies, 12% up on Waaree Energies, again reacting to numbers. Walker, there is some announcement by the company on the exchanges, so that's pushed up the stock by nearly about 6.5%. Suzlon Energy has been having a couple of good days now, so Suzlon Energy is up and about in trade, and Whirlpool, another 5% gone on Whirlpool.
You know, the biggest volume-led gainer is Waaree Energy, right? 12% higher, and stocks at about 24.66 coming through there. I mean, actually, it's possible that for on the, I think, solar wafer imports, import duty, etc., tomorrow perhaps in the budget. We'll have to see. But I read that as one of the sector-wise expectations, which anyway this time around they're quite low. Suzlon is at number 2 in terms of volume-led gains, is up about 4%, got smashed on the way down, but coming up almost about 60 rupee levels. L&T continues to gain 4%. I think we mentioned that. Navin Fluorine, etc. Hitachi Energy is up another 5% after yesterday's 20% circuit move. You know, the question for many of these names, of course, is valuations for Hitachi Energy. And we discussed this yesterday as well. We got what Premier Energy, again, on the renewable space, 5% higher. Tata Consumer, 3.5% higher. Blue Jet, Biocon, Deepak Fertilizer, Walkhard, Astral. These are all between 2 and 4% up at this point in time. 2:1 in terms of advances to decline ratio. And we've got, I mean, you know, the first rates coming through. Prestige is a 5% cut. So that's kind of stands out. And KPIT is down about 2.5% as well. We had the management of KPIT with us yesterday. Stock was, of course, a big mover on the upside, but it's seeing some profit booking coming through now. Samir Arora is our market master of the day, founder and fund manager at Helios Capital. Samir, good morning. Great to have you with us here as always. Thank you very much.
Good morning.
Good morning. Good morning. You know, I was in the morning, we were just chatting, and I was saying that I should keep expectations low. And my co-anchor Surabhi and Rima were saying that I'm being too philosophical. And, you know, if we beat expectations, then the market will do well in any case. If it doesn't, then you're not too disappointed. How are you looking at it, Samir?
This we are talking about expectations every morning from the market or from the budget. So I have higher expectations every day from the market than I have from the budget. Every morning I think now it should be okay. Yeah, so budget, the thing is, for whatever reason, whether it's discussion, pre-discussion, or these corporates meeting and then, you know, making us feel in the past, that's because they made this representation as if that is about to happen. This time that discussion has also gone away, the chatter has gone away. So therefore, in that sense, yeah, there is no expectation. I agree.
It's actually so exciting for Samir, by the way, that Samir is reaching office. What time tomorrow, Samir?
Tomorrow is a holiday, so I don't come to office.
No, it's not a holiday.
It is a holiday.
No, it's not a holiday.
It is a holiday in Singapore, so I can see the same. I can see you guys from home.
From home.
Don't have to.
Doesn't matter. Markets are...
We have, you know, every time these guys, and I've been doing it for 20 and 30 years. In the olden days when I was in Alliance, I used to fly to India for the budget and we would sit in a room. And I don't remember every episode, but literally every year we have lost money trying to trade that day.
But
So
you know,
now-
Samir, and to that point, I still remember all our conversations last budget, July 24. तो उससे तो अच्छा होगा, because that's when 10% became 12.5%, right? So it can't be.
Interpretation.
Oh, okay.
I'm talking about my interpretation trading that day. Only in Feb 18, I got it perfectly right when the capital gains tax was increased. And that day, in our long short fund, we shorted nearly 20% index of the whole fund. Okay, so quite many hundreds of crores we shorted. That turned out to be all right. But broadly speaking, on these individual stocks, oh, there is this allocation, that allocation, which I used to do more in the olden days, or railway, something has increased or something has increased. All that has been not 100%, 99% given up.
No, because those are budget day trades. So therefore, thank you for the candor.
Not work.
Exactly. So it's one day here and there, and then it fizzles out. But, coming down to...
Just to finish that point, it's on the day of the budget. Even if you're right, sometimes you're wrong. Because, you know, you'll be right for the first half, and the second half,
it could be very different.
It'll turn, and it's happened so many times.
Yeah.
My best story is that I was in the CNBC office in Singapore on the day when this retrospective tax on ITC or whatever was introduced, and nobody knew about it. And I said, very good budget. And it actually was the worst budget we've ever seen, or at least in many, many years. Because we didn't know about that while the talk. And that's why you don't see me on budget day on TV. I come after budget.
No, but I remember, and you're being so candid, and we really, really appreciate that, and on live television. But must say, now to come back to the larger philosophical point, Prashant has been telling us to just keep expectations low. But I'm saying that in July, when capital gains tax was increased, the market had to deal with a real blow. At least no one's expecting, that kind of a shocker this time. If anything, market has got its hopes up again. I'm hearing people say lower STT because STT collections are now touching almost 45,000 crores. So on taxes, are you, hoping for or expecting anything realistically?
I'm expecting, but it may not be material. So I am thinking that since the chatter is there and it is logical that the government has given some incentive to the corporate sector through lower taxes in 2019, and they've done something for the lower this thing in terms of giving food and subsidy, and the states are giving, that you might do something for the middle class or for the taxpayer. And that also is coming now, but I've been saying it for the last 30, 40 days, that, there is some scope, maybe $4-5 billion, say 30, 40,000 crores. But if you divide that by number of people who may get it, say, I don't know, 2 crore or 3 crore taxpayers, it'll come to 8-10,000 rupees or something like that per annum. So you can get that much. I think it's possible to make it a little fair, and because the chatter and the people getting upset nowadays, at least on Twitter and others, which anyways, middle class guys on Twitter, they are all feeling a bit upset in life. And I can see that because I am a lot on social media. Yeah.
No, why wouldn't they, Samir? Because in the last budget, again, and to go back to that point, the super rich got a surcharge relief. Now the super rich can be in the new regime. 43% came down to 37%. Middle class didn't get anything. So maybe fair point. But Rima,
so that's what I'm expecting. But I was talking when we were talking that what do we do with it? Okay, suppose we know, suppose we think and it comes. Then what are we supposed to do with it in terms of which stock to buy? We said we don't know. Therefore, we said let's forget about trying to figure out, because even if you know this, what will you do tomorrow? Will you buy a consumer staple stock or will you buy Zomato because you
will you?
Will
you if there is some sort of a reasonable relief to at the middle level? How would you not trade it that day, but in general, would you make any changes to the portfolio?
I don't think it will matter, because it's let us say in a family you're getting 600-700 rupees per month. Okay, now what will you do with it? Because inflation is there. Secondly, the basket of people have changed. Will they order one more time Zomato, or will they change or buy an extra lipstick? Who knows? Because in the olden days, these things were much simpler to do. Or maybe there'll be a telecom price hike after a few days and some of this money would have gone away or whatever, 600, 700, 300, 200, whatever. So the point is, you don't exactly know what to do if the amounts are otherwise small, and nowadays the basket is a bit wide. So you will say good and thank you and on behalf of everybody, and it'll help the consumer sector. But now which stock will they go to McDonald's more? Where, by the way, I own that stock also, which has been a dud for 2-3 years, but before that was good. So will you go one more time to Westlife? Who knows? But
Samir, as a broader call for consumption, do you prefer staples or do you prefer discretionary stocks like the Trends and Nykas and Zomatos of the world?
I don't consider Zomato as a discretionary stock, in the sense it is just replacing what you were doing, which is why we like those kind of stocks where you are not trying to say that the customer has to spend more money. It is just reorienting. That's why we like the quick commerce. He's not spending extra money. He's just making it convenient for him to buy this channel versus that channel. I don't like the consumer staple because I think that the consumer basket has expanded to beyond just upgrading a soap or something because monsoon has come, which was the old formula. In the old formula, when I was in Alliance Worli, we would see if there's rain outside our window in Bombay, and then you would go and buy levers and you'll make some 5-10% in 6 months. So those days are gone. Now you don't know. There are private labels and then the customer himself or the consumer himself has or herself may want to buy something which they can show on social media or in a photograph or in a selfie. Some of these things, who knows? Big picture.
Those sound like simple days. Samir is saying you could watch the rain and then think that, okay.
Yeah, those days were great days. And that also in Bombay.
Easier to make money,
and
now it's too complicated. Don't even have to step out for a channel check.
Outside our office.
And then you buy a lever. Fantastic anecdote from the past. Prashant.
No, it used to. It used to be. It used to happen. I think even 10, 15 years ago. But of course, not anymore. Samir, but what is the market looking like? Has the structure weakened a little bit? Are the go-go times behind us? What is your sense now? I mean, budget will come and go.
Market structure has become right now, this month. By the way, today morning I was saying that this month has been very strong. If you call this month the Chinese New Year month, because that was 2 days ago. Depends on what is this year. But this year, in terms of the calendar year of the Western world, has been tough because the companies doing badly have been penalized much more than you would normally expect. So if you are slightly off, they are down 8-10%. But over time, somehow we are not feeling negative in our bones, maybe because over time we have eliminated these stocks which used to have either very high leverage or some personal leverage or shares that were leveraged, or something where it was a government type stuff where, an order is not coming and so the guy is bleeding to death. But still, this has been a tough month. But somehow I'm not feeling that negative because, as I say, the world is doing well. And if the world is doing well, we are not such thorough idiots as a country that we will be negative when the world is positive. You may lag them, you may underperform them, but you are not supposed to have negative performance. That is not what I have seen for so long. And also, the flows still come. Even we, as a small mutual fund, still get flows. We even get flows in our PMS, in our AIF, in our offshore long-short fund. This month, actually, we got more than 25 million in our offshore fund, which, normally don't get in a sort of a bad phase. But the world is not going to give up so easily because the world otherwise is happy in life. So they can be a little unhappy to here, there, and that.
No, absolutely. But is there a bit of a factor change in terms of what will do well from here, or you think it'll be the same? So, people were chasing high growth and ready to pay very high PE multiples. You think people will now, and one should look at slightly maybe steadier growth. You don't have to go for the...
So the point is, our formula always has been that we want both hands. We are not such dumb people that we can, in a country which is 1% of the world, say we will analyze only 30% of that market. So we have a few stocks which are of this high growth, like say the one which you're talking about, Policy Bazaar, growing say 40%, but has high valuation, but it looks that it can grow like this for long. And on the other hand, we'll also have these ICICI banks and HDFC banks and also these IT guys, which if they grow 2% instead of 1.8%, the stocks go up a lot. So I don't want the market to decide for me. I will have a mix. And maybe on the margin, you will say, okay, based on results, buy this more or that more. But I am not going to be a prisoner to the market that I only buy this and then I will wait 5 years for my turn to come. And then I will make a lot of money and outperform. And then again, the guys investing that day will be underperforming because they are coming when that cycle is doing the best. There is no need when you are managing a small country in the world where the rest of the world fund managers can invest in 40 countries and in 30 instruments and in debt and in commodities. And I, even within India, can't be at the simultaneously buying one Zomato and one HDFC bank.
Okay, so it's a buffet. So have a make a nice plate, which I think you've done. Samir, I don't think we can convince you to come to office tomorrow. You enjoy your holiday, watch us on TV. But Monday morning is when we speak
Monday
again.
morning, I'll see you. I would have analyzed all what your guests say.
Lovely.
Then I will conclude what I think.
Thank you very much.
Brilliant, and we look forward to that Monday call, Samir. You have a fun Saturday watching us on the sidelines. Thank you so much. Well, the topic at hand is really consumption and can the budget spur it or not. Our next guest is actually joining in to talk about the third quarter performance. We'll do that, but also talk about this big consumer issue. Tata Consumer is the company on the radar. Overall, the third quarter results were largely in line with the expectations. International margins came in healthy, but there has been some pressure on the India business margin, and that's because of the rise in tea prices. To talk about this and more, we have with us Sunil D'Souza, Managing Director and CEO at Tata Consumer. Mr. D'Souza, thank you so much for joining in. We have so many questions on that margin pressure, on the outlook for the beverages business, etc., etc. But I want to start with something that the previous guest was just saying, considering it's all eyes on budget tomorrow, and the hope is that there'll be some relief in the form of, income tax changes. But some of the guests, what they've been telling us is that a small marginal relief of, say, even if it's 1,000 rupees per month at an average for an individual, does that materially change anything for consumer companies? Some of the market experts say perhaps not. But you are sort of running the business, so you tell us, will some sort of a small relief on income tax really improve demand for you?
So I wouldn't try to forecast, or I wouldn't try to make policy changes in a subject which is beyond me. But all I can say is, I think, and we had alluded to this last quarter, I think there is probably the high interest rates, slightly higher inflation, slightly lower government spending is impacting overall consumption in the economy. And any measure which goes to elevate that, we would welcome it. So from our perspective, I think we've delivered a decent Q3. If you see the volume growths across the place, in a very good place. India margins, as you rightly pointed out, under a bit of pressure, but that's primarily to do with tea prices. Tea prices have gone up about 25%, and we've only priced in about 40% of that. But remember, Tata Consumer, we are not playing for this month or this quarter. We're building a FMCG powerhouse of the future, and therefore we remain focused on building long-term competitive strength. We have grown, while there has been pressure on the margins, tea volumes have grown by 7%. And in salt, where we took a significant price increase, we've again grown volume. So we remain pretty confident of where we are. Consumption boost would definitely help our business going forward.
No, absolutely. I mean, the volume growth has been pretty good. The revenue and top line growth for across the businesses has been pretty good. For Starbucks, it's 8% year on year. For the India Foods business, the growth is about 11%, I think, which is well along expected lines. But just to complete that point on volumes, how confident are you in terms of these levels sustaining? Because those who want to nitpick, though, I mean, the stock's doing really well today, the market loves the numbers, but there are those who will say that perhaps the expectations were running even higher, specifically from, some of the newer businesses, some of the recent acquisitions. So on volumes, what can you guide as we step into the new fiscal?
So our guidance doesn't change from a mid to longer term. We've always maintained salt and tea to be growing mid-single digits and a couple of basis points on pricing. Our growth businesses, which includes the organic businesses that we had getting into last quarter of Soulful, Nourishco, and Sampann, we had guided for 30% growth. And with the Capital Foods, that's Ching's, as well as Organic India coming in, we have said medium term also growth businesses will grow 30% and contribute to 30% of the portfolio. So we remain pretty confident of that. And there is a bunch of reasons for that, because we've done some basic work. My distribution at the front end has expanded significantly. We've got roughly 30% more feet on street with split routes to give focus. A. B, we've strengthened our logistics at the back end and digitized to a large extent with the auto replenishment system, permanent dispatch plan. We've got a new front end app for the sales team. We've focused on the channels where the consumer is moving. E-commerce has been growing at 59% for us, and it's now larger than modern trade. Quick commerce is 50% of that business. That's where the consumer is going, and we are there. Innovation has been firing for us on all cylinders. So all in all, I think we're in a pretty good wicket.
That's very interesting to hear that e-commerce is now a bigger channel than general trade for you. And this is, telling us about the times that we're in.
Indeed. Mr. D'Souza, just getting back to the earlier point about tea prices and the fact that they've gone up 25%. You're saying you've only accounted for 40% of the tea price hike so far. And what does that mean in terms of just margins for the near term, say Q4?
See, overall, if you looked at Tata Consumer EBITDA margins, we were down by 210 bips. Almost all of that I can attribute to the pressure on tea prices. Tea prices, because of the two droughts and therefore the supply-demand equation going out of whack, went up by about 25%. Overall, we take price hikes calibrated to make sure while we are trying to recover margins, we are not losing competitiveness. So we've done that. And therefore, we've recovered only about 40% of the tea price hikes. And not all of it has flowed in last quarter because we've been taking consistently and will continue to take price hikes to try and mitigate that. But remember, tea is also a cyclical commodity. Starting March, April, the new crop will start to come in. And when the crop starts to come in, assuming that the crop is good, we will have hopefully an increase in margins. Or if the crop is not good, industry will start taking price increases to mitigate that entire piece. So from that perspective, I would say the pressure on margins is a short-term perspective. We remain focused on growing the business for the longer term. So while there was pressure on margins, we have managed to grow tea volumes by 7% and value by 10%. So I think we will react to pricing, to costs and make sure that we take calibrated price so that we're not giving a shock to the consumer. We're gradually taking it up.
So do you think in Q4 also, because you are taking a calibrated approach to price hike, margins will come under pressure compared to Q3 levels? Is that the possibility?
So the heavy lifting of the pressure, I think, has happened in Q3. Starting Q4, I remember in Q4, there is hardly any tea plucking in North India, and therefore there is no supply coming in. So we have inventory sitting in at a certain price. We will take calibrated price increases apart from the increases of the last quarter flowing in. So margin profile will become slightly better, but will remain under pressure from a longer term normative where it should be. I think middle of Q1 to about middle of Q2 is when you will start seeing the tea margins coming back.
Mr. D'Souza, hi, good morning. Ching's and Organic India, the run rate is at about 850 crores for the 9-month period. Could you give us a sense of what we are looking at for this portfolio for growth in FY26?
So overall, like we said, the growth businesses for us will contribute 30% and grow at 30%. So Ching's and Organic India is part of that. Remember, we bought this business with a very clear business case, which stated that we can grow the business faster than the original owners and more profitably. The more profitably piece, I think, has already happened because we've taken out significant costs. And if I don't add the amortization that we do, we're significantly ahead of where the businesses were with the prior owners. So from that perspective, we are in a good place on structurally. So I think we've taken about a couple of quarters to understand the businesses. They're slightly different from what we operated. Ching's, for example, is processed foods, value-added products. The frequency of buying is different. The commodities that go into it are different. There is a significant export business, which we took time to understand and build. Organic India, there is a huge supplement portfolio, which is not distributed in India. In the US, it is the Amazon process, which we've got to build. So we had a bit of learning, a couple of quarters. The good part is this quarter, the business has stabilized. While Ching's has grown marginally, Organic India is more or less there. We do expect acceleration starting Q4. Also, adding to the fact that we had committed that we will start a food service distribution to take advantage of Ching's, and we will start a pharma distribution to scale up Organic India. For both these, we ran pilots. We ran pilots in 2 cities for food service, which we now already starting to expand to 16 cities. And for pharma, we ran a pilot in 10 cities, which was fantastic results. And we're now expanding to 40 cities. So innovation will come in, distribution will start expanding to newer channels. We've understood the categories better. Brand building. You would have seen the new Kurkure Ching's product out there in the market. That gives us a fantastic sampling platform. I mean,
right.
It's one second.
Right. And just 30 seconds, any new, any more acquisitions, any new categories?
So in our new strategic profile that we've...
Go on, sir, go on. We can hear you.
Yeah. So from a strategic perspective, we've sort of tweaked the pillars for strategy for us. And one of the pillars is focus on new businesses. So apart from digesting and creating value in Capital Foods and Organic India, We remain focused on looking at opportunities that there are in the market. While in the short term, we will focus on delivering value against what we have already acquired. Going forward, we remain open to organic as well as inorganic growth.
All right. We leave it there, Mr. D'Souza. Thank you very much for your time. Pleasure, good luck, and speak to you soon again. Thank you. Well, we'll take a quick commercial break here. 70 points higher on the Nifty. And look at Hitachi India Go. I think 20%. The recent low on Hitachi was 8,800 rupees. It's at almost 14,000 now in 3 days flat. So that is a powerful, powerful rebound coming through. Take a break. See you on the other side. We'll have the management of Max Healthcare and Prestige Estates to talk to us about numbers and the outlook. Okay, welcome back. Lots happening in the market in terms of single stocks, and it's another 100 points on the Nifty. So which means from Tuesday's low, the Nifty is up almost 500 points now, but this is still the first hour today. Max Healthcare is the next company which is with us now. Reported a strong set. Revenues and profit after tax came in strong, but average revenue per occupied bed has been slightly subdued. Let's talk about this and more with Abhay Soi, Chairman and Managing Director at the company. Abhay, good morning. Great to have you with us here on CNBC TV18. As always, Prashant here. So let's just start with that RPOP question. Slightly subdued, I guess, new units responsible. Not exactly bad news for patients, but as an investor, I've got to ask this. What was behind it, and what are you seeing from here?
So, we've had, in the existing units, we've had 8% growth of RPOP, which is in line with what has been in the past as well. So, no complaints over there. Whilst the new units, and, you're aware that we acquired 3 new units and we started a new greenfield venture. So, there are 4 more units that we started last year. And all of those, obviously, initially are going to have play on lower RPOPs. And that is what has dragged the overall RPOP down. So like I said, I think, that's exactly why we bought them. That's exactly where the opportunity was. Although there's been an increase in EBITDA, we've more than doubled EBITDA in the last 9 months, even on a Q-on-Q, on a year-on-year basis for this present quarter. There's been an increase of 94% on EBITDA in the Lucknow unit, as well as 25% on the Nagpur unit. Besides, we've broken even in a space of 6 months, for the Dwarka unit. But, they've obviously dragged down the overall RPOP. Having said that, we still had an EBITDA increase of 32%. So I think that's the positive takeaway from this.
Dwarka, what's the picture looking like specifically for that one?
Specifically for Dwarka?
Yes, Dwarka. I think that's the last one which came up, right? After Lucknow and Nagpur, which came on earlier.
Well, the last one has been the acquisition of JP Hospital, which happened in October. So that's too early to call. I have no doubts that JP will go the same way as Lucknow and Nagpur have. We've had great success over there. Dwarka, which we started in July, typically, and that's a greenfield. Typically, a greenfield takes about, as you're aware, 18 months to 2 years to sort of break even on EBITDA. We've broken even in the month of December. So that's within 6 months. Of course, the quarterly loss for it was 5 crores because the month of October and November was sort of still on ramp-up stage. But in December, we broke even. And, we believe it's only going to go stronger from here.
All right. Abhay, hi. Good to have you on the show. Speaking about the new facilities and the expansion, I just have a question on, Thane as well as Punjab. Thane as well, I think it's a 500-bed facility that you're setting up. You're adding more beds in Punjab as well. So all things put together, how much will you be spending on Capex? This year is almost ending. I'm not sure. I mean, some of this perhaps runs into the first quarter of next year. And how do you manage the balance between debt and cash? Our colleague who tracks the company was telling us that the debt is around 1,600 crores right now. So how are you funding this expansion?
So both these are built to suit. That means we have local partners who will be developing, who have the land, who will be making the land and building, and will be leasing it to us. There is no capex towards land and building. Eventually, we will be contributing in terms of the medical equipment over there. And of course, a basic deposit to tie in the lease. So these are lease assets. These are built to suit. Commercial real estate leases normally run at 8 to 9% cap yields, whereas our ROCs are 35% and northwards. So you can imagine we've leased it at those sort of commercial values and enjoy higher ROCs without any capital expenditure towards them. There won't be any capex towards these two facilities over the next, till they get occupation certificate and whatever else.
Oh, okay. So that's good. And by when do they start contributing? I mean, what are the timelines for Thane? Dwarka, like you're saying, is already break even. So when do you expect to see higher occupancies and maybe higher RPOB in Dwarka? And also with Thane and Punjab, how many months or how many quarters before they start contributing to the top line?
Well, these are greenfields, both of them. So these are asset-light greenfields that we've entered into. Thane should take about 3 years for construction, and Mohali, Punjab, Zirakpur should take another 24 to 30 months for construction. So it's and like I said, during this course, it's asset-light model. There is no contribution from our side. It's the developer who invests in the land and building.
Right. What about Max Lab and Max at Home? We have the current quarter's revenue, but how would you be scaling that up? Say by the end of FY26, what would the quarterly run rate look like for both of them?
Well, both we've been, generating, we've been growing at a CAGR of 24-25%, for past many years now. And I think that trend should continue unless we were to look at some inorganic growth opportunities over there. Max at Home, unfortunately, is the largest home care business in India. It's perhaps the only profitable one in India. So there are very far and few opportunities to acquire. So it will be organic growth. But as far as the diagnostic is concerned, if we get decent bolt-on acquisitions, then we could consider them on a case-to-case basis. But, sans that as well, it's been growing at a 24-25% CAGR, and we believe that should be the run rate going forward as well.
Got it. Abhay, I remember sometime last year when we spoke, you said FY26 will be an explosive growth year. We're closer to 26 now. So looking very strong, super strong?
Looking super strong. We are looking at, commissioning 3 of our brownfields in the first quarter itself. April, May, June, we will have 268 beds in Nanavati in Mumbai, which are getting commissioned. We have 400 beds at Saket in Delhi, which get commissioned, and 155 beds in Mohali. And brownfields have a very good amount of operating leverage, so they contribute almost immediately to both the top line as well as bottom line. Followed by December in 26, where we should be commissioning our semi-brownfield, which is in Gurgaon, which is another 500 beds. So we have a very exciting year ahead. We've grown at revenue has grown by 34-35% this quarter. EBITDA has grown by 32% this quarter. We are now entering a strong quarter, which is the Q4, which is typically the strongest quarter of the year. So we believe and we hope this trend continues. And then by Q1 next year, you'll have all of these new sort of brownfields kick in. So I think I'm looking forward to a very good
How many beds in total, Abhay, in FY26 between the first quarter and then December?
So I think collectively we should be looking at about 14 to 1500 beds.
And Abhay, the margin profile, because as you explained, a lot of operating leverage will kick in. These are brownfield expansions. So the margin improvement that we can expect, say, by the end of first quarter, FY26?
Well, by the second quarter, I think, in the first quarter, while it's still opening, you'll have ramp up. So you'll have, you may have static margins in the first quarter, but yeah, definitely improvements thereafter. So, I have no doubts on that front.
Thank you. Thank you very much for joining in. That's the word coming in on Max Healthcare. Moving on now to Prestige Estates. Now, they reported a muted Q3. The company's sales have fallen by 43%. Irfan Razak, Chairman and Managing Director of the company, is now with us on the show. Thank you very much for joining in. So in the first 9 months, you've managed sales of about 10,000 crore rupees. But when we last spoke, you had guided for sales of 25,000 crore for the full year, which means if you want to achieve that guidance, in Q4, you need to do 15,000 crore. Do you think it's possible, or are you looking to lower your full year guidance on sales?
Good morning. Yes, we have done 10,000 crores, which is the positive. And I believe that we have 5 projects that are waiting for all regulatory approvals like RERA and other things. And there are 5 different cities, that is Bangalore, Chennai, Hyderabad, as well as in Mumbai and NCR. Now, once these RERA approvals come in, RERA numbers are granted, I don't see any reason why we cannot cross that number which we have guided. The good news is all these projects are approved by the authorities. It's only the last mile RERA number that needs to come. And it's imminent, and I think it's come. The demand is there. We get that traction. We get the feel from the market that people are very keen to invest and buy their homes in these projects. So I think we should cross this. And the only disclaimer is, in case these RERA numbers get delayed by a couple of weeks, then it'll just spill over to the next quarter.
What's the combined potential of these 5 projects for which the RERA approval is imminent?
See, we have starting, if you'd like to know the total number, it's there. But then if you ask me, there's 52,000 crores worth of value of inventory that can come in once the approvals and the RERA comes in. But out of this, if I take a breakup, it's about 5,000 in Bangalore, it is 5,000 in Mumbai, it is about 10,000 in NCR, and 3,000 in Chennai, and another 3,000 in Hyderabad. So this is the sum total of this that will be launched in as soon as we get these RERA approvals. And there is demand. The customers are pretty keen. In fact, it's like a pent-up demand that is there. Of course, physically, we should be able to do. And pretty much our experiences, when we do a launch, at least 30 to 40% is sold off the shelf almost immediately. So we are hoping that this will happen in the sense that the regulatory comes in. We are in an environment where we have to have that discipline, and I'm very happy that discipline is there. And I think we should be able to work towards it.
Mr. Razak, good morning. Prashant here. Good to see you. So this is, so the numbers the breakup adds up to about 27,000 crores. That is your share from the saleable. Yes. Okay. That 52,000 crores is the total kind of project value. Okay.
50,000 is many more other projects, but this is what is imminent, which can happen in this quarter, in the current quarter.
Okay, and there's no real slowdown in RERA approvals in that sense. Or is it running a little slow generally for everyone, or not really?
You cannot say. See, now we have authorities. We have the first of all, it's the approving authority. Then you have also the RERA authority. Now, every state has their own method of working. But I believe discipline is required, and I think we should not regret that. It's only that a lot more effort is required. And unlike in the past, you can't bring the product to the market till you have registered and got the RERA number allotted to you. And we are hopeful that it'll get done, and very soon. That's the good news.
In Karnataka, Bangalore, that E-Khata system, all that is stabilized now, right? Things are.
Yes, it has. See, any change always has its stress. But I think the change is for the better. And just brings in that much more discipline again. For changeover from one system to the other to get people to get used to it, including authorities, it takes time. But I think it's stabilized now.
There is no slowdown in demand, in your opinion, right? You're not sensing any of that at all. Inquiries, etc., remain super strong. We've heard from some mid-tier developers out of NCR that the velocity has slowed down. It could be maybe a one quarter, 2 quarter thing, but are you sensing anything?
Not really. I think the demand is quite good. Unless the pricing goes up too high, that's where we are very conscious. We are trying to bring the product at a fairly acceptable price. At the same time, seeing that the bottom line for the company is also properly protected. And I think the demand is there. And I believe the demand is there because we can sense the demand. Because people are reaching out to us that they want to buy, they want to invest, and then unfortunately we can't really accept even a single rupee or probably even advertise till the product is the RERA numbers are allotted.
Out of time, Mr. Razak, but thank you very much for joining in. That's prestige for the markets. It's now inching towards 23,400, and the Tata Group stocks are on fire. It's Trent right on top, followed by Tata Consumer, 3.5%, Titan, Tata Steel, all showing you some solid gains. So it's a good market. Midcap index is up nearly 1%. Get into a break. On the other side, we'll talk tax. Akhil Chandna of Grant Thornton and Akhilesh Ranjan of Price PwC will join in to talk about in detail their direct tax expectations from the budget.
It is something that we are betting on if the market has to recover from here. I just want the Nifty to take out 23,350. I mean, that's my only marker number on the upside. Once that is cleared, I think the bulls take some control. Auto as a sector, auto and FMCG, and even PSU, these three baskets, which have seen a very large fall over the last 6 to 8 months, can also come back. And mind you, if you look at the mid caps and small caps, they have been in a consolidation or a time correction for almost 8.5 months. They've come to a point where the risk reward for top quality mid caps and small caps is once again lucrative. Again, please look at the context of the rise in mid caps and small caps in the last 2 years. Many of these stocks were 3x, 5x, 7x. If after that they lose 30% from the highs, as a technician, I would still consider it normal. So anybody who got into the market in 2024 must be complaining. But if you have been invested over the years, I still feel that this correction is digestible.
Welcome back. It's all eyes on the union budget as Finance Minister Nirmala Sitharaman gets set to present the document in the floor of the House tomorrow. Now, there's been a lot of chatter and speculation about potential tax changes, specifically on the income tax side, personal income tax, to give some relief and boost consumption. Well, what are the key tax expectations in terms of direct taxes? To discuss this, we have with us Akhil Chandana, partner direct tax at Grant Thornton, And we also have Akhilesh Ranjan, Advisor Tax Policy, PricewaterhouseCoopers, and of course, the former member of the Central Board of Direct Taxes. Gentlemen, thank you very much for joining in. Good to have both of you on. Mr. Ranjan, I want to start with you. In your earlier avatar, you would have heard such clamor, so often, and the request for relief, right? And I think the clamor and the noises are a little louder this time, because companies have been telling us that indeed there is a slowdown in urban India, and this slowdown in urban demand, perhaps not too many people saw it coming. So what do you have to say about this huge expectation of a relief in income tax?
Yes, good morning, and thanks for having me here. Certainly, yes, there is a lot of clamor and a lot of noise about the distress in various parts of the population. There are, of course, economic concerns. I think the concerns on private investment, the concerns on skill upgradation, on employment, job creation, a whole lot of things. But it's quite refreshing to see the focus on the middle class this time. This is a class which I think very important, not just because of the numbers in the population, but because it really contributes, or it can contribute tremendously to economic growth. It is also the repository of talent, which is, I think, something we need for long-term sustained growth. So the noise is good. The discussion is nice. Let's see what ultimately comes out. What are the constraints of the government? Coming to the tax structure, I think I would talk essentially about the so-called middle class as far as direct tax is concerned, which would be people earning between 5 lakhs and 25 lakhs. In my view, that is the class to be seen. This class covers about more than 3.5 crore of taxpayers, and this is, I think, the main backbone of the tax collection system. Now, there have been some attempts made, and in fact, a lot of attempts made to give relief to the lower part of this lower segment of the middle class, people earning up to 10 lakhs. I think that's quite fair enough at the moment. You don't pay tax up to 7 lakhs. You pay just 50,000 rupees if we have 10 lakhs. I don't think it can get better than that. But it is the portion of the segment which is between 10 and 25, which is the problem area, I think. And it's not just the question of giving relief, but also of rectifying the structure. So I think, yeah.
No, absolutely, sir. And I mean, that segment up to 10 lakhs was given relief even in the July budget in the new tax regime with certain tax slab changes. And, there's the overall sweetener of higher deduction. But I have a slightly more sort of philosophical question on tax policy, or rather tax philosophy. And I want both of you to weigh in on this. And if I could take our viewers also back in time, because 2019 is when the government decided to move forward and, cut the corporate tax rate. And that was a radical move and radical reform at that point in time. Akhil, now come in on what has happened since then, because I think the whole the stance the government has always taken is to stimulate the economy, stimulate corporate India, lower taxes, spend on, even on government capex, and hope for all of that, the benefits of that to percolate down to the consuming class. Do you think that will continue to be the view of the government, even if we might be an interim short-term consumption slowdown? Akhil?
So I think Mr. Ranjan has clearly laid down that for middle class, the expectations are to lower the tax rates. And recently, we've done a survey at a GT Bharat where, more than 500 respondents, especially from a personal taxpayers, they've responded. And the overall theme is on the similar lines, that out of 500 people, 57% of the people feel that the tax rates are still higher. Though the government has been continuously giving some kind of reliefs, but they believe the tax rates are still higher. That should be reduced, and even some exemptions should be bring in. Though the theme is to move to the new tax regime, and we've seen in the last year that 72% of the people, like more than 5 crore, if I see the numbers in front of me, more than 5.27 crore people have filed their tax returns under the new tax regime. But still, they believe that to make it more attractive, we need to bring more exemptions and deductions, available under the new tax regime. And that's the overall theme which has been coming, from the survey or otherwise also, that people are looking for simplification of tax compliances, especially NRIs, if you ask me, lower tax rates, and more deductions and exemptions, be it standard deductions or the benefits given under the laws from property and all.
So those are the overall themes which we have to see tomorrow, what the government has to offer.
Sure. Yeah. Absolutely. Mr. Ranjan, if I could come to you with that same question, thematically speaking, it's been all about triggering the animal spirits in corporate India and also stepping up public capex and then hoping for those benefits to trickle in. Whether you see a change in that approach at all. And, then let's bring in the other segment as well. On the corporate side, of course, there's a big ask to come back with the concessional rate of tax for new manufacturing companies. If you see, that could be a possibility or anything else. So you've discussed on personal income tax, there is need for, some changes maybe in the 10 to 25 lakh bracket. What about the other side?
So I think the corporate tax reduction was something which it was a good policy move. The rate of 25 is something which makes the Indian economy quite competitive. The only problem was that it was not accompanied at the same time by personal income tax reforms. We had submitted a report in 2019 in August at the task force, which was headed by me, and the corporate tax was part of it, which has been implemented. The personal income tax also needs a rejig, in fact, to make the whole thing become cohesive. There has to be some, you can't have a situation where a corporate pays 25% tax on a huge profit, but the salaried individual with 15 lakhs pays 30% tax. That is something which should be rectified, and I hope something is done about it this time. The middle class is also, is important because, there is this theory of marginal propensity to consume. A small reduction in the tax liability for the middle class really translates into a higher spending in consumption. So I hope all hopes for that. As far as corporates are concerned, as I said, the tax rates are reasonable and moderate. There are other concerns out there. There are concerns of tax certainty, of litigation, concerns which are bordering around how can the government incentivize manufacturing. The last time we had the concessional rate, it didn't really take off probably because there were so many other concerns or other risks that the investors feel that they're in the economy. I think it has to be a coordinated approach, maybe go back to a slightly concessional regime, modified regime, but with a host of other things like low-cost credit, things on skill upgradation, encouraging startups and entrepreneurs. I think those are the things which should be done if we are really looking at sustained and high growth over the next several years, which I think is what India really needs.
Okay, gentlemen, very quickly, coming now to market-linked taxation, where obviously capital gains is the big talking point. Akhil, quickly, in brief, are you expecting anything else? Any further clarification? I'm not even going into another hike or another cut, but anything more if you would expect on capital gains tax and specifically on STT?
I think before I come to the capital gain, just to add what Mr. Ranjan has said on the corporate tax, I think 15% though has been given to domestic manufacturing companies up till 2024. I think the expectation is that 15% should increase. With the years, the benefits should increase and even extend to more other than domestic companies to GCCs and all. And there's a buyback, of shares. That addressing taxation on that is very much expected by the people. They can come up with, I think everyone knows what the expectations are there. Now coming to capital gain, I don't see, any change happening. But if you ask me, I think people are expecting that old capital gain tax regime should be brought in. And even for that matter, STT, if the capital gain continues like this, the STT should not be charged. But let's see what's there tomorrow.
Okay, finally, to wrap it up, just 30 seconds left, Mr. Ranjan. You've been the man on the inside as well in your earlier avatar. So in 30 seconds, if you were to sum up, what could be the likely realistic expectations on the direct tax front tomorrow? What would they be? The top one or two, perhaps.
I think there might be some relief for the middle class, but that may not be to the extent that one would hope for, essentially because of the constraints of the government. I think they will stick to the fiscal deficit of 4.5%, and therefore that leaves less of leg room for any major changes. But that change should be there, and look at and see what the corporate sector really needs. I think it's not just the high-income corporate group, but the MSMEs, which need a lot of attention. And I think that the government is alive to that concern. I hope to see a lot of changes for the benefit of the MSMEs. So on both counts, I think there should be some changes for the better for all sections. On the capital markets, I don't think there'll be a change, and I don't think there should be a change. Things are fine. We have just changed the capital gain structure. Should let it settle down before making any further changes.
Got it, got it. So the finance minister has a tough ask ahead of her, right? A please all budget. Can she really deliver that tomorrow? And please all sections equally. Thank you very much, gentlemen, for weighing in on the likely big tax expectations. We do have to take a very quick break on that note. On the other side, Lata joins in and she will be in conversation with Debabrata Chand of Bank of Baroda to talk about the third quarter earnings fine print. Welcome back, and we are coming back to earnings analysis. Bank of Baroda posted a good set of numbers. You can't complain. The asset quality has improved considerably, and the advances and deposits growth at about nearly 12% each is fairly decent compared to most other banks, especially public sector banks. The problem for the market is really the NIMs. The net interest margin is not climbing above the 3% mark for the bank as a whole. And that's pulling down the profit growth as well, as you will see in just a minute. Let's invite the management. We have with us Mr. Debabrata Chand, the Managing Director and CEO of Bank of Baroda. Good morning, Mr. Chand. Thank you very much for spending time for us. Appreciate it. For starters, if you can tell us the NIM problem. I mean, I'm starting with the negative because that's the only thing investors are worried about. They're happy with everything else. The net interest margin, is it large? Is it that your cost of funds has gone up? Is it showing any signs of plateauing?
So thanks, Lata, for inviting me. And the fact of the matter is that the bank is very consistent in terms of whether it is a top line, bottom line, asset quality. The profitability has been very consistent for the last 8 quarters, so as the ROA. As far as the margin is concerned, let us be very clear that there is an underlying market where there is a cost of deposit, it's still elevated, right? A scenario where the cost of deposit is elevated, we had a guidance earlier from 3.10 to 3.20. But in between, there was an accounting change in terms of the penal interest and penal charges also that impacted the NIM by almost 5 to 6 bps. Having said so, if you look at the 9 months NIM, it is at 3.08, which is marginally lower than the guidance we had given of 3.10. So looking at a Q3, something slightly lower at 3, but we are hopeful that for the full year, we'll be maintaining the margin at 3 to 3.10. It's quite natural in a market wherein if there is a elevated cost of fund, the deposit market is tight, the margin would slightly get squeezed. But a scenario where the margin is squeezed, again, we're able to optimize the ROA. The net interest income has been very strong. So it's a combination of multiple factors. We have been very consistent in terms of the growth profit. The 9 months profit has been almost up by 12.6%. The top line is growing at almost 12%. So these are very consistent, stable. That is why sustainability is key, important part of the profitability, not the margin per se for a particular quarter.
Okay. No, I take your point that so much depends also on how you deploy funds, and you have had a very big retail deployment, which must have given you a higher yield, higher return on the funds deployed. Higher retail gives the fears of unsecured debt. What is the percentage? And are you noticing any signs of trouble? What is the NPA in the unsecured credit itself?
So that's a very fair point. If you look at my retail growth, we are consistent almost 20% for last many quarters, 8, 9, 10 quarters now. Having said so, we have also said earlier that the focus continue to be on the secured part of the retail. The loan in the mortgage loan, the housing is growing almost at 17%. The auto is growing at almost 17%. So we are not focusing on secured personal as a growth lever in terms of the retail loan. The book as on today is almost 30,000 crore. And the GNP on the unsecured personal loan is almost like 3%. And if I talk about the retail GNP, it's something around 1.6%. So the levels are much, much lower in terms of the overall slippage. And saying so, we said earlier, actually, rather, we're the only, the bank to say in June 2023 that we're going to moderate on the unsecured personal loan. At that time, the growth almost used to be 80 to 100%, but now the growth is almost 24%. And in between, we have strengthened a lot of underwriting standard quality, the model and everything. So we're quite comfortable growing at 25-30%. And the book is not giving any kind of elevated slippage for us to slightly be concerned about that. We're quite comfortable with the retail growth of 20%, and primarily the focus continue to be on the mortgage side rather than the unsecured personal.
Okay. Can you give us some guidance on what's the loan growth expected overall, retail?
See, going forward, we said that full year we are targeting a loan growth of 11 to 13%. Rather, we'll try to operate at the upper band. That means I'm talking about 13%. Within that, the retail continue to be at 20%. The agri MSME would grow at 14%, and the corporate would grow at 10% for the full year. So maybe the total can be around 13 or slightly marginally higher than 13% for the full year.
Okay. Okay. You'll be able to bring down your loan deposit ratio in that case? Will advances, what I mean is, will deposits also grow as good?
So that is what actually, we had given a guidance last time, rather we revised the guidance 1% lower last quarter. And we said the deposit growth would be 9 to 11%, right? And the current quarter growth is 11.78%. So saying so, the guidance on the deposit continue to be 9 to 11%. So we operate at the upper band, let's say 11% deposit growth and 13% advance growth. My LDR, the CD ratio continue to be at 84.
Okay.
So
Mr. Chand,
there is nothing.
I will have to interrupt you because the Prime Minister is speaking ahead of the budget session. Please hold on. We have to listen in.
बजट सत्र के प्रारंभ में मैं समृद्धि की देवी मां लक्ष्मी को प्रणाम करता हूं। और ऐसे अवसर पर सदियों से हमारे यहां मां लक्ष्मी का पुण्य स्मरण किया जाता है। सिद्धि बुद्धि प्रदे देवी, सिद्धि बुद्धि प्रदे देवी, भुक्ति मुक्ति प्रदायिनी, भुक्ति मुक्ति प्रदायिनी, मंत्र मूर्ते सदा देवी, मंत्र मूर्ते सदा देवी, महालक्ष्मी नमोस्तुते, महालक्ष्मी नमोस्तुते। मां लक्ष्मी हमें सिद्धि और विवेक देती है, समृद्धि और कल्याण भी देती है। मैं मां लक्ष्मी से प्रार्थना करता हूं कि देश के हर गरीब एवं मध्यम वर्ग समुदाय पर मां लक्ष्मी की विशेष कृपा रहे। साथियों, हमारे गणतंत्र के 75 वर्ष पूरे हुए हैं। और ये हर देशवासी के लिए सर्वाधिक गौरवपूर्ण है। और विश्व के लोकतांत्रिक जगत के लिए भी भारत का ये सामर्थ्य अपनी एक विशेष स्थान बनाता है। साथियों, ये देश की जनता ने मुझे तीसरी बार ये दायित्व दिया है और इस तीसरे कार्यकाल का ये पहला पूर्ण बजट है। और मैं विश्वास से कह सकता हूं कि 2047 जब आजादी के 100 साल होंगे, विकसित भारत का जो संकल्प देश ने लिया है, यह बजट सत्र, ये बजट एक नया विश्वास पैदा करेगा, नई ऊर्जा देगा कि देश जब आजादी के 100 साल मनाएगा तब विकसित होकर रहेगा। 140 करोड़ देशवासी अपने सामूहिक प्रयास से इस संकल्प को परिपूर्ण करेंगे। तीसरे टर्म में हम मिशन मोड में देश को सर्वांगीण विकास की दिशा में, चाहे वो भौगोलिक रूप से हो, सामाजिक रूप से हो या आर्थिक भिन्न भिन्न स्तर के संदर्भ में हो, हम सर्वांगीण विकास के संकल्प को लेकर के मिशन मोड में आगे बढ़ते जा रहे हैं। इनोवेशन, इंक्लूजन और इन्वेस्टमेंट, ये लगातार हमारे आर्थिक गतिविधि के रोड मैप का आधार रहा है। इस सत्र में हमेशा की तरह कई ऐतिहासिक बिल पर सदन को चर्चा होगी और व्यापक मंथन के साथ वो राष्ट्र की ताकत बढ़ाने का काम करने वाला कानून बनेंगे। विशेषकर नारी शक्ति के गौरव को पुनः प्रस्थापित करना, पंथ संप्रदाय के भेद से मुक्त होकर के हर नारी को सम्मानपूर्ण जीवन मिले, उसको भी समान अधिकार मिले, उस दिशा में इस सत्र में कई महत्वपूर्ण निर्णय लिए जाएंगे। रिफॉर्म, परफॉर्म एंड ट्रांसफॉर्म, जब विकास की तेज गति को प्राप्त करना होता है तो सबसे ज्यादा बल रिफॉर्म पर रहता है। राज्य और केंद्र सरकार ने मिलकर के परफॉर्म करना होता है और जन भागीदारी से हम ट्रांसफॉर्मेशन देख सकते हैं। हमारा युवा देश है, युवा शक्ति है और आज जो 20-25 साल की आयु के नौजवान है, जब वो 45-50 साल के होंगे तब वो विकसित भारत का सबसे बड़े बेनिफिशियरी होने वाले हैं। उम्र के उस पड़ाव पे होंगे, नीति निर्धारण की व्यवस्थाओं में उस जगह पे बैठे होंगे कि वे गर्व के साथ आजादी के बाद जो शताब्दी शुरू होगी, एक विकसित भारत के साथ आगे बढ़ेंगे। और इसलिए ये विकसित भारत के संकल्प की पूर्ति का प्रयास, ये अथाग मेहनत, आज जो हमारे टीनेजर्स हैं, हमारी युवा पीढ़ी है, उनके लिए ये एक बहुत बड़ा तोहफा बनने वाली है। जो लोग 1930 में, 42 में आजादी के जंग में जुट गए थे, पूरी देश की युवा पीढ़ी खप गई थी आजादी के जंग में, और उसके फल 25 साल के बाद जो पीढ़ी आई उसको नसीब हुए। उस जंग में जो नौजवान थे उनको नसीब हुए। आजादी के पूर्व के वो 25 साल आजादी के जश्न मनाने का अवसर बना। वैसे ही ये 25 वर्ष समृद्ध भारत, विकसित भारत, ये संकल्प से सिद्धि और सिद्धि से शिखर तक पहुंचने का देशवासियों का इरादा। और इसलिए बजट सत्र में सभी सांसद विकसित भारत को मजबूती देने के लिए अपना योगदान देंगे। विशेष करके जो युवा सांसद है, उनके लिए तो सुनहरा अवसर है, क्योंकि वो आज सदन में जितनी जागरूकता, जितनी भागीदारी बढ़ाएंगे, और विकसित भारत के जो फल है वो तो उनकी नजर के सामने देखने को मिलने वाले हैं। और इसलिए युवा सांसदों के लिए एक अनमोल अवसर है। साथियों, मैं आशा करता हूं कि हम देश की आशा आकांक्षाओं के इस बजट सत्र में खरे उतरेंगे। साथियों, आज एक बात आपने जरूर नोट की होगी, मीडिया के लोगों ने तो जरूर करनी चाहिए। शायद 2014 से लेकर अब तक शायद पहला पार्लियामेंट का सत्र है कि जिसके 1-2 दिन पहले कोई विदेशी चिंगारी नहीं प्रगटी है, विदेश में से आग लगाने की कोशिश रही हुई है। 10 साल से 14 से देख रहा हूं, हर सत्र के पहले शरारत करने के लिए लोग तैयार बैठते थे, और यहां उसको हवा देने वालों की कोई कमी नहीं है। ये पहला सत्र में पिछले 10 साल के बाद देख रहा हूं कि जिसमें किसी भी विदेशी कोने से कोई चिंगारी नहीं हुई। साथियों, बहुत बहुत धन्यवाद।
Okay, I think that has definitely increased the expectations. The Nifty, we should get the intraday chart, had just seen a slight uptick with the Prime Minister's announcements. He appears to be saying that we will do everything, that there will be investment and there will be inclusion. The market is betting on one of the two, but looks like we will get both. As well, he has promised that as the first full budget of the third term of the NDA government, we should expect something major, something big. So the market's excitement has just gone up, as you can see, from 10:20 onwards with the Prime Minister's speech. The expectations have definitely been aroused, and you're seeing both capital goods stocks as well as FMCG stocks just get a bit of a leg up. There seems to be a little enthusiasm, a little increase in the hope as to whether the budget can make a big difference. But we will get the economic survey today, and there we will perhaps get an idea of what will be the growth assumption. Will they assume a 10.5% growth, 11% growth, I mean nominal, and a real GDP growth of 6.5% or 7%? Those will be the first expectations. Our colleague Parikshit has been nosing around and probably has a few things about what the survey might say. Morning, Parikshit, tell us.
Well, we're expecting Finance Minister Nirmala Sitharaman to table the survey officially in the Lok Sabha at around 12:30, 12:45. But ahead of that, the Chief Economic Advisor, Anant Nageshwaran, has written in an op-ed where he's actually set the context for the economic survey this year. And he has said that the economic growth slowed to 6% in H1 of FY25, second half to be better. In fact, our sister channel CNBC Awaz has been reporting how the survey could indicate a less than 7% GDP growth. So let's see what the survey finally says. Anant Nageshwaran in his article has also spoken about the long-term challenge that India faces in managing energy transition, bringing down share of fossil fuels while ensuring affordable energy security and also the transition to electric mobility. There is also a worry about over-dependence on China, which may be indicated in the survey. For example, Anant Nageshwaran goes on to say that the challenge confronting India right now is that the dependence on imports for crude oil supplies is replaced by dependence on imports from a single source for critical components, minerals required for renewable energy. He's also spoken about the need for private sector to step up, something that he has been saying over the last few months. Social stability, long-term profitability rest on the private sector, finding the right balance between capital deployment and labor employment. The economic survey will delve into the obligations of the private sector. The path ahead will require constrained optimization of limited resources to achieve maximum output. This is the CA speaking about the kind of steps that would be needed for India's economic growth. He also said that India, to navigate this complex global landscape, will require strategic foresight, adaptability, and willingness to make tough but necessary choices. The survey will answer questions on the course of key interest rate expectations, impact of AI on job markets, impact of AI on global trade as well. The survey will also explore how India can respond to uncertainties and accelerate economic growth while ensuring equity and inclusion. So these are some of the points that the CA has highlighted in his article, and we are going to find those answers in the survey as well.
Yeah, thanks a lot for that, Parikshit. That was an excellent op-ed, which I read, written by Dr. Anant Nageshwaran yesterday in the Mint. So we got a good 24-hour heads up. Incidentally, this dependence on China is for critical raw materials. The overall dependence, current account deficit of India is also high vis-a-vis China. But I just want to leave you with one thought. For the first time, the cost of the yuan, that is the rupee-yuan rate, is in favor of the rupee, in the sense the yuan has become expensive. It costs now 12 rupees and 7 paise to buy a yuan, about the highest, which is very good. That reduces the imports from China. On that note, wrap up on Bazaar. Chartbusters will take the action.
Sitharaman is set to create history as the first woman finance minister to present her 8th consecutive union budget. From replacing the colonial-era briefcase with the Bahi Khata to delivering the longest budget speech in history, her tenure has been marked by milestones and transformative policies that have shaped the nation's economic journey. Her maiden budget speech in 2019 set the tone for bold reforms, and she has since introduced several initiatives that left lasting impact on India's economic policy. Let's dive into the landmark schemes and key tax reforms introduced under her leadership. Now, Sitharaman's budgets have introduced numerous initiatives aimed at driving inclusive growth, like the PM Suryodaya Yojana in 2021. Announced in the budget 2021-22, this initiative aimed to provide solar energy to villages that lacked grid connectivity. It was a step towards clean and sustainable energy, empowering rural communities while promoting renewable energy adoption. The credit guarantee scheme for MSMEs was another such scheme. Revamped in budget 2024-25, this scheme provides collateral-free loans with a guarantee cover up to 100 crore rupees, addressing financing challenges faced by MSMEs. PM Vishwakarma Yojana is another such scheme. Announced in the budget 23-24, this initiative supports artisans and craftspeople with collateral-free credit up to 2 lakh rupees, toolkit initiatives, skill training and marketing assistance, helping preserve traditional crafts. The Vivad Se Vishwas scheme is another such milestone. Launched to resolve pending tax disputes, this scheme offers taxpayers a chance to settle cases by paying only tax amount with penalties and interest waived. PM Gati Shakti Master Plan in 2021. Now, a 100 lakh crore initiative focused on integrated infrastructure development, enhancing connectivity and reducing logistic costs. The Atmanirbhar packages in 2020 during the COVID-19 pandemic. A range of measures supporting MSMEs and businesses were introduced under this initiative during the pandemic, emphasizing self-reliance and domestic manufacturing. Now, the tax reforms on the taxation front have also been big. Sitharaman's budgets have implemented sweeping reforms to streamline the system.
In just 24 hours and 20 minutes from now, Finance Minister Nirmala Sitharaman will rise to present her 8th union budget, and the market is in full anticipation of some big bang announcements. As you can see on top of our screens, the index is at the highest point of the day at 23,400, and the Nifty Bank has just slipped into the red, but the mid-cap and the small-cap indices are continuing their rebound. You're watching Chartbusters on CNBC-TV18. I'm Ormas Fatakia, with me is Vinny Motiwala, and we are counting down to the budget, but can't not take stock of earnings.
Absolutely, can't not take stock of earnings. A whole host of earnings that have been reported. And first up, today we're going to start the show with an earnings candidate. We have Astral that's in focus, and that's what we're going to talk about. The management of the company is joining in with us. The company has reported a mixed quarter with 2% rise in terms of revenues, 7% rise in terms of EBITDA during this Q3 FY25. We have Hiranandan Salwani, who's joining in with us from the company, Executive Director as well as CFO. Good morning, sir, and thank you so much for joining in with us. And I want to talk about the numbers as well as in terms of the demand trends, sir. You specifically highlighted that, the demand has been a bit slow. Now, I want to understand, where is this slowdown actually coming in? Which segment? Real estate doesn't seem to be doing too bad, but is it the infra side? Which side is not doing well?
So you rightly said that the demand was slow, particularly in the infra side and the agriculture side. That is why you see the most of the company's volume pickup is not there in the Q3. So we hope that in this budget, some allocation will be there to the infra side and the things will come back. So that is going to support our industry. And we are confident that in the coming time, we are going to deliver what we used to deliver in the past.
Right. Just want to understand how much of your revenues actually come in from whether you say the infra side or the agriculture side. What portion of the revenues for the company is from these two segments?
So both put together will be roughly about 20-22% of the revenue.
Mr. Savlani, good morning. Thank you for joining in. Subdued demand, subdued commentary. What does that do to your guidance then? Because you are at 3.5% for the 9 months in terms of revenue growth. Do you still hold on to that 15%? Because the ask rate for the fourth quarter is pretty steep.
No, I don't think it is possible now because already there is a down. And secondly, polymer price has also not supported since last couple of years. You see, polymer is continuously going down. So we are feeling that now otherwise it is getting bottom out. And from here on, polymer price will also support us. And anti-dumping duty also is expected any time post-budget. So because of that, the polymer price will also go up, and that is also going to support us in the top-line growth. And we are confident that the next year we can definitely deliver 15% kind of revenue. And this year base will be low, so that is also going to support us to grow even more than that also.
So you get to 15% in FY26, Mr. Savlani, but what you would end this year with?
This year depends how the budget is getting rolled out and how the situation is getting improved in the market. Based on that, it will be decided. But definitely this quarter is our peak quarter. So definitely we are going to deliver good numbers.
Right. Savlani, just one clarification I want. You said 20% of your revenue comes in from infra as well as agriculture, right?
Yes.
Infra and agriculture. Okay. I just want to understand now specifically in terms of the volume growth in the plumbing business, what is it that you're looking out for there? And in terms of the outlook that you also have for the paints and adhesive side of the business, what are we watching out for here in terms of demand trends now?
So like plumbing, we are continuously going to deliver 10 to 15% volume. Adhesive, if you see the last 5-6 years, we are continuously delivering close to about 15% kind of CAGR growth. Paint, it is a new vertical for us. So initially, we are just creating the network and opening up the new cities and new states. So it will take some time. But maybe from next year, second half onward, paint is going to give us a minimum 15% plus kind of growth. Maybe even higher also because our base is low. But otherwise, our core business is that is our mainly adhesive and the plumbing. It is definitely going to deliver 15% kind of growth.
So will that change your revenue mix by any chance, Mr. Savlani? Because it's currently somewhere around 74-26. Does that change with the outperformance of the paints and the adhesives business?
Yes, over a period of time, definitely the percentage term it will go up in the coming time.
And by how much, if you could quantify that?
Maybe a couple of percentage will be more, not more than that, because still we are confident that our main core segment of pipe is going to deliver robust number in the coming time, because we have just recently opened up our office in Dubai also, and we are getting a very good inquiries from that side also, and we are expecting good number from that geography also. So pipe, we are still bullish, and that is our sizable contributor to our business. So that will, if perform, then the percentage may not go that high, but maybe couple of percentage we can say that other portion may go up.
Okay, Mr. Savlani, thank you so much for joining with us on the show this morning and explaining us what the outlook of the company is going forward. Thank you so much for that. As of now, Astral is trading near the day's highest point. But on that note, we'll slip into a very short break. On the other side, we'll have a conversation with Indegene's CFO, who will be joining us to discuss the third quarter numbers.
Fairness. Like the corporate tax reduction in 2019, the corporate tax rates were slashed to 22% for existing companies and 15% for new manufacturing firms, making India an attractive destination for global investments. The optional personal tax regime, or the new tax regime in 2020, a simplified system with lower tax rates but no exemptions was introduced, giving taxpayers the flexibility to choose between the old and the new regimes. Another such initiative was the capital gains reform of 2023. The government removed the indexation benefit from the debt mutual funds, bringing all asset classes, including equities, debt funds and fixed deposits, under the same tax regime. While this reform created parity in taxation, it also drew mixed reactions as it increased the tax burden on long-term equity investments. The abolition of angel tax was another such initiative for all classes of investors. In 2024, in the budget of 24-25, Sitharaman proposed abolition of the controversial angel tax for all categories of investors. This move was expected to bolster the Indian startup ecosystem, boost entrepreneurial spirit and foster innovation across sectors. Now, Nirmala Sitharaman's budgets have been a mix of bold reforms and targeted policies, be it support for MSMEs, sustainable energy or comprehensive tax reforms. As she gears up to present her 8th budget, expectations are high for announcement that she will steer India's next phase of growth.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC.
Back with us on Chartbusters, the Nifty at the highest point of the day now, 170 points higher, led mainly by FMCG stocks. But we continue with our corporate conversations. Indegene is the next management on our show after a muted quarterly performance. It was an 11% gain in its profit after tax, but it was almost a 12% dip in its EBITDA numbers. We've been joined by Suhas Prabhu, who is the Chief Financial Officer of Indegene, who is discussing here the quarter gone by. Suhas, good morning. Thank you for joining in. You know, your revenue growth on a sequential basis was muted, but the EMS business is the fastest growing for your company. Does that remain the key growth driver going forward? And what do you expect to end FY25 with in terms of revenue growth, profit growth, and if you could give a margin number as well?
So once again, thanks for having me on your channel. And as you rightly mentioned, coming off a quarter with a strong sequential growth of 4.9%, proud to say that we have achieved a significant milestone of crossing 700 crores in revenue for the very first time on a quarterly level. And also a strong performance on the margin with EBITDA north of 150 crores and PAT also north of 100 crores with a very healthy 15.2% PAT margin. And as you rightly observed, the EMS business has performed strongly. This is coming from a momentum that we are seeing largely, I would say, not entirely, but largely out of customers whom we classify as mid-tier customers. And by mid-tier, we mean outside of the top 20 globally ranked biopharma companies. And we made significant inroads in that over the past few quarters now. And that is reflecting in a higher rate of growth in the EMS business. But having said that, the strength is demonstrated across all our segments. Even our ECS business has grown sequentially, even omni-channel activation and the smaller businesses which are aggregated as others have all grown sequentially. And we believe the momentum is being seen by us, not just in the enterprise medical solutions, but across the board. And coming to the customer segment, while currently the performance of the mid-tier segment is reflecting positively on our results, we still remain very positive given our traction, given the pipeline in the top 20 customers as well. But given that they are larger enterprises, these are more transformational deals. The time to conversion, the time to go live.
Sorry to cut you in, Suhas. We are running out of time, so just wanted to get a few things out of the way. Your top 5 client concentration has reduced on a year-on-year basis from 46.5. You've brought it down to 40.3. Do you see that trending further down as well? Very quickly, if you could tell us.
Yes, in the near term, we would see that trending down. But as I was mentioning earlier, we still remain bullish on the top 5 and our top 20 customers. And while it will take a little longer, we see that also growing in tandem and coming up a couple of percentage points in the medium term. But in the near term, we would potentially see that going down.
And what about growing other businesses beyond biopharma? Because almost all of your revenue comes from that segment. Your 94% is almost everything, right? We're planning on growing other segments as well?
No, we remain focused on life sciences. So it's biopharma, med devices, biotech, and that ecosystem. It's a large area, as you understand. The industry is more than $1.8 trillion. The spends are large. So we believe we have significant headroom to just grow within this segment. And this remains our focus segment for the near future.
Right. All right, Suhas, thank you so much for sparing time and joining in. Running out of time, so it's a short conversation, but wish you good luck for the year ahead as well.
Thanks again for having me on the show.
That is the management there of Indegene, the stock at the flatline currently after its results. Time for a short break, but before we do that, it's time for Growth Code, which is a special initiative by Grow and CNBC-TV18 designed to provide you with valuable insights and strategies to navigate the market and make informed trading decisions. Today, we'll take a look at how the new SEBI guidelines on F&O trading are impacting the market, how traders are adapting to those rules, and what lies ahead for you. Watch out to find out.
Derivatives trading has skyrocketed in India.
F&O volumes have jumped from 4.6 lakh crore in 2018 to 138 lakh crore in 2024. While the number of active traders have grown eightfold to reach over 40 lakh.
Most of these new traders are under the age of 25. The risk-taking ability of this current generation is extremely high. They are lured into the markets because of quick profits, because of the hype in social media and ease of digital access.
To protect these investors, SEBI announced new guidelines for F&O trading. What has been the impact?
The volumes of retail traders have significantly gone down. Even the market's volatility has gone down since these rules have been implemented.
However, these rules have brought up a few challenges.
So because of increased margins and because of increased costs and increased charges, the profitability has definitely come down. A lot of small-time option writers would be forced into option buying where the odds of success are much lower. Let's say a new trader who wants to experiment in the markets. Previously, he would have come with a very small amount of capital and that was enough to experiment and dabble in the markets. But now because of increased margins, the same amount has gone up.
For individual F&O traders, adapting to this new era will be key.
Focus on risk management and focus on long-term sustainability rather than having like a quick buck in a quarter.
As the market adapts, these new rules can help create a more resilient ecosystem, offering traders better protection.
Headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com.
Welcome back. The Nifty at the highest point of the day now, 23,420 is where the index is, spurring excitement on the street after the Prime Minister's address ahead of the budget session. And there are 3 indices that are leading the charge is FMCG, auto and the real estate index. These are the 3 indices that are leading the charge in today's trading session. And two specific stocks as well. Possibly the stock of the morning is Kalyan Jewellers, are almost 10% higher now after its quarterly results and recovering from the lows that it had made. Remember, the stock is still down well over 40% from its peak. And the other one is Navin Fluorine after the results, and of course UBS giving it a price target of well in excess of 4,800 rupees, so 8% higher on Navin Fluorine as well. Take your leave on this edition of Chart Busters from Winnie and the team that put this show together. Thank you so much for watching. Trading Hour takes you through the President's Address and of course earnings from Nestle India anytime now. Thank you so much for watching.
Most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
भारतीय जनता पार्टी की हरियाणा की सरकार ने दिल्ली में यमुना से आने वाले पानी में जहर मिला के भेज दिया है.
Right before the Delhi elections, Arvind Kejriwal has made very serious allegations. He claimed that the Haryana BJP is committing mass genocide by mixing poison in the Yamuna water supplied to Delhi. In fact, Delhi's Chief Minister Atashi has called it water terrorism. The Election Commission, which had asked Mr. Kejriwal to provide proof, said that his allegations was prima facie, quote-unquote, promoting disharmony and enmity between different groups. Now, the former Chief Minister of Delhi has until 11 a.m. tomorrow to prove his point. Things got so serious that Haryana Chief Minister Naib Saini even took a sip of Yamuna water to prove it's not poisonous. Let's find out how it all started. Arvind Kejriwal had cited a letter from the Delhi Jal Board claiming that ammonia levels in the Yamuna river have reached levels where water purification plants cannot operate at full capacity. In fact, Chief Minister Atashi alleged that the ammonia levels have steadily increased in the water coming from Haryana to Delhi via the Yamuna river due to the mixing of untreated sewage or industrial waste from Haryana, with levels rising over 7 ppm in the last 2 days. That is 700% above the treatable limit. Now, rejecting his claims, Election Commission said, and I quote, "Actions of yours can have and leave permanent scars between well-identifiable groups of residents of two states and or living together in the state of Haryana and Delhi." Now, the Election Commission has demanded Kejriwal to submit factual evidence along with specific and pointed responses to the type, quantity, nature and manner of poisoning of the Yamuna and details of engineers, location and methodology of detecting the poison by Delhi Jal Board engineers by 11 a.m. tomorrow, that is January 31st. The Commission said if Kejriwal fails to submit the evidence, an appropriate decision will be taken in the matter.
ECI राजनीति कर रहा है. क्यों? क्योंकि राजीव कुमार को पोस्ट रिटायरमेंट 28 फरवरी को पोस्ट रिटायरमेंट उनको नौकरी चाहिए. मैं 3 बोतलें इलेक्शन कमीशन के लिए भी भेज दूंगा. हमारे पास 20 बोतलें हैं. कल रात को हमने
Hello and welcome to Trading Hour. I'm Reema Tendulkar. With me is Vivek Iyer, and with the rally, the outperformance seen in the Midcap Index today, the Midcap Index has turned positive on a week-to-date basis. So till yesterday, the Midcap Index was still down given the gashes that we had in the early part of the week. But now with this 1.5% up move, the mid-cap index is now positive for the week so far, though the small-cap index is still down close to about 0.9% if you do a tally of the first these 5 days. The benchmark indices are holding up pretty well. The Nifty is well above 23,400. We had a gap up opening, but through the first 2 hours of trade, we've managed to build on that. The Sensex is higher by close to about 500 points now. The only disappointing bit is banks not performing. So ICICI Bank is dragging the overall banking index, so that's a bit flat. But outside of that, consumption names are higher. So Trent is doing well. PSUs are up and about like BEL. You've got infrastructure names like L&T on the back of strong order inflows. That's higher. Auto names are participating on the way up. So it's fine. It's just on the way down. You've got an ICICI Bank Bharti, which is struggling a bit.
That's actually kind of recovered. The Bank Nifty now near the flat line. It was a significant underperformance at the start of the session. Well, a couple of stocks. The first one that you mentioned was Larsen. Very strong order inflow momentum, and that's actually aided the stock to rally despite the fact that the core margins remain significantly weaker than expected. The specialty chemical stocks today are doing very well. Navin Fluorine, yesterday moved up almost 4.5% higher. Strong commentary, strong results, lot of EPS upgrades, and that stock is up over 8% today. On the other hand, what the street didn't like were the results of JSPL. Results were slightly muted. Additional Capex that the company announced, something that the street didn't like. Bharat Electronics, like you mentioned, some follow-up buying. And on the other hand, one more stock, from the Bank Nifty that's actually dragged lower today is Bank of Baroda. Slightly muted set of results. The management also trimmed its NIM guidance, and on the back of that, over 4% lower as far as Bank of Baroda is concerned. So a lot of individual hits and misses, and that is what is keeping, the street very, very active.
Indeed. Let's get to corporate interaction then. We've got the management of E-Clerks joining in on the discussion. They reported their numbers about 2 days back. The top line of the company has gone up by 13%. Margins are on the flatter side, but within the company's guidance of 24 to 28%. Srinivasan, the CFO of the company, is now with us on the show. Thank you very much for joining in. First, if you could talk about the top line and the way forward. Now, for the first 3 months, first 3 quarters, you've clocked in about an 11-12% kind of a top line growth. Is that the run rate for Q4? And is FY26 likely to be better than FY25?
Yeah, hi. Thanks, Rima. Thanks for having me on the show. I think sequentially, our revenue went up by about 1.8%. And as you rightly noted, about 13% year on year. That's pretty much in line with expectations. And we're happy to note that all 3 of our businesses have shown growth in the year. We do have quite a strong pipeline, so we are expecting that if there are no significant roll-offs or changes, then there should be growth in Q4 as well.
Okay, and Q4 growth should again be in low teens. Is that the run rate? And what about FY26?
FY26 is kind of hard to predict. The pipeline is good, as I mentioned. And what we are also seeing is a buildup of large deals. So when we had put up our strategy for the year, we wanted to focus on large deals, and we wanted to also focus on cross-selling work between our 3 businesses. And there's been a buildup of pipeline in both these areas. So we are unable to predict what the revenue growth for FY26 will be, but all indications are that, the early indications are positive.
How much better is your deal pipeline today compared to, say, 3 months ago or 6 months ago?
I think it's about 20% up from 3 or 6 months back, and nearly 40% up from over the previous quarter last year.
Okay, that's a positive to note, because considering the wins have also gone up, you've managed to replenish that in terms of your pipeline, and it's up 20 and 40% respectively quarter on quarter, year on year.
Mr. Srinivasan, the other thing which we want to ask you is, as far as Q4 is concerned, what is the guidance that you have in terms of new logo addition? You've also mentioned in the call that you're looking at significant cross-selling and upselling opportunities. So Q4 FY26, top 10 clients, can they grow?
We don't give specific guidance on new logos or on the growth of top 10, not top 10 in advance. So I will not be able to answer that question. But broadly, we should be able to see a growth.
But your top 10 clients didn't grow, the strategic clients didn't grow in Q3 versus Q2. Any particular reason for that?
There are always a little bit of, movement quarter on quarter. So if you look at in the first 2 quarters of this year, top 10 growth was very, very strong. Just the third quarter, there has been a flattish trend on the top 10, but these are sort of short-term outcomes. The long-term outlook remains positive.
But are there any particular clients of yours which are under stress, facing certain headwinds because of which they brought down their work?
No, not really. There was short-term work that we were doing for some of these clients, which ended in Q2, the full impact of which we felt in Q3.
What about the cable as well as, the telecom industry vertical? There's been a little bit of softness there. When do you expect that to recover?
I think the industry has been under pressure for some years now as companies, as subscribers are tending to cut the cord, move to streaming services, and so on. However, in that space, our delivery has been excellent. So even though clients are under stress, we've been able to grow our footprint and we've demonstrated growth in that segment. So for us, the outcome has been positive.
Getting back to the deal pipeline and your focus on large deals, what percentage of your pipeline today is, what you would constitute a large deal? And, how is the deal conversion into revenues now? Because there was a slow down in the industry. There were deals in the pipeline, but it was just not converting into actual numbers and revenues.
So we don't comment. I can't comment on the percentage of large deals in the pipeline. But to your second question, it seems that with the new year, the budgets have opened up and we are seeing some amount of traction and progress in conversion. So conversion seems to have turned positive, faster than what it was from the previous quarter.
Could you give us a sense of attrition levels currently? Also give us a sense of staff utilization rates. We understand that on a sequential basis, it fell close to 140 basis points. What's the reason for that?
So in Q1, we had a buildup of staff because we were anticipating a lot of work in Q2. And that's why the Q2 utilization is at an all-time, near all-time high. And then that has sort of normalized in Q3. On the attrition is about 18% or so, which is well within manageable levels.
Srinivasan, what about generative AI? Because you're saying that the company has done a lot of proof of concepts on generative AI, but potential monetization has not been seen. Why is that? And do you see that changing in this, say, calendar year 2025?
Yeah, so monetization has not happened because clients are taking a lot of time to think over what it means for them and how they want to actually deploy the AI, whether they want to do it in a private cloud, and that if that is the case, then it means a lot more cost for them, or whether they are comfortable having the data go out and do it on the public LLMs. Then that leads to some amount of your data being shared outside, and therefore there is some amount of slowness in decision making that we are seeing from them, specifically on conversion of pilots to pay. Having said that, we have embedded Gen AI in all our productized services. So in our product data management tools, Gen AI is embedded. In our KYC compliance manager solution, Gen AI is embedded. So to that extent, we are using Gen AI in all the services that we are delivering to our clients.
Got that. And what would be the margin pulls and pushes in FY26? What are the tailwinds and headwinds as you see it looking ahead?
Yeah, so we've established a new center in Latin America. So there's going to be some facility costs. We've added 1,800 seats in our India delivery centers. So there's going to be housekeeping security costs. So we do expect there to be some pressure on margin in Q4 as well. But overall for the year, we should be well within our 24 to 28 band.
Understood that. Thank you so much for joining us, giving us a sense of how Q3 panned by and also sense of the deal pipeline as far as Q4 and FY26 is concerned. Well, moving on, time now for a short break. Saurabh Agarwal from EY India and MS Money from Deloitte India join us next to discuss their expectations from budget over indirect taxes.
20 बोतलों का पानी मैं 3 बोतलें राजीव कुमार जी को भेज दूंगा, वो प्रेस कॉन्फ्रेंस में तीनों इलेक्शन कमिश्नर पी के दिखा दें, हम मान जाएंगे कि हमने गलती की।
Another important aspect of this controversy is that Delhi Jal Board CEO Shilpa Shinde has already denied Arvind Kejriwal's claim that the Haryana government had released poison into the river. She called the allegations factually incorrect, without basis and misleading. As the political war broke out earlier today, Aam Aadmi Party MP Sanjay Singh and other party leaders reached near BJP headquarters carrying 3 bottles of 7 ppm ammonia contaminated water from the Yamuna river, daring Amit Shah and the Haryana Chief Minister to drink it.
हार के डर से आपदा वाले बौखला गए। हरियाणा का भेजा यही पानी दिल्ली में रहने वाला हर कोई पीता है। पिछले 11 साल से ये प्रधानमंत्री भी वही पानी पीता है।
Well, here's a fallout of the DeepSeek phenomena. The Indian IT Minister Ashwini Vaishnav making the big...
Welcome back to Trading Hour. Well, IRDAI has come up with new rules to prevent the burden of rising premium on health insurance for senior citizens. Yashil here with more details.
Well, Vivek, IRDAI is talking about a problem that, is so frequently discussed. That is, the steep increase in health insurance premiums, instances of which the regulator has come across very often in the recent past. We've seen increases happening to the tune of 60, 70, 80% in health insurance premium, and that's exactly what the regulator wants to arrest at this point of time, at least for senior citizens. What the regulator has said is that insurance companies cannot increase health insurance premiums by more than 10% in 1 year for senior citizens. If there are situations, there are circumstances where an insurer wants to increase more than 10%, then it can only do so with a consultation and an approval from the insurance regulator, that is IRDAI. Apart from that, IRDAI approval will also be needed by insurers in case they want to withdraw any individual health insurance products for senior citizens, which means without the approval of the regulator, these individual products for senior citizens cannot be withdrawn. Finally, the regulator has also asked insurance companies to have a common set of hospitals empanelment with them for cashless facility, as well as negotiate package rates on the lines of PM Jan Arogya Yojana, which is expected to bring the treatment costs also down for policyholders.
Thank you very much for that. In fact, let's talk about the budget tomorrow and find out what the expectations are from the indirect taxes. We have with us Saurabh Agarwal, tax partner at EY India, and we also have MS Money, who is the partner of GST at Deloitte India. Gentlemen, thank you very much for joining in. If both of you could weigh in, and Saurabh, you could start with this. There has been a lot of clamor for safeguard duty for protecting the domestic industry. We've heard that from all the titans in the steel industry. So are you expecting any import duty revisions in areas like steel, green energy, equipment, life-saving drugs? Take us through the expectation on this front.
If you look at from a custom duty perspective, it has been a much talked about area wherein it is expected by the industry that there will be tariff revisions in some areas. I don't foresee that there will be a big thing which is coming. But what I expect from the government when they are looking at rationalization of customs duty is to ensure that, like they gave a boost to the manufacturing by way of bringing in PLI scheme in various sectors. In some of the sunrise sectors, as you are talking about, solar module manufacturing, electronic components, semiconductor, green hydrogen, electric vehicles, lithium-ion cells. It's important for the government to clearly lay down the path of customs duty. Long back in the Kelkar committee, they laid down the 5-year tariff structure. So one of the expectations which is coming from the industry is to lay down a path for 3 to 5 years, divided into what should be the duty for raw material, intermediary, and finished goods, and how over a period of time these duty rates will pan out so that it provides a requisite clarity to the various stakeholders so that they can set up and build capacities, private equity and bankers can fund them, and the foreign companies can agree on tech collaboration and joint ventures.
Mr. Mani, come in on this point. Do you expect the finance minister to lay down the roadmap for the taxation, say for the next 3 or 5 years, which provides clarity and that impetus to domestic manufacturing? And if yes, drill it down on individual sectors and the numbers in terms of expectations this time of protection.
Look, there is certainly a need, as we keep talking about various plans for the future, to have a very clear roadmap, not only in respect of customs duty that Saurabh said, also in respect of GST. We need to look at both and have a roadmap, because we have to bear in mind that both customs duty and GST are transaction-specific taxes. And since these are indirect taxes, businesses have to factor in whatever taxes they end up paying into the price of the products that they sell. So the competitiveness, the profitability, the funding, the working capital, it all depends and flows from this. And therefore, there is a need for clearly a roadmap in respect of customs duty tariffs, in respect of customs duty reforms, and also in respect of the GST reforms that are expected. Because while GST is the mandate of the GST Council, and it is not the mandate only of the central government, from a directional perspective, what is the status in respect of rationalization of GST rates? How are we in respect of inclusion of fuel-related products in GST? Do we have some kind of a roadmap of 1 year, 2 year, 3 years for that? What is it that we are going to do to make input tax credits easier for businesses, where they are literally struggling today, and there are a lot of disputes on input tax credits as well? It is essential to have a roadmap covering all these issues as part of the budget. Now, whether we will see a roadmap in respect of customs and whether we will see some kind of directional clarity on GST, I guess we need to wait for roughly 24 hours from now.
Okay. Mr. Agarwal, another important aspect that, markets will be looking forward to is that, do you think there could be any change in taxes as far as tobacco is concerned? Not only that, do you expect any tinkering in the excise duty in the oil and gas sector? So petrol, diesel, CNG, do you expect any changes over there?
So tobacco is one subject which has been much talked about in the past, and every time, before the GST came in, there used to see some tweaks in the tobacco part of this story. But I don't foresee that there will be much of the changes as far as tobacco is concerned. But of course, on the petroleum products, we can foresee some bit of changes on the excise duty side.
Mr. Mani, on GST, do you expect any GST exemption or any sort of relief on the life insurance premiums, particularly on that front in this budget?
See, the budget cannot announce an exemption on the GST premiums or any relief to senior citizens or anything in the budget, because that can be only announced by the GST Council. But this is something where the GST Council has been actively working with the business for quite some time. And therefore, from a direction perspective, when they talk of the measures taken for senior citizens, for example, or when they talk of the measures taken to increase the insurance penetration in India, it is quite possible that we'll see some direction being given in terms of which way the next wave of GST reforms are headed. That's what we'll be watching out in the budget tomorrow.
Mr. Agarwal, one question that we want to ask you is, as far as the solar value chain is concerned or green energy is concerned, there are multiple duties that have come in which have actually protected the domestic market. Along with that, there are also certain laws that indicate that there has to be a certain component of domestic manufacturing that has to be used in this particular development of green energy. Do you expect any tinkering of taxes? Do you expect some more SOPs to be given as far as the entire green value chain is concerned?
So, if you look at from a solar module perspective, from in 22, the rate of duty got changed to 40% as a basic customs duty, and on cell it got changed to around 25%. Duty rates are already quite high when it comes to module and cell. The wafer production as of now is not there in India. I do expect that government should clearly lay down that when do they plan to levy tariff duty or a tariff barrier as far as wafers are concerned, which will give a clear plan to the industry as to by when they need to set up the wafer and ingots manufacturing in India. So that's something which is very important. The other thing I think which is very important is around the entire story around SEZ as far as the green hydrogen is concerned, because a lot of green hydrogen players are planning to set up a unit in SEZ in order to bring down their capex cost. And there are some bit of clarities which are awaited. So maybe in this particular budget, if government gives some clarity to this particular industry, that will be really helpful for the industry to form up their plans.
Mr. Agarwal, what about the amnesty scheme for customs? There are so many cases which are pending. There is litigation going on. Is this a key ask of the industry, and how likely is it that it could be announced in the budget?
So I think last 2 to 3 years, it has been the ask of the industry. And again, if you see in the last budget, government has come out with the GST amnesty scheme, some sort of a GST amnesty. I may not call it as amnesty in particular. As far as customs is concerned, it has been quite long that government has not come up with the amnesty scheme. One of the reasons of the government not to come up with the amnesty scheme is because it is considered that amnesty schemes are not good for the bona fide taxpayers who have complied with the law time and again. But if we look at the long pending litigation which is there, it is clearly has been an ask of the industry for the last 2 to 3 years. And if you ask me at my personal level, I do expect an amnesty scheme for customs being rolled out as a part of this budget.
Mr. Mani, from the ease of doing business, what do you expect from the FM tomorrow in terms of the indirect taxation route? What are your key asks from her?
Look, in terms of ease of doing business, there has been a lot of work already done on the customs side in respect of making the import processes easier and quicker, in respect of making the export processes easier and quicker. A lot of work has happened already on customs in the past few years. But there is clearly much more that we need to do, because when we compare the import clearance time and export clearance time in India, compared with many of the other countries which are importers and exporters, we are far behind. So a lot of work needs to be done in respect of expediting the movement of both import cargo and export cargo. This is one area. The other area when it comes to GST is there is a lot of struggle even today in respect of the eligible input tax credits and the ineligible input tax credits. And we have to bear in mind that when we talk of input tax credits, it's not a tax term that is used, which some people use. An input tax credit is working capital for any organization. It could be a large player, it could be an SME or MSME as well. So when the input tax credits get blocked due to some reason, or they are not available due to some reason, people's ability to scale up their working capital suddenly comes into picture. And the business that was viable suddenly tends to become unviable just because they have money in their books which they are not able to utilize. So in respect of the input tax credit changes, how do blocked input tax credit get treated? What needs to be done in order to make it seamless for businesses? That was the promise of GST. I guess something on those lines would be very good. But as I said earlier, the remit of the GST Council is to look at GST. It is not part of the union budget. And therefore, from a directional perspective, we might get to hear that they are planning to make input tax credit easier and smoother for all businesses.
Indeed. Thank you very much, gentlemen, for joining in, and look forward to more conversations once the fine print, the budget is out and we get a chance to go through the fine print. Thank you for your inputs. We'll slip into a very short break. Before that, some stocks are slipping, even though at the headline level we're holding up well. Whirlpool is now down close to about 10%. Voltas continues to remain under pressure. The street was disappointed with the numbers. Voltas is down another 1.5%. And Credit Axis Grameen has now dipped into the red. These are some stocks which have lost some momentum and steam in the last 30 minutes or so. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar joins in next.
The Chinese large language open source model DeepSeek will be brought to Indian servers, will be brought to Indian shores so that it becomes available to Indian users. Sounds simple? Well, not quite. A lot of jargon there. What does it actually mean? Let's help you break this down to understand what really has transpired with this announcement being coming from Ashwini Vaishnav. Now, let's assume, and I'll explain that with the help of an analogy, the analogy of the humble tea, the common denominator between 2.8 billion Indian and Chinese. Now, for example, let's assume that DeepSeek is this Chinese tea in this cup of tea. Now, what's important is that this is an open source AI model. What that effectively means is that the core code, which is the heart of the model, which is the recipe of the Chinese tea, is publicly available. So what the Indian government is proposing is that we'll use this recipe of the Chinese tea and replicate it here on Indian shores, on Indian servers, and have exactly the same model here present in India for Indian users. But that's not all. Let's bear in mind, we like our masala chai. Like most things in life, we like a little tadka in our life. So we'll add a little input to this. We'll add some components. We'll add some sugar. We like some sugar in our tea. We'll definitely add some ginger. We like ginger as well. And let's not forget the milk in the Indian tea. And having done that, we'll come to the finished product, which of course is a humble masala chai, is a humble cutting chai. So why are we doing all of this? Why is Ashwini Vaishnav doing all of this? Well, the long and short is, number one, let's not forget the obvious out of the way, which is the masala chai tastes a lot better. But having addressed with the obvious, the other two key components why the Indian government is doing is number one, all the components that we added, the sugar, the ginger, the milk, what that essentially represents are tweaks that Indian engineers will be able to do on Indian servers to this DeepSeek model. Now, why would we want to do that? Well, let's bear in mind there were niggles with DeepSeek when it initially came out. It wouldn't accurately answer questions about, say, the 1962 war or the status of Arunachal Pradesh. So this masala chai, with all these components, represents tweaks that the Indian engineers will be able to do on the Indian server.
Welcome back. Let's talk about the market technicals. It's been a good Friday so far. Mitesh is back with us. Mitesh, you were saying that markets need to conquer levels of 23,300, 350 for that bullish momentum and bias to come through. Now, that's happened, and quite convincingly, because we've been holding above 23,400. So what's the strategy now?
So, good morning. Beyond that, I was looking at a test of possibly 23,500. And looks like we'll possibly do that. And once we start getting past 23,500, 530 zone, good chance that we might actually make a dash to about 24,000 levels as well. So stay positive. Just trail your stop losses now to about 330 zones, and hope that this kind of up move extends on the upside, which is what the charts are suggesting. So there's a good possibility of us continuing to head higher and test higher levels.
Mitesh, any individual stock calls for the day?
I have a buy on M&M. Keep a stop below levels of 29.80 here. Look for a target of around 31.30. And AV Capital is a buy with a stop at about 175.5 for targets of 180.
Thank you so much, Mitesh, for joining us, giving us a view on the markets as well as your individual stock picks. Well, moving on, it's now time for the Growth Code, a special initiative by Grow and CNBC-TV18 designed to provide you with valuable insights and strategies to navigate the market and make informed trading decisions. Today, we look at how the new SEBI guidelines on F&O trading are impacting the market, how traders are adapting to these rules, and what lies ahead for you. Watch out to find out.
Derivatives trading has skyrocketed in India. F&O volumes have jumped from 4.6 lakh crore in 2018 to 138 lakh crore in 2024. While the number of active traders have grown eightfold to reach over 40 lakh.
Most of these new traders are under the age of 25. The risk-taking ability of this current generation is extremely high. They are lured into the markets because of quick profits, because of the hype in social media and ease of digital access.
To protect these investors, SEBI announced new guidelines for F&O trading. What has been the impact?
The volumes of retail traders have significantly gone down. Even the market's volatility has gone down since these rules have been implemented.
However, these rules have brought up a few challenges.
So because of increased margins and because of increased costs and increased charges, the profitability has definitely come down. A lot of small-time option writers would be forced into option buying where the odds of success are much, much lower. Let's say a new trader who wants to experiment in the markets. Previously, he would have come with a very small amount of capital and that was enough to experiment and dabble in the markets. But now because of increased margins, the same amount has gone up.
For individual F&O traders, adapting to this new era will be key.
Focus on risk management and focus on long-term sustainability rather than having like a quick buck in a quarter.
As the market adapts, these new rules can help create a more resilient ecosystem, offering traders better protection.
become slightly more comprehensive. But the second and perhaps a larger concern that the government has is that the government doesn't want you sipping tea from the Chinese cup of tea, as that will leave your imprint, and by your imprint I mean your data with the Chinese servers. What the Indian government is essentially saying, let it come here and have a cup of tea from the Indian cup of tea, the Indian server, so that your imprint, your data stays safe within Indian shores. So this Chai Pe Charcha is the long and short of why the Indian government is bringing DeepSeek on Indian servers to Indian shores.
Welcome back to Trading Hour. Well, George Thomas from Quantum AMC joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much for joining us, George. First up, what are you making of the earnings season so far, especially given the fact that you've now had a couple of large capital goods companies like L&T go ahead and deliver their earnings? So how are you looking at that space particularly?
So from a capital goods perspective, from an earnings standpoint, it looks reasonably okay in terms of the order book growth or execution. If we look at it, it has been in line with expectations. So there is not much, nothing much from an earnings perspective. But the clear problem is with respect to valuations, where it remained elevated across most of the space. So even with the recent market correction, if we look at the broader market level, so at least if I consider the top 750 odd names, which has recent market caps, decent market caps, if I look at it, the correction has not been material enough for us to trigger a new addition. So if I look at almost 60% of the stocks have fallen by less than 30% from their recent highs. So considering the recent stellar rally, those have not been enough for us to make a new addition into any of those space.
George, on the whole, how has the earnings season been to your mind? What's the skew of upgrades, downgrades, and any firm trend that you've identified post the Q3 earnings, which you can incorporate it in your portfolio in terms of a strategy?
Clearly, there is some moderation in terms of consumption, and some part of it is due to high base. For sectors like real estate, where we have seen a stellar rally in the last 2-3 years, a lot of that earnings moderation is due to high base. So once we normalize, we don't see there is any clear thing to worry. But on so rather than speaking on a broad sectoral level, there has been selective opportunities. Like we have added some positions in some of the existing portfolio names into. So one of them is a rural-based two-wheeler company, and the other one is a gas transmission company where the demand visibility looks reasonably good, and they have a fairly good guaranteed return kind of model, where we feel the recent stock prices offer a decent amount of upside. But from a broader sector call, like I said initially, the valuations have not come off to a level where we could justify fresh additions which meets our threshold upside levels.
Understood that. And how are you looking at the banking and NBFC space? They've recovered quite significantly from the recent lows after the RBI liquidity, infusion that has come in. But post that, what exactly has transpired? Do you like any of these stocks?
Yes, so some of our recent additions have been into private sector banks. So clearly, if you look at it, the system liquidity is improving, and our sense is as those credit environment kind of normalizes, some of the better underwriters would stand out. And our sense is in the times to come, considering the levels at which they are currently trading, some of the private sector banks and large financials could lead the next leg of rally. Because considering that they are at fairly attractive levels and the environment is kind of normalizing. So even if you look at the broader macro perspective, even the private Capex or even the infra development has not been at its best pace in the recent past. So as and when that normalization happened, we should see some ripple effect passing on to them. Plus, the credit environment is normalizing. All these would lead to some of the good underwriters standing out.
Understood that. And so within the BFSI space, what would be the order of preference? Or would you like private banks, PSU banks, or would you like the NBFCs? And within NBFCs, how would you rate vehicle financiers versus home financiers?
See, private sector banks is the obvious preference there for the reasons which I already stated. But within NBFCs, we have positions in certain select NBFCs which has good niche skills. One, it could be either a certain segment where they have good track record and ability to underwrite, where the masses may not have. Or it could be a cost of funding advantage because of better parentage and things. But some of the home financiers which have come up in the recent past, our sense is, their collection systems has little more room to streamline. And once, until that is verified, we would stay away from such names.
What about stocks like Zomato? Is it a buy at 220?
See, I don't want to give a stock-specific call, but obviously some of these new age business models where profitability has barely started showing up. So from a fundamental investor to justify these kind of valuations, you would have to factor cash flows far out into the future. And that is quite challenging. The valuation is a clear challenge there, where you would have to justify the current levels with cash flows which are far out in the future. And those are very sensitive to how a lot of assumptions move out. So some of the new age names where cash flows are kind of back-ended, we would currently stay away from them at these levels.
Understood that. Now, within the materials and mining space, how do you look at cement companies and how are you looking at the metal names?
See, both these sectors are at interesting juncture if you look at it. If you look at cement, the environment has not been great. The pricing environment has not been that conducive in the recent past. And our sense is from the kind of consolidation which the sector has gone through, it could be just a matter of time before the pricing power comes in. And at that point in time, we would see the profitability levels inching up, because clearly, if we look at certain regions, the current profitability levels does not justify any incremental investment, and therefore that itself would give a natural push to pricing over the medium term. And therefore, we are quite positive in some of those regional names. So coming to the metal names, globally, if you look at metals, the capacity additions have been quite minimal. And the largest economy, China, they have very clear goals in terms of emission standards and their targets in terms of capacities in various metals. So some of the key metals could see reasonable support from the basis that the incremental capacity additions is limited. And therefore, pricing support should be a lot higher than what we would see, we have seen in the past cycles. So from that perspective, some of the metal names looks interesting. But of course, upside has to increase slightly from the current levels.
Thank you so much, George, for joining us and giving us a sense of how you're looking at markets, your fundamental picks, and your sectoral views. Well, some time ago, you saw a few flashes on your screen. This is regarding, definition of geographical areas as far as city gas distribution companies are concerned, and they have now been notified as common carrier areas. This will have significant implications for the incumbent CGDs, so names like Gujarat Gas, Mahanagar Gas and IGL will remain in focus. We'll await more details on this particular development. But time now for a short break. Management of Wellspun Living joins us next to discuss their Q3 numbers and more.
Testing.
Welcome back. Let's invite the management of Wellspun Living. Now, the company's top-line growth was fairly muted. Remember, this is a company which gets most of their revenues from textile and part of it from the flooring business. And the company's top-line growth this time was just 3.2% on a year-on-year basis. Margins contracted to 11.3%. And as a result of this, profits of the company were down close to about 30%. Dipali Goenka, MD and CEO of the company, is now with us on the show. Dipali, morning. This is Rima here. First, talk to us about the textile business. Revenues are muted, margins under pressure. What happened in the company? What happened in the quarter?
First of all, let me tell you, our top line is on track. Today, also 11.7% YTD is our top line. Our margins, there was a small blip for this quarter. It is also because of the margin mix, because of the currency, because rupee depreciated, and also because of the freight issues. And I think this is just going to be this quarter. And hence, we've given a target of around 14% EBITDA for this annual year, for the year annual. But top line on track, 15,000 crores as we committed on 2027. It is just a matter of this quarter. So I don't think so there's anything to really fret about anywhere.
So what would be, are you on track for your margin guidance, or do you think it's going to be lower?
As I spoke about, our margin guidance, we've given a 14% EBITDA margin instead of 15%. And that's the only deviation. And that's also been a matter of because the macro effects, in the, and we all know that, Yeah.
Understood that. Dipali, first of all, thank you so much for joining us. So as far as the top line is concerned, you've maintained the guidance that you've given. And for the EBITDA margin, you've slightly lowered it. Could you give us a sense of the capacity utilization trend as far as the new pillow facility is concerned? Because that is something that the street believes will drive revenues going forward. How was it in Q3? How do you expect that to revive in Q4 and expectations for FY26?
So pillows is something that we've invested in America, and right now it is at the capacity of around 24 to 30%. But going forward, we are looking at, and this year, end of this year, we'll be at a top line of around $20 million, and we'll be doubling it for the next year, around $45 million. The opportunity is that it is equivalent to the the volume of towels in the United States of America. So that's where we see a great opportunity, and definitely made in America will be also a very interesting thing to see in the new regime as well. So yes, made in India for our home textiles, along with this mixed bag of make in America and also distributed in America through our warehouses is an interesting way forward.
Dipali, I understand that you're maintaining your revenue guidance, and if I look at the 9-month performance, you're on track, 11% kind of a top line growth. But particularly in the last 3 months, growth has slowed down compared to what it was in the first half of the year. So has anything in the demand environment changed, or from your clients' end, which explains that?
So let me tell you, when we talk about our home textile business, there's a way that, we work in. Half one has always been the highest quarters. Half one is the highest part of the year, and half two generally tends to slow down because quarter three is the end of the year for most of the retailers, where they have the stock correction, and it is, the fag end of their, festival season. So they are correcting their inventories. So it's always been that the quarter three tends to slow down, and more so that you've seen right now, because it is actually also on a larger base. So that's where you've seen it, but we'll continue to grow on this larger base as well, where we are headed towards our numbers. And I think our guidance towards our top line is intact. EBITDA has just by a blip of 1%, I think definitely that's it.
Dipali, the other question is, you had earlier guided the street to a net debt of 14 to 1500 crore by the end of FY25. On a sequential basis, net debt has increased by close to 150 crore. Is there a one-off? Do you continue to retain the net debt reduction guidance? And we also believe that by FY28, you aspire to be debt-free. So is that on track?
Absolutely. And end of this year, we will be at 1,500 crores. It is a matter of working capital. And, our Capex, that's where you've seen this impact on the net debt. But we are on track for that as well in the quarter four. And as we go forward, year 28, we are absolutely looking at net debt, zero.
What are the early indications of FY26? You would have heard from your clients and the kind of ordering for the coming year. So what can you guide your shareholders about FY26? How much better compared to FY25?
So we'll maintain a steady state growth of, 9 to 10% on a home textile business. Emerging businesses will continue to grow and contribute to over 30% to our top line. Domestic business will grow at a CAGR of around 30-35%. And we are waiting for the budget as well. I think that could be a great opportunity because, with the kind of higher disposable income that will come into the consumers is going to be a great opportunity for India. The tax relief that people are talking about, I think, is a very interesting thing that we are seeing. So overarchingly, maintaining a growth of home textile in the terms of 10%, CAGR of 30% in the emerging businesses is the way forward for what we are talking about.
Dipali, I want to understand from you on the flooring business. We understand that revenues from the B2B segment increased by close to 12% on a year-on-year basis. But sequentially, there's been quite a sharp dip, a little over 20% dip. So what actually happened over there, and how's the branded segment of the flooring business performing?
So India actually has grown and actually is getting on EBITDA positive for us. And let me tell you, it has grown by 10 to 12%. And when I talk about the global flooring, again, the freight and the Red Sea issues have been a kind of a slight aberration for this quarter. Yes, and I think, and that with the new administration coming in, that is going to be behind us. The freight costs are also coming down. So yeah, we will see a positive upside on that as well. And we're working with OEMs and the home improvements and the others as well, and the commercial and the institutional businesses there.
Dipali, how does the depreciating rupee impact you on the margin? Is it net positive?
It will be. I mean, if we, if we plan for that, and it's just as we go forward, it definitely will be. And also, let me also give you a perspective. If I compare it to our peers currencies are far more depreciating vis-a-vis us, and so hence they challenge us in the terms of being competitive, in the global, competitiveness in the terms of products. So I think definitely that's going to be an opportunity. India definitely is in the bright spot in the terms of the supply chain as well, where people are looking at India, where you have a stable supply chain of cotton, and also your vertical integrated plants and the skilling of your manpower definitely is going to be a very huge opportunity. And yes, in the budget, we also feel if we can get a good impetus for the MSMEs, it could give, because they are the bedrock of our home textile, that could be a great one for us to see.
Thank you, Dipali, for joining in. That's the word coming in from Wellspun Living. Get into break. But here is some good news for all our viewers, because India's business news leader is now just a click away. So we're introducing the all-new app. So get instant access to breaking news, all our articles, financial world updates at your fingertips. Download the app now from the Apple Store or the Google Play Store, or you could just scan the QR code on your screen.
इसके लागू होने से प्रदेश में सच्चे अर्थों में सशक्तिकरण भी होगा, सुरक्षा भी होगी। इसके द्वारा
Welcome back to Trading Hour. Well, ahead of the budget tomorrow, there's a bit of rally, especially as far as auto stocks are concerned. Have a look at names like Ashok Leyland, that stock near the day's highest point. Have a look at Hero MotoCorp, down up almost 4%. Some of the other names that are doing quite well, names like UPL, even the entire wires and cables pack today has recovered quite smartly. Have a look at names like Havells, have a look at Polycab, KEI Industries. All of these stocks today have recovered quite sharply from the recent lows. But with that, it's time to call an end to trading hours. Stay tuned. Halftime report is up next.
अब हलाला, इद्दत, बहुविवाह, बाल विवाह, 3 तलाक आदि जो कुप्रथाएं हैं उन पर पूरी तरह से रोक लगाई जा सकेगी।
Prime Minister Narendra Modi kindles expectations of important initiatives in the first budget of the NDA in its new term. Industrial and consumer durables are the big gainers, even as financials drag.
L&T rakes in over ₹1 trillion of orders in the third quarter, overshadowing the muted margin show. The engineering major also exudes confidence in meeting its full-year guidance. The stock perks up.
Tata Consumer delivers an in-line performance but intends to take price hikes in the fourth quarter and sees healthier margins ahead. This even as the expansion of its distribution stays on track. The stock gains.
Prime Minister Narendra Modi says his government will follow the mantra reform, reform and transform, raising expectations from the union budget. He also highlights an inclusive approach with women empowerment being a key pillar. Hello and welcome to Halftime Report. I'm Prashant. With me is my colleague Surabhi Upadhyay. Surabhi, hi. Good afternoon. And well, markets are doing well. I think we tried to keep expectations a little low.
I think markets have listened to you, Prashant, in the last, 12 hours, right from, the closing hour yesterday. Prashant has been talking down the market, saying, guys, just be real, keep expectations low. I think now it's okay.
You're not appreciating the master strategy. If you keep expectations low, only then can the market do well. If you raise the expectations,
then you're bound to fall.
So I think, but I mean, it was, of course, we'll play out those PM bites as well. And of course, coming from the Prime Minister, that does raise hopes, expectations that maybe something will happen. And essentially what will happen, I think that we'll have to kind of wait for. But just a couple of points on the market before we go any further. We are at 23,450, which means now that we are up 600 points, roughly, right? I mean, what was the low? The low was about 22,800, 22,786 to be precise, which is Tuesday's low. And today we are at 23,430. So, yeah, 600 odd points from the lows already that we've seen. And many stocks, of course, have seen 20-25% kind of rallies from that lowest point. Of course, nobody buys at the low or sells at the top. But broadly, we've seen a decent recovery, which has come in. And this is a far steadier looking screen that we are sort of reporting on, have been reporting on for the last 2.5 odd days or so. So that's the picture. Sectorally, I mean, just a quick look at the Nifty Bank. Banking will be, of course, it's front-facing, economy-facing. So anything which is done, in the budget in terms of spending here, there, it always, of course, banks are, it'll show up in banks. But can something specifically be done? I mean, if you think about it, over the last 12 months, 18 months, what's been the big concern for banks, right? Deposits, lack of deposits. Will the government, through the budget, one way or the other, in some way incentivize sort of deposits, bank deposits, right? I mean, can that happen? That's more direct, but of course, everything else affects banks as well. The Nifty Bank and what's happening there, it's underperforming what the Nifty is doing, but it has outperformed from the lows so far in terms of the bounce that we've seen. 49,370 on the Nifty Bank at this point in time. But, given a limited move, it's still at the day's highest point. So lots happening. So news flow coming through on Vodafone Idea as well. Surabhi.
GST demand penalty on Vodafone Idea. We'll try and get you some more on that in just a bit. Plus, there are numbers flashing from Nestle. That profit number is pretty much in line with the expectations. We'll get to the rest of it as well and try and get you some more clarity on the news on this GST demand with respect to Vodafone Idea. But Prashant, I also just wanted to mention that we must keep in mind that today's rally, and actually not just today, the last couple of days, the Nifty has now moved to the top of the range. Remember, the fall really started from these levels, exactly here, 23,424 thereabouts. It was around the 20th of January, and then we had several down waves. We broke the 23,000 mark. Now we've recovered all of that. We've traveled that distance across about 11 calendar days, and we're back at that level, hoping that there's nothing fresh negative in the market. So we'll talk about that. Keep your eye on PSU stocks because there's a big wide-ranging PSU rally underway, anticipating a renewed Capex push. More on the budget in just a bit, but let's move on and address some more numbers. Dodla Dairy is a company that we are tracking right now. Now, Dodla reported a good revenue growth for the quarter gone by. Gross margins were slightly compressed. To discuss this and more, we have with us Mr. Sunil Reddy, Executive Director and MD at Dodla Dairy with us. Mr. Reddy, good to have you on. Thank you for joining in. Just, for the benefit of our viewers, we're putting up the numbers. Revenue is up almost 21%. Your margin has moved from about 11% to about 10.6%. That's the EBITDA margin. And profits have done really well. Profits are up 53-54%. So let's just talk about the factors at play. How has the quarter gone by been in terms of volumes and pricing? And, why is there this slight dip at the EBITDA margin level?
Thank you very much for having me on your show. Basically, what happens is we have three streams of revenue that we look at it as in Dodla. We look at Dodla Dairy India Limited, we have a Dodla Dairy Africa operation, and we have our cattle feed operation. The slight dip in the margin that came in is because we had two things that happened. One was in Africa, we have started a new plant in Kenya, which gave us a 40,000 litre volume, but didn't give us the expected margin because it was a very new operation. And also Africa had a little bit of a tougher summer where the milk prices didn't come down, which has been rectified going forward. It will also look much better. And another reason is we also had a little bit of inventory that we had sold, which was basically increase the top line, but didn't contribute much to the bottom line. But in an absolute number basis, we still grew in our profitability. So as a percentage, it came down because two streams of revenue which came in didn't have the kind of margin that we had. Therefore, it was a very small correction that happened. So that's the basic reason.
And what about the India business itself? So that you explained us sort of the issues at play in some of the international markets. But the India-based business itself, how do you describe the demand environment, volumes there, and what you're seeing in terms of pricing and margins?
So demand for the year gone by, because it was one of the highest price increases that the industry had taken. So a few of us did have to also look into it as number of packs increased, but volume per pack decreased in terms of, therefore a volume did come down, but inflationally the revenue went up in terms of the number that we earned as money in terms of rupees and paisa, not in terms of liter. But going forward, I think it's now stabilized. People have got used to it. And I think it will continue to maintain the growth trends that we had as earlier, of the 10% volume growths and value growth of around 15% will continue.
Sorry, could you repeat that number? The value growth is 15% and volume is how much?
Around 10% by volume it will grow.
And this is a projection for... Sorry, this is a projection for FY25, the year as a whole?
Yeah, yes, FY25 is the year. No, not, this is for the FY26. FY25 will be better because we had bulk sales. We had a new plant of Kenya coming into operation. This year is showing will continue to be at those 20% growth levels. FY25 would be around the 15% and 10% in terms of...
FY26, you mean? So FY26, 15% value growth and 10% volume growth.
Yes.
Okay, got that. Just want to understand, what is the current procurement capacity, and if you could give us an outlook on the expansion plans that are underway.
So current procurement, we are doing around consolidated around 17 lakh liters of milk procurement per day. We have now just announced that we are going to be setting up a new plant in Maharashtra where we're spending 280 crores and building out a larger plant there, which will have a capacity of close to around 1 million liters, which is around 10 lakh liters a day. Out of for which I think by this year end also we are looking at enhancing our already existing 2.3 lakh liters per day milk procurement to at least 4 lakh liters a day of milk procurement. So we are looking at our milk procurement moving towards the 20 lakh liter per day mark, and on an average maybe it will be slightly lesser, but we will at least touch the peaks of 20 lakh liters a day. In the short
when do you get to 20 lakh liters a day?
In the short term, it should be mostly by this year end in the peak.
Oh. Okay, by the end of perhaps this year itself. Got that point. Just a sense on how margins will improve. I mean, you explained some of the other issues because of which Q3 was impacted. But how do you see this resolving itself? And then you're looking at more value-added products as well. So overall, what could exit margins look like for FY25? And then as you look forward to the new fiscal, what's the outlook?
So the exit margins for FY25 will remain status quo in terms of we are trying to maintain it at what we have as our existing margin levels. Because if we get any benefit of even further margins, we are trying to pass it on to the customer because we do not want the customer pricing to go way too high even to affect their consumption patterns. I think we will try to maintain these double-digit margins as we go forward, exiting in 25 and for 26 also.
Okay. And in terms of key target markets, market share, expanding your distribution network, give us a bit of a geographical sense in terms of how the next, perhaps a few quarters will play out for you.
So basically, this geographically, we will still be increasing our depth in areas where we are already operating for the year 25-26, because we're not looking at much of new geography. We still have a lot of blank spaces in the areas where we are operating itself, which we will be filling those and going ahead and getting those operational going. We are confident that our feed business, which is now the new plant, which has come to 30% capacity utilization, will reach its 50% capacity utilization. And our Africa business also, which has done extremely well, will also grow by another 10-20%, because in Africa, the Uganda market, we are becoming the market leaders, and also we'll try to do the same in Kenya, which will also give us another 50-60,000 liters of growth in Africa. So a combination of all these three will give us our growth. In India, I think we are looking at our Maharashtra plant coming into operation in 18 to 20 months' time from now. So I think that will cater to the next year after that growth. Mostly the 27's growth will come from Maharashtra.
Okay, all right, got it. We will watch out for those products as they sort of, are in the distribution channels here in the state. We, of course, are talking to you from Maharashtra itself. Thank you so much for joining in, and good to get that perspective on the business. By the way, while we were speaking to the management of Dodla Dairy, look at Nestle. Nestle's margin picture has been really loved by the market. The stock is soaring away, 6% higher, and they've done better than the estimates. And the market's absolutely saluting that. You don't get FMCG beats too easily in this environment. And this is one that has happened. Healthy growth led by a combination of pricing and volume. That's the commentary coming in from Nestle. More on this as well as we come back. But we'll have to take a quick break. More on the markets in just a bit.
I think the biggest disconnect for most market participants in India is for the first time, India has gone completely off track as a market. And you have the world staying very, very strong and in a bull market, whether you look at the US markets or the European markets or the Asian markets. I believe that this is still a correction within the larger bull market because I think we saw a massive run-up for about 18 months. And in that context, I think this fall is still quite normal, even though a lot of people might not want to believe the same. The real damage has really been in the broader markets because the average decline, the whole of NSE is about 28%, whereas if you look at the Nifty itself, it's fallen about 12%. I do believe we've come to a point where sentimentally we are oversold, technically we are oversold, and based on bread data, we are very, very oversold. So a deeper cut from current levels looks unlikely. It seems as if the market is stabilizing. 22,800 was and remains a very important support. We've seen some stability from that number in the last 2 days. And if the Nifty can build up from here and possibly get past 23,350, 23,500, I think all can be well very soon. And because all of our problems have been homegrown, I think what happens on the 1st of February, I think will be very critical to the overall trend of the market. So I would be optimistic. I think from a risk reward perspective, the downside from here is very limited, but as an investor, I think the upside potential is quite large. So I would be constructive from here. I think the downside is limited. For the last 4 years, since the time we started rallying from the COVID lows, every time there has been a correction, we've seen a V-shaped recovery. I wouldn't be surprised if something similar happens. It's not that we've not seen corrections in the past. I remember late 2022, we had an 18% fall on the Nifty. Everybody questioned the bull market, questioned the fact that India is going to underperform, and then we came back very strongly. I think something similar can happen because I think India will have to be aligned with the rest of the world. So I think the upside potential is very large. Again, if I look at the markets from an 18-month perspective, I think there is potential 20% upside from where we are right now. And the reasons.
Okay, welcome back. You're with us here on Halftime Report. We've got, I think, the Nestle numbers which should come back up on the screen. And we'll take stock of the numbers and what they look with some analysts who are joining us as well. So what do we have? Nestle, my God, that is a big, big rally. I don't think we've had a large cap name like Nestle move up 7% on the back of just sort of sheer numbers. If we can have the numbers up, net profit at 700 crores, nearly 700 crores compared to, I mean, this is in line with what the expectation was. Revenues have come in at about 47, 80 crores. So this is also absolutely in line with the expectation. So what are we missing? EBITDA has come in at, again, in line, 1,100 crores compared to 1,085 odd crores or so. Margins are about 30 basis points better than expectation at about 23% compared to 22.7, which was the expectation. So numbers are in line, but the stock reaction is completely, not out of line, but this is a very strong reaction which is coming through.
Maybe it's the volume number which we're just trying to get a hand of. Perhaps we should ask the analysts. We have some experts joining in to decode why the market's absolutely elated with this Nestle performance. Naveen Kulkarni, Chief Investment Officer at Axis Securities, is with us. We also have Prakash Diwan joining in. Good to have you both. Naveen, do you have the volume number? What do you make of the stock reaction?
So numbers broadly appear in line, but of course the expectations were very, very muted. Right? So stock was pretty much trading at 52-week low. So that could probably be the case, right? So inline numbers and there's some growth that we have seen in the overall metrics. So from that perspective, I think the stock reaction has been a little faster than what we expected.
No, absolutely. So, sorry, the surprise. Are you surprised with the stock reaction, Naveen? It's too early. I mean, it's just the initial.
To some extent, I'm a bit surprised, but obviously, Nestle was beaten down quite a bit in the last couple of months, right? So, from that perspective, I would say that some bit of buying coming in is not something which is very, very surprising.
Stock is, by the way, stock is at even now at similar levels where it was in middle of 2023. So it's been but most FMCG stocks have not really done anything for the last couple of years. Prakash Dewan is with us with what he's making of the numbers. Prakash, anything sort of stands out to you? Because it's a standout reaction in the stock.
No, absolutely, Prashant. The reason why the market is so excited is Nestle usually is the harbinger of change in the volume trajectory. The simple reason that their products, do not go through the quarterly ups and downs in terms of competitive intensity and, which other segments could. I mean, you don't have a competitor to Maggi or to Nescafe or to Milkmaid or to so many of their product segments. So when volumes are better, EBITDA margins are better. I think the market is very excited about that change in EBITDA margins. I know it's 30 basis points, but it's the beginning of a change that could probably be more sustained. And in terms of valuation, it's available at, if I'm not mistaken, at one of the lowest, softest PE multiples in the last 12 or maybe 16 quarters. So it's definitely something where flight of capital will happen, and things could only become better. Remember, their Gujarat unit is the Sanand facility is also something which is just got commissioned. So if volumes pick up, it'll probably be perfect timing. They are producing more, but they're also selling more. So all of that kind of is what could make things look very positive from here on.
Okay. Naveen, what's been your call on the stock so far? And I mean, maybe you do your numbers and do the math once more details emerge. But where is it in the overall pecking order, Nestle?
So overall, from let's say pecking order perspective, Nestle over the last I would say that 3 to 4 years has been a standard company in terms of the overall FMCG pack, right? In terms of volume growth and terms of product innovations, everything put together, right? So, of course, last couple of years or 1.5 years is where the stock has not performed, but otherwise it was probably one of the better performing stocks. So we have been positive on the company. Of course, last 1.5 years, it has underperformed, but now probably it warrants a relook considering the valuations are reasonable. Maybe something is turning around. We need to look into this a little more in depth. Probably we'll be able to ascertain in a couple of days how to look at the stock again.
Okay, now got that. And we'll sort of revisit this, right, once we have the volume growth numbers, etc. Naveen, by the way, since we have you on the line, I mean, really speaking, are you expecting anything on the consumption side in the budget tomorrow? Something focused?
Yeah, so I think that's been the key area, right? So we have seen the state governments definitely focusing on revival of consumption. So maybe it could also flow through to the central government also that there could be some activity, whether it is tax cuts or whether it's something else, which could mean that there will be focus on reviving the whole consumption theme in India.
Fair enough. Will it be a sprinkling of lots of stuff or will it be something focused? I think that'll make a fair bit of difference as well. Naveen and Prakash, thank you both for joining us. Stock's starting to come off a little bit, and I think that's rightly so. I mean, 6%, 7% move in a large 2 lakh crore market cap stock. I mean, and numbers are largely in line. So that is the sort of stock for you on Nestle. Market, of course, is holding 185 points. But of course, let's start our economic survey coverage as well. Let me toss it across to my colleague Shireen in Delhi. Shireen.
Well, guys, we are still waiting for the economic survey to be tabled. The president's speech is over, the vice president's speech is over, and we are expecting Finance Minister Nirmala Sitharaman to table the economic survey 2025 in Parliament. Shortly, in a few minutes from now, is when it will be tabled. It will then be made public in some time, because remember, then it has to be tabled in the Rajya Sabha as well. But here's the context of the economic survey, and actually, let's hear it from the man himself, the horse's mouth. month, the Chief Economic Advisor, Anantha Nageshwaran, has written an op-ed in the Mint ahead of the economic survey presentation, laying out the challenges that India will need to contend with: global uncertainty, artificial intelligence, its impact on jobs, the interest rate trajectory globally, what that could potentially mean as far as fund flows are concerned, and of course the energy transition. I think the economic advisor has kind of laid out the roadmap that the economic survey is likely to touch upon. What the solutions will be, we will have to wait to find out as the survey is presented. But I want to come back to what seems to be a theme that the Chief Economic Advisor has been highlighting now for the past several months: the obligations of the private sector. In fact, if you look at some of his speeches where he has publicly talked about the fact that corporate profits are at a record high, balance sheets are a lot healthier, and the economic advisor saying corporate India needs to step up and do more when it comes to private investment. Also making it clear that, look, the government has done its part. It cut corporate taxes in 2019. It has given corporates, much more by way of ease of doing business. But more importantly, it's government Capex that's been at record highs now, including last year, which has really been driving growth. And, the nudge really from the government has been that the private sector needs to step up and do more. In fact, in this piece, and I just want to read that out for the benefit of our viewers, the economic advisor makes it very clear: social stability and long-term profitability rest on the private sector finding the right balance between capital deployment and labor employment. The survey in various places delves into the obligations of the private sector. Those are not my words. Those are the words of Anantha Nageshwaran, and that is what we could perhaps expect the economic survey to focus on. As I pointed out, this has been something that he has been pointing out for the last several months now. So what will the survey say on growth? I think the expectation is anywhere between 6.5% to 7%. That's the expectation. That's the assumption. Even as far as this year is concerned, second half is expected to be better. He is on record saying that. But more importantly, as we talk about what AI potentially could mean, what the Trump administration could perhaps do on tariffs. And remember, the economic survey was the first last year to highlight the need for a more pragmatic approach in economic engagement with China, where the chief economic advisor had made it clear that he believes that India will need to do business with China if we want to get a share of this global supply chain. So that was the first sort of government document. Of course, the finance ministry then distanced itself from that idea. But I think there is within government an acknowledgement that there needs to be some thought on re-engagement, economic re-engagement, and we've seen that now playing out in different ways. Of course, the border issues are work in progress, and there has been a breakthrough there. What will it mean now potentially as far as economic re-engagement is concerned? This was one of the big ticket ideas from the economic survey of 2024, but we're still waiting now for the survey to be tabled, and I think we should expect a fair degree of the survey to focus on the private sector and the onus on the private sector now to drive growth. And once again, we will, of course, have our budget editors joining us shortly. But if you watched the budget banter yesterday, this is what we've been talking about. The share of private investment is still in that 30 to 33% range. And that's where it has been for the last 3 or 4 years. It hasn't moved past that. And it hasn't moved beyond that. So the expectation of what more can be done to really unleash that cliched animal spirits is the question at this point in time. But the market certainly going into the survey and the budget strong, Prashant.
Absolutely, Shireen. And, from the lows earlier in the week, the Nifty is up about 600 points. So, it complicates the situation because, I mean, if the budget was, say, last Monday, it was completely bombed out picture, right? So it was looking very weak. So budget this way, that way wouldn't do any harm at the margin, right? But we've seen a bit of a recovery, nowhere close to the falls that we've seen. It's still largely a little nervous looking market. But of course, we've had this bounce now as we head into tomorrow's budget session. So, it's a bit more tricky in that sense in the very near term. I mean, typically, over the last, if you look at the last 10 years, actually, all the budgets of this government, I think there was only one budget This was during the COVID time, when on the day of the budget, the market ended higher. Otherwise, the markets always ended flat to slightly lower. So, you know, that's the history so far. And they've largely kind of focused on sort of fiscal consolidation and those kind of things. You know, that's worked very well, of course, from a market standpoint. But the question this time, I think, because growth for the first time, actually for the first time, you know, I don't think many people are framing it like that. But if you talk to people off the record, they do say that it is actually a choice between, you know, can you do something to boost consumption, put more money in the hands of the people, because growth for the last 2 or 3 quarters has been weak. And now everybody acknowledges it, and that maybe a little bit of help is needed. And so in that context, for FY26, is it possible the government says the FRBM mandates fiscal deficit to be 4.5%? Is it possible the government says, well, okay, we won't do 4.5, we'll do 4.7. You know, it's not that important right now, 20 basis points. The only thing is, history suggests that that's not the case. The government has focused and has stuck with you know, what it has said it will do. It's achieved that. So I think that's the context here. By the way, the Nestle, Shireen, the numbers are coming, and third quarter volume growth is 3% compared to the expectation of between 1 and 2%. So I think that's essentially what the market, maybe, you know, there was a whisper number as the basic numbers had come out, and that's essentially the reason why the stock actually spiked sharply higher, because otherwise, if you look at the profits, the margins and revenues, they were all bang in line with expectations.
No, I just wanted to come in on the Nestle numbers, Prashant, and you know that 3% volume growth is on the back of a negative 1.5%. It was minus 1.5% the previous quarter. So that clearly is what the market has been excited by. So the volume growth coming in at 2% plus 3%. And remember, the previous quarter, the volume growth was minus 1.5%. So that's the story that's playing out there as far as volume growth is concerned. And this is what we were also talking about. You know, yesterday, that rural has seen an improvement, but it is urban that is at this point in time still seeing some pain. So there has been a recovery in rural, and that perhaps is being reflected there as far as the Nestle numbers are concerned. But, you know, back to that point about fiscal consolidation, Prashant, if you go by, and you were mentioning that as well, if you go by the record of this government, especially in the last few years post-COVID, I think they have been very clear about the fact that they would like to stick to the fiscal consolidation roadmap. So I'm not sure whether we're likely to see a slip on the fiscal deficit number that's already been articulated by the government in the budget. But I think they do, as you know, as Neelkant was pointing out, have some cushion to play around with. How that's going to be used, again, they haven't really been, you know, big on sort of money in the hands of the consumer, so to speak. They've been much more on driving capex and infrastructure spending. I would imagine that we're likely to see a bit more of that. But, you know, you heard from Akhilesh Ranjan. He's the man who drafted the original tax code. And this is the budget that is likely to take the tax code and simplify it, or at least that was what the promise was last year around. And his point was that, look, there is pain in the 10 to 25 lakh bracket. Is that where we can see some relief being provided by the government? Is this going to be the budget that finally does it? Is the big question.
Absolutely. And he made that point very emphatically, Shireen, Mr. Akhilesh Ranjan, that is, that, you know, how long can you go on taxing corporate India on a large profit base at 25% and taxing someone who's earning 10 lakh rupees a year at 30%. So that was a very, you know, direct argument. But how much of that will, you know, find its way in the budget speech tomorrow? We have to wait and see. One more thing, I was going through a lot of the, you know, brokerage expectations across the board. It's very, very interesting. Of course, most people want it all. So UBS kind of summed it up. I thought that line was quite interesting. They said the key focus of the expectations would be capex growth, focus on consumption, boosting employment, but all within you know, a general fiscal consolidation roadmap. So we want it all, but along with fiscal consolidation. However, one note kind of stood out for me, and I just want to put that on the table as well. And that's a quote from Goldman Sachs. The point that Goldman Sachs is making is that this whole expectation of government capex almost endlessly driving growth, this might have to be tempered, this particular expectation. The rise in government capex has been running at a clip of almost 30% in the last couple of years, the past couple of budgets. GS is saying we need to sort of come down to reality of this number coming more in line with the nominal GDP growth, which would be around 10 to 12%. So perhaps, putting the onus on the government for that heavy lifting, may lead to some disappointment. Though, of course, having said that, even now, the market is expecting, considering we've had such a bad year, FY25, on, the pickup in Capex, perhaps we will look out for better announcements there.
Okay. I think what we'll do is, absolutely, and I think those are great points, Surabhi. Shireen, maybe we can just take one small detour as we wait for the economic survey to begin. The Biocon Biologics earnings set was a weak one for the third quarter. It's earnings season in full flow. So why not play out this piece of this interview that my colleague Winnie conducted with the MD and CEO, Srihas Tambe, and she began by asking him about the results themselves. Listen in.
For your benefit of your viewers, just reflect on the quarter that's gone by. It's a very significant quarter for Biocon Biologics because it marked the completion of a full year of having run the business as Biocon Biologics as a fully integrated company on our own. And this is very important because that was an acquired business. It was something that we hadn't done ever as a company. And I'm very proud the way the teams responded, where we've seen very strong customer confidence, where market shares have grown across all key markets and across all products. So that's something very, very comforting in terms of how the market, how the customers, patients, physicians have perceived the company and the acquisition. The second thing I think which is very important that just went past in this particular quarter was the debt management effort that we had put in place. So that's behind us. And I think what is very, very important is the delayed FDA approvals, which were long awaited, came through in this quarter. So the quarter, apart from the numbers that we are talking about and you referred to, there's several other milestones that will enable the company going forward. So to respond to your questions, I think these building blocks that we were long waiting for, I'm very happy to report that those are now falling into place. So the coming quarters, what you should expect, because we've tried to avoid giving guidance for a very long time, is that those look brighter and in line with what our expectations have been. So we will continue to grow the business. We'll have 5 products launching in the next 12 months. And we will be looking to see mid-20s EBITDA margin contribution. So a very, very exciting future, Vinny, for those watching Biocon Biologics.
Shreyas, I just wanted a clarification one thing. So when I was seeing the press release, so there's this core EBITDA margin that is given. When I'm just looking at it versus last year, I don't know if it's fair to compare it, but I was taking it from the press release. So 26% in Q3 FY23 versus 27% in Q3 FY24. Just trying to understand what is this decline that we're seeing here. You said that margin trajectory is expected to be in these mid-20 ranges, so we could expect 26% to continue, right?
The reason you see a shift is because some of these operating costs will move between quarters. And we probably also just had an earnings call where we guided that some of these costs you saw being, as we completed some of the settlements, moved from Q2 to Q3. And as we get into Q4, you will see them, getting balanced, and you will see an improvement in that core margin profile. So you're right to point that out, but it's not a reflection on the core health of the business.
Okay, so that's not a worry there. It'll come back again in Q4 is what you're highlighting. Shreyas, one more thing I want to know, and this is, the US FDA during this quarter had validated biologics license application, and this is for denosumab, the biosimilar over there. So I want to understand, and what is it that, which geographies have you filed in for? What is it that the factors, when are we expecting the launches coming in from this front? Because, this is something that is interesting the street as well.
Yeah, and so denosumab is a large asset. It has 2 indications, one in bone health and the other in oncology. So it's 2 indications, 2 brands. The way the regulatory process works in the United States or even in Europe is you make a submission to the regulator, and the regulator then reviews your application to see if it's suitable for them to go and review it. And that's when they validate the application saying, okay, you have met the base criteria for us to go and start reviewing your application. And that's when they say that it's validated, and now we are willing to review it, and you get a goal date by which they will make a determination on your application. It's a very important milestone because unless you are validated, your review process itself does not begin. So it was an important milestone for us to have achieved this. We've achieved this both in Europe and in the US and in other geographies. All filings that we develop are for the world because we believe we want to broaden access. But these are large markets. It's a big asset. And that is really what this was. So the validation was a big milestone, and I'm very proud that the teams achieved it in the course of the last quarter.
So Shreyas, then when does this launch start? I'm just trying to understand that. When would the company start launching now? What is next?
So the launch thing, I think it's important to see what's coming up in the next 12 months. In the next 12 months, now that we've got the US FDA approval, or I would say the classification as VAI, that allows us to launch new products into the United States. You will see us bring in bevacizumab in the oncology space. You'll see us bringing aspart, which is in the diabetes space. And then we just talked about ustekinumab, which was the other product in the autoimmune space. And then the denosumab that you just referred to is going to be coming in after it's approved, because these three products were approved. Denosumab is under review. So once approved, you will bring that. Our biosimilar aflibercept, which is also a biosimilar to a very large asset called Eylea, is already approved. And once we get past the litigation that we have, we will be in a position to bring that to patients worldwide. We'll, of course, be bringing it to Canada in July of this year.
You're very busy. And just a last quick one. Are you considering any strategic initiative around the small molecule business? Maybe separate listing, divestment, anything on that front? Is that a thought process right now?
I think the small molecule business, even today on the earnings call, the CEO of that business, Siddharth Mittal, did talk about the fact that it's been a long time coming that our GLP-1s will play out. We've had some success already with the regulatory process in UK, and we are looking to bring this product to other geographies shortly. So clearly, there's a lot more excitement than we've had before. So we are very confident of how our small molecule generic business will play out in certain niche therapy areas, which will be very complementary to what Biocon Biologics does as well.
Okay, that was our colleague Vinny in conversation with the management of Biocon. In the meantime, as we are awaiting the economic survey, which will be tabled in the parliament shortly, look at the market. Market's going gangbusters. Good mood out there last couple of days. And we are at the highest point of the recent 10-day trading trajectory on the Nifty. So going with full hopes into the event. Take a break. Come back with more in just a bit.
I am thinking that since the chatter is there and it is logical that the government has given some incentive to the corporate sector through lower taxes in 2019, and they have done something for the lower this thing in terms of giving food and subsidy, and the states are giving, that you might do something for the middle class or for the taxpayer. And that also is coming now, but I've been saying it for the last 30, 40 days, that, there is some scope, maybe $4-5 billion, say 30, 40,000 crores. But if you divide that by number of people who may get it, say, I don't know, 2 crore or 3 crore taxpayers, it'll come to 8-10,000 rupees or something like that per annum. So you can get that much. I think it's possible to make it a little fair. I don't think it'll matter, because let us say in a family you're getting 600-700 rupees per month. Okay. Now, what will you do with it? Because inflation is there. Secondly, the basket of people have changed. Will they order one more time Zomato, or will they change or buy an extra lipstick? Who knows? Because in the olden days, these things were much simpler to do. Or maybe there'll be a telecom price hike after a few days, and some of this money would have gone away, or whatever, 600, 700, 300, 200, whatever. So the point is, you don't exactly know what to do if the amounts are otherwise small, and nowadays the basket is a bit wide. So you will say good and thank you and on behalf of everybody, and it'll help the consumer sector. But now which stock will they go to McDonald's more? Where, by the way, I own that stock also, which has been a dud for 2-3 years, but before that was good. So will you go one more time to Westlife? Who knows? I don't consider Zomato as a discretionary stock in the sense it is just replacing what you were doing, which is why we like those kind of stocks where you are not trying to say that the customer has to spend more money. It is just reorienting. That's why we like the quick commerce. He's not spending extra money. He's just making it convenient for him to buy this via this channel versus that channel. I don't like the consumer staple because I think that the consumer basket has expanded to beyond just upgrading a soap or something because monsoon has come, which was the old formula. In the old formula, when I was in Alliance Worley, we would see if there's rain outside our window in Bombay, and then you would go and buy levers and you'll make some 5-10% in 6 months. So those days are gone. Now you don't know. There are private labels. And then the customer himself or the consumer himself has or herself may want to buy something which they can show on social media or in a photograph or in a selfie.
Welcome back. We are counting down to the economic survey. Of course, it has now been tabled. The question is, when will we get the details? That process, of course, will be underway shortly. It's about 12:40, so any time now is the expectation. And the markets have gone into the economic survey and to the budget looking strong at this point in time. So to decode what we can expect, not just from the economic survey, but also from the union budget, we have two former budget makers here with us, right here with me in the studio. Also our budget editor Tanu Chakrabarti, the chairman of HDFC Bank, also the former Economic Affairs Secretary. Also with us Subhash Chandra Garg, the former Finance Secretary, and of course joining us Kanika Pasricha, the Chief Economic Advisor at Union Bank of India. And also with us will be more guests that will join in through the course of the day, and of course my colleague Lata here with us as well. Mr. Chakrabarti, let me come to you, sir. As I pointed out, you and Mr. Garg have of course been in the hot seat, so to speak. So today, sitting here with us in the studio, as you watch your former colleagues present the economic survey and the budget, you know, do you sympathize with them given the challenging global and domestic environment that we're faced with?
Well, they have control over the full set of data. Of course, economic survey is more of a snapshot. So in a sense, it's not that kind of a challenge. Tomorrow, of course, budget making, whether good times or bad, are always challenge.
Always a challenge. But what is your expectation, Mr. Chakrabarti? Given where we find ourselves today, with growth having slowed down, the expectation is that it will pick up now. What would be the one or two big numbers or the big expectations that you go into the budget with?
Well, I would go by what has been stated by government in the previous budgets. If you recollect, in the last budget, Finance Minister had spoken about budget reduction starting from FY 26-27. So containment of debt, I guess, would be one major expectation around.
You don't expect any deviation from the fiscal consolidation glide path, which is the clamor at this point in time, that loosen the purse strings a little bit more to drive consumption?
No, frankly, I don't think so.
You don't think so?
I don't.
Relief for the middle class. That's the other big demand that's come in, that this really has to be the budget that delivers on that promise, given where we are seeing consumption. What's your expectation realistically? I mean, what are we really talking about when we talk about the possibility of relief?
Last year had seen certain amount of tax reforms already. What one seeks in the tax structure is more of stability. And what we are actually seeking is growth and welfare on that side. Welfare comes partly, it also has some political element always involved in this. However, it's more of growth which gives relief to the middle class as well as low inflation.
Right.
Then any of the other factors. Because there is also the balancing game has to be done with respect to the fiscal deficit, keep it on the glide path, as well as bring down the primary deficit.
So you would say that Capex heavy and be tempered and measured in our expectations on any income tax relief and so on and so forth?
Capex around 3 to 3.5% of the GDP, which is a range it has been in, Beyond that, one should not expect. Heavy lifting has to come from the corporates of India. And they have to build in larger capacities.
And that is what the economic survey perhaps is going to hint at. If you look at what the chief economic advisor said, as I was pointing out in his op-ed in the Mint, saying that, look, the private sector has obligations and the private sector now needs to start doing some of the heavy lifting. Let me get Mr. Garg in with a quick comment as well. Mr. Garg, as I was pointing out, I mean, you've been part of the budget making process and exercise as well, sir. What are you going in with in terms of realistic expectations from Budget 2025?
So, Shireen, the situation this time is a little more difficult, somber for the government. The tax growth has been sliding down. Expecting more than 10% growth would be difficult on taxes. The government has, in a way, scaled down the privatization and the disinvestment program. So on the resource side, I think there is a bit of a constraint, quite a lot. That would define how do you deal with the expenditure. But on the other element of resource, the fiscal deficit, I think the government will stick to what it announced for 25-26, 4.5%. So this gives you together the tax growth at about 10%, no growth on the disinvestment side, hardly any growth on the non-tax income, and scale down fiscal deficit to 4.5% on a lower nominal GDP base of, let's say, about, if you build it on 324, which was the number in the first advance estimates, and take it 10%. So all this gives you a little bit of a constraint on the expenditure side. I think 4.5% to 5% might be the level of the expenditure growth, which will then let the government decide which way you put your priorities. I think Capex continue to be a strong point of the government, though this year's underperformance, which might make the 24-25 Capex to be around 10 trillion, and then the government may like to increase it by another 20%. So maybe around 12 trillion or so of the Capex for the next year, which will, as interest expenditures keep on rising because of the very heavy debt base, I think it will constrain the other expenditures. The government will not have much space to expand the freebies or the cash handouts or the populist program. On the middle income, I think there is a very much due. The demand is very genuine, as is also been articulated. I think 2 or 3 adjustments if the government does. The minimum tax slab is raised to about 5 lakh, and the 30% slab is shifted to about 30%. I think you can arrive at a tax structure which might be favorable to the middle class.
Yeah. Okay, well, we have 2 former secretaries with us. So, I have a cheeky question to you, Mr. Garg. How important is this survey at all? I remember Pranab Mukherjee's statement saying that I give full freedom to my economists to give all his ideas in the survey. And, that's their ideal expression. The budget is more practical. On the other hand, in the previous few budgets, some of the important ideas have come out. Like, Shireen pointed out last year, the survey said that we should engage with China for FDI, even if we have other problems. And that's exactly what happened afterwards. In a previous one, you remember the sovereign dollar bonds? That also was leaked out in the survey, and it was actually announced. So how seriously should we take the survey, Mr. Garg?
See, the chief economic advisor is a part of the budget-making team. And that is what brings the survey and the budgets somewhat together. Of course, the chief economic advisor is not the final who calls the final shots as far as the budget is concerned. And that gives him the freedom to sort of express what he considers desirable in the economic survey. So wherever the economic surveys have been presented by people with independent thinking, with their own views about how the economy should be handled, you would find good suggestions emerging from that. It depends upon the government's ability and the capacity to take those ideas. For example, what you mentioned about the Chinese, I think it makes absolute economic sense to learn to do business with the Chinese. Otherwise, we'll end up increasing our imports without investments. But the government will take up that idea. So I think this year also, I expect the chief economic advisor to come up with some sensible ideas. But whether the government will adopt them or not, we will see it tomorrow.
Okay. Well, the other thing, and I wanted Mr. Atara Chakrabarti on it and Kanika as well. First to you, Mr. Chakrabarti, you know, one of the very important statements the finance minister made in the July budget is that she will release an economic policy framework in the next budget. And that will lay out the cooperation between centre and states. I mean, there were many things in it, that development will be a joint effort between centre and states. Do you think we must look for hints on that score, a new economic policy framework? Mr. Chakrabarti.
Well, Lataji, part of the economic framework in any case is through the Finance Commission. That is constitutionally mandated. So that remains. Balance is how they go together to see that they are more in synergy than sometimes, you know...
Conflict.
I would not say conflicted, but in a sense, synergy and sort of build on each other. But let's face it, there are different governments in states and different governments and centre, sometimes in opposition, having very different sort of ideological outlook on economy itself. Therefore, but all of them want development. At the end of the day, across the board, I see a more or less bipartisan in that sense of term, consensus on growth
and development, absolutely.
Therefore, I guess a framework which comes, which builds over and above the Finance Commission framework would certainly be welcome, where especially issues like smaller infrastructures, education, health, states starting not only investing more, but also improving their quality of governance. There's a whole lot of things which states do and perhaps would be doing, and together with centre, perhaps even better.
I agree with you there, but you know, that's just one of the many things that the budget had promised, the last budget had promised. There was also the promise of the overhaul of the direct tax code, but what we are given to understand that is going to deal with more simplification as opposed to rationalization of taxes. So one will have to wait to see. There was also the FDI, overhaul that was promised in the last budget as well. So that's going to be something else to watch out for. And of course, some of the promises that were already made, you know, they had to do with the internship scheme and so on and so forth. Those are still work in progress. I'm not sure we've actually seen a lot of momentum yet on them. The big one, of course, that 1 lakh crore rupee R&D corpus that was announced by the budget, that is yet to be operationalized. So those are some of the promises that were already made, which are yet to be taken forward. But Kanika, what are you hoping to see, not just in the budget, but also to hear from the economic advisor in the economic survey? Growth expected to be anywhere between 6.5% to 7% is what we're hearing.
So thanks, Shireen and Lata. Thanks for having me on the show. See, 3 points is what I'm looking at. First, of course, as you talked about, the growth numbers become very important. Last time round in the economic survey, they were very conservative. They were more conservative than the RBI. They were at 6.5% to 7%. What kind of growth numbers, not just on real, but also on nominal basis, will lay the path to the budget tomorrow as well? Second, of course, fiscal priorities. We are all having a consensus that the consolidation will be 4.5% or lower from 4.8%, 4.9% in the current year. But what becomes very important is what's the kind of roadmap laid out for the coming years when they want to move from, say, 4.4%, 4.5% to 4%. And also the quality of spending, because Capex spending is what has suffered this year, as Mr. Garg was talking about 10 lakh crores from the budgeted number of 11.11 lakh crores. Third and most important is of course, the economic survey and the budget may not be completely mapping each other. But is it that, like last time round, while of course they highlighted the private sector, China investment point, but what becomes important is last time round, it was still about nuts and bolts fixing in the economy. Currently, it's coming at a juncture where there's so much uncertainty, there's so much expectation and hope from the budget to support growth. So what is the kind of short-term stimulus measures that they talk about? Is it that they're talking about demand from just tax cuts or labor-intensive sector Capex focus? Or just freebies or direct benefit transfer boost to bottom of the pyramid? And the long-term policy roadmap, like you mentioned about CE's article on energy transition, AI, how do they get private sector to get involved in the growth path? So these are some of the measures I would want to look at in the economic survey this time. Thanks.
I don't know how much of the how much does political economy matter as well, right? I mean, when we these are all expectations, and we'll know tomorrow. But the government, the BJP won the elections, the Maharashtra elections. There are no big state elections this year. In any case, I mean, even if there is some fiscal help coming, maybe we're talking small numbers, right? I mean, 4.5 extended to say 4.7. So how much will that really help at this stage, and will the government do it when there are elections, etc., on the corner as well? Mr. Garg, on something related to market specifically, one expectation is that maybe the government will take note of doing something to incentivize bank deposits a little bit more, because that's been a problem for the last 12, 18 months. Of course, there's the RBI role as well, and they've done some things on liquidity, and more is expected. But what is your sense? And I do hope it is not at the expense of the equity markets. that we got enough of last year. But just your thoughts, Mr. Garg.
So, Prashant, the 5-year fixed deposits still have the incentive, the tax incentive, they're included in that ATCC. But you see the bulk of the taxpayers are now out of the income tax because of the fact that you up to 7 to 7.75 lakh, you don't have any tax effectively. So I don't see any other measure coming on the bank deposits front. I don't think it's economically desirable also. It's not good to distort the deposits market in the banking system. How do you deal with the bonds? How do you deal with other financial instruments? I think the policy should stay away from incentivizing the commercial banking instruments for the tax point of view. So I don't expect anything to come on that front.
Let me put that question to Mr. Chakrabarti as well, sitting here as the chairman of HDFC Bank. Any expectations at all as far as deposit mobilization is concerned, Mr. Chakrabarti?
Well, I guess the overall system growth is there at roughly about 11.9%. Therefore, I frankly don't see neither there is an expectation for any particular instrument to be incentivized. After all, there's a larger system within which the banking operates. Wherever there is an expectation of a rate shift, normally there is a flow out of what is known traditionally as CASA.
Right.
And that increases the cost of funds for the banks, and that's why the clamor. I don't think banks would love to have any incentives on time deposits. They would like to have more of current accounts and saving accounts. And that number has been going down, and which increases cost of funds, which squeezes their net interest margin. So the game is completely different. It is overall stability, which is more important for the banks. Then the system grows even faster. So growth is, at the end, the key, which brings in money for the system.
Okay, that's the first flash that's coming in. FY26 GDP growth being seen in the range of 6.3 to 6.8%. So it's much lower than the expectation of 6.5 to 7%. So it is at the lower end, 6.3% to 6.8%. As Kanika was also pointing out that even the last time around, the survey had been more conservative as far as its growth estimates were concerned. So the economic survey projecting the FY26 GDP growth seen at 6.3 to 6.8%. Kanika, a first reaction from you.
So Shireen, as you said, credible, same as last time, 6.5 to 7. In fact, had they maintained it at 6.5 to 7, we would have said that they have actually lost their conservatism. But this time they are more candid. As CA even wrote in that article, there is global uncertainty. In fact, it's only likely to increase this year. So we are in an environment with global and domestic challenges. So 7% plus numbers looks difficult to achieve. So in the current context, 6.3 to 6.8, we are at 6.5, looks more credible and a good number to work with. It actually is somewhere implying nominal GDP growth of close to 10% or lower.
Well, Kanika, I did a poll about 1 hour back, and you also participated in that poll. And that was exactly 6.3 to 6.8. The highest number I got was 6.8. The lowest number I got was 6.3 for FY26. So, well, full brownie points for honestly reflecting the forecast of the economy. As Kanika pointed out, the more important number for the budget will be the nominal GDP. And over there, we have a range of estimates because so much depends on what you are assuming is going to be the wholesale price index. There is a little more clarity when you're forecasting CPI. WPI, so much depends on whether China will dump or not, and therefore will commodity prices fall or not. So if you assume a benign commodity environment, then you have to assume a lower WPI and a lower nominal GDP. Last year, the budget assumed a nominal GDP of 10.5%. And what did the MOSPI say? It actually was 9.7%.
FY25.
So, there is a danger of assuming too much. But then given that base, will the WPI be higher? That will be the real number we will have to grapple with. But for the moment, I think you will have to give full marks to the economic survey for putting it exactly as the market is forecasting at this point in time. But Mr. Garg, if it is 6.3, very little maneuverability, isn't it, to spend? Okay, we cut to the finance minister.
One, the economic survey 2024-25. The economic survey 24-25 statistical appendix. Thank you.
सभा की कार्रवाई कल शनिवार 1 फरवरी 2025 को रात 11 बजे तक के लिए स्थगित की जाती है.
Okay, so that's it. The economic survey being tabled by the finance minister. The Lok Sabha stands adjourned now. We'll resume business tomorrow. We will, of course, get you more details from the economic survey, but that's the big headline that's coming in. Growth being assumed at 6.3 to 6.8%. That's the range that the economic survey is going with. And as we've been pointing out, this is really rooted in reality. It's a reflection of what we've been hearing through our poll as well. Let me bring in quick comments to that headline growth projection number from Mr. Garg as well as Mr. Chakrabarti. Mr. Chakrabarti, your first take.
Well, this was more or less expected because advance estimates peg the real number around this, so it's more or less in line. However, there is no reason to feel that 6.3 is a bad number. Let me put it this way, because considering the global growth scenario, to my mind, it's a very healthy number.
A healthy number. Mr. Garg?
See, I see this is quite realistic, 6.3 to 6.8, but slightly on the little optimistic side. So to me, it looks like that it might tend towards the lower side of it. And I can draw comfort from what happened last year. Last year also economic survey was very conservative, 6.5 to 7. But what we are going to see the growth for this year is on the lower side of it, or might be slightly lower than the 6.5%. So I would take it fair deal. Probably the chief economic advisor wouldn't have gone for below this. I would expect it 6.1 to 6.6. as the more reasonable, realistic rate. But I am happy with what has been stated.
Yes. Prashant, quick take on the markets and how the markets may have reacted to this?
I mean, nothing, Shireen. We're still trading up 220 odd points. And so far, I mean, I was also watching because, I mean, as we've been discussing, if these are numbers and Mr. Garg is saying actually the number should be at the lower end, then will there be too much that the government can maneuver to provide help and stuff like that? I mean, if anything at the margin, if expectations mean anything, the expectations go down a little bit about maneuverability in that sense. But so far, the markets have taken a little bit. I mean, it's small. I mean, 20, 30 points or so off from the highs on the Nifty. Otherwise, still about 200 points there, Shireen.
Yeah, because even if you have a 6.2...
Yeah, guys, I just wanted to come in. I do now have the economic survey with me. And as we've been pointing out, and again, this is something that the CA had spoken about as well. Deregulation is likely to be a big focus theme running through the survey. And that is what the Chief Economic Advisor is talking about. He says, going all out to attract, promote and facilitate further domestic and foreign investments, India needs to become competitive and an innovative economy. It will not be easy because competition for investment is not only with other emerging economies, but advanced economies too, who are determined to keep their businesses at home. Equally, investing in and strengthening domestic supply chain capability and resilience will be the hallmarks of strategic and long-term thinking on part of the private sector. Now, what is he suggesting in terms of measures to go all out is the question. Another priority related to the above that calls for a calibrated and careful approach is climate change and energy transition. Public policy will have to recognize the role of energy security and energy affordability in enhancing and maintaining competitiveness. It means that forging India's own path to energy transition and diversification away from fossil fuels. It will also require appropriate skilling and education for India's youth, and achieving competitiveness will be an incomplete project without raising productivity in the primary sector. Above all, underpinning specific policy efforts will have to be the philosophical approach to governance, getting out of the way and allowing businesses to focus on their core mission is a significant contribution that governments around the country can make to foster innovation and enhance competitiveness. The most effective policies governments, unions and states in the country can embrace is to give entrepreneurs and households back their time and mental bandwidth. This means rolling back regulation significantly. As I was pointing out, that's the core theme. Roll back regulation significantly. We'll have to go through the details of what that deregulation exercise that the economic survey is proposing. But the key headline, getting out of the way, that is the underpinning as far as the policy stance that the economic survey is taking. Mr. Garg, your first comment, sir.
So I think this is a very well said statement. You need to deregulate. We have too much of the laws, regulations, rules in the country. It has been pointed out many times, 60,000 odd compliances on the labor front alone by the industry. So I think that is fair. But the point is that in the context of budget, these don't amount to much. What does the budget do about it? I think this is what the government need to do for the entire year. If you try to shift from it, that what it might bring in the budget, I think if the budget deals with this theme, it might only be some sort of advices, some sort of exhortation, some sort of pious wishes, but not a real policy making.
Yeah, point taken, sir. I just wanted to point out, I ran through the contents to check out what are the themes, and as the CEA had mentioned in the edit in the op-ed piece in the Mint newspaper, I think there is a great deal of emphasis on the elephant and the dragon in the room. So clearly the India-China dynamics and polemics is going to be discussed. That's an important chapter. And he pointed out in previous occasions as well how we could use Chinese FDI. But this time he's actually going to point out that while we are getting freed from using fossil fuels and dependence on oil because of the rise of renewable, we are probably getting dependent on one country for a lot of critical elements in the renewable space. I mean, we know how much the world is dependent, and India is dependent on critical parts from China, including rare earths, rare minerals from China, especially for the renewable space, and even to some extent for semiconductors. So I think that's going to be a very big chapter on, how will be the new problems of trade dynamics given the importance of renewables. Let me just stress on the other point that Shireen very correctly pointed out. getting out of the way of business. If deregulation is going to be the theme, Mr. Chakrabarti, my question to you was going to be exactly that from the start. You know, the 1991 budget, which we still hold as iconic, it did not give us a fiscal boost. It actually got out of the way. There is a better way to boost the economy by getting out of the way than by spending. Do you think there are any spaces where the government can do that? Just be less government. Have less regulations.
There is whole lot, frankly, all budgets, they do not give much space for more spending or less spending in that sense of term, because on the margins, the scope is very little. But on the policy making, the reforms, it's a very continuous process. And deregulation, frankly, is a music to my ears. I really like it, not only for, say, labor reforms, which central government has been working and perhaps should be working more on that, doing away lot more of laws which come in the way for an entrepreneur, but also for those areas which are regulated and need either lighter regulation or regulatory stance through not prescriptive framework, but more through a principle-based regulation. I guess that is a core. That's how I look at it. That wherever there are regulations, and perhaps needed also, they also need to be less prescriptive. That will open up lots of scope for a lot of entrepreneurial juices to flow. And that's critical. Whether it's an insurance sector or whether it's a banking sector or whether it's the electricity sector, there's a lot of prescriptive regulation which needs to slowly go away. It can't happen overnight. We have excellent regulators, but the regulatory stances have to be defined more in principal terms than in prescriptive terms.
Well, I'm just going through the summary of the many chapters of the economic survey. Chapter 6, of course, has to deal with the focus on infrastructure. The government has laid a special focus on infrastructure in the last 5 years. Reflecting this intent, the capital expenditure by the union government on major infrastructure sectors has increased at a trend rate of 38.8% from FY20 to FY24. It essentially gives you a breakup of the kinds of projects that the central government has taken forward as part of its infrastructure spending. The industrial sector is what it deals with in Chapter 7. But, it seems I'm still trying to get some sense of whether the survey has given a clear roadmap or prescribed where it believes that regulation needs to be pulled back or the government needs to get out of the way. But very quickly, as far as inflation is concerned, the expectation is that inflation will align lower. That's the expectation at this point in time. Good Rabi production is likely to contain food prices in the first half of FY26. There are many upsides to domestic investment and output growth and disinflation in FY26. Fundamentals of the domestic economy remain robust. Expect the FY26 growth in the range of 6.3 to 6.8%. Mr. Chakrabarti, on the back of what the survey seems to be suggesting as far as both inflation and growth is concerned, the expectations now for rate cut from the MPC?
Well, whatever needs to be done for lower inflation, MPC should.
Mr. Garg, rate cut expectations, especially on the back of what the survey seems to be suggesting there as far as inflation and food inflation specifically?
I think the case for rate cut in India existed for last 6 months to 1 year. It's being delayed. I don't know for what good reasons. The consumer prices on which the RBI bases its rate decision is not in the control of the Reserve Bank, not as part of the monetary policy. So in my judgment, it should happen, whatever economic survey says or budget says, the rate cuts should be phased in now, at least 1% for next 6 months.
Again, another cautionary note here, and this is an extension of what the survey had kind of addressed last time around. And let me get Mr. Chakrabarti to react to this. Risks pertaining to India's financial sector, that's one of the chapters that the survey talks about. There is evidence of increasing reliance on the financial markets as a funding source. Financial markets must work in tandem with the banking sector to bridge the capital requirement gap. Financial markets must grow in line with, but not faster than, the economy's capital needs and overall economic growth. Crucial to be aware of the potential vulnerabilities that must arise. India must prepare itself with appropriate regulatory and government policy measures to intervene and mitigate these risks when necessary. Banks need to enhance their capabilities to meet the demands of new age households and the digital economy while maintaining their primary credit creation function. Excessive financialization can hurt the economy. The cost may be particularly high for a low middle income country like India. This is what he had said last time around as well. Mr. Chakrabarti, he's reiterating that this time. What's the message that you take away?
Government has reasonably kept its distance while promoting the growth of the financial sector. It has intervened for financial inclusion, development of and promotion of payment systems and so on and so forth, which has actually brought a lot of dividends and reduction of poverty, and also improving the velocity of money, easier payments, as you would have seen. Therefore, I guess banking, para-banking, fintech sectors, for them, as I mentioned, they need to be regulated, no doubt about it, but they would be regulated lightly so that they have their elbows free to do more and more.
But this excessive financialization risk, once again, I mean, we already saw measures coming in, especially on the F&O side and so on and so forth, because that was the overarching concern last time.
Well, that would happen. That is more tactical in a sense that F&O, or for that matter, where people need to go or do not need to go. So that regulators can easily adjust by margin calls and those kind of things. So that's more tactical. Right. I don't see much of a strategic interference there. I think market should be allowed to play freely as much as possible. They'll improve their depth, and if anything where the government needs to come in, and I don't see survey acting on that, is development of bond market. Very critical, because banks can't provide long-term financing.
Right.
So perhaps they would have talked about it, and we have missed it. But I see development of bond market and necessary tax infrastructure for that as a key for development.
Lata?
I just want to make, Shireen, just one point. In the Outlook section, this is page number 32. And I'll just read out this portion, and this directly links to what we may actually, and we were discussing this in our program yesterday in the afternoon. It says capacity utilization in manufacturing remains above the long-term average, and private sector order books have shown steady growth. However, these gains could be tempered by global excess capacities in sectors like steel and others, leading to aggressive trade policies in search of demand. Now, and this is not just steel. We've been talking about this steel safeguard duty, which is the industry has been clamoring for. But even for things like, solar wafers, etc. I mean, there are very few things this time around where there are specific expectations, unlike, 10 years back where there would be sector-wise lots of stuff which people would watch out for. But in terms of customs import duties, and because of these excess capacities around the world, could we see that being taken up? I think that is something which we'll just have to watch out for. I don't know if Mr. Garg has a view. It's also complicated because we have, the US administration saying if you keep tariffs high, import duties high, we'll tariff your products when they come into the US. But any thoughts, Mr. Garg, on this?
I think this is a real catch-22 situation. There is a lot of excess capacity in several sectors in the world. You mentioned steel, whether you take EVs, whether you take solar wafers, cells, and many others. So I think there is that real risk is there. We have been trying to sort of put some restriction on this by putting the tariffs high, also to encourage the domestic manufacture. But in the absence of the core technologies, we have not been able to scale up the manufacturing in these areas very much. So how do you deal with it? Your higher tariffs are invites a lot of objection from Trump and America and others. and that strategy also doesn't work. So I think this will present a very difficult policy question for the government. How do you deal with it? In my judgment, I think we should go for lowering the tariff. Also take that other advice which has been there, that invite the Chinese, Vietnamese and others to manufacture in India, open to do business with them, so that manufacture here rather than trying to control through the tariffs. So I think the way to go forward is to reduce tariff and make India a better manufacturing hub.
Okay, I would just like to draw the panel's attention to what the survey is saying on increasing deregulation. And there are several examples there. And it seems the survey is, pinning some responsibility on the states as well, along with the center. In fact, I just want to quote a line in that particular chapter saying, ease of doing business 2.0 should be a state government-led initiative focused on fixing the root causes behind the unease of doing business. And also the survey goes on to sort of, give very specific examples where, this is impacting growth and sort of hurting sentiment. The example here would be current regulations act as binding constraints on growth by increasing the cost of market entry, force-fitting inefficient models for operations and prolonging industrial sickness. For example, factory regulations make it cheaper for a business to run 250 worker factories rather than one 300 worker factory, discouraging economies of scale. So these are the kind of bottlenecks that the survey says that the center and the state governments need to focus on. But the onus is not only on the center. The survey says that states need to focus on ease of doing business.
Actually, the government has brought this point up repeatedly. When you define something as MSME and the benefits are given, then nobody wants to become larger than that number, that threshold. That is repeatedly pointed out. In fact, I would request all of you to get to page 156, which is the deregulation chapter, and there is a table on approach to reform, description and the current status. So the survey points out what has already been pursued in phase 1 of ease of doing business and what may be pursued in phase 2 of ease of doing business. And that's where what Surabhi says, liberalize standards and controls, set legal safeguards for enforcement, reduce tariffs and fees, like minimize or remove the mandated charges for certain utility, for inflating the utility costs. That's exactly what they're inviting the municipalities and the state governments to remove unnecessary charges and fees.
There's an interesting facet here, Lata, and these are all in the 2.0. So the survey has now brought forward the concept of ease of doing business 2.0 and the things that need to be addressed there. And that's what, some of the points that Lata was reading out. It's saying use risk-based regulation, tailor legal norms to the risk profile of businesses and involve third parties in enforcement. These are some of the suggestions that the survey seems to be making.
Instead of giving a one-size-fit-all, you tailor it to the extent of risk that a business faces. Reducing tariffs and fees. For instance, one of the grouses of the central government is the high and erratic stamp duties on land in various states, but the states will tell you, you sit in our position and you know that is the only way to make money. The rest of it is taken away as GST.
I don't know if all of this, right? I mean, gives us a sense that this is going to be if the eco survey, and you ask that question, how relevant is the eco survey in the context of the budget? But if it is relevant, does it look like a guidance type of budget tomorrow? With a laying out what needs to be done rather than a lot of stuff actually in it? Because it's possible. We've had a few of those budgets
Shireen
as
will
well.
get a chance to interview the Chief Economic Advisor and we will have to pose that to him. But I want to again say that the budget did point out that there will be an economic policy framework extending for the next 4 years. And it is quite possible a timetable of deregulation, a timetable of, reduction of tariffs and, cooperation between center and states on various issues, even stamp duty for that matter. Shireen, my sense is that there could be a roadmap since that economic policy framework was promised.
Yes, so we will have to wait to see how much they detail by way of that roadmap. But, Lata, again, as I point out, that all of this boils down to execution. Is this the first time that we've heard somebody within the policy framework and the government talk about the need for deregulation? Is it the first time that we've heard an economic survey also say that, look, we need to unshackle MSMEs? I mean, go back to even his predecessor, KV Subramaniam, and, even before him. I mean, these have been themes that have been talked about in many economic surveys, but the question boils down to execution. And I want to come back to, I think, what will really be the focus and should be the focus as far as the budget is concerned tomorrow, and that comes back to private capex. And here's, again, as I was pointing out, this has been something that the CA has been talking about for a while now, and he's kind of alluding to that once again. Public investment has sustained capital formation in the last several years, even as the private sector has shed its balance sheet blues and begun investing in FY22. Now it has to receive the baton from the public sector and sustain the investment momentum in the economy. The signs are encouraging. Even last year, if you remember the conversations that we had with the then Finance Secretary, Mr. Somanathan, it was very clear. He said, look, there is a limit to how much we can do as far as Capex is concerned. The private sector needs to start and needs to do more. And that's the message that the government is sending out, or at least the economic survey is sending out. Again, Mr. Chakrabarti, would that be one of the big signals that you pick up from the survey, again, that the baton now needs to move to the private sector?
I guess the government's role in building up infrastructure will not completely go away. Let's face it. However, private sector could come in where they are viable. Those assets are to be monetized either through InvITs or through REITs. There are so many other mechanisms, or plain simple privatization. That's one area where private sector can come in, or areas like airports and all, where they are there in big way. However, government's role is likely to be there. What one has not seen over the last post-pandemic period is little capex coming from private sector. Or I would rather use the word not commensurate investment coming through as one thought would come in. Perhaps that was driven by the domestic demand, considering that there were uncertainties globally. They still exist today, and there are a lot of, as one may use the word, predictable unpredictabilities. DeepSeek being the latest one. Therefore, obviously, they would be driven by what kind of demand they are, and our other than few IT or pharmaceutical, most of the other sectors are more constrained by their lookout only on the domestic demand. They also need to hunt demand globally, so that they can create those capacities and bring economies of scale, or be part of GFCs, which is global supply chains. However, one part we see that in GCCs. Global capability centers, which have grown very large, and they are actually a part of a supply chain in a sense. And that's very critical, and that's where the duties play their part, because if the duty is very high, then really the supply, we get out of the supply chains. But it is a chicken and egg situation, and one has to play that very, very deftly as one goes along, so that the dumping doesn't take place and we don't lower our guard. There are geostrategic imperatives which also need to be kept in mind in all these things. Therefore, there is nothing like passing the baton. Both the things operate.
We'll have to work.
And there is a limit to what government can possibly do. But as the GDP grows by investment, both private capital formation as well as the government capital formation, perhaps higher GDP will permit higher investment and a virtuous cycle build.
Yes, that is right. But Mr. Garg, on that question, should we temper expectations in terms of these record numbers that we have been seeing as far as government capex is concerned?
Yes, I do see that very clearly. Number one, the resources available with the government are much smaller than would it be. And but I think government will not let go the USP of the capital expenditure so as yet, and therefore there would be a plus kind of addition to last year's the Capex target. As I said, I see it about 12 trillion rupees or so. So it is not going to go away. But the broader question which we have been discussing about passing the baton or raising the animal spirit in the private sector, I think this question is not handled by only making a lot of exhortations or advice. This have been given for many years, as you have also rightly noted. The government can only influence it by tweaking the policies, whether on tech side or the regulatory side or on the other side. And that is the instrument which should be used rather than the exhortation. So I think that's, otherwise the private sector is not in the business of doing charity. They won't make investment for the sake of investment. Government may make it, but not the private sector. So don't expect the private sector to take the bait of the offered through the advice and exhortation, rather than the real policy change which makes the difference for them.
Yeah, and I just wanted to point out some of the sectors that the economic survey is focusing on. Sectors to transform include travel. Again, this has been a low-hanging fruit that we've been speaking about for years now. Health, recreation services. Remember, we've been talking about this experience economy opening up and what that could potentially mean in terms of having a multiplier impact as far as job creation is concerned. So the survey highlighting that the sectors to transform include travel, health and recreation services, untapped sectors, telecom, insurance and pension. Those are the three that they point out as untapped sectors. The survey also making a note of caution as far as the FDI trade outlook is concerned. India needs a new strategic trade roadmap. Global trade dynamics have shifted significantly from globalization to protectionism. India must reduce trade costs and improve facilitation to boost exports. Industry must continue to invest in quality, also highlighting that it's going to be a challenging environment as far as FDI is concerned. Lata, Prashant, anything more that you wanted to add?
Yeah, well, there is a fairly detailed paragraph on the softening of gross fixed capital formation. You know, one of the reasons why the second quarter numbers saw a dip, the GDP number, was because Capex fell from 10.1% in the first half of FY24 to 6.4% in the first half of FY25. I'm taking both quarters, Q1 and Q2 together. And the survey goes on to argue that this could be temporary. Private sector investment may have remained subdued on account of domestic political timetable. I mean, they were waiting for elections to get over, global uncertainties and overcapacities. But they have reason, I mean, the big paragraph where they point out that we have reason to believe, paragraph 1.40, the slowdown in investment activity is likely to be temporary. Green shoots are visible. The union government Capex is up 8.2% if you took July-November. You know, we all know that if you took April-November, then it is minus 12.5 compared to a year ago. Yeah. But he is pointing out that if you took July-November, it is up 8.2%. That is the Capex spend. Early results of the RBI's order books, that is that Obicus survey they do, order books, inventory and capacity utilization. That shows that manufacturing firms' capacity utilization has reached 74.7. The long-term average is 73.8. So when it goes above the long-term average, people normally invest in fresh capacity. That's the argument they're making. A private sector report's analysis of a sample of capital goods companies indicates order books of these companies have risen by very sharply by 23.6% in FY24, as against a CAGR of 4.5% in the preceding 4 years. So in 4 years, it is 4.5. Of course, those two of them are COVID years. But 23.6 indicates that Capex is on the rise. And then finally, the Reserve Bank's report on private investment showed that investment intentions increased to 2.45 lakh crore for FY25, a study of about 2,500 companies. The year before, it was 1.6 lakh crore. So that, again, is a doubling of Capex. Mr. Chakrabarti, are you convinced? After all, you head a bank, which I think concentrates still on retail. Have you seen any signs of Capex?
No, my bank also does a lot of wholesale work. In fact, it's one of the largest wholesale banks after SBI. That notwithstanding, I am not a great fan of intentions. I would rather see the investment on the ground. If that is so, then wages would also rise because there would be competition for getting more skilled labor in, and that will provide larger employment. Therefore, I like to really smell the coffee when the things are really there. At this stage, yes, perhaps some intentions would come in, but early days.
Early days, and the survey also says that the signs are encouraging of private capex. But here, Lata and gentlemen and Kanika, I think this again, as I've been pointing out, this has been reiterated now by the economic advisor in his public engagements, through his writing and his speeches publicly, and it's now in the survey. Here is the message, the clear, sharp message to corporate India. And I quote, "It is in the enlightened self-interest of the Indian corporate sector swimming in excess profits to take its responsibility to create jobs seriously." I'm repeating that. This is the economic survey. It is the enlightened self-interest of the Indian corporate sector swimming in excess profits to take its responsibility to create jobs seriously. What do you take away from this statement, Mr. Garg? What could it result in terms of policy action, if anything at all?
See, two things. I don't think the government or the chief economic advisor is a better judge of what is in the enlightened self-interest of the private sector. So let it be left to the private sector. How does it think what is best in their enlightened self-interest? Second, I think this statement that they're skimming in very large profits, I think that phase is also over. This year's corporate earnings, if you look at, the profit increase, etc., is down. It has started coming down from the last year. The extraordinary profits which were there in 21-22 and 22-23 are now looking like a distant past. So I don't think we can base, or the government can base, an advice for investment based on a very high degree of corporate profitability.
But does this also signal, and I'll get Mr. Chakrabarti and Kanika to comment on this, does this also signal that we must temper expectations then on any further big bang incentives or any incentives to aid private capex, to aid corporates at this point in time? Would that be the broad read, the broad understanding? Kanika, let me start by asking you.
Sure, thanks, Shri. So actually, I will go with what Mr. Garg talked about. A moral suasion doesn't work with the private sector, even if the CA has been asserting the same time and again. But then 3 points in my view. First, maybe what we can look for in this budget is anything for labor-intensive sectors. So maybe another PLI scheme or an investment incentive, because the private sector, yes, the large corporate houses have really gained, but the labor-intensive sectors are yet to show up that capacity utilization of 74-75% that the CA may be talking about. So maybe something to push the private sector towards, specifically towards labor intensity of manufacturing sector, that becomes very important at this juncture. Second point, as you rightly pointed out, last time round as well, they had given a number that listed companies are giving, are showing in FY24, 8.5 lakh crores of total capex, 20% YOY, but it's all very K-shaped recovery. It's all led by mainly sectors like, power, auto, iron and steel, maybe cement somewhere, some refineries here and there. But broad basing of private capex recovery is what I would personally want to understand from the economic survey and the budget tomorrow. Last but not the least, as everybody has been pointing out, at the core of the issue is weak demand, which is impeding that broad-based private capex recovery. So what is it that the government wants to do to reinvigorate that demand engine in the economy to facilitate the private sector to start investing and start oiling the economy via tax cuts, maybe more transfers, maybe labor-intensive sectors, jobs. But this is the core area I would want to understand from the budget tomorrow. Thanks.
Yes, we will all want to understand what the budget has to say on demand creation and, of course, on some of those key numbers and how much of the intention and the sentiment that the economic survey is putting forward by way of prescription translates into policy action. But we will say thank you to our budget editor, Atanu Chakrabarti. He'll, of course, be with us bright and early tomorrow morning right here on CNBC-TV18 as we decode the budget numbers live, as we always do. Many thanks to Subhash Chandra Garg as well as to Kanika for joining us here on CNBC-TV18 to take stock of the economic survey and the messages that it sends out. We'll see you again as the budget numbers are revealed. But we will take a quick break. Don't go anywhere. We're back in a moment with more. Stay tuned to CNBC-TV18. We're decoding the economic survey. We're talking about the budget and, of course, the markets. Back in a moment.
Who knows?
Well, here's a fallout of the DeepSeek phenomena. The Indian IT Minister Ashwini Vaishnav making the big announcement that the Chinese large language open source model DeepSeek will be brought to Indian servers, will be brought to Indian shores so that it becomes available to Indian users. Sounds simple? Well, not quite. A lot of jargon there. What does it actually mean? Let's help you break this down to understand what really has transpired with this announcement being coming from Ashwini Vaishnav. Now, let's assume, and I'll explain that with the help of an analogy, the analogy of the humble tea, the common denominator between 2.8 billion Indian and Chinese. Now, let's assume that DeepSeek is this Chinese tea in this cup of tea. Now, what's important is that this is an open source AI model. What that effectively means is that the core code, which is the heart of the model, which is the recipe of the Chinese tea, is publicly available. So what the Indian government is proposing is that we'll use this recipe of the Chinese tea and replicate it here on Indian shores, on Indian servers, and have exactly the same model here present in India for Indian users. But that's not all. Let's bear in mind, we like our masala chai, like most things in life, we like a little tadka in our life. So we'll add a little input to this. We'll add some components. We'll add some sugar. We like some sugar in our tea. We'll definitely add some ginger. We like ginger as well. And let's not forget the milk in the Indian tea. And having done that, we'll come to the finished product, which of course is a humble masala chai, is a humble cutting chai. So why are we doing all of this? Why is Ashwini Vaishnav doing all of this? Well, the long and short is, number one, let's not forget the obvious out of the way, which is the masala chai tastes a lot better. But having addressed with the obvious, the other two key components why the Indian government is doing is number one, all the components that we added, the sugar, the ginger, the milk, what that essentially represents are tweaks that Indian engineers will be able to do on Indian servers to this DeepSeek model. Now, why would we want to do that? Well, let's bear in mind there were niggles with DeepSeek when it initially came out. It wouldn't accurately answer questions about, say, the 1962 war or the status of Arunachal Pradesh. So this masala chai, with all these components, represents tweaks that the Indian engineers will be able to do on the Indian servers so that it becomes slightly more comprehensive. But the second and perhaps a larger concern that the government has is that the government doesn't want you sipping tea from the Chinese cup of tea, as that will leave your imprint, and by your imprint I mean your data with the Chinese servers. What the Indian government is essentially saying, let it come here and have a cup of tea from the Indian cup of tea, the Indian server, so that your imprint, your data stays safe within Indian shores. So this chai pe chacha is the long and short of why the Indian government is bringing DeepSeek on Indian servers to Indian shores.
इसके लागू होने से प्रदेश में सच्चे अर्थों में सशक्तिकरण भी होगा, सुरक्षा भी होगी। इसके द्वारा जो कुछ कुरीतियां हैं, अब हलाला, इद्दत, बहु विवाह, बाल विवाह, 3 तलाक आदि जो कुप्रथाएं हैं, उन पर पूरी तरह से रोक लगाई जा सकेगी।
Final 2 hours of this trading week. I wish I could have said that, but we have a market that is functioning in tomorrow's session as well. You're watching Midcap Radar on CNBC-TV18. I'm Hormuz Fatakia, with me Vivek Iyer, and the markets are going into the budget day with full gusto, 1% higher on the index. And the broader markets too doing fairly well for themselves as well. But we can't not take stock of results, with Marico's numbers flashing on your screen. Revenues at around 2794 crore, in line with expectations of around 2750 crore. The EBITDA also up 4% on a year-on-year basis, a 533 crore figure compared to 513 last year. Also in line with expectations. The margins though have seen some bit of pressure, almost 300 basis points, almost 200 basis points lower on a year-on-year basis, and the stock taking a bit of a knock from the highs of the day. It will be interesting to see how the margin figure pans out compared to the estimates. The net profit is absolutely in line with the expectations, so not a very earth-shattering number from Marico, but in line with expectations, but some margin pressure.
Well, if you recall, the company, along with the other FMCG companies, had actually given out an FY20, Q3 FY25 update. So the company had said that the domestic business, on a sequential basis, had seen some growth as far as the underlying volumes are concerned. Along with that, they did mention that higher than expected inflation in copra, which is the key raw material, as well as vegetable oils, was something that impacted gross margins. So going into Q3 results, the gross margin, the EBITDA margin expectation that we had was close to 19.4%. The calculated EBITDA margin that you can see at the bottom of your screen indicates margins of close to 19.1%. So that's a miss, and that is something that the street will look forward to. What else are we looking forward to? The volume growth numbers. So the domestic volume growth trend expected in the range of 4 to 5%. If that comes in line or is a beat, then the results will be viewed favorably. Otherwise, Marico would be seen as a bit of a miss, but other than that, the headline numbers bang in line with what the street was anticipating. Not only that, we also saw Jyoti Labs, they also came out with the numbers. Hormuz was just telling me that
the margins were a bit of margins were under pressure for Jyoti Laboratories as well, and that too has seen a bit of pressure on the stock. There you can see at the lowest point of the day now is Jyoti Laboratories. So we keep an eye out on the investor presentation from Marico. We'll get the volume growth number in just a bit. But getting on to earnings conversations, then Mass Financial is the management that's joining us on the show. Mr. Kamlesh Gandhi, who is the chairman and managing director of the company, is joining us. Mr. Gandhi, good afternoon. Thank you for joining in. I'd like to start off with your disbursals. They were very strong this quarter. Do you see this trend persisting into the fourth quarter and going into FY26 as well? If you could give us a growth target that you have.
You could say that we could register an 18% growth on business land and around 20% growth in our AUM. Usually, we always have a strategic intent to grow our book AUM anywhere between 20 to 25%. And in times like this, it was on the lower end of the spectrum at around 20 to 21%, while maintaining the profitability at around 25%. And very importantly, maintaining the quality of assets at around 1.6% of as net NPL of our area. And going ahead, we are confident that we'll be in a position to maintain a growth trajectory anywhere between 20 to 25%. But having said that, we always believe in discovering growth rather than just determining growth. We will see the market situation from time to time and then plan our strategies accordingly. But as I say right now, we see no reason why we should not be in a position to register anywhere between 20 to 25%.
Mr. Gandhi, thank you so much for that. Also need a couple of numbers from you. In terms of the net interest margin, sequentially, we understand there's been a bit of a dip. So do you see that recovering in Q4? Also, post-rate cut, how do margins trend? And along with that, could you give us some guidance as far as asset quality and credit costs are concerned?
So, historically, we have been in a position to maintain anywhere between 6.8 to 7.1% of NIM this year. This one also is close to around 7% of the interest margin is concerned. The credit cost hovers at around 1%, between 0.95% to 1.10, 1.15%. That we hope to continue at the same level. And having said that, this will leave us with an ROA of anywhere between 2.8 to 3%. And we are confident that they should continue. On the question of reduction in interest rate, when it really percolates down and when the transmission happens, it definitely benefit us. But it takes time because majority of our borrowing is MCLR bill. So whenever there is an MCLR reset, we will get the advantage of this.
Mr. Gandhi, what about the MFI space? Where this has been one sector that has been under a lot of stress in recent times. How much is MFI as part of your overall book, the microfinance space, and how much for how much longer do you expect this pain to continue? What are you witnessing on ground currently?
We have been very circumspect dealing with MFI since more than one and a half year, given the operational realities. So currently, as I talk to you, our exposure on MFI is less than 5%, and that too is behaving very nicely. We have been very selective on the NBFCs whom we have worked with or whom we have left. And coming at the ground level, in reality, I think MFIs are loans either between 18 to 24 months. So we have seen the pains we have seen last 2 or 3 quarters, and I think that things should stabilize given the new operational practice on the ground level of extending back and the price which is due, extending credit where it is due, and aggressive collections. Given that reality, I think within the next 2 quarters we should see stability, and then we can think about distant growth.
Mr. Gandhi, one last question. You had given us a couple of guidances last time around, 20 to 25% growth guidance. Will you meet that in FY25? You had given us a GNPA guidance in the range of 2.25 to 2.5. Do you continue to maintain that? Fresh FY26 targets, if you've unveiled them, could you help us with that particular number as well?
We are already 9 months through this year, and we have registered a 21% growth, and we are confident that we will be anywhere between 20 to 22% growth for FY25. For FY26, difficult to give the exact numbers, but the trajectory will be between 20 to 25%, and as I shared earlier, depends upon the situation that unfolds from time to time. Because of the Banking Institute, we have an horizontal presence across sectors and geographies. So we have to take this decision from time to time, depending upon the quality of the portfolio. But as I see right now, 25-26 will also see a decent growth of anywhere between 20 to 25%.
Last time around, you had also told us that direct distribution growth for you will grow at a much faster pace compared to indirect distribution. So how's the on-ground distribution? How's the on-ground disbursement? And are you facing any issues in terms of collection?
We are expanding our distribution to our geographies. Right now, we work in 9 states. We have 100 branches. We are adding the branches regularly. Currently, we have more than 40,000 pin codes being served, which was around 12,000 a quarter ago. So we are continuously endeavoring to increase our direct distribution to our direct reach, whereas our distribution through NBFC is also going solid, and it has yielded very favorable results for a company in the last 15 years. That was a model we introduced in 2011.
Right.
That is working nicely. So the direct distribution will grow at a faster pace as that continues, and with our expansion of branches and more customers.
Right. All right, Mr. Gandhi, thank you so much for sparing time joining us today. Wish you good luck for the road ahead as well, the management of Mass Financial. But the stock over the last 10 minutes has been Marico. The whipsaw that you've seen on the stock and the recovery from the intraday lows is courtesy the flash that you can see on your screen. The domestic volume growth at 6% compared to the CNBC-TV18 poll of a 4 to 5% increase. So volume growth beating expectations. Margins have been under pressure, but I guess the volume growth figure will give the street some heart from where the number has come from, and you can see the recovery as well from the lows of the day. Back in the green is Marico, the domestic volume growth of 6% compared to a poll of a 4 to 5% rise. But with that, it's a wrap on this. That's a wrap on this edition of Midcap Radar. From Vivek, me and the team that put this show together, thank you so much for watching. Your stocks on the other side.
set to create history as the first woman finance minister to present her 8th consecutive union budget. From replacing the colonial-era briefcase with the Bahi Khata to delivering the longest budget speech in history, her tenure has been marked by milestones and transformative policies that have shaped the nation's economic journey. Her maiden budget speech in 2019 set the tone for bold reforms, and she has since introduced several initiatives that left lasting impact on India's economic policy. Let's dive into the landmark schemes and key tax reforms introduced under her leadership. Now, Sitharaman's budgets have introduced numerous initiatives aimed at driving inclusive growth, like the PM Suryodaya Yojana in 2021. Announced in the budget 2021-22, this initiative aimed to provide solar energy to villages that lacked grid connectivity. It was a step towards clean and sustainable energy, empowering rural communities while promoting renewable energy adoption. The Credit Guarantee Scheme for MSMEs was another such scheme. Revamped in budget 2024-25, this scheme provides collateral-free loans with a guarantee cover up to 100 crore rupees, addressing financing challenges faced by MSMEs. PM Vishwakarma Yojana is another such scheme. Announced in the budget 23-24, this initiative supports artisans and craftspeople with collateral-free credit up to 2 lakh rupees, toolkit initiatives, skill training and marketing assistance, helping preserve traditional crafts. The Vivad Se Vishwas scheme is another such milestone. Launched to resolve pending tax disputes, this scheme offers taxpayers a chance to settle cases by paying only tax amount with penalties and interest waived. PM Gati Shakti Master Plan in 2021. Now, a 100 lakh crore initiative focused on integrated infrastructure development, enhancing connectivity and reducing logistic costs. The Atmanirbhar packages in 2020 during the COVID-19 pandemic. A range of measures supporting MSMEs and businesses were introduced under this initiative during the pandemic, emphasizing self-reliance and domestic manufacturing. Now, the tax reforms on the taxation front have also been big. Sitharaman's budgets have implemented sweeping reforms to streamline the system and enhance fairness. Like the corporate tax reduction in 2019, the corporate tax rates were slashed to 22% for existing companies and 15% for new manufacturing firms, making India an attractive destination for global investments. The optional personal tax regime, or the new tax regime in 2020, a simplified system with lower tax rates but no exemptions was introduced, giving taxpayers the flexibility to choose between the old and the new regimes. Another such initiative was the capital gains reform of 2023. The government removed the indexation benefit from the debt mutual funds, bringing all asset classes, including equities, debt funds and fixed deposits, under the same tax regime. While this reform created parity in taxation,
Well, we are counting down to the union budget. The economic survey has been tabled. We've, of course, been analysing what the survey has to say. And as I've been pointing out, the theme running through the economic survey is deregulation. Get the government out of the way. That is what the survey is highlighting. And of course, it does have some focus areas that it believes the government ought to put its bandwidth behind. But of course, the message to the private sector is you need to pick up the baton from the government as far as investing is concerned and start to do the heavy lifting on investments. How much of all of this will translate into policy action and policy decisions, we'll know tomorrow. The growth number, of course, as we've been pointing out, rooted in reality between 6.3 to 6.8%. Ratin Roy, Distinguished Professor at the Kautilya School of Public Policy, with us, also one of CNBC-TV18's budget editors this year. Ratin, great to have you join us on the program. Also with us, Anish Shah, the former president of FICCI and president and group CEO, managing director of Mahindra Group, and Surjit Bhalla, the former ED to the IMF. Gentlemen, appreciate you joining us. Ratin, first takeaway from the economic survey and the messages it's sending out.
Well, there's nothing wrong with the messages. I think everyone would agree that the growth forecast is reasonable, that the chief economic advisor, this particular one, is an honest man. And he has been honest about the maximum possibilities implied in the next year. Everyone knows, following the Trump election, that the external front is going to be likely rocky and India will have to navigate it carefully. Everyone knows that agriculture has far too high an increasing share in GDP, and manufacturing has a lower share in GDP than we would like. It's the lowest in my lifetime. So I think in terms of his message of government getting out of the way, as a truism, I have no disagreement. The ED should get out of the way, and no doubt Surjit Bhalla's deep state should get out of the way. So I think it's quite an unexceptional economic survey. There isn't much economics in it, frankly, but that's okay. That's okay. This is not an economics-oriented government. And therefore, the political and economy messages, I think, are both clear and honest and modest. And the sort of overall aphorisms that are contained in the survey about what's happening in the world and what's happening in India are not easy to disagree with, very difficult to disagree with. So it's a good survey. And what I like about this survey is it's not this last 10 years, at least since 2017, we had these sort of flash bang economic surveys which pretend to have a theme and a focus and that sort of thing. This is what an economic survey traditionally was. It's very good geography. It's very astute. It provides a 360-degree view of the Indian economy and the rest of the world. I think that's a very good thing. I like this survey.
Yes, the survey highlighting, of course, what has happened across each of those sectors, from manufacturing to infrastructure to the PLI schemes, etc. Let me bring Anisha into the conversation as well. Anish, as I was pointing out, the message to the private sector is you are swimming in excess profits. In the words of the economic advisor, those are not my words. And it is time now for the private sector to do more on job creation, Anisha. In light of what the survey is suggesting, what's the expectation that you go into for the budget?
So Shireen, good afternoon. I will start with a direct response from a private sector standpoint. The Mahindra Group has tripled capacity in auto for the last 3 years and has added 60% more capacity for tractors and is investing significantly in multiple areas. So we see a lot of optimism in India. We see the fundamentals very strong for growth in India. And the survey is essentially taking that forward. In fact, there's a lot of optimism. We see PMI up for literally 14 quarters in a row. And there are a number of other indicators that are positive as well. Yes, growth is at 6.3 to 6.8%, a little lower than what we'd like. But we will continue to see some blips along the road. But overall, the India story is a very strong one. Specifics in the survey that we think are very positive are first around farm and the fact that the agri-produce will likely be better. Second, the focus on productivity. That's a critical thing from an India Inc. standpoint. And third, specifically what you have on the screen up there around deregulation, but more importantly, reducing the cost of manufacturing. That is going to make India the manufacturing hub. We have a number of ingredients in place to be able to make that happen. And with greater focus and emphasis on ease of doing business and on deregulation, that will help us reduce cost along with other measures that need to be taken and some aspect of demand stimulation. So I think these are all the factors that really put us on the right path, and we feel good about where we are.
Well, you're going into the budget feeling good about where you are. So let me ask you about what the hope now is as we count down to the budget 24 hours away. In light of what the survey is saying, what's the expectation on Capex? Of course, it has been a record number that we've seen over the last few years. Do you anticipate a significant increase, or do you believe that it's likely to be around the similar number that we saw last time around? And demand stimulation, what's the expectation outside of Capex on demand stimulation, Anish?
So first, we would say stay the course on Capex. That's been a plus in the budgets over the last few years, which is a focus on the multiplier effect that Capex brings in and the positivity from an economy standpoint on that front. The second is there is clearly a need for some demand stimulation because we see weakness in the middle and the lower segments, and that's something that needs to be addressed in a pinpoint manner for them. One potential way to do it that also links in with simplicity is to simplify the tax code and potentially have a stimulus again for the lower and the mid segments of society that will hopefully get us stronger demand. And these are the main things that we would look at. Yes, there may be a few others, but these are the primary ones.
Yes, I think the focus on Capex, the hope is that that will continue, and the assumption is that that will in fact continue. What can the government do in terms of providing tax relief is the big question. Will this be the budget that finally addresses the middle class by way of tax relief? The hope is building on that front. Whether we'll see a slab rejig is the big question. But let me welcome Surjit Bhalla to the conversation as well. Surjit Bhalla, many thanks for joining us. Your big read from the economic survey, but more importantly, what you believe it could perhaps signal the budget will take forward.
The big read from the economic survey is that we've got a very strong inclusive growth. We don't have high growth. That is very clear from the survey, expecting only about 6% or so, 6.3% next year, of this year. But, you know, the inclusive growth numbers are very, very impressive. Whether you look at what has happened to consumption growth across the sectors, and they cite the survey, the latest 23-24 survey. So agricultural growth is very, very strong. And actually, this is a big story that I think is underemphasized. We used to have agricultural growth for the last 55, 60 years at somewhere around 3%. And now we have graduated upwards to about 5% agricultural growth. So that's the good news in the economic survey that I see. There are some not necessarily good news, but something I don't understand. And Shireen, you pointed this out about expecting job growth to come from that. What is it? Give me the exact quote that the government has to
enlightened.
Do something.
No,
Yeah.
it's in the enlightened self-interest of the private sector.
You know, I think we should discuss that a bit more. Look, I've just stated that I think there's a lot of inclusive growth, and I think there are very robust numbers to suggest that. But I haven't, you know, it's got to be the very definition of socialism, right? That it is in your enlightened self-interest to give a higher wage. I just do not understand that statement. Second, I think the government, or the economic survey rather, is not reading the data. They present data on very high growth in employment, which I think is very positive, part of inclusive growth. But, you know, they want to circumvent also the conclusion that real wages have not risen to a very strong extent. There has been a very solid growth in the real wages of the casual workers. But the salaried workers, which are basically the middle class, there has been almost zero real growth in real wages. So this is the problem. And, you know, why don't they connect the two? If I were to try and make some sense out of this, you've got a big expansion in supply. That supply is being accommodated by the market, but it is being accommodated, as Econ 101 would suggest, by not much rise in real wages. That's the story. So enlightened self-interest won't do anything, and I don't expect anybody to really work in the enlightened self-interest. Everybody is working towards maximizing, you know, it's age-old stuff, maximizing their utility, maximizing their profits, etc. Let that be. That is the state of the world. That is the state of the economy. So let's not bring in these other weird notions of enlightened self-interest.
So very quickly, Surjit Bhalla, do you expect tax cuts for the middle class tomorrow, you know, to the point that Anish was making in terms of stimulating demand?
Absolutely. You know, I think it's absolutely necessary, given the results that I have just talked about, and I have written about it, will be writing about it, that I think it's it's an absolute necessity for them to have significant tax cuts across the board. Real wages have not increased for the salaried middle class. And, both for political reasons, and, it's good politics to have, if you will, satisfy or accede to the interests of the middle class. Middle class, it used to be the case that most of India was poor. So therefore we do policies in the name of the poor. I think now most of the population is middle class, and therefore our policies should be in the name of the middle class. One such policy, and a very important one, is to boost up their real disposable income. A growth in real disposable income is needed, and that can only be done by having a significant tax cut.
A significant tax cut, that's the call there coming in from Surjit Bhalla. Ratin, again, and I'm trying to link what the survey is sending out by way of messages saying, look, it's going to be a difficult external environment. FDI is going to be challenging given the move towards greater protectionism. In this context, do you believe that there's likely to be any preemptive move that we could take to try and encourage more FDI to come in, but also more domestic private investment to pick up?
Well, I don't know about domestic private investment because, your interlocutor from the private sector is saying both things at the same time. He's saying that, the private investment has doubled and tripled, at least for the Mahindra Group. That is so of the whole economy, then why bother? And he's also saying, of course, that demand is somewhat muted in the lower areas. So I don't think that private investment will come in, and here I agree with Surjit, in their visualized self-interest. Enlightened self-interest is something I was not taught in school, much like implicit growth. But visualized self-interest is that the private sector can see a pathway where if they increase investment, they're going to make more money. Then they will invest. At the moment, they're not seeing that. And they're not seeing that for a variety of reasons. But I don't think, and one of the reasons obviously is that the growth engine of the top 10 to 15% of the population has maxed out, what people are pleased to call the middle class. It's a bit absurd because don't forget, people start paying personal income tax in this country at 3.5 times the per capita income. In any other G20 country, it starts at, even Indonesia, the second poorest, slightly above the per capita income. So if you're earning 3.5 times the per capita income and only then you begin to pay tax, then I'd submit the solution is that people should earn a little more at lower levels of per capita income, which requires a higher per capita income and perhaps a more egalitarian distribution of income. And that would give you the demand boost that people are looking for. But, you can't do that in one economic survey. That's a structural issue. When it comes to navigating the globe, I think India has been fairly adept at it. I'm a bit puzzled at recent events in the exchange rate, but maybe that's a blip. But otherwise, India has maintained a fairly non-volatile exchange rate that has been fairly realistic in terms of, the fact that we do run a current account deficit. Therefore, it must depreciate, but the depreciation has both been orderly and well calibrated through the taper tantrum. So macroeconomic management has been okay. The fiscal deficit has been going down fairly steadily post-COVID. And as for the rest, the state of the Indian economy is not one that is going to be, sort of adversely affected by most headwinds, except perhaps if we get into a battle on tariff. But that's not been spoken of in the economic survey. But I do trust that this administration will handle the Trump administration skillfully and avoid that pitfall or danger. Because one of the few countries in the world with whom we do run a balance of payments surplus is the United States. Very unfortunate if that changed. Our attempts to sort of lower our trade deficit with China have obviously not succeeded for the very good reason, again, that China is one of the cheapest manufacturers in the world. So navigating headwinds and being honest that external headwinds is good. I would have liked to see a little more honesty about the structural problems the Indian economy is facing, but then one can't expect that to come in an economic survey. So I think he's gone as far as he can with his messages that the private sector is not doing enough, and we need to investigate why, and the private sector also needs to be a little more honest and a little less public relations. about what exactly ails them from investing more in the economy, and also not celebrate, and he has not done this, the growth in agriculture and the decline in manufacturing, suddenly overnight, as if we have found some new miracle way to attain Viksit Bharat or whatever it is called. 6% growth is 6% growth. It is highly unsatisfactory. It's the growth I see. If there is, like Surjit's implicit growth and Surjit's deep state, something I do not see, then that is speculative, and it's quite right that the economic survey did not speculate on it.
Yeah, Anish, I know you have a board meeting, so I'm going to let you go with a final comment. You know, that really has to do with tying in everything that we've spoken about. But you know, specifically from a global standpoint, the threat of tariffs, we don't know what the Trump administration is going to do. We will perhaps find out on the day of the budget itself. But, you know, any preemptive action that you anticipate on that front? There is, of course, a customs duty overhaul that's also expected.
Shireen, we've seen uncertainty in a very significant way over the last few years. And the one positive we see with the Trump administration is that they're very focused on the economy and they're very focused on growth. And that, in my view, augurs well for India. So at this point, no preemptive actions required on that front. And we will deal with the uncertainty as it comes with, as we have so far.
Yes, and we will, of course, have to wait to see what action the Trump administration does take. Anish, many thanks for joining us. Appreciate you taking time out of a board meeting to join us here on CNBC-TV18. But Surjit, I want to come back to you. And again, you know, this is a theme that is, in a way, making its way back into the survey. It was there in different ways last time around as well. The survey is saying one critical risk to guard against is the dominance of the financial markets in shaping policy and macroeconomic outcomes, a phenomena known as financialization. Last time around as well, this was a cautionary message of the survey, but more in the context of the move towards the markets and F&O and so on and so forth. What do you take away from this?
Well, I'd rather, you know, first comment on deregulation, which is the dominant part, as you're saying, in the economic survey, that we need deregulation. Absolutely. I don't think that's has the good housekeeping seal of everybody's, that we need deregulation. But then I was a little bit worried when you look at FDI, and FDI has really declined. They really don't have a version of understanding of what is causing FDI to go down. And that's contradictory to their emphasis on deregulation. FDI is heavily deregulated, heavily regulated, and through the bilateral investment treaties that we have now engineered over the last 7-8 years, a new form of treaty of FDI, where when the FDI comes in, it will only be arbitrated by an Indian judge, rather than whenever they have a disagreement, which happens often, I guess. But previously, and around the world, the policy is that, look, when there's disagreement between the foreign investor and the domestic investor, this is not portfolio, this is FDI, then you go to a third country judge. The new policy, starting in 2015, and which is really beginning to bite now because all the old bilateral investment treaties are pretty much gone, is that when there's a disagreement, you will go to an Indian judge. And that is why the foreigners, the investors, foreign investors in India have voted with their feet. They are not bringing in any more FDI, which means technology is not there, and which really is hurting. So this is a huge regulation that the government has brought in, unlike any other country I know. Now, it makes sense if the U.S. were to say that, look, we'll go to the U.S. courts. It makes sense if a lot of the European courts say that, look, we will go to our courts, because there is universal trust in their courts. There is no universal trust in most courts of most developing countries. So therefore, to bring in that we will be, arbitrated by an Indian judge, I think, and it's just a one stroke of the pen that they have to do, and boom, we will get deregulation, we will get foreign investment, we will get growth, and we don't have to appeal to enlightened self-interest to get growth for it.
Well, we'll have to see whether the stroke of the pen is exercised tomorrow or not. But, Rathin, you've been poring over the budget numbers as they currently stand. So I'm going to ask you to put together what you believe is the space that the government may have to do what the Prime Minister suggested this morning as he addressed the media outside Parliament. And I'm quoting the Prime Minister, "Ma Lakshmi ki kripa garibo aur madhyam varg par bani rahe." This was part of his opening remarks. So given the space that the government has to play with, what does the cushion look like, and what would you expect the government to prioritize?
The government has never lacked space. What it has lacked is the ability to execute well. People seem to have forgotten. I don't know, I'm sure they've forgotten. No one ever remembers an economic survey the next day. Last year's economic survey focused on state capacity. And let me give you one example of a place where there was plenty of space, but the government's muddy thinking across 11 years now has resulted in that space not being utilized, and that is disinvestment. I mean, I agree with Surjit about a lot of what he said about court jurisdiction. But in addition, how can you take a government that has a target of 2 lakh crores for disinvestment and ends up with 20,000 crores disinvestment seriously? Even the government didn't take it seriously, and therefore has now moderated its targets. And even those vastly moderated targets in the sort of 50,000, crore range, they don't achieve. So there's plenty of fiscal space if you want and are able to find it. Now the question is, what will you spend it on? And I don't do this Mahalakshmi kind of cringe stuff, but let us assume that. But you do have a choice given the demands of fiscal prudence. You can either increase capex, or you can do whatever he said, prepare on the middle class and cut taxes and cut, have expenditures on the poor and cut the subsidies of 800 billion you give. That would be a cruel thing to do, given the fact that in my lifetime, and post-COVID especially, I'm seeing the highest number of people back in rural areas that any country has seen. Normally, you see people leaving rural areas for urban areas. That actually number has increased. Obviously, there's a lot of distress in the country, and the government quite correctly has responded to that distress. So I think let me put a good spin on what the Prime Minister said. The Prime Minister, I think, is cautioning against too much mollycoddling of people who earn 4 times the per capita income. I think he's pointing out that a lot of people are not that fortunate, and therefore those people must necessarily get priority. And that priority is what the government should give to its fiscal space. And of course, I hope he's saying what he did not say, if he used the word implicit, that there is a lot of fiscal space that the government could get, but through a combination of incompetence, indifference, and inaction, it is not getting. And that fiscal space could be put to good use then in widening the scope, not to have to make these unpleasant trade-offs. That's how to implement this comment as a benevolent comment from the Prime Minister, if indeed it was intended to be so.
Well, disinvestment, of course, there is not even tempered expectations on that front. In fact, what we are now starting to see is the government is infusing capital to revive PSUs at this point in time. 6 PSUs like RINL put more money into MTNL because there is a view within government, and the financial services side certainly believes that the banks should not be left with having to deal with haircuts on account of what happens on the PSUs, and privatization, of course, off the table for what it's worth at this point in time. But Surjit Bhalla and Rathin Roy, appreciate you joining us here this afternoon to take us through the economic survey. Yeah, you wanted to make a point?
Yeah.
Rathin?
Yeah. Very quickly.
And Surjit, okay, very quickly.
Yeah, the best
yes,
way
Surjit, go ahead.
Public sector not to get haircuts is to sell it to the private sector as soon as possible. And in a situation, I would rather worry about Anil Ambani's haircuts than the public sector's haircut. That's the only long-term structural solution.
Surjit.
Yeah. You must have covered this in the early part of this. and perhaps tomorrow we can discuss, what is this preoccupation with the fiscal deficit? Second, I suggest that you should ask the various industrialists that come to your program as to what they think about FDI policy and about the BITS policy being banned. I think that can get into a very constructive dialogue between the interest groups that are involved in the making of what I think is a policy that I do not understand at all. Also on fiscal deficit, the preoccupation with the fiscal deficit, I really do not understand.
Well, we have many economists debating and arguing that, and of course 4.5% is the fiscal deficit target that's been outlined by the government, and the expectation is that they will stick to that and of course provide the glide path for the year ahead as well. Surjit Bhalla, Ratin Roy, always a pleasure. Many thanks for joining us. See you tomorrow bright and early on budget day as we pore over the numbers and see what direction the government finally decides to take. Lots happening in the markets. We're back in a moment with Closing Bell. Stay with us.
Drew mixed reactions as it increased the tax burden on long-term equity investments. The abolition of angel tax was another such initiative for all classes of investors. In 2024, in the budget of 24-25, Sitharaman proposed abolition of the controversial angel tax for all categories of investors. This move was expected to bolster the Indian startup ecosystem, boost entrepreneurial spirit and foster innovation across sectors. Now, Nirmala Sitharaman's budgets have been a mix of bold reforms and targeted policies, be it support for MSMEs, sustainable energy or comprehensive tax reforms. As she gears up to present her 8th budget, expectations are high for announcement that she will steer India's next phase of growth.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters team?
A bit of a muted opening that's come in for the South Korean markets.
The Nifty has basically had 3 days of positive close. Yesterday, we hit the 20-day moving average and then basically gave up some gains.
The execution has been quite strong. Core margins continue to remain quite unhealthy at this point of time.
Midcap index is up about a quarter.
I don't consider Zomato as a discretionary stock.
We are not playing for this month or this quarter. We're building a FMCG powerhouse of the future.
As far as direct tax is concerned,
which would be people earning between 5 lakhs and 25 lakhs in my view.
और ये हर देशवासी के लिए सर्वाधिक गौरवपूर्ण है.
Outperformance seen in the Midcap Index today. The Midcap Index has turned positive on a week-to-date basis.
It has been a much talked about area wherein it is expected by the industry that there will be tariff revisions in some areas.
Numbers broadly appear in line, but of course the expectations were very, very muted.
Not sure whether we're likely to see a slip on the fiscal deficit number that's already been articulated.
I don't see any other measure coming on the bank deposits front.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Good afternoon. That's the day so far, and it's been a good day. And actually, so far, it's been a good week. I don't want to jinx it because the week is not over. Tomorrow is the big day. But ahead of that, the bulls seem to be going into the event with faith and with positioning. And you're seeing that in the kind of stocks that are rising higher. But the good news is that the market, Nigel, has come to the top end of the trading range that we've seen for the last 10 odd days. I mean, 20th of January, we were around these levels. And we're back there.
Well, that's right. And it's the start of a new series, right? So and history suggests that when the FIs are net short by close to around 89%, not to say they can't go higher than that, but history suggests when they've been at 89%, then we normally see a bounce. It happened in October 2023. You know, in November 2023, in that series, the Nifty went up by close to around 6.5%. A lot went on there. The ruling BJP did very, very well in the state elections. The Fed as well sounded more dovish. But who's to say that we can't see an encore? So let's see how that goes. But today's the last day of January, and there's another data point that this will be the 4th straight month that the Nifty will end in the red. And that's the first time that it's happened in more than 20 years. So that's another data point.
Well, looking to break the jinx, and can, this week provide that? Can tomorrow really provide that? That's what it's all about. And you can see that build up in the market. Also, so what's moving higher? There's a fair amount of a consumption play in the market today on FMCG stocks, which has also been aided by, to be fair, with good numbers coming in. Nestle really pleased the street. Marico's numbers are also not bad. The volume growth for both Nestle and Marico is slightly higher than the street's extremely muted expectations. Nestle just sort of took off to the races immediately after those numbers came in. And then let's not take our eye off the entire PSU basket, CPSEs. Once again, your railway stocks are, pushing higher. Your economy-facing government-owned stocks, they're pushing higher. So if I just sort of name a couple of them, as a sense, look at Ircon. Ircon also won a, JV order. That's another reason why the stock is up. But look at NBCC. Again, NBCC, frankly, there's another reason because of the fact that it's getting added in F&O. But the broad point is look at RVNL, look at Texmaco Rail, look at Hoodco, look at Railtel, look at BHA, look at NHPC, BEL. These are your budget stocks with the hope that Capex is coming back. And to add to this, today we've got some decent earnings reactions also coming in. So just to quickly name a couple of them. Naveen Fluoro, Nestle, I've already mentioned. Kalyan Jewellers is interesting. It's earnings plus sort of some action happening at the board level, which we'll talk about later. But these have been the big movers. I think JSPL is the only real disappointment on earnings today. And Nigel will tell us why in just a bit. But I guess all things put together, Nigel, not looking too bad, at least as of now.
Well, that's right. And JSPL, in fact, has come off closer around 7% from the low point of the day. It's not so much the earnings, the grey area with regard to why they're doing such a big Capex. That's the fear. I'm trying to get the management to clarify. Reached out to the company as well. So let's hope they put some clarity on board. But otherwise, they're just spoiling their own party, going ahead and, in fact, increasing capacity from 9 to 15 million tons. And suddenly you announce this big Capex. They'll have to come out with some rationale to cool off the market, because otherwise the cheapest stock in the among the private miners. So we'll have to see whether or not there is some support at lower levels, and that's precisely. I think the low of the day was 730. From there, it's up closer around 8-9% or thereabouts.
Okay, so that's JSPL's. Lots of action. Let's straight away get to it. We've got, of course, our technical experts joining in to kick things off. Mitesh, afternoon. It's been a nice green day so far. I'm in sync with the market's mood, I think. But the question is, now for the last 1 hour, what would your trades be?
Good afternoon.
Looking at the chart patterns and the structure, I think the idea is to be on the positive side. The only worry is the impending event tomorrow. So you will be long, but not very aggressively because, again, the guessing an event outcome can be very tricky. But yeah, I think the Nifty should head towards 23,500. It's actually kind of done that today, 530 being the high. But I think we should be able to capture that. And once we start closing above 23,500, 520 zones, then I think look at a possibility of 850, even 24,000. So I'm quite positive in the short term, looking at the structures of the Nifty and the Bank Nifty chart. The Bank Nifty needs to clear 49,600, 650, 700 zone. We got a high of 49,674. I think once that is cleared, then Bank Nifty could head towards 51,000 plus levels. So again, both the indices are positive, so trade with long bias. But as I said, looking at the event, just you might want to be slightly on the cautious side. I have a buy on Nestle India with a stop at about 22.90 for targets of 23.70, and the other one is the other one is a buy on Opera Realty, which I would recommend buying with a stop just below levels of 17.94 and a target of 18.60.
Okay, all right. Thanks a lot for that, Mitesh. And bang on, Mitesh. I recall when the markets were less than the 23,000 odd mark, you had come out there, I think around 22,800, 22,900, and you said you're saying that we're oversold and it should bounce from here. Now you're saying maybe if you can get past those higher levels, maybe there's more in store. So we'll keep that in mind. Thanks a lot for that. Well, let's hop across to Nimesh. He's here to tell us about Titan as well as Jubilant FoodWorks. Both of them are in focus on the back of a Morgan Stanley note. Nimesh, tell us more.
Yes, Nigel. Both the stocks are buzzing in trade on the back of a good upgrade from Morgan Stanley today morning. So Morgan Stanley yesterday upgraded both Titan and Jubilant FoodWorks to overweight. On Titan, they've raised the target price to 38.76, and on Jubilant, they've raised the target price now to 781 versus their earlier target was of 620. So meaningful upside on both these names, according to the Morgan Stanley. Now they've identified 3 reasons why they've upgraded both these names, which is Titan and Jubilant FoodWorks. One, these businesses are building customer captivity against a weak consumption backdrop. So that's one big positive for both these names. Second, strengthening their core. And third, steady market share gain. So both these companies have seen market share gain in the last few quarters. That's the key reason why they've upgraded both these names. Now, coming specific to Titan, Morgan Stanley says that the consistent and predictable growth strategy deserves a quality premium. And they believe that this cannot get unnoticed by the market for a very long time. So, and as and when the competition intensity lowers down, you will see market latching up to it. And the fact that by Titan is the core business is growing for Titan, and they've retained the market share, which Morgan Stanley believes is quite important. And that's the reason why Morgan Stanley is recommending clients to buy such a predictable business, which is Titan. So that's the reason for Titan to be upgraded. On Jubilant FoodWorks, I spoke about the target price, but on Jubilant FoodWorks, Morgan Stanley believes that the business, while it's been struggling in the very near term, but they're still delivering growth, and which is quite visible in the recent numbers as well. And they were surprised the kind of growth that Jubilant has reported in the last few things. And also the strategy what they're doing to fuel the growth going forward, that's very important as far as Jubilant FoodWorks is concerned. So 2 upgrades in the consumer basket, both Titan and Jubilant FoodWorks upgrade to overweight. And on both the names, Morgan Stanley has sharply raised the target price on Titan as well as on Jubilant FoodWorks.
Okay, all right. Thanks a lot for that, Nimesh. And on Titan, I recall we had this chat on Editors Roundtable that if you want to pay jewelry space in the last many years, they'll have an up and down year, up and down quarter. But that's really been the flag bearer, right? You have various other companies. You had Tara Jewels, you had PC Jewelers, you had Gitanjali Gems. A lot of them came and went, but this one is really holding strong. And in the past, you have Kalyan Jewelers as well, has done reasonably well, but it's come off from the high point of the day. By the way, we have Vedanta that's reported a set of numbers. We'll have to keep an eye out on the segmental breakup, which will be the most important part of these numbers, because we already have Hindustan Zinc that's come out with their set of numbers. So the crucial number to look at for Vedanta will be the mix. And the aluminium business, the EBITDA that we're working with is close to around 4,350 crores, 4,300, 4,400 approximately. That's the crucial number on the aluminium business, and that's bulk of the profitability as well. So we'll get that EBITDA number out for you with regard to Vedanta. But let's get in Prakash. Prakash, what are you making of Titan as well as Jubilant FoodWorks? Prakash?
I can't hear you.
All right, Prakash, am I audible now?
Yeah, yes. Now you are. Thank you, Nigel. Thank you.
Brilliant, Prakash. Prakash, Friday afternoon, let's talk about pizza or maybe some jewelry. You know, Titan as well as Jubilant FoodWorks. Nimesh just told us about brokerages being a little bit positive, and I was just making this point that we've seen many jewelers in the past, but only one has really stood the test of time, right? And it has closed on 7% of the market share as well, and they're saying that they'll take it to double digits. Your view on Titan as well as Jubilant FoodWorks?
Good afternoon, Nigel. So, you know, I think Titan has mastered the craft of balancing, you know, the sales growth on all counts, thanks to its wonderful product mix. I mean, there is not a single segment that you would want to, you know, believe will not grow at some point in time through the year, through the cycle. I can tell you, you know, what they've achieved through some of these. I mean, while the world is kind of getting worried about LGDs, they continue to march ahead with some amazing growth in even their Zoya product line. While, you know, Tanishq, of course, continues to do well all around as much as other players have also, you know, been noticing growth. But the interesting thing about Titan is that it has managed to get the best in class service and product combination. And that is something which is a moat in otherwise what seems like a very undifferentiated market. So I don't think there's ever going to be any letdown in the P multiples that it will fetch, the premium that it will fetch in the market. So from that perspective, any growth will get very amply rewarded. Operating leverage has already come in and the market will recognize that. Only caveat is that if other things start growing, broad mass consumption starts growing, you may not have people wanting to only buy the discretionary spending, you know, elements or you know, businesses that are right up there on the top end of the spend. So that's the only thing. It will probably be a little bit of a dilution in terms of allocations. But if you don't have Titan in your portfolio, you need to buy it at some point in time. This is there's no better time than today to do it, given where they stand. On Jubilant, I can tell you one thing: the companies thinking in terms of how to counter, you know, food delivery competition. So, you know, as we've already discussed this ample times, that it's not they're not competing against other pizza players, but they're competing against other delivery guys. And from that perspective, they've been able to retain value even when they are priced higher than some of the other segments. So other categories, and that has started reflecting in their results. So instead of focusing too much on you know, new stores, they've probably deepened their business in existing stores, the ones that are well located and that can cater to a much larger geography now. So there are subtle changes, but that's kind of taken up. I think at 700, it also gives you a very good playing field to level playing field to kind of actually expand about 30-40% in terms of revenue and commensurately with that margin also. So my target for something like this is almost like a 35-40% upside in the next 12 to 18 months. And remember, we are talking about consumption coming back. Usually, this is one area where it starts having a very linear impact as it starts. So hopefully, things will be better tomorrow after the budget and for players like this. And of course, through the year as well.
Right. Prakash, I wanted your view on Vedanta as well. You know, the stock ran up one way from the start of January till I think the middle of 2024. And then, in fact, it's cooled off a little bit. But taking into account the dividend as well, I think at around 440 rupees, actually it should be around a 490 to 500 rupees stock. Now, the numbers look quite good. And I say this because the aluminium number, you know, the EBITDA number that Kotak was estimating was 4,350 crores. Right. They had that benefit of aluminium prices improving. And they're focusing a lot on the cost side, a lot about backward integration, trying to get more amount of their coal from their own backyard, a larger amount of their alumina as well from their own backyard. And that's clearly showing up. Now, what do you do of the stock? At around 440 rupees, if you believe the world is going to recover, it's not going to be a very dull place, then you, in fact, you'll have to play the metal pack. And this one has all the metal stocks in there. It also is a special situation because that demerger should take place sooner rather than later. Tell us more.
No, I think there's not much that I have to add except for the fact that I would echo two things from your narrative. One is aluminium seems to be still on a very strong footing. Look at how, we've discussed this, but I'm just repeating for the sake of, corroboration with the sector. Nalco went all the way down just because alumina prices were shrinking, and then again has made a very significant comeback because aluminium is going up. And I don't think consumption or demand for aluminum is going to let any price cool-offs happen beyond where you see it today. It'll probably be in a very tight, narrow band. The other thing is the EBITDA from other businesses, which are zinc and silver, and all of that is also extremely very robust in the current set of earnings. So my sense is, if you have a year-on-year growth which is about 25 or in the range of 30%, you will not see that taper off in a hurry. There's nothing which is going to drop off a cliff. And from Vedanta's perspective, the demerger could unlock values and bring in efficiencies, let's say, a year from now. So somewhere in the middle of the year, you will probably be very ideally poised to buy into that event, but not at this point in time, but closer to maybe, April, May, June. That's where, things will start kind of looking more promising. And by the time whatever price equilibrium had to be discovered, thanks to its dividend payouts and all of that will happen. But at this level, yes, the risk reward is favorable. I'm not too sure of the upside being very imminent, but yeah, over the next 12, 18 months, you will see it do very well if the entire commodity complex continues to do well as well.
Okay. Got that. By the way, I was looking at a very interesting chart that's come in from the economic survey. And right now, I mean, there are the CEA there briefing the press, and I was looking at some charts that he's putting up in that press conference, and one of the most interesting ones is talking about the disparity between corporate profits and wage growth. For most of the years in the last 5 years or so, that chart talks about how, corporate profits have soared and wage growth has been quite low. In fact, just to quote that number, since, I was looking at it, corporate profitability in FY24 is about 30-odd%. This is obviously the aggregate that chart is talking about. However, in FY24, corporate profits are 31.7%. This is FY24 over FY23. However, wage growth is at 13%. So it takes us back to that whole debate about, distribution of corporate profits and why consumption is slowing down. But speaking of consumption, we've discussed the pizza stocks, we've discussed Titan. Let's talk about the FMCG names as well, Prakash. After a long time, there's green on some FMCG names. Tata Consumer has been doing exceedingly well. Nestle's numbers were good. The volume growth was better. Even Marico's volume growth, better than street estimates. So what do you make of it? And too early to say the worst is over?
Not really, Surbhi. I think the change is very clearly evident, and volume growth is definitely a very decent indicator. And this is not some season where, cyclically, for Q3 is not something where you would expect some major change that would happen. I mean, Q2, Q3 is usually better post-monsoon and things like that. But, I have a lot of anecdotal belief in the fact that Nestle has the product mix that always gives you the first indication of change, because they actually are at the cusp of rural and urban consumption most of the time. So if that is happening, I would be surprised if the rest of them also follow suit, probably with a lag. And when Dabur finally kicks off its change in volumes favorably, the cycle is turned. We had some caution that was expressed by, I think, Godrej Consumer, if I'm not mistaken, but that seemed to be very company specific or segment specific. But if you look at numbers from Marico and Nestle, there's no reason why you would believe this is not this is just a one-off and would follow through. But and possibly if the economic survey which you are alluding to brings out the fact that there needs to be some reduction in disparity between income levels and wage increases have to follow through in some way, consumption will definitely get a boost, and that's what most FMCGs will love to see happen. And the market is also probably waiting to see, because they're available at very decent valuation from a historic perspective. So you can't go wrong if things start looking up. You might just have to wait it out for another 3 to 4 quarters, but things could look very, very well out there.
On a lighter note, Prakash, so at lower level of wage growth, and then we work 90 hours, and that's that's the destiny, I guess, right? That's on a lighter note. Just jokes aside.
This will be the highest number of working hours for the week, because
we cross 90 regularly.
And then even on Sunday, you'll have to look at the budgets. Will be. I hope you're bracing yourself. But Upasana is waiting by, so let's go across. Upasana, tell us more about the specialty chemical stocks.
Well, certainly, specialty chemicals companies are in focus as Q3 suggests a glimpse of recovery in the chemical business. First up, let me talk about Gujarat Fluorochem. Company reported Q3 numbers which were above the street estimates. It was a margin beat, and EBITDA margin reported saw an uptick of 480 basis points on a Y-on-Y basis at 25.6%. Now, company's segment, that is fluorochemicals, has outperformed with a revenue uptick of 19% on a Y-on-Y basis, and company has given an outlook that it expects specialty chemical volumes to improve from Q4 FY25 onwards. Next up is SRF. The company reported a good set of numbers supported by growth in its chemical business. Now, company has reported a 14% top-line growth coupled with margin expansion of 120 basis points in its chemical business. Now, brokerages still have a mixed view on this stock. Now, next up is Navin Fluorine. The company has reported an upbeat performance aided by margin expansion. Now, company is confident of achieving 25% plus EBITDA margin by Q4 FY25 and has shared an outlook on its specialty business. It says that the ramp-up of Dahej and Surat plant is likely to aid growth in FY26. Multiple upgrades on the stock, and Citi has given a buy rating with a target price of 4,500 per share. Now, we'll be closely watching out for numbers of Aarti Industries reporting its Q3 FY25 numbers tomorrow. We are estimating a flattish revenue growth, and EBITDA margins are likely to remain under pressure around 13.5% versus 15% on a Y-on-Y basis.
Okay, all right, got that. Prakash, very quickly, so some light at the end of the tunnel for chemical companies as well.
Yes.
Are you convinced about any of them?
No, I think I would want to see the Aarti numbers come through, but my anticipation is, given a channel checks, that things could probably start looking up. This was anticipated somewhere in the middle of last year, calendar 24, didn't happen. We waited maybe 3 quarters after that, 2-3 quarters after that, but this seems to be the turning point. So fingers crossed, we'll have to wait for the commentary as well, not just the numbers, to establish some sort of a correlation with the improvement. But very, very likely that you will probably see that, given what Navin has done. But remember, Navin's margin expansion is still not the same as what it had during its peak years, about 5-6 years back when the multiples were...
Prakash, I'm so sorry. Prakash, so sorry cutting you off over there. But our colleague Timsi is actually quizzing the CEA. So let's quickly go across.
Only then people can buy the cars that Force Motors is manufacturing. So given all of this, what is your view, or what government can do on the employment side?
Again, what the government can do was already demonstrated in the July budget of last year, when the government announced multiple schemes to incentivize.
People can buy the cars that Force Motors is manufacturing. So given all of this, what is your view, or what government can do on the employment side?
Again, what the government can do was already demonstrated in the July budget of last year, when the government announced multiple schemes to incentivize labor augmentation in businesses, both in manufacturing, non-manufacturing, new jobs, adding to existing payrolls, etc., by defraying some of the contributions to EPFO, announcing the corporate internship scheme. So what the government can or should do was extensively mentioned, and even policy actions taken in the last budget of July 2024. And of course, the government can continue to take policy actions as it has been doing with respect to PLI schemes on labor-intensive sectors, and also in terms of the deregulation action, that is the government's not just the union government, but the state governments and local governments' contribution to employment generation, is by reducing the fixed cost of doing business so that firms can raise the variable cost by hiring more people. Beyond that, I think not everything needs a policy tweak or a policy intervention. Some of it is in the natural self-interest of businesses to be able to find this balance. And that is why I gave the example of Mr. Henry Ford. I'll just ask my colleague Anuradha, do you have anything to add? No.
Dr. Nageswaran Karishma this side from Business Today. The previous economic survey had mentioned about the China +1 strategy and how India could draw dual benefit out of it. But this one does not explicitly mention it. Does this indicate a change of stance of the government, or the strategy is still a part of it?
There is nothing. This time we are speaking about the importance of growing importance to be given to domestic growth drivers, building domestic supply chain resilience, which is the same as what has been the thought process behind the Atmanirbhar Bharat, China Plus One, etc. So this is the continuation of the same theme.
122. सर मैं लक्ष्मण हूँ CNBC आवाज से। छोटे छोटे दो सवाल हैं। एक तो आपने
happening in the private sector on the number of hours. So that is not something that we want to join. The point here is that small businesses do get seasonal surges in orders. And it will be good for them to have the flexibility to be able to achieve the weekly working hour limits over a longer period, which countries like Korea, Japan, etc. do that. So it is all about managing the seasonal surge in businesses. We are not going into the question of number of hours that Indians need to work, etc., which is a debate happening elsewhere. It is very difficult to give you a quantitative estimation with respect to the impact of trade policies that may be pursued by other countries, because right now it is hypothetical and speculative. But in general, what we have done is to take into consideration the uncertainties posed by the current global environment in terms of rising trade restrictions, rising investment restrictions, and therefore the growth number that we have spelled out does reflect these uncertainties, broadly speaking.
39.
All right, so that's the CEA addressing some of the points that the economic survey has raised today. But with that, let's move back to the market. It's still pretty steady as far as the gains are concerned, 250 points higher. The market has actually, the Nifty has traded above the 23,500 mark as well, and it's inching back towards that high point of the session. So let's see, another 30 minutes to go. 30? Yeah, just about 30 minutes to go. Prakash, thanks very much for joining in. We do have to take a very quick break on that note. Back with more in just a bit.
And chart wizards. Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
I am thinking that since the chatter is there and it is logical that the government has given some incentive to the corporate sector through lower taxes in 2019, and they have done something for the lower this thing in terms of giving food and subsidy, and the states are giving, that you might do something for the middle class or for the taxpayer. And that also is coming now, but I've been saying it for the last 30, 40 days that, there is some scope, maybe $4-5 billion, say 30, 40,000 crores. But if you divide that by number of people who may get it, say, I don't know, 2 crore or 3 crore taxpayers, it'll come to 8-10,000 rupees or something like that per annum. So you can get that much. I think it's possible to make it a little fair. I don't think it'll matter because let us say in a family you're getting 600-700 rupees per month. Okay. Now, what will you do with it? Because inflation is there. Secondly, the basket of people have changed. Will they order one more time Zomato, or will they change or buy an extra lipstick? Who knows? Because in the olden days, these things were much simpler to do. Or maybe there'll be a telecom price hike after a few days and some of this money would have gone away or whatever, 600, 700, 300, 200, whatever. So the point is, you don't exactly know what to do if the amounts are otherwise small, and nowadays the basket is a bit wide. So you will say good and thank you and on behalf of everybody, and it'll help the consumer sector. But now which stock will they go to McDonald's more? Where, by the way, I own that stock also, which has been a dud for 2-3 years, but before that was good. So will you go one more time to Westlife? Who knows? I don't consider Zomato as a discretionary stock in the sense it is just replacing what you were doing, which is why we like those kind of stocks where you are not trying to say that the customer has to spend more money. It is just reorienting. That's why we like the quick commerce. He's not spending extra money. He's just making it convenient for him to buy this via this channel versus that channel. I don't like the consumer staple because I think...
Welcome back. Well, it's just a little after 3 p.m. and the market's in a good mood so far, gearing up for the big event tomorrow. There you go. Most of the gains are also intact. We have Vikas Khemani, founder, Carnelian Asset Management, joining in. Vikas, good to have you on. So just a few hours to go now, right? It's not even 24 hours anymore. What would you say? I mean, is this budget, because of the situation that we are in, the macros, the micros, the global and the local, has this budget become a little more important perhaps for the market this year?
I think so. If you see over the years, the importance of the budget has been going down because there was a time when most of the policy announcement used to happen through budget, which has kind of been taken away. I think it's largely now probably reduced to 2 or 3 things. One is, I think, how government is thinking about the fiscal deficit and the breakup of the expenditure between capital and revenue. And secondly, I think to some extent on the direct tax, especially the personal income tax. So I think these are the 2 things market would look and watch forward this time around. I think by and large, there's an expectation there will be some rationalization on the personal income tax, which could leave some money in the hands of middle class. So I think to that extent, it could be positive for the consumer stock sentiment. My own view has been that I think these things tend to last, maybe a week or so. They don't, necessarily change anything from a direction of the market perspective. So I think probably next week we will, it'll be done, event and forgotten. And I think the story will move to the, earnings growth, liquidity, valuation, all those things. So I think, this will come and go. And I don't think that there is specific big game changing is likely to happen from this budget per se. Of course, some of these things which we are looking to watch out, we will watch out. And if some personal income tax reduction happens, that will be good news.
All right. Hi, Vikas. Good afternoon and good to see you. Vikas, over the years, I've heard you, from the corporate job till you started running your own fund, and you're one of the flag bearers about this India story. Keep investing, stay bullish, And I like the quote you put out as well, on your Twitter ID just a few days ago. When you said you need to have a 10-bagger, you can get there, but you need to have the stomach to take the blows as well. When the stock becomes half, then you need to back yourself. So I think a lot of investors will take a lot of heart from that fact, because a lot of stocks, after falling 40%, in fact, they pull back a lot of those losses. But you need to have the stomach to take some of those blows. That said, Vikas, what about budget? It could be a few days event, But I think the Capex spend is something that the street is really looking forward to, because that could be a compounder, that could be a multiplier as well. Some rationalization of taxes will have consumption. But I think that Capex spend that number is going to be important. And I think the following week we have the RBI as well. That's realized there's a problem, liquidity is required, and they're taking measures as well. So comment on both these two factors.
No, absolutely. And I think, see, government has been always very clear about the direction to spend on Capex. If you see last couple of budgets also, this has been very clear. And this government understands very well that we need to spend money on building infrastructure and do Capex, and which has been executed. I think last year, per se, there was a little bit of slowdown because of the election, tightness in the liquidity and all those things, which I'm sure there are measures being taken to correct that. I see no reason why, any thing bad will come out in terms of Capex number in the budget. I think it'll be fairly fine in my opinion. So while market should get clarity, but I don't see any big change in because I think as far as the broader vision of government is concerned, we know budget is just a subset of that outcome, subset of that policy broadly. So I don't think anything negative will come out on that.
And Vikas, I think, you all have been participating in this fall, right? You all have been nibbling in. So if you could tell us, how are you all positioned with regard to your cash? Are you all seeing, the flows that are coming in are as solid as well? And if you could hint to us at least, what have you all been buying? That would be great news for our viewers.
I think so. I think the fortunate news is that in the last couple of days, we've got a lot of clients calling us and that shall we put more money? And we have seen flows coming in. And we were last couple of months were sitting on sort of cash. We were deploying slowly the fund. So we have used this opportunity to deploy, not fully, but still some amount of capital. So we're not sitting on a whole lot of cash, but generally speaking, we are in a more deployment mode because we don't think anything materially has changed India's story. Apart from the prices. So when you see a 30-40% correction in a stock on a market, I think it's a great news from a structural story perspective. Of course, that does not mean that the markets will run away tomorrow. And market had its own cycle. So I've been saying this market probably will be in a 22,500 to 25,000 range for quite some time. Market needs to consolidate, and which is what is happening. And in such consolidation phase, whenever you get such kind of opportunity, they are the great times to kind of buy stocks. But from long-term perspective, because short-term uncertainty, nobody can kind of time out and can play out how they will work out. So our view continues to remain that India is one of the great story. Nothing major changing structurally perspective. There will be 1 or 2 quarters of here and there, whether it's corporate earning or Capex cycle or some other reason, right? But they don't disturb the long-term story. And I'm as bullish as I was ever from a structural point of view.
Okay, all right, Vikas. By the way, we should just pull up the UPL share price. Let's get UPL on the screen. Another one that's hitting the mark from the chemical space. So yeah, there you go, 7.5%. Why has this happened? Because year on year, there's a dramatic improvement in the numbers. And I just want to sort of read them out for the benefit of our viewers. There is a profit of over 800 crores, 828 crores versus a loss of some 1,200 crores last year. The revenue is up about 10%, and the margin, EBITDA margin, has come into almost 20% versus 4.2% last year. Not just that, the company is sounding optimistic, saying that they're confident of delivering EBITDA and free cash flow for the full year in line with their guidance. Market is absolutely loving it. Now, Vikas, help us understand this, because you've been sort of studying and following up on the China Plus One theme for a long time, right? And many of these chemical companies, I think we'll get Vikas back. We'll just drop that line with him. But Carnelian, along with the Make in India, Atmanirbharta theme, China Plus One is also a big theme for them. And what's happened with the chemical space is that we've got a string of positive surprises across the board. There's SRF, there is UPL, there was Deepak Nitrite earlier. Even I think Gujarat Fluoro was not too bad, perhaps. So a couple of these companies, all of them have delivered well. We'll try and get Vikas back on and get his sense on it. Yeah, there we go. We've got the commentary from UPL as well on the screen right now. So looking good.
Yeah.
But Nigel.
Yeah, I think we, by the time we get there, I think let's just get done with JSPL. That was the stock of the day in early morning trading session. So let's run you through a few, pointers on that. The numbers are a little bit lower operationally. The standalone EBITDA per ton was a little bit low in comparison to what our poll threw up. The net debt number as well moved up by around 1,500 crores or thereabouts, or around 1,000 crores on a quarter-to-quarter basis. The pain point was that they announced some more Capex Capex, and there was lack of clarity on that 16,000 crore rupee Capex that was additional in comparison to what they have already announced. And that's, they're saying it's because to improve operational efficiency as well as reduce costs, but no big capacity addition. So that's why the street didn't like that too much. What are the brokerages doing? ICICI Securities, they got it bang on. They went ahead, they downgraded the stock to hold from buy. They have lowered their EBITDA estimates and they've reduced their valuation as well. They were giving it 7 times earlier, now they're giving it 6.5 times. Novama, they have retained their buy rating. The target price they have lowered out there, and they are saying that this, commercialization of the enhanced capacity that's got delayed, which they don't like it too much, and also because of that, they are factoring in lower volumes in the next few years, which results in lower EBITDA contribution as well. Moving to Nuvama. Moving to Nomura, they have maintained their buy rating, reduced their EPS estimates as well as their EBITDA estimates. They are factoring in weaker steel prices as well as lower cost efficiency for the company. So put all this together, JSPL was a stock that was down 13% in a morning trading session, and that's recovered a little bit because many believe that maybe at around 13% lower, bulk of this negative news was in the price. But I don't know whether we have Vikas back with us. All right, we don't have Vikas back with us, so let's talk about budgets. It's just a day away, and Yash joins us to tell us what the insurance sector is expecting. Yash, take it away.
Well, Nigel, the last couple of budgets have become pretty significant for the insurance sector because of the intervention which came in on the taxation side largely. And this time around, the insurance sector is expecting a few things from the union budget. First two things have been long-standing demands. The first one is from the life insurance sector. They've been seeking a separate tax reduction window outside of ATC. ATC provides, of course, 1.5 lakh rupees tax exemption benefit. Life insurance sector has an argument that they're quite big in terms of the premium coming in to them, and they want a tax exemption limit outside of ATC. If anything on this comes through, it will be positive for all life insurance companies. Now, coming to general insurance and health insurance companies, they've been seeking an income tax exemption window outside of ATD. This has been something that they've been asking for quite some time. If something comes through, it will be positive for all the general insurance as well as health insurance companies. Now, moving on to the next one, and this is widely anticipated, right? The government is expected to give more incentivization to the new income tax regime. If that comes through, if the government in any way sweetens the new income tax regime and makes it more attractive for people, then it could be negative for all life and all general and health insurance companies, simply because the new tax regime does not provide any income tax exemption for ATC or ATD. Finally, Nirmala Sitharaman, the finance minister, could announce taking up the Insurance Amendment Act in the budget session. There are 5 important elements under this. Increase of FDI to 100% in the insurance sector, positive for all insurers. Composite insurance license, positive for all insurers. Allowing individual agents to tie up with more than one life insurance company, negative for LIC, positive for all other private life insurance companies. Allowing merger and amalgamation of insurance companies with non-insurance companies. This will be positive for Max Financial Services. And finally, changes in the investment regulations for insurance companies. Sure. This will be positive for all life insurance companies.
All right, thanks very much for that. Perhaps not tomorrow, but in the budget session, we should hear more on this. Thank you, Yash, for the details over there. But for now, let's head across to Nimesh for D Street chatter. And the street seems to be feeling very optimistic and happy. Nimesh, it's been a couple of days of good recovery, lots of green on the screen. Now all eyes on Madam Finance Minister.
Well, absolutely. Surabhi, I'm a little surprised the way, the confidence with which the markets are going into the budget, and market wisdom is always right. So I guess, market knows more than what we know on what can come in the budget. But having said that, again, there has been a big recovery in the broader market names, and that's backed by FI buying as well. So within flows, the sense I'm getting is there is a bit of tilt towards the mid and small cap stocks in today's market. In fact, there is selling in some of the large liquid private bank names from larger institutions. That's from a flow perspective. Technically, I've been saying this 23,300 is a big resistance. Now we are trading above that. So maybe if there is something positive in the budget, you might see further short covering rally on the Nifty and in the bank Nifty. So that's from a technical point of view. I guess the market is clearly positioning Surabhi towards the rate sensitive stocks and names. So real estate for second day running or the third day running, there are very strong buy flows. NBFCs is what a lot of institutions are betting on and bidding for as well. So that is one space which is well bid from larger institutions. So all eyes will be, of course, on the budget. But I guess from a momentum point of view, looks like some buying interest is back in the broader market names and backed by institutional buying as well.
Okay, all right. By the way, those are Sun Pharma numbers on the screen. They don't look too great. The fact is that there's lower contribution from one of the big drugs, Revlimid, this time. I'm not sure if it's that or something else, but those numbers are at the operational level. There are a slight miss, the margin and the EBITDA. Stock's been volatile, suddenly fell, now it's rising. So let's see how it settles.
Just one point on Sun Pharma should be, the street was positioned for a weak set of numbers. The stock in this week itself is down 5%.
Yeah, that
so the
explains
street
it.
is positioned for this. These numbers look disappointing, no doubt, in comparison to what our poll threw up. But the street is positioned for that. That's today's chart. Pull up a 5-day chart. You'll see what I'm talking about. There's a big open interest built up as well out there. So keep an eye out on them. Disappointing numbers, but it appears the street seems to be prepared for a weakish set. Let's go back to Nimesh. Nimesh, just that one day you took a break and didn't give us some stocks, but then you're back in action. So that's good. Tell us what you're picking up.
So Nigel, I've been saying for the last couple of days that there's some bit of interest is back in the PSU names. So today the first stock is Hindustan Aeronautics, HAL. Good amount of buying interest is back from larger FIs is what I understand. So the flows are positive on the buy side and expect high delivery volumes in HAL today. So that's the first name. The second stock is ITC Hotels. Second day, it's locked at 5% down socket. There is selling pressure from larger FIs. So that's the reason why even in a trending up market, that stock has been struggling post-listing. Also remember for ITC Hotels, the bigger risk or the near-term overhang is the stake of Suti and BAT, and that can come. So that is the reason why the street is a bit nervous, and you're seeing selling pressure in that name. So that's the second stock. The third stock is Zomato. Well, the stock has been pretty much in the range of between 200 and 220 in the last couple of days. Some bit of bid interest is back, is what I understand from larger FIs in Zomato. So that's the third name. And the last is Geo Financials. This is interesting. I've been reporting that there has been constant selling from larger FIs and global funds into Geo Finance. Looks like that's pretty much coming towards an end. And in the last couple of days, the sense I'm picking up is that a leading domestic mutual fund has started accumulating at lower levels. So maybe that's the reason why you're seeing a bit of uptake in Geo Finance in the last couple of days.
Okay, all right. Thanks a lot for that, Nimesh. Well, I'll tell you what, we'll slip into a short break. You come back, we'll get into further detail with regard to Sun Pharma's numbers. Don't go anywhere.
Basket has expanded to beyond just upgrading a soap or something because monsoon has come, which was the old formula. In the old formula, when I was in Alliance Worli, we would see if there's rain outside our window in Bombay, and then you would go and buy levers and you'll make some 5-10% in 6 months. So those days are gone. Now you don't know. There are private labels, and then the customer himself or the consumer himself has or herself may want to buy something which they can show on social media or in a photograph or in a selfie. Some of these things, who knows?
Well, here's a fallout of the DeepSeek phenomena. The Indian IT Minister Ashwini Vaishnav making the big announcement that the Chinese large language open source model DeepSeek will be brought to Indian servers, will be brought to Indian shores so that it becomes available to Indian users. Sounds simple? Well, not quite. A lot of jargon there. What does it actually mean? Let's help you break this down to understand what really has transpired with this announcement being coming from Ashwini Vaishnav. Now, let's assume, and I'll explain that with the help of an analogy, the analogy of the humble tea, the common denominator between 2.8 billion Indian and Chinese. Now, let's assume that DeepSeek is this Chinese tea in this cup of tea. Now, what's important is that this is an open source AI model. What that effectively means is that the core code, which is the heart of the model, which is the recipe of the Chinese tea, is publicly available. So what the Indian government is proposing is that we'll use this recipe of the Chinese tea and replicate it here on Indian shores, on Indian servers, and have exactly the same model here present in India for Indian users. But that's not all. Let's bear in mind, we like our masala chai. Like most things in life, we like a little tadka in our life. So we'll add a little input to this. We'll add some components. We'll add some sugar. We like some sugar in our tea. We'll definitely add some ginger. We like ginger as well. And let's not forget the milk in the Indian tea. And having done that, we'll come to the finished product, which of course is a humble masala chai, is a humble cutting chai. So why are we doing all of this? Why is Ashwini Vaishnav doing all of this? Well, the long and short is, number one, let's not forget the obvious out of the way, which is the masala chai tastes a lot better. But having addressed with the obvious, the other two key components why the Indian government is doing is number one, all the components that we added, the sugar, the ginger, the milk, what that essentially represents are tweaks that Indian engineers will be able to do on Indian servers to this DeepSeek model. Now, why would we want to do that? Well, let's bear in mind there were niggles with DeepSeek when it initially came out. It wouldn't accurately answer questions about, say, the 1962 war or the status of Arunachal Pradesh. So this masala chai, with all these components, represents tweaks that the Indian engineers will be able to do on the Indian servers so that it becomes slightly more comprehensive. But the second and perhaps a larger concern that the government has is that the government doesn't want you sipping tea from the Chinese cup of tea, as that will leave your imprint, and by your imprint I mean your data with the Chinese servers. What the Indian government is essentially saying, let it come here and have a cup of tea from the Indian cup of tea, the Indian server, so that your imprint, your data stays safe within Indian shores. So this Chai Pe Charcha is the long and short of why the Indian government is bringing DeepSeek on Indian servers to Indian shores.
इसके लागू होने से प्रदेश में सच्चे अर्थों में सशक्तिकरण भी होगा, सुरक्षा भी होगी। इसके द्वारा जो कुछ कुरीतियां हैं, अब हलाला, इद्दत, बहुविवाह, बाल विवाह, 3 तलाक आदि जो कुप्रथाएं हैं, उन पर पूरी तरह से रोक लगाई जा सकेगी।
Welcome back. Keep an eye out on Sun Pharma. That's the one, the numbers, the prima facie look like a little bit of a disappointment, but the stock, the positioning was such, and that's the point that we were making, that in this week itself, it's gone in with some weakness. The open risk build-up is massive. So there's a bit of a miss on the operational performance, but the street seems to be buying into that bad news, at least as of now. We'll get the bigger reaction, I think, in the next session. But for now, positioning is playing out on that particular stock. Let's get in Mitesh for a couple of trades, though. Mitesh, the bulls are going into events saying, we want to see some action, and they believe there's going to be something good for the market, good for the economy as well. They're giving a thumbs up, and they are coaxing, the center or the Ministry of Finance that give us something good. But what about you? Tell us a couple of stocks. Mitesh, we'd like to hear you.
Now it's good.
Perfect.
Yeah. Okay. So I think what I'm trying to say is that I have a very similar opinion. The idea is that one, the Nifty is just edging above 23,520. Positive sign. The Bank Nifty recovery is again very positive. So looking at both the indices, I think tomorrow could be a good day. At least the start would be very good. On the stock side, I have a BTST on ONGC with a stop at 259.5 for targets of 267, 268. Maybe higher, but we'll start with that. And the other one is a BTST on escorts with a stop at about 36.04 and a target of 36.65.
Okay. All right. Thanks a lot for that, Mitesh. Well, by the way, I think there is a bit of an adjustment that we have to look at with regard to Sun Pharma. We'll try to get in Vinny because there's a forex element out there as well. So maybe adjusted for that. The numbers don't look as bad as what it was. But as the numbers came out, we told you first itself that, these numbers are a miss, but positioning as such, so just be a little bit careful. Slip into that break, come back. We'll wind down the markets for you. We'll try to get you more clarity with regard to Sun Pharma as well. Welcome back to Closing Bell. Well, Sun Pharma was the stock of the last half hour, Rod. The EBITDA number prima facie appeared as a bit of a miss, but then you adjust for the forex element that we briefly mentioned about before you went into that break as well. And the adjusted number actually doesn't look so bad. And that's why the stock has now recovered all of its losses. It's at the high point of the day. But today has been a good trading session. We're going to be going home. The last stick is going to be at the day's highs. So super trading session. A few numbers that came out. The street chose to look at more positives than negatives. You had Tata Consumer that was up close to around 6%. You had L&T that's up close to around 5%. So both of them put on a lot of weight. And yesterday you had BEL that came out with a set of numbers. That stock as well goes home with a gain of close to around 5.5%. When L&T goes into the budget with a 4.5% returns, it's telling you that the street expects something. They expect something for the economy to boost it up if there is some kind of slowdown. Well, they're expecting some measures to be taken. And that's why L&T, that's one of the largest contributors on the upside in today's trading session. What else? What else did well? Vari Energies, that came back, and it came back in style. Remember, that's the one that corrected from around 3,500 rupees all the way to around 2,000 rupees. The street likes the margins much better than what we saw on a sequential basis as well as on a year-on-year basis. And that was the big outperformer on trade. Whirlpool, the parent saying, well, we have come down to 51%, we want to come down to 20%. The street is not buying that. They're saying that, hey, we consume some part of that supply, but yesterday the stock was down 20%. Today the stock is down another 10%. What else did well? Kalyan Jewellers. The street says, let's ignore the noise for now. Buy into the numbers. Buy into, one of the prominent names coming back on the board. So that stock goes home with a gain of around 15%. Jupiter Wagons, the management commentary was good. That was up close to around 13%. Ola Electric as well. It's fighting for its market share, trying to get it back. Is it coming at the cost of margins, at the cost of profitability? That's something the street is debating about. But otherwise, that one as well did well. And railway-facing themes, RBNL, IRCON, both of them did pretty well in today's trading session. Short point is, it was a solid trading session. The bulls have fought back. Just a few sessions ago, we were flirting with around the 22,800 odd mark. Boy, oh boy, we're closer to around the 23,500 odd mark today. But you need to take note of the fact that for the last 4 months, the Nifty has entered in the negative terrain. And that's the first time in 24 years that we have the Nifty losing for 4 straight months. We'll wrap up on this edition of Closing Bell. Stay with us. Editor's Roundtable comes up next. And we have Siddharth Bhaiya who's joining us.
history as the first woman finance minister to present her 8th consecutive union budget. From replacing the colonial-era briefcase with the Bahi Khata to delivering the longest budget speech in history, her tenure has been marked by milestones and transformative policies that have shaped the nation's economic journey. Her maiden budget speech in 2019 set the tone for bold reforms, and she has since introduced several initiatives that left lasting impact on India's economic policy. Let's dive into the landmark schemes and key tax reforms introduced under her leadership. Now, Sitharaman's budgets have introduced numerous initiatives aimed at driving inclusive growth, like the PM Suryodaya Yojana in 2021. Announced in the budget 2021-22, this initiative aimed to provide solar energy to villages that lacked grid connectivity. It was a step towards clean and sustainable energy, empowering rural communities while promoting renewable energy adoption. The credit guarantee scheme for MSMEs was another such scheme. Revamped in budget 2024-25, this scheme provides collateral-free loans with a guarantee cover up to 100 crore rupees, addressing financing challenges faced by MSMEs. PM Vishwakarma Yojana is another such scheme announced in the budget 23-24. This initiative supports artisans and craftspeople with collateral-free credit up to 2 lakh rupees, toolkit initiatives, skill training and marketing assistance, helping preserve traditional crafts. The Vivad Se Vishwas scheme is another such milestone. Launched to resolve pending tax disputes, this scheme offers taxpayers a chance to settle cases by paying only tax amount with penalties and interest waived. PM Gati Shakti Master Plan in 2021. Now, a 100 lakh crore initiative focused on integrated infrastructure development, enhancing connectivity and reducing logistic costs. The Atmanirbhar packages in 2020 during the COVID-19 pandemic. A range of measures supporting MSMEs and businesses were introduced under this initiative during the pandemic, emphasizing self-reliance and domestic manufacturing. Now, the tax reforms on the taxation front have also been big. Sitharaman's budgets have implemented sweeping reforms to streamline the system and enhance fairness. Like the corporate tax reduction in 2019, the corporate tax rates were slashed to 22% for existing companies and 15% for new manufacturing firms, making India an attractive destination for global investments. The optional personal tax regime, or the new tax regime in 2020, a simplified system with lower tax rates but no exemptions was introduced, giving taxpayers the flexibility to choose between the old and the new regimes. Another such initiative was the capital gains reform of 2023. The government removed the indexation benefit from the debt mutual funds, bringing all asset classes, including equities, debt funds and fixed deposits, under the same tax regime. While this reform created parity in taxation, it also drew mixed reactions as it increased the tax burden on long-term equity investments. The abolition of angel tax was another such initiative for all classes of investors. In 2024, in the budget of 24-25, Sitharaman proposed abolition of the controversial angel tax for all categories of investors. This move was expected to bolster the Indian startup ecosystem, boost entrepreneurial spirit and foster innovation across sectors. Now, Nirmala Sitharaman's budgets have been a mix of bold reforms and targeted policies, be it support for MSMEs, sustainable energy or comprehensive tax reforms. As she gears up to present her 8th budget, expectations are high for announcement that she will steer India's next phase of growth.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters, as we've done for the last 25 years.
Celebrating 25 years.
Hello and welcome to this special edition of Editors Roundtable. Usually this is a wrap of the week and we are winding down, getting ready for the weekend. This week is obviously very, very different because we are fully charged up and fully warmed up ahead of the big event tomorrow, which is the Union Budget 2025. So, well, as always, I have a full house with me. Of course, there's Prashant, Nigel and Nimesh, but we have a very special guest joining in. Someone who's been a big investor in this market for years, for decades, and someone who kind of flagged off a bit of the caution in the market in terms of the elevated valuations, quality of stocks and companies, and just, you know, the exuberance many months ahead of the curve, might I say. Siddharth Bhaiya, fabulous to have you with us on Editors Roundtable today.
Hi, Nigel. Hi, Prashant.
Good to have you, Sid. How are you feeling now about the markets? You know, you were cautious.
Yeah.
Tell us the top 3 reasons you were cautious about, and have any of them moved to those levels where you believe you'll not be as cautious as you were the last time we spoke?
Yeah, thanks, Nigel. Hi, everyone. So I think we first became cautious around July, August on the markets, right? June, July, August, around that time. And our cautiousness primarily stemmed from the fact that valuations were absurdly high, right? Like as high as I've ever seen. Like, I'll give you context. That people used to talk about Nifty P being 25 or 26 or whatever, or the Nifty 500 P being like 27, 28. But you know, you have to understand this, that in Nifty 500, of the top 50 companies, okay,
they contribute 70% of the profits.
Yeah.
And they are available at 16p. The rest, 90% of the stock, the average P multiple is 36. Everybody talked about Nifty being 25, 26, but their portfolios were all 40, 50, 60p multiple. The small cap index was quoting at 40p multiple. The mid cap index was at 45p multiple. And when you're talking about an index being at 45p multiples, then a lot of stocks are at much higher this. So I think today even today, more than 500 stocks, which have a market cap of more than 500 crores, have a P multiple of more than 100 and a price to book of more than 10. So our first these are valuations that I've never seen, even during 2008, right? And we've got data, 2008, the mid cap and small cap P multiple was 30.
Okay.
And here you had valuations which are 50% higher.
Can we, can we take it one by one? So let's delve into valuations a little bit. I have 2 points. One, haven't valuations now been, I don't know the answer, I don't think anyone knows the answer, but I wanted your thoughts. Have you seen a step up in valuation bands itself? Because if you take a look at, so you said 2008, what is 20, maybe what is 40 is the old 20, I don't know. Has a step change happened?
So
that is
does
one.
This work in the market? The whole point is...
Prashant, you're using those 4 dangerous words. This time it's different.
No, I'm not saying that. All I'm saying is, have we moved higher in terms of valuation bands? Because valuations actually, for example, lots of people say that from the highs, markets have corrected quite a bit. But they were very high. They've just become high now. But is 60 times okay after falling from 100 times? I don't know. So that is one. And second is, you said that the proportion of the companies, large company P multiples are small, but isn't P based on rates of growth? Who's growing how fast?
Second,
so
good point. So first we came to valuations, right? See, you have to understand the markets are far, far, far older than the last 10, 15, 20 years.
Yeah.
Markets have been around for 500 years, right? When there was a crash in the US in 1928, there was a depression even in India. Stocks tanked even in India. So remember, the global economy that time was correlated. So this time, so valuations are stretched by any, are very, very stretched by any historical this. And they said this was 4 years back where nobody wanted to touch small and mid caps. I have bought stocks in March 2020 at, below cash. So let us not say that, we going toward this. Now coming to growth. The argument in June, July was, India is a growth market. Growth is phenomenal, the P is justified. That doesn't mean that you can justify any P multiple, but what happened after that? Growth has actually collapsed in India. Right? We just did this analysis. More than 500 companies have reported their results till now for the quarter. Do you know what is the top line growth and bottom line growth?
I think it's minus 5%.
It's 4% top line growth and close to 3% PAT growth. This is for the companies that have reported. US growth rate has been far better than that. A lot of European countries have reported better growth.
But
so I don't have the data, but amongst the top 10 economies, ours will be the slowest growth rate this quarter.
No, there's no taking away from that, and we can't debate or argue against those numbers. They're hard facts, right? But a large part of the market, Siddharth, wants to believe that this is a short-term phenomenon. We've kind of wound ourselves in this funk. It'll sort itself out. So the narrative throughout brokerage notes, if you read them, is second half is going to be better. And it's pegged on two, hopes. One is that government ko to spend karna hi karna hai. Government Capex has to pick up. And the second hope is that thoda bahut income tax here and there, we get something, and consumption will revive.
So we'll come to the second part of government Capex later on. First, we'll answer this. One, market doesn't work on hope. Market works on reality. You can't be a bull or you can't be a bear. You have to be right. Right? And we got pillared in the last 3 months by a lot of people on social media saying you guys are bear or you're bearish or to mandodi. Look, we made the most money in the previous 4 years. Right? March 31st, our 5-year CAGR was 53%. I don't remember, it could be some of this. And I said, these returns are not sustainable. You've made what people make in fixed deposits in 70, 80 years, you've made in 5 years. what you're supposed to make in the stock market in 15 years, you've made in 5 years. I said, better to take that money home, right?
Enjoy the
cash in the balance sheet is what you own. Cash.
True.
Your stock markets, can
Notional.
get this. Right?
What is the cash you all are sitting on as of now? As a
Oh,
percentage?
it's gone up from the last time we spoke, so it's much higher.
So what is it?
We're more than 90% now.
Wow.
In cash.
In cash.
So you're clearly cautious on the markets.
Very cautious.
Actually, just an anecdote. Nimesh, it's your question. I just if you remember, Siddharth was with us on the day of the budget.
Yes.
It was around 2:30, and everybody was,
Hearing and
Siddharth really, put the cat among the pigeons, and there was a sannata for a while. But I think so. You were absolutely.
So, and we mentioned a very important point that day.
Yeah.
We said, the government doesn't, and we'll answer that question on Capex as well, that it doesn't have an absolute majority.
Yeah.
The first 10 years, there was a lot of focus on development.
Yeah.
The moment you have a fractured majority anywhere in the world, not just India, the moment you have a coalition government, you go on to freebies. You go on to welfare schemes. We pointed out very clearly in this that the focus will go towards welfare schemes. You saw that with Maharashtra. You're seeing that in
other states as well.
In the other states, you saw that a lot of the budget went towards Bihar and Andhra. So, as I said, what the government says and what it does is more important. So I hear a lot of this saying the government is not spent, but the government doesn't have money. Government balances with RBI is only 67,000 crores when I last saw it. So it's not like the government has the money and it's keeping it.
Yeah.
The government doesn't have the money.
Yeah.
So before this, a year back, everybody was talking about Capex. But there's no money to do the Capex. And you've had a fantastic year as far as tax collections are concerned.
Yep.
Right.
That's thanks to capital markets. No? That's been the biggest contributor
and
of
personal income tax. Let's not forget personal income tax.
A lot of people have paid a lot of capital gains. It's not going to be there next year.
But Siddharth, when I was chatting with you off the record, you had a very interesting point on the slowdown as well. You believe that it's capital market driven slowdown. If you can just share your rationale there.
So, Nimesh, the capital market has to be an outcome of the economy. If the economy does well, the stock market has to do well.
Correct.
In India, the narrative was stock markets. Everybody wants an interest rate cut. Why? Because the stock should go up.
Yeah.
Nobody cares a damn about the economy.
Yeah.
It's the
really,
Wall Streetization of Dalal Street, is it?
As I said, Wall Street is a different thing. We'll discuss that. So, I don't.
Let me ask you this. So your cash is 80%?
More than 90%.
More than, okay. But is the cash level for viewers who are watching, right? They do SIPs and they are. So what should they do? I mean, everybody, they can give you money, but not all, right? And you'll.
We're not taking money, Prashant, for the last 6 months.
Okay, so that's also closed. So they can't top. You can't top tops and bottoms. So my question is your cash level a reflection of the fact that you find other things more expensive, or you see significant downside here? Because it's possible markets stay here, others do better. Is that what the call is?
No.
Or
So clearly, as far as Indian stock markets go, they're terribly expensive. When I'm telling you, 90% of the companies in the Nifty 500 have a PE multiple of 36, right? Where there is no absolute profit growth. And I'm not even going to the small and mid caps, which are far more expensive, right? So on an absolute thing, and as you said, see, this is something which will play out over 18 months or 24 months, Bear markets don't end in... So there are going to be a lot of short covering rallies, and that day people are going to curse me, saying he was wrong.
But you think that this is a proper bear market that has to play out?
So, Surabhi, we discussed valuations.
Correct.
We discussed growth, which is collapsing right now, right, across this. So much of the domestic wealth is tied to the stock markets. I'm really surprised that so many people have called me that we've lost so much money.
Yeah.
And
only
I said,
in 3 months.
In 1 month.
In 1 month, yeah.
Right? 1 month is basically where people have lost so much money. And as he said, 1 month of a bear market is equal to 1 year of bull market. 1 year of a bear market takes away 5 years of bull market. We've all seen that in 2009.
Yes.
So when you say this will play out in 18 to 24 months, you're saying a period of no returns? Or you see...
It'll be a combination. It'll go down, it'll come back, it'll go down, it'll come back. There'll be stagnancy, right? As I said, I can be wrong. This is how I see it. I draw parallels from 2007-8. I look at the valuations at that point in time. I look at the excesses at that point in time, whether it is the IPO, whether it is the, QIPs, everything.
Yeah.
And then I see that this market has been at a much higher, the bubble is much bigger than what it was in 2008.
All right, but Sid, what will make you, personally, I'm keeping my SIPs going. I'm putting it for the longer term, and that's my view about it. But what will make you turn this cautious view that you have?
So again, as I said,
you're being cautious. You're sitting on a lot of cash as well, and in the last few years, some of those stocks for you have gone up 7, 8, 9, 10 times as well. So good amount of money.
Yes.
But what will make you start, again deploying some money, levels or a particular trigger or something?
So, and it's there, this has been our philosophy for the last 10 years, is do as the promoters do.
And promoters sell, you sell.
And they've been selling.
Promoters buy, you buy.
By 2020, every single company in my portfolio, the promoters were massively doing buybacks.
Yeah.
Right? Nigel, who the guys who've sold in the last 18 months?
A lot of promoters,
early stage investors.
Right.
First they had the story and the investors.
Now we're holding the story.
investors
And mutual fund
But tell us,
investors.
make that point.
So, FIs have sold nearly $50 billion in the last 18 years. And the promoters, through QIPs, IPOs, FPIs, everything, have sold another $50 billion. That's $100 billion. Who's bought it?
We have. Absolutely, we are holding mutual funds.
Quite brave of you to say that you have, but yeah.
Domestic mutual funds. I don't think me.
It is the retail directly and indirectly.
Yeah.
Right?
Yeah.
Where's your SIP gone? To the promoters.
Yeah.
Through the QIPs, through this. It will come out. All these things will come out at some point in time as to what was the due diligence that went into buying $1 billion QIP, and how much time did you actually spend? We spent 3 months researching a stock before we buy 100 shares.
In a bull market, 3 months stock is... so it's...
As I said. So, and if you had no shares, what made you all of a sudden buy $1 billion worth of stock? So there are a lot of excesses, right? I don't even want to venture into the SME space, which was a casino, right? Too many excesses.
Yeah.
So...
that needs
we'll figure out. We'll figure out. We'll see how this unravels. I hope I'm wrong, right? Because
no, absolutely take that point. And I think for mutual fund managers, we've seen that period where they were being, loaded with so much cash on a monthly basis, still are being. That at some level they had to start deploying.
And the argument that I get is, oh, we don't have an option. Of course you have an option. You can stop taking money.
Yeah.
Oh, yes.
Of course you have an option,
Take the high road.
right? This is you're doing a fiduciary job. You can stop taking money. You can stop launching all the riskiest types of, NFOs.
Oh my goodness! Don't even get me started.
At the peak of the valuation. So let's not discuss that.
No, not really. But I'm glad you brought this point up because it's a fact. It's something that we, as commentators on the market, we've seen that the NFOs that came in on thematic funds, on sector funds, on momentum-based ETFs, right? So questions will be asked. Anyway, we have to take a very quick break. Back, and the conversation continues in just a small while.
CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Welcome back. You're tuned into Editors Roundtable, and we are in conversation with Siddharth Bhaiya. Well, Siddharth, you're sounding fairly cautious, but the other big argument we have is India is, on its way, it's marching ahead. Growth is going to be back, which obviously you put out a couple of data points as well, and we're up to a multi-trillion-dollar economy. But there's this debate, this raging debate, India versus China. And you had launched that fund where you were talking about China being at attractive levels a few months ago or so. Well, how do things stack up right now? China suddenly seems to be coming back to life.
Yeah. So in fact, the Chinese markets last year outperformed the Nifty. Yeah. Right. And in fact, in the global rout post DeepSeek, it is only the Chinese stocks and Hong Kong stocks which have gone up. Right. So couple of things. One is, what you have to understand is, in the long run, the economic growth or the GDP growth translates into stock market growth. If you look at a 70-year, 80-year horizon, our nominal GDP growth is equal to our money supply growth is equal to the rate at which the stocks have returned. But Nigel, I grew up in the 90s, right? 1991, the Sensex was at 4,200. 2001, a decade later, the Sensex was at 2,800. Yeah. And 70% of the companies which were there in the Sensex in 1991 were not there in 2001. Correct. And it was a decade of massive innovations. Yeah. And great companies that came, HDFC Bank, ICICI Bank in the new avatar, Bharti Airtel, Sun Pharma, IPCA, TCS, Infosys, Wipro, all the nifty companies today. But that did not necessarily translate into this. So, to me, my bigger concern is, yes, over the next 10 years, as a country, we are going to do really well. Okay, we've all the groundwork which is necessary for us to do economically well. But that does not necessarily mean that it will lead to return. A lot of that growth is already priced in. We've, 2047 is already priced into the stock markets. So one part is, that is my disconnect. People say, oh, you're bearish. No, I'm not bearish. I stay here, I pay my taxes, right? I pay and I bring up my kids here. So I'm very bullish as far as our country is concerned. We're a strong democracy, everything is in place. The problem is with the stock market. Okay. Second, coming to China, right? They said, China is a $19 trillion economy. We are a $3 trillion economy. Slightly more than that. MSCI weightage for India had become higher than MSCI weightage for China. Now, how is that even possible? You're getting, I'll give you an example. Meituan in China, okay, it's similar to Zomato, is available at 15 P multiple. It was founded much after Zomato, and it's grown at a much faster pace. And it's a much bigger company. It's probably 7 times the size of Zomato. And we all know what the P multiple for Zomato is. Yeah. I don't even know. I don't even bother.
So China is clearly cheap, much cheaper. That is true. You like gold as well, Siddharth,
yes.
Right? So for our viewers, I think that's another area of interest. What are you thinking, and where will gold head from here?
Okay, so I'd done a presentation on gold in 2021 when gold was at 47,000 or something, and I said gold is a great asset class to own. Okay, 2001, 2009, COVID, all days when your portfolio is bleeding, gold is actually up. Okay, there are few things about gold, which gold is not endemic to the earth. Gold came to earth through a meteorite. Okay, all the gold that has been mined till date can be stored in a 25 by 25 by 25 square cube building. Okay. At the same time, gold is the only standard. Gold doesn't have an half-life. A kg of gold will remain a kg of gold 1 million years down the line. It's very ductile. It's very malleable. If you draw a string, which is 1 mm.
You're making me fall in love with the actual stuff.
When you read the facts, okay? So you can't mine, you cannot, for thousands of years, people have spent time trying to make gold.
I think the annual rate of production increase is about 1.5%, right? Nothing. I mean,
right? Again, come to a country like India. You know, if you have a financial fraud against you, do you think you can recover your money back? And which has always been the case, right? You still have Ponzi schemes in Bombay, the latest jewelry scam that we had. So for an housewife, for somebody who's, you know, semi-literate, that's their only source of wealth. Right? And it's a great hedge against currency depreciation. Imagine if you were in Sri Lanka or Nepal or Bangladesh or any of those countries where your currencies just tanked. It is only the price of gold that went up immediately.
So how do we play this gold theme? You know, the sovereign gold bonds, that's not come about. But gold Bs?
Gold ETF, yes.
Gold ETF,
yes.
So but on the price itself, is that $2,800? Do you have a figure?
It just
in
made
mind?
a new lifetime high yesterday.
Yeah. So where is it headed, you think?
Prashant, you'll be surprised to know that since 2000, gold has outperformed the S&P 500. For all the Microsoft, Amazon, gold has actually done well. It's in dollar terms. It's outperformed the Nifty in INR terms.
You know, since we're having this discussion across asset classes, obviously listed equities, you still have a lot of concerns out there. I don't know if you're looking at the unlisted space because that suddenly started getting very hot. It was a sign of sort of, you know, exuberance and euphoria as well. But the IPOs that have come in, and there have been many in, you know, throughout 2024, right? And some of them are new businesses which weren't listed before. Now, whether it's it's a different debate. Solar cells, whether they'll go out of fashion because there's oversupply, separate debate. Or, you know, whether companies like Sagility, etc., absolutely new businesses. Has anything caught your attention or imagination, either recent IPOs or
so I was
soon
just
to be listed
discussing with Nimish before this. He said, I have not applied to an IPO in 3 years. I said, I have not applied to an IPO in 25 years.
Oh my God, okay. The wrong question. So that's what I'm saying. That
no, so I'll tell you, Surbhi, do you know that between 1991 and 1995, there were more than 5,000 IPOs in India? Okay?
Okay.
And out of those 5,000 IPOs, today the listed stocks itself are 6,000. After that, a lot of IPOs came. Before that, there were a lot of listed companies. 9 out of 10 companies in India eventually delist over a period of time. Okay, IPOs to me become a gambling game, where people just apply for listing gains and then sell it. So, if you're treating it as a casino, then don't come and blame the stock markets later on if you lose money, right? So, and coming to innovation, we've always been innovating. We kind of feel that we are innovating, but everything here, this camera, everything is an innovation. We tend to just underappreciate it.
You know, let me pull you back to large caps as the category, because you began by saying that large caps maybe, does that segment have value, you think?
So, amongst the top 50 companies that I mentioned, okay, 25 of them are PSUs, which are by historical metrics quoting at a much higher P multiple than their historical right? A big segment of that is banks. And everybody's been bullish on banks for the last 1 year. And I've been telling banks will not do well. And banks have actually underperformed throughout this. For the simple reason, Prashant, last 15 years, we've not seen what an NPA cycle is. The last NPAs arose in 2007-8, got cleaned up in 2015-16, right?
And people but that was more of corporate NPAs. Now the corporate balance sheets are quite strong, right?
Precisely the point, Nimish. But the pain is on the consumer side.
Sure.
The pain is on the consumer side. The corporate lending is... So Nimish, this time there's not going to be any NPA. There's going to be equity. There is going to be NPA in the equity book.
But you know, historically we've seen the retail NPAs doesn't seem to be that bad as what the corporate NPA is to be, right? I mean, obviously we've not seen the history of retail NPA going belly up and not paying off, but still, you know, at least the corporate balance sheet is good. So from that perspective, don't you think bank makes a good point to enter?
Never before have we had retail lending like this as well. 15 years of, you know, MFIs and NBFCs and this we've not seen for 15 years.
But we've had periodic busts, right? I mean, IL&FS happened 2018. We've had, I mean, their entire cycle, DHFL.
See, IL&FS was more again infrastructure.
It's all
it had got nothing to do with
retail. We've not seen a down cycle and how that looks like and feels like.
Right, and
but we are seeing the accident now in MFIs, right? Credit access, all the stocks
But
are
MFI
MFI
is supposed to have an NP cycle every 10 years.
Yeah,
I mean, that's the nature of the business.
But people forgot, right? That is why they go, otherwise why would you give 10 times price to book for the MFIs?
Right. So just to complete that point on large caps, what's the view? I mean,
what's the view? Again, as I said, large caps would be a hiding place. Okay. People said, as I said, Nifty went from 20,000 to 25, 26,000, whatever. Stocks went up 100%, 200%, 300%. Nifty is back to 23,000 and you've seen the damage. If Nifty goes to 20,000, you can imagine what the damage on the rest of the portfolio.
But where to hide, Siddharth? Where to hide?
Gold.
From the large caps.
Let me ask.
No, and from the large caps. Gold we got.
See, as I said, I've never been a large cap investor, so I don't want to, go about. I'm just putting out the analysis for you.
So let me ask that question in a different manner. Your point on valuation is well taken. And we know you don't like much in the market. You're sitting on 90% cash. But which could be the pockets, whether mid-cap or large cap, wherever, where valuations would kind of somewhere come, not right now, that might not be the case right now, but maybe as things progress, where you find realistic valuations with decent growth. Let's not compare with China. Now, China's a different story. I mean, the major one example.
Look at the European markets, right? First, you have to understand valuations in the global context as well, right? US banks have had a record quarter of profit growth. Why wouldn't anyone in the global FII in their right mind buy, HDFC Bank over a JP Morgan or a Citigroup or a Goldman Sachs? When HDFC Bank, for the next 4 quarters, growth is not going to be there. Right? So to all those people who are saying we're going to punish the FIIs, we're going to force them to buy higher. Look, guys, you're 3% of the global GDP. Right? For the FII, India doesn't matter. It does, means, and those are the guys who've been investing since 1991. They have made money in India over the last
30 years,
35 years. We're telling them that we know.
No, and now they've sold because we've given them the exit. Otherwise, they would have not sold. I mean, just because there is so much of domestic liquidity which is helping them to exit, they are happily exiting.
Oh, they've made so much money on option trading.
Yeah, absolutely.
They've made so much money on option trading.
That is another topic which is very close to your heart, but we've not found time to address that. So I hope you come back.
Yes.
For
sure. Forward to more of these.
Yes. Thank you very much.
Thank you.
Thank you, sir.
Thanks.
Thank you.
All right, thanks so much. And with that, it's curtains on this extremely interesting conversation. Thank you for watching.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
I am thinking that since the chatter is there and it is logical that the government has given some incentive to the corporate sector through lower taxes in 2019, and they have done something for the lower this thing in terms of giving food and subsidy, and the states are giving, that you might do something for the middle class or for the taxpayer. And that also it's coming now, but I've been saying it for the last 30-40 days that, there is some scope, maybe $4-5 billion, say 30,000-40,000 crores. But if you divide that by number of people who may get it, say, 2 crore or 3 crore taxpayers, it'll come to 8,000-10,000 rupees or something like that per annum. So you can get that much. I think it's possible to make it a little fair. I don't think it'll matter because it's let us say in a family.
On the eve of the budget, the economic survey projects sluggish growth next year, pegs FY26 GDP growth rate between 6.3 to 6.8%. Growth rate for the current financial year estimated at 6.4%, the slowest in 4 years. The economic survey warns India Inc. of wage growth moderation when corporate profits are at a 15-year high. Says it is in the enlightened self-interest of corporates to take job creation seriously. The survey also says the private sector needs to do more to boost consumption.
So deregulation is not just about ease of doing business, it is a pathway to employment generation.
The chief economic advisor makes a big pitch for deregulation, asks governments to get out of the way and allow businesses to focus on their core mission. Says governments must stop micromanaging economic activity. The economic survey warns of a churn in the labour market due to the rise of artificial intelligence, as the problem is magnified for India given its size and relatively low per capita income. The budget session of Parliament kicks off with the President's address. The government has listed 16 bills besides the financial legislations related to the budget. Opposition sharpens the knives, calls for a debate on the economy and the Kumbh Mela tragedy, among other issues. Well, those are the headlines from Parliament as the budget session begins. Thanks very much for joining us on Business 360. I'm Shireen Bhat. But the other big stories we're tracking for you this evening. Stock markets perk up ahead of the budget. The Sensex gains over 700 points. The Nifty reclaims 23,500. Both indices up 2% this week, snapping a 3-week losing streak.
My response to competitors is I think they celebrated too soon. Yeah. Right? Let them bring their response to our announcements today, and we'll see. Market mein milenge unse.
Competitor celebrated too soon. It's game on, says Ola Electric's Bhavish Agarwal. The company launches 4 new electric scooters with a starting price of 80,000 rupees. Apple's revenue rises 4% in the December quarter, but iPhone sales failed to meet expectations. Tim Cook says the company is particularly keen on India as sales hit a record high. Nestle India meets estimates in Q3. Volume growth at 3% beats estimates, making it the first major FMCG company to deliver higher growth in this quarter.
मां लक्ष्मी से प्रार्थना करता हूं कि देश के हर गरीब एवं मध्यम वर्ग समुदाय पर मां लक्ष्मी की विशेष कृपा रहे।
भारत की विकास यात्रा के इस अमृतकाल को आज मेरी सरकार अभूतपूर्व उपलब्धियों के माध्यम से नई ऊर्जा दे रही है। तीसरे कार्यकाल में 3 गुना तेज गति से काम हो रहा है। आज देश बड़े निर्णयों और नीतियों को असाधारण गति से लागू होते देख रहा है।
Boring. No comment.
No, poorly. The president was getting very tired by the end.
Repeating the same thing again
No,
and
she
again.
could hardly speak, poor thing.
It's the eve of the union budget. The government has tabled the economic survey projecting FY26 GDP growth at between 6.3 to 6.8% for the financial year. It has been estimated at 6.4%, the slowest in 4 years. With growth slowing down, the chief economic advisor sent out a clear message to corporate India. The baton on capital expenditure needs to pass on to the government, and India Inc. needs to do more. The CA points that corporate profits are at a 15-year high, but wage growth is moderating. The CA says, and I quote, "It is in the enlightened self-interest of corporates who are swimming in profits to take job creation seriously," end of quote. But not just corporate India. The economic survey also has a word of advice for the government, and that is get out of the way. Allow businesses to focus on their core mission. Deregulation clearly has been the big central theme of the economic survey. It says the government must stop micromanaging economic activity. And it's not just deregulation that the government has pitchforked as an idea. The survey also warns India Inc. not to ignore the impact of artificial intelligence. Over the next few minutes, our team of reporters will decode the key commentaries from the survey. But first, listen in to the chief economic advisor who, without mincing words, said the private sector needs to do more to boost consumption.
The growth in profitability and the growth in employment expenses, which is a combination of hiring and compensation, there is a huge disparity between the two, which has been highlighted by several private sector players themselves in the last few months. And this happened even as Indian corporate sector profitability hit a 15-year high in March 2024. And some of you may have heard that when in the 1960s, when Henry Ford raised the minimum wages for his car workers, he said, otherwise there will not be enough people to buy the cars the Ford Motors produces. So in some sense, raising wage and salary growth for workers is also a source for aggregate demand for businesses in the medium run as well. So it is both, it is enlightened self-interest rather than being seen only from a moral prism as well.
The government can continue to take policy actions as it has been doing with respect to PLI schemes on labor-intensive sectors, and also in terms of the deregulation action, that is the government's, not just the union government, but the state governments and local governments' contribution to employment generation is by reducing the fixed cost of doing business so that firms can raise the variable cost by hiring more people. Beyond that, I think not everything needs a policy tweak or a policy intervention. Some of it is in the natural self-interest of businesses to be able to find this balance. And that is why I gave the example of Mr. Henry Ford. Recommendation which is made not just to the union government, but to governments around the country is actually a step to boosting employment, income generation, and therefore consumption. This is about deregulation, is exactly towards that. It is not a recommendation only to the union government. So by simplifying regulations and by looking into the nuts and bolts of regulations that affect small businesses, we are lowering the cost of doing business for them, therefore opening up the space for them to hire more, which will lead to income growth and therefore better consumption. That is the very precise recommendation that the economic survey is making to governments all around the country.
Well, that's the message to governments across the country from the chief economic advisor. But let's focus on the growth outlook. The economic survey expects growth for the next fiscal between 6.3 and 6.8%. It mentions elevated geopolitical and trade uncertainties and the possible commodity price shocks as key headwinds. Sapna joins us now. Sapna, the survey projecting growth pangs are likely to continue, and of course a realistic assumption there on the numbers.
Absolutely. In fact, the survey has borrowed heavily also from the IMF outlook as well as the World Economic Outlook. So keeping that in mind, first in terms of the nominal GDP for the next 5 odd years, the survey says that, as predicted by the other agencies, around 10.2% in US dollar terms is what India's nominal GDP could be, and 10.7% in INR terms. Also in the US dollar terms, our CAD could be around, it may rise very gently and in a very calibrated manner over the next 5 odd years, around 2.2% of the GDP. But this is actually in dollar terms. In terms of the growth numbers, it says very clearly that the 6.3 to 6.8% assessment for FY26 is also based on the IMF's growth assessment of 6.5%. Starting, FY25 onwards, from the current financial year onwards. So basically, this range of 6.3, 6.8 actually hinges on the IMF's, estimate of around 6.5% growth for India over the next 5 odd years. Now, the CA, the economic survey also mentions very clearly that even if these variables India is able to achieve over the next, 3 to 4 odd years, it's a very good scenario for us because looking at the global context and the global situation at the moment. So, no doomsday indications that, we are down and out. In fact, the commentary, the narrative is extremely positive. And as you have heard, what really is required going forward may not be that much in terms of economic reforms per se. Like somebody asked the CA, what about the employment sector or rather the labor sector, and what further tweaks are required. So he indicated that look, in terms of the employment schemes and skill sets that have been announced in the previous budget, these are policy actions in course, in practice, ongoing at the moment. So I think what the hint over here is that instead of economic reforms, we should be looking actually at business reforms, where the industry, the state governments and academia particularly need to come together and figure out what needs to be done, how those basic bottlenecks need to be removed so that the growth momentum is maintained at the moment, and also whatever we are predicting is achieved and maybe even higher than that. But it's a challenging situation globally. He has also spoken about the China factor very clearly, both in terms of the energy transition, China being the single sole major supplier of critical ingredients for a lot of sectors, also for the technological sectors. So, the elephant and the dragon in the room is the exact phrase used in the economic survey. And this is something that we'll have to be very, very mindful over the next 1 to 2 odd years. In fact, even 3 to 4 odd.
All right, Sapna, many thanks for joining us. And the survey has also raised the alarm over disproportionate rise in corporate profits, while wage growth has not grown significantly. In fact, it has remained stagnant. Shivani's here with more on what the survey says. Shivani.
India Inc. is witnessing a record surge in corporate profitability. According to the economic survey, corporate profits hit a 15-year high in FY24, with Nifty 500 firms' profit to GDP ratio climbing to 4.8%, the highest since FY08. This boom was driven by strong performances in financials, energy and automobiles. Large corporations, particularly non-financial sectors, significantly outperformed smaller firms in profitability. However, despite profits rising by 22%, employment grew only by 1.5%. Highlighting a sharp disparity. The survey also highlights an analysis of 4,000 listed firms found that while revenue grew by 6%, companies focused on cost cutting, with employee expenses rising just 13%, down from 17% in FY23. The survey flags wage stagnation, especially at the entry-level IT positions, despite stable EBITDA margins of 22% over the last 4 years. While labor share in gross value added has slightly improved, the disproportionate rise in corporate profits, especially among large firms, raises concerns over income inequality and its impact on consumer demand. The warning is clear: for sustained economic growth, wage growth must align with corporate profitability. Without higher employment incomes, consumer spending could slow, impacting future investments and economic expansion. The survey underscores the need for a fair distribution of corporate earnings between capital and labor to ensure long-term sustainability and stability. Back to you.
All right, Shivani, many thanks for joining us. Deregulation, that's been the central theme of the economic survey. The survey asked governments to get out of the way and allow businesses to focus on their core mission. It says governments must stop micromanaging economic activity. The word regulation and deregulation together has been mentioned close to 350 times. Pariksha joins us now with more. Pariksha, the CA urging the government to pull out all levers of deregulation.
Economic Survey 2025 has given a clarion call for deregulation and getting out of the way. The CA has gone on to say that the future of reforms and economic policy must now be on systematic deregulation. India needs to go all out to reduce compliance costs, administrative costs and minimize controls. We need accelerated deregulation to attract, promote and facilitate domestic and foreign investments. The get out of the way theme also stood out, with the CA saying that the government should not micromanage the private sector and drop the principle of guilty until proven innocent and rather follow the principle that says one is innocent until proven guilty. The survey says that India is overly dependent on China for critical components, minerals and other electronic equipment, and if the China challenge is big for Europe, then it's equally serious for India as well. The only way for India to reduce overdependence on China is through deregulation. The survey also said that deregulation is more critical for MSME growth than large enterprises. The survey also says that reduction in tariffs and fees, digitization of systems, setting legal safeguards for enforcement and risk-based regulation are all ways through which deregulations can take place in the next few years.
Parikshit, many thanks. The survey has also warned of a churn in the labour market due to the rise of artificial intelligence. Ashmit is here with more on that. Ashmit, what has the survey said on AI and possible job losses and what it prescribes as a possible intervention?
Well, two key themes to what the economic survey is saying. One, that it may be costly if you underestimate the risk coming in from AI replacing jobs. That's one. The second is there's also perhaps a case to be made for taxation of profits made from replacing jobs with technology, with AI. That's the twin theme. The economic survey begins by saying that the impact of AI in terms of job losses will be magnified here in India due to the large scale of the market here. And number two, the low per capita income that we have, or saying that there are already churns being seen as far as the labor market is concerned in anticipation of this technology that is coming. Then going on to say that we need to guard against any form of complacency. There's a low probability, but we still need to guard against it. There needs to be a constant state of vigil. And then finally going on to urge the industry that there needs to be a staggered approach in which this technology is adopted. There needs to be a sensitive approach to adopting this technology. And then going on to say there are already conversations being had in international circles at forums like the IMF that there is perhaps a case to be made for taxation of profits that are made from replacing humans with upcoming, newcoming technologies. And finally going on to say that there is perhaps a three-point agenda that we need to follow. Number one, having institutional readiness, ensuring that our institutions are geared for this change. Number two, ensuring that there is a regulatory framework in place to push the technology in one specific direction. And finally going on to say that there is also a need to structurally change the skilling framework that we have to make sure that children are ready, are geared for the future.
And the survey highlights the progress of the industrial sector and measures taken by the government to boost the sector. Timsy standing by with more on that. Timsy.
Well, that's right. The economic survey has laid out some key challenges and some positives when it comes to the industrial reforms. The survey says that India's industrial sector has seen a growth of 6.2% in FY25. Especially when it comes to the strong growth it is seeing from electricity and construction growth. It also lays out that the industrial growth, which had slowed down to 3.6% in the second quarter due to weak exports, monsoon impact and festival timing, seems to be easing in the latter half of the fiscal. It also says that the manufacturing exports are hit by global economic slowdown and rising trade competition. But yes, heavy monsoons, which were slowing sectors like mining, construction and manufacturing, are also to be seen. But yes, also to be noted is that this heavy monsoon is actually giving a boost to agriculture. The festival timing shift led to a second quarter decline in the growth, but consumer demand is slowly picking up since October. The reforms also laid out in the survey say that the state level industrial growth varies, especially there is a scope for further expansion across various regions, and now states need to do some bit of heavy lifting there to boost industrial growth. Also, it says that the government focus on R&D and MSMEs and capital goods to boost long-term industrial growth are yielding some benefits, and that is also going to be the thrust that the government is going to focus on. So let's see what are the policy measures that the government announces, because survey says that many policy measures are under the review to address export challenges and strengthening the domestic manufacturing. And yes, the upcoming budget and the next fiscal is something where government will keep on intervening whenever required to give the industrial reforms a boost, something that we'll have to see.
Timsy, many thanks. The survey also highlights that India's external sector showed resilience amidst global headwinds and uncertainties in economic and trade policies. Abhimanyu is here to detail more. Abhimanyu.
India's current account deficit had moderated to 1.2% of the GDP in the Q2 of FY25 compared to 1.3% in the corresponding period in the previous financial year. Also, the economic survey indicated that India's forex reserves were sufficient to cover 90% of the external debt as on September 2024. Also, uncertainty in the global markets and profit-taking by foreign portfolio investors had led to capital outflows. The survey further observed that the gross FDI inflows had shown signs of revival in the first 8 months of FY25. Also, several non-tariff barriers had been erected by developed countries, including EUDR and CBAM, which may impact India's exports in the years to come.
Abhimanyu, many thanks. Up next, Ola Electric's Bhavish Agarwal dares rivals, saying competitors celebrated too soon and that it is game on. Stay tuned for that and more when we return.
₹700 per month. Okay. Now, what will you do with it? Because inflation is there. Secondly, the basket of people have changed. Will they order one more time Zomato, or will they change or buy an extra lipstick? Who knows? Because in the olden days, these things were much simpler to do. Or maybe there'll be a telecom price hike after a few days and some of this money would have gone away, or whatever, 600, 700, 300, 200, whatever. So the point is, you don't exactly know what to do if the amounts are otherwise small, and nowadays the basket is a bit wide. So you will say good and thank you and on behalf of everybody, and it'll help the consumer sector. But now which stock will they go to McDonald's more? Where, by the way, I own that stock also, which has been a dud for 2-3 years, but before that was good. So will you go one more time to Westlife? Who knows? I don't consider Zomato as a discretionary stock, in the sense it is just replacing what you were doing, which is why we like those kind of stocks where you are not trying to say that the customer has to spend more money. It is just reorienting. That's why we like the quick commerce. He's not spending extra money. He's just making it convenient for him to buy via this channel versus that channel. I don't like the consumer staple because I think that the consumer basket has expanded to beyond just upgrading a soap or something because monsoon has come, which was the old formula. In the old formula, when I was in Alliance Worli, we would see if there's rain outside our window in Bombay, and then you would go and buy levers and you'll make some 5-10% in 6 months. So those days are gone. Now you don't know. There are private labels. And then the customer himself or the consumer himself has or herself may want to buy something which they can show on social media or in a photograph or in a selfie. Some of these things, who knows?
Well, here's a fallout of the DeepSeek phenomena. The Indian IT Minister Ashwini Vaishnav making the big announcement that the Chinese large language open source model DeepSeek will be brought to Indian servers, will be brought to Indian shores so that it becomes available to Indian users. Sounds simple? Well, not quite. A lot of jargon there. What does it actually mean? Let's help you break this down to understand what really has transpired with this announcement being coming from Ashwini Vaishnav. Now, let's assume, and I'll explain that with the help of an analogy, the analogy of the humble tea, the common denominator between 2.8 billion Indian and Chinese. Now, let's assume that DeepSeek is this Chinese tea in this cup of tea. Now, what's important is that this is an open source AI model. What that effectively means is that the core code, which is the heart of the model, which is the recipe of the Chinese tea, is publicly available. So what the Indian government is proposing is that we'll use this recipe of the Chinese tea and replicate it here on Indian shores, on Indian servers, and have exactly the same model here present in India for Indian users. But that's not all. Let's bear in mind, we like our masala chai, like most things in life, we like a little tadka in our life. So we'll add a little input to this. We'll add some components. We'll add some sugar. We like some sugar in our tea. We'll definitely add some ginger. We like ginger as well. And let's not forget the milk in the Indian tea. And having done that, we'll come to the finished product, which of course is a humble masala chai, is a humble cutting chai. So why are we doing all of this? Why is Ashwini Vaishnav doing all of this? Well, the long and short is, number one, let's not forget the obvious out of the way, which is the masala chai tastes a lot better. But having addressed with the obvious, the other two key components why the Indian government is doing is number one, all the components that we added, the sugar, the ginger, the milk, what that essentially represents are tweaks that Indian engineers will be able to do on Indian servers to this DeepSeek model. Now, why would we want to do that? Well, let's bear in mind there were niggles with DeepSeek when it initially came out. It wouldn't accurately answer questions about, say, the 1962 war or the status of Arunachal Pradesh. So this masala chai, with all these components, represents tweaks that the Indian engineers will be able to do on the Indian servers so that it becomes slightly more comprehensive. But the second and
Well, let's talk about the market action. The markets going into the budget strong. The Sensex gained over 700 points. The Nifty reclaiming the 25,300 mark. Financials, though, marginally underperformed the blue chips, with the Nifty Bank closing about 0.5% higher. Midcaps closing almost 2% higher today. It's a 1,000-point rally there as far as the Midcap index is concerned. But Trump's tariff threats pushing gold prices to a record high today. This after investors flocked to the safe haven metal. The yellow metal is now on track for a 5th consecutive weekly gain. This also marks gold's best monthly performance since 2024. Competitors celebrated too soon. It's game on. That's the word coming in from Ola Electric's Bhavish Agarwal. His comments come months after Bajaj Auto MD Rajiv Bajaj took a jibe at e-scooter maker at CNBC-TV18's India Business Leader Awards. Agarwal was speaking at the launch event of 4 new electric scooters. The Gen 3 models, as Ola calls it, start at an introductory price of 79,999. He added the company had enough headroom for aggressive pricing.
Gen 3 allows us to reduce the cost of manufacturing while improving performance. That's because, again, technology allows us to deliver better in lower cost. So we have that benefit, and Gen 3 gross margin benefit starts now, doesn't end now. Through the year, I had again last quarter said that through the year we'll keep getting benefits from the Gen 3 platform as we add more and more technologies into the Gen 3 platform through this calendar year. So all of that said gives us more headroom in the gross margin. Market pricing will be opportunistic and tactical depending on how competition is evolving, depending on how our market share strategies are evolving. So time by time, period by period, festive season, that will keep evolving the pricing strategies. Sure. But our leadership on cost of manufacturing actually enhances with Gen 3 significantly. So 30-35% is what I'm continuing to guide the street on. And if you see the last 2 weeks in January, we've actually been in that zone on a weekly level. We've been in the 30+ zone on a weekly market share level. And I think with all the new products, with the 12 products that we have now and the pricing, we should get there. And, if competition is aggressive on pricing, we have enough headroom to be aggressive on pricing.
I don't know if you heard Mr. Rajiv Bajaj at the CNBC-TV18 event saying, Ola to Ola hai, but Chetak to Shola hai. But the gap between you and your competitors right now is also very close. So what gives you the confidence you'll be able to, bridge this sort of in the coming months?
See, my response to competitors is I think they celebrated too soon.
Yeah.
Right? Let them bring their response to our announcements today, and we'll see. Market mein milenge unse. Market mein mil hi rahe hain, and we are back to number one. Yeah. And we have all these products, the technology. The incumbent ICE companies had a one-time advantage of distribution scale, which we have nullified now. And the product advantage was always with us. It has enhanced with our Gen 3 portfolio. And the pricing advantage also with our better cost structure is also with us. So I think game on.
Well, that's Ola Electric's Bhavish Agarwal. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment.
That the government has is that the government doesn't want you sipping tea from the Chinese cup of tea, as that will leave your imprint, and by your imprint I mean your data with the Chinese servers. What the Indian government is essentially saying, let it come here and have a cup of tea from the Indian cup of tea, the Indian server, so that your imprint, your data stays safe within Indian shores. So this Chai Pe Charcha is the long and short of why the Indian government is bringing DeepSeek on Indian servers to Indian shores.
इसके लागू होने से प्रदेश में सच्चे अर्थों में सशक्तिकरण भी होगा, सुरक्षा भी होगी। इसके द्वारा जो कुछ कुरीतियां हैं, अब हलाला, इद्दत, बहुविवाह, बाल विवाह, 3 तलाक आदि जो कुप्रथाएं हैं, उन पर पूरी तरह से रोक लगाई जा सकेगी।
history as the first woman finance minister to present her 8th consecutive union budget. From replacing the colonial era briefcase.
Well, we are counting down to the union budget. The economic survey has been tabled. We've, of course, been analysing what the survey has to say. And as I've been pointing out, the theme running through the economic survey is deregulation. Get the government out of the way. That is what the survey is highlighting. And, of course, it does have some focus areas that it believes the government ought to put its bandwidth behind. But, of course, the message to the private sector is you need to pick up the baton from the government as far as investing is concerned and start to do the heavy lifting on investments. How much of all of this will translate into policy action and policy decisions, we'll know tomorrow. The growth number, of course, as we've been pointing out, rooted in reality between 6.3 to 6.8%. Rathin Roy, distinguished professor at the Kautilya School of Public Policy, with us, also one of CNBC-TV18's budget editors this year. Rathin, great to have you join us on the program. Also with us, Anish Shah, the former president of FICCI and president and group CEO, managing director of Mahindra Group, and Surjit Bhalla, the former ED to the IMF. Gentlemen, appreciate you joining us. Rathin, first takeaway from the economic survey and the messages it's sending out.
Well, there's nothing wrong with the messages. I think everyone would agree that the growth forecast is reasonable, that the chief economic advisor, this particular one, is an honest man. And he has been honest about the maximum possibilities implied in the next year. Everyone knows following the Trump election that the external front is going to be likely rocky and India will have to navigate it carefully. Everyone knows that agriculture has far too high an increasing share in GDP and manufacturing has a lower share in GDP than we would like. It's the lowest in my lifetime. So I think in terms of his message of government getting out of the way, as a truism, I have no disagreement. The ED should get out of the way, and no doubt Surjit Bhalla's deep state should get out of the way. So I think it's quite an unexceptional economic survey. There isn't much economics in it, frankly, but that's okay. That's okay. This is not an economics-oriented government. And therefore, the political and economy messages, I think, are both clear and honest and modest. And the sort of overall aphorisms that are contained in the survey about what's happening in the world and what's happening in India are not easy to disagree with, very difficult to disagree with. So it's a good survey. And what I like about this survey is it's not this last 10 years, at least since 2017, we had these sort of flash bang economic surveys which pretend to have a theme and a focus and that sort of thing. This is what an economic survey traditionally was. It's very good geography. It's very astute. It provides a 360-degree view of the Indian economy and the rest of the world. I think that's a very good thing. I like this survey.
Yes, the survey highlighting, of course, what has happened across each of those sectors, from manufacturing to infrastructure to the PLI schemes, etc. Let me bring Anisha into the conversation as well. Anish, as I was pointing out, the message to the private sector is you are swimming in excess profits. In the words of the economic advisor, those are not my words, and it is time now for the private sector to do more on job creation, Anisha. In light of what the survey is suggesting, what's the expectation that you go into for the budget?
So Shireen, good afternoon. I will start with a direct response from a private sector standpoint. The Mahindra Group has tripled capacity in auto for the last 3 years and has added 60% more capacity for tractors and is investing significantly in multiple areas. So we see a lot of optimism in India. We see the fundamentals very strong for growth in India. And the survey is essentially taking that forward. In fact, there's a lot of optimism. We see PMI up for literally 14 quarters in a row. And there are a number of other indicators that are positive as well. Yes, growth is at 6.3 to 6.8%, a little lower than what we'd like. But we will continue to see some blips along the road. But overall, the India story is a very strong one. Specifics in the survey that we think are very positive are first around farm and the fact that the agri-produce will likely be better. Second, the focus on productivity. That's a critical thing from an India Inc. standpoint. And third, specifically what you have on the screen up there around deregulation, but more importantly, reducing the cost of manufacturing. That is going to make India the manufacturing hub. We have a number of ingredients in place to be able to make that happen. And with greater focus and emphasis on ease of doing business and on deregulation, that will help us reduce cost along with other measures that need to be taken and some aspect of demand stimulation. So I think these are all the factors that really put us on the right path, and we feel good about where we are.
Well, you're going into the budget feeling good about where you are. So let me ask you about what the hope now is as we count down to the budget 24 hours away. In light of what the survey is saying, what's the expectation on Capex? Of course, it has been a record number that we've seen over the last few years. Do you anticipate a significant increase, or do you believe that it's likely to be around the similar number that we saw last time around? And demand stimulation, what's the expectation outside of Capex on demand stimulation, Anish?
So first, we would say stay the course on Capex. That's been a plus in the budgets over the last few years, which is a focus on the multiplier effect that Capex brings in and the positivity from an economy standpoint on that front. The second is there is clearly a need for some demand stimulation because we see weakness in the middle and the lower segments, and that's something that needs to be addressed in a pinpoint manner for them. One potential way to do it that also links in with simplicity is to simplify the tax code and potentially have a stimulus again for the lower and the mid segments of society that will hopefully get us stronger demand. And these are the main things that we would look at. Yes, there may be a few others, but these are the primary ones.
Yes, I think the focus on Capex, the hope is that that will continue, and the assumption is that that will in fact continue. What can the government do in terms of providing tax relief is the big question. Will this be the budget that finally addresses the middle class by way of tax relief? The hope is building on that front. Whether we'll see a slab rejig is the big question. But let me welcome Surjit Bhalla to the conversation as well. Surjit Bhalla, many thanks for joining us. Your big read from the economic survey, but more importantly, what you believe it could perhaps signal the budget will take forward.
The big read from the economic survey is that we've got a very strong inclusive growth. We don't have high growth. That is very clear from the survey, expecting only about 6% or so, 6.3% next year or this year. But, you know, the inclusive growth numbers are very, very impressive. Whether you look at what has happened to consumption growth across the sectors, and they cite the survey, the latest 23-24 survey. So agricultural growth is very, very strong. And actually, this is a big story that I think is underemphasized. We used to have agricultural growth for the last 55, 60 years at somewhere around 3%. And now we have graduated upwards to about 5% agricultural growth. So that's the good news in the economic survey that I see. There are some not necessarily good news, but something I don't understand. And Shireen, you pointed this out about expecting job growth to come from that. What is it? Give me the exact quote that the government has
enlightened.
Something.
No, it's in the enlightened self-interest of the private sector.
You know, I think we should discuss that a bit more. Look, I've just stated that I think there's a lot of inclusive growth, and I think there are very robust numbers to suggest that. But I haven't, you know, it's got to be the very definition of socialism, right? That it is in your enlightened self-interest to give a higher wage. I just do not understand that statement. Second, I think the government, or the economic survey rather, is not reading the data. They present data on very high growth in employment, which I think is very positive, part of inclusive growth. But, you know, they want to circumvent also the conclusion that real wages have not risen to a very strong extent. There has been a very solid growth in the real wages of the casual workers. But the salaried workers, which are basically the middle class, there has been almost zero real growth in real wages. So this is the problem. And, you know, why don't they connect the two? If I were to try and make some sense out of this, you've got a big expansion in supply. That supply is being accommodated by the market, but it is being accommodated, as Econ 101 would suggest, by not much rise in real wages. That's the story. So enlightened self-interest won't do anything, and I don't expect anybody to really work in the enlightened self-interest. Everybody is working towards maximizing, you know, it's age-old stuff, maximizing their utility, maximizing their profits, etc. Let that be. That is the state of the world. That is the state of the economy. So let's not bring in these other weird notions of enlightened self-interest.
Very quickly, Surjit Bhalla, do you expect tax cuts for the middle class tomorrow, to the point that Anish was making in terms of stimulating demand?
Absolutely. I think it's absolutely necessary, given the results that I have just talked about, and I have written about it, will be writing about it, that I think it's an absolute necessity for them to have significant tax cuts across the board. Real wages have not increased for the salaried middle class. And, both for political reasons, and, it's good politics to have, if you will, satisfy or accede to the interests of the middle class. Middle class, it used to be the case that most of India was poor. So therefore we do policies in the name of the poor. I think now most of the population is middle class, and therefore our policies should be in the name of the middle class. One such policy, and a very important one, is to boost up their real disposable income. A growth in real disposable income is needed, and that can only be done by having a significant tax cut.
To delivering the longest budget speech in history, her tenure has been marked by milestones and transformative policies that have shaped the nation's economic journey. Her maiden budget speech in 2019 set the tone for bold reforms, and she has since introduced several initiatives that left lasting impact on India's economic policy. Let's dive into the landmark schemes and key tax reforms introduced under her leadership. Now, Sitharaman's budgets have introduced numerous initiatives aimed at driving inclusive growth, like the PM Suryodaya Yojana in 2021. Announced in the budget 2021-22, this initiative aimed to provide solar energy to villages that lacked grid connectivity. It was a step towards clean and sustainable energy, empowering rural communities while promoting renewable energy adoption. The Credit Guarantee Scheme for MSMEs was another such scheme. Revamped in budget 2024-25, this scheme provides collateral-free loans with a guarantee cover up to 100 crore rupees, addressing financing challenges faced by MSMEs. PM Vishwakarma Yojana is another such scheme. Announced in the budget 23-24, this initiative supports artisans and craftspeople with collateral-free credit up to 2 lakh rupees, toolkit initiatives, skill training and marketing assistance, helping preserve traditional crafts. The Vivad Se Vishwas scheme is another such milestone. Launched to resolve pending tax disputes, this scheme offers taxpayers a chance to settle cases by paying only tax amount with penalties and interest waived. PM Gati Shakti Master Plan in 2021. Now, a 100 lakh crore initiative focused on integrated infrastructure development, enhancing connectivity and reducing logistic costs. The Atmanirbhar packages in 2020 during the COVID-19 pandemic. A range of measures supporting MSMEs and businesses were introduced under this initiative during the pandemic, emphasizing self-reliance and domestic manufacturing. Now, the tax reforms on the taxation front have also been big. Sitharaman's budgets have implemented sweeping reforms to streamline the system and enhance fairness. Like the corporate tax reduction in 2019, the corporate tax rates were slashed to 22% for existing companies and 15% for new manufacturing firms, making India an attractive destination for global investments. The optional personal tax regime, or the new tax regime in 2020, a simplified system with lower tax rates but no exemptions was introduced, giving taxpayers the flexibility to choose between the old and the new regimes. Another such initiative was the capital gains reform of 2023. The government removed the indexation benefit from the debt mutual funds, bringing all asset classes, including equities, debt funds and fixed deposits, under the same tax regime. While this reform created parity in taxation, it also drew mixed reactions as it increased the tax burden on long-term equity investments. The abolition of angel tax was another such initiative for all classes of investors. In 2024, in the budget of 24-25, Sitharaman proposed abolition of the tax for all categories of investors. This move was expected to bolster the Indian startup ecosystem, boost entrepreneurial spirit and foster innovation across sectors. Now, Nirmala Sitharaman's budgets have been a mix of bold reforms and targeted policies, be it support for MSMEs, sustainable energy or comprehensive tax reforms. As she gears up to present her 8th budget, expectations are high for announcement that she will steer India's next phase of growth.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years. It's the eve of the Union Budget. The government has tabled the economic survey projecting FY26 GDP growth at between 6.3 to 6.8% for the current financial year, estimated at 6.4%, which is the slowest in 4 years. With growth slowing down, the chief economic advisor sent out a clear message to corporate India. The baton on capital expenditure needs to be passed on by the government and India Inc. needs to do more. The CA pointed out that corporate profits are at a 15-year high, but wage growth is moderating. The CA says, and I quote, "It is in the enlightened self-interest of corporates who are swimming in profits to take job creation seriously," end of quote. Without mincing his words, the CA also said the private sector needs to do more to boost consumption. Let's listen in.
If you look at the growth in profitability and the growth in employment expenses, which is a combination of hiring and compensation, there is a huge disparity between the two, which has been highlighted by several private sector players themselves in the last few months. And this happened even as Indian corporate sector profitability hit a 15-year high in March 2024.
Well, that is the Chief Economic Advisor's message to corporate India. We're now joined by Sanjeev Puri, President of CII, Rajiv Memani, President-Designate of CII and the Chairman and Chief Operating Officer at EY India, Chandrajit Banerjee, Director General at CII. Gentlemen, appreciate you joining us here on the program. Sanjeev Puri, let me start by asking you what you make of what the economic survey has highlighted. Growth between 6.3 to 6.8%, realistic expectation and assumption. That's what the CNBC-TV18 poll of economists is also suggesting at this point in time. But overall, the message of deregulation, but the message of the private sector to do more. What do you take away?
Shireen, I agree with you. I think it's a very realistic projection. In fact, CII also estimates for the current year anywhere between 6.4 and 6.7, so it's extremely realistic. I think it also brings out the point that despite the global challenges, the Indian economy has made steady progress. And not only steady, I would say that the number that we are going to achieve in the second half, which is about 6.8 based on the estimates, it's a good number considering the situation in the world that we are faced with. And the economy is very clearly on a solid foundation. It is kind of also validated by internal surveys of CII. And I think the survey also captures some very important facets that we need to kind of act on to unlock the full potential of the economy, whether it's on human capital development, whether it's around deregulation, boosting investments in the economy, revitalizing MSMEs, and very importantly, I think very clear recognition that agriculture is extremely important for the future. It's a sector of the future, and it has benefits beyond the economics of it, and huge potential in the world, given the largest arable land that we have in India. And I think very the survey on this issue of climate change also recognizes the need for urgent action on adaptation. And this is also something areas also where CII has been advocating, because energy transition by itself is not enough. Is going to benefit us after several decades. Adaptation is a criteria. So several things that CII has also been talking about are very clearly mentioned in the survey. So I think it's a good balanced approach.
Sanjeev Puri, let's pick up on linking what the survey's messages are with the possibility of policy action in the budget. Now, again, as I said, thematically, the survey is making it clear that, look, the government has continued to do the heavy lifting when it comes to Capex, and now it is time for the private sector to also pick up the pace. The private sector needs to do more when it comes to job creation, also needs to do more in terms of wages. The CEA putting up a chart there saying that while profitability is at a 15-year high, wage growth has moderated. Now, in light of what you have heard from the economic survey, what's the expectation? Do you really believe that there's going to be more by way of incentives or SOPs to stimulate demand for industry?
Okay, let me make three comments on it. First of all, yes, every participant of the economy has to do more to realize the dream of Viksit Bharat, and that's a point that was there in the economic survey. So very clearly, industry also recognizes it. The second point is that, we've had a lot of success in sectors like the electronic sector and some cutting-edge manufacturing. I think we need to take those lessons to sectors that are very labor-intensive, like apparel, like footwear, like furniture-related, even tourism for that matter. And provide the policy impetus. You see, the incentive part of it is just one facet of it. There are other facets of it, like, tourism requires infrastructure status. Sectors like apparel and footwear will benefit from FTA, will benefit from ease and cost of doing business tremendously. We're also recommending an integrated investment, trade, and infrastructure and training policy. So this focused approach on these sectors will also unlock the potential of these sectors and create employment. And the third point, let me say, is that, you see, investments are happening. Private Capex is happening. And there is this announcements database also of CMIE, which is showing that it is happening. The question, I think, for us really is about how do we create more investments and how do we create investments in sectors that are more labor intensive, and for that I think it's about the next generation of reforms, and it's about targeted focus on certain sectors that I alluded to. And let me also end by saying that as far as this whole debate on profitability and wage growth is concerned, see, it's like this, that when wages are determined by inflation, it is determined by wage surveys in the market. They are not indexed to profitability. And because when profitability goes down, the reverse doesn't happen also. That's not the way it is done. And what we have to also look at the fact is when we are looking at wage growth, we are looking at an aggregate number. The fact of the matter is industry has become efficient and needs to do so to be competitive. The fact of the matter is there is certification of industry. A lot of components of manufacturing are now become to be done by specialized services agency. And that's what's happened across the world. So we have to dissect this in many ways, because we know for a fact and we have feedback from members that, wages are revised time to time. In fact, periodically it is done. And there are many industries that, are also faced with this whole issue of, really competing for the same pool of talent. So the people have to do it, and that's what the industry does.
So wages need to be indexed to inflation and other factors and not profitability, and that would be the appropriate way of looking at it. That's the message coming in from Sanjeev Puri. But let me bring Rajiv Memani into the conversation as well. Rajiv, passing the baton to the private sector in terms of investments, what does that tell you about what we should realistically now expect as far as government capex is concerned? No one's saying that the government is going to step back, but the expectation that it will be a 20% or 20% plus kind of growth on capex, should that be tempered ahead of the budget, or as the countdown to the budget begins? And more importantly, some of these other items where the survey clearly says deregulation is needed, but of course it also has to happen at the state level and so on and so forth. I mean, do you expect anything concrete in the budget? They had promised this, framework for the centre and states to work closer together on many of these issues. Do you expect that to be taken forward?
Yeah, thanks, Shireen. I'm in the car, so my camera is switched off. I hope my voice is clear.
Yes, it is.
I would think that clearly the private sector has been investing, and the investment rates are going up. At least the more, as we talk to most of the membership of CII and others, I think most of them have pretty healthy balance sheets. They're looking for expansion. A lot of investments happening in the area of energy transition, a lot of capacity expansion happening. I think some of the things have slowed down slightly, partly because, during the elections and other time, the capex slowed down and the economy had some slowdown. There was the impact of, on, especially in some sectors and some industries, the impact of unsustainable capacities that were set up in China, and the impact of that on global commodity pricing, and the long-term view on how how quickly how agile would we be in responding to that. I think that because of that, some slowdown in capacity expansion happened. But overall, I would say the posture of corporate India is very aggressive. I think there's a lot of faith and belief in the Indian economy. The macroeconomic fundamentals are very strong. And you would say maybe the speed may not be what the government is expecting, but we can see surely the signs of capex investments are going up. I think the couple of reasons why some things have slowed down, and I think one of it has been mentioned, and I'm glad that he has really raised it in a very emphatic manner, about deregulation, or as we have called it, ease of doing business. I personally don't think that there will be anything concrete in the budget, but I think in the various in the way he has laid it out, in the various interactions with government, I think this is an issue that is clearly on top of the mind of the government. I'm sure there will be a reference of this. I'm hoping there'll be a reference of this in the budget, but concrete steps will have to be taken by both central governments and state governments. and more so state governments, in terms of trying to see how they can reduce rules, regulations, and the issue that he raised about trust deficit. How can we reduce that? Or and the whole thing around proven guilty, or and when you're innocent, when you're guilty. I think that's a very fair statement, and I'm very positive that I think in the next 12 months we'll see movement on that. On your question on capex, I think the capex will happen. The capex growth government will do, whether it is 15%, 20%, 25%. It's very hard to say that. I think obviously from a CII standpoint, our recommendation is to go with 25%, but the government will have to do the maths on it and see. It definitely has a massive multiplier impact.
But Rajiv, and that's what I want to ask you, because if your recommendation is hike capex by 25%, then does it leave room for the government to do more by way of stimulating consumption and give more tax relief or significant tax relief, which is also the expectation? I mean, if you look at the Prime Minister's comments this morning outside Parliament, he said, Mahila, Garib and Madhyam Varg पे focus होना चाहिए. So if it's 25% on capex, what does it leave them to do as far as tax relief, if possible, is concerned?
Yeah, no, I understand. I think the maths has to work. I would say only three things, Shireen. One is any reduction in income tax, anything that will go to consumption, will add to the GDP growth and therefore will add to the overall buoyancy. Any relief that you give at those levels, a large percentage of that it doesn't go into savings. It all goes into consumption, and therefore a lot of that leads to accelerating in the government revenues also, through direct tax, through indirect tax, and through higher GDP growth and greater tax buoyancy. So I would think that that is one. The second is maybe there can be greater amount of aggression in disinvestments, especially given where capital markets are, given where SIP flows are. So if there are ways to augment revenues, so that if you give the fillip, the growth is there. And the third thing is, I don't think that we will meet our BE numbers. It'll be good to see. I think the RE number should be less than what probably the BE number on the budget is. So the percentage versus the RE percentage versus what the BE is, should be a good percentage, and we should look out for that. Only one thing I just want to add, one of the reasons also where capex slow down to some extent in the private sector, it's not hit the full potential, is that whilst there is this whole issue on employment, but the availability of skilled labor for lots of people who are looking at expansion, whether it is capex growth or other areas, there is a lot of the match between what the demand is and the skilling for those people, and linking that with people who are looking at jobs. I think that chain is still not working very smoothly. So I know a lot of capex plans are also delayed because of the availability of people and skilled people. And the second is the issue with China, because especially in areas of energy transition, a lot of the capex imports are actually coming from China, and there is variability in the speed at which it comes, visa approvals, other approvals, and things like those.
Biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key news makers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
I am thinking that since the chatter is there and it is logical that the government has given some incentive to the corporate sector through lower taxes in 2019, and they have done something for the lower this thing in terms of giving food and subsidy, and the states are giving, that you might do something for the middle class or for the taxpayer. And that also is coming now, but I've been saying it for the last 30, 40 days, that, there is some scope, maybe $4-5 billion, say 30, 40,000 crores. But if you divide that by number of people who may get it, say, I don't know, 2 crore or 3 crore taxpayers, it'll come to 8-10,000 rupees or something like that per annum. So you can get that much. I think it's possible to make it a little fair. I don't think it'll matter, because it's, say, let us say in a family you're getting 600-700 rupees per month. Okay. Now, what will you do with it? Because inflation is there. Secondly, the basket of people have changed. Will they order one more time Zomato, or will they change or buy an extra lipstick? Who knows? Because in the olden days, these things were much simpler to do. Or maybe there'll be a telecom price hike after a few days, and some of this money would have gone away, or whatever, 600, 700, 300, 200, whatever. So the point is, you don't exactly know what to do if the amounts are otherwise small, and nowadays the basket is a bit wide. So you will say good and thank you, and on behalf of everybody, and it'll help the consumer sector. But now, which stock will they go to McDonald's more? Where, by the way, I own that stock also, which has been a dud for 2-3 years, but before that was good. So will you go one more time to Westlife? Who knows? I don't consider Zomato as a discretionary stock, in the sense it is just replacing what you were doing, which is why we like those kind of stocks where you are not trying to say that the customer has to spend more money. It is just reorienting. That's why we like the quick commerce. He's not spending extra money. He's just making it convenient for him to buy this via this channel versus that channel. I don't like the consumer staple, because I think that the consumer basket has expanded to beyond just upgrading a soap or something because monsoon has come, which was the old formula. In the old formula, when I was in Alliance Worley, we would see if there's rain outside our window in Bombay, and then you would go and buy levers and you'll make some 5-10% in 6 months. So those days are gone. Now you don't know. There are private labels. And then the customer himself or the consumer himself has, or herself, may want to buy something which they can show on social media, or in a photograph, or in a selfie. Some of these things, who knows?
Well, here's a fallout of the DeepSeek phenomena. The Indian IT Minister Ashwini Vaishnav making the big announcement that the Chinese large language open source model DeepSeek will be brought to Indian servers, will be brought to Indian shores, so that it becomes available.
CB, let me bring you into the conversation. And Raji was making that point about Capex, and 11.11 lakh crore rupees was the outlay, and we're unlikely to touch that number. It's probably will be closer to about 10 lakh crore rupees on account of the elections and so on and so forth. But, on disinvestment, CB, we have, forget undershooting. I mean, we're nowhere in the vicinity of the target as far as disinvestment is concerned. And what seems now to be clear is that there is no talk even of privatization at all at this point in time. In fact, if anything, there is an effort to try and infuse capital into SIC public sector companies, RINL being a case in point, MTNL being another case in point. So this expectation that we are perhaps going to see some cushion being provided on account of disinvestment and privatization, I mean, is that a real expectation?
This is something that we have put up very strongly, that how do we bring down, government ownership, and how do we really move towards disinvestment? We have been very strongly saying that even if you bring it down to 26%, you don't lose control. But okay, forget 26%. Even if you bring it down to 51% of some of the major companies, we can easily get up to something around 10 lakh crore, and you don't lose control. It's not just that government giving up control at all. So focusing on not only just some numbers, but seeing to it that there is implementation of the disinvestment program, it would be very, very critical, not just for factors that we have talked about, the question that you asked as to where will the money come from if we are going to spend so much on capex again, etc. The money is pretty much available, but it's all that we'll have to implement and really talk and see to it disinvestment is done. It should be a major budget priority. I mean, we should not lose. We remember that we had started talking 10 years back that this will be one of the priority areas of work. And I think that's something that we can pursue. And excepting for one or two signal ones, we have not seen much happening on it.
Sanjeev Puri, the survey highlights the fact that it's going to be a challenging environment to draw in FDI, particularly because more and more governments, including the US government, looking much more protectionist at this point in time. Given that, what would you like to see the budget signal to draw in more FDI, to also spur more domestic spends in sectors like manufacturing, labor-intensive sectors, and so on and so forth? Specific measures, tangible measures that you would think the budget may spell out or articulate?
So I think this is a very, very important question because given the global context, and Rajiv alluded to this whole issue about China also, I think the investments will flow to India on two reasons. One is because of the large growth potential within the Indian economy, and two, India as a hub for the global economy. On both these counts, it can flow to India. And this whole issue about supply chain resilience and diversification is a real focus area globally, despite whatever, the tariffs, etc. are coming. This whole thing about supply chain diversification and supply chain resilience are important lessons. Second is, the world is making a lot of investments on energy transition. The world is going to make even more investments on digital transformation. Now, these three sectors are sectors where India can develop the capacity to attract and also, therefore, become a global hub for such services and exports. There is also this opportunity given the concern on food and nutrition security across the world because of climate change. I think getting competitive, getting resilient in these sectors, creating the ecosystem and enabling policies in these sectors, is what is that will ultimately attract the. We're already seeing it. The question is really how to accelerate it. And if I was to just take an example, if you look at apparel and footwear, labor-intensive sectors, I think the chief advisor spoke about deregulation, specifically focused on labor flexibility. And I would say this sector needs more than what was articulated in terms of weekly buckets. I think it needs far more flexibility in the nature of the industry. And many other industries need that.
Rajiv Memani, one of the other interesting things that the survey did talk about was that we should not be complacent about the challenges that an AI-led world will mean, especially for a developing economy like India, both in terms of job displacement, skills requirement. And one of the suggestions that the survey makes is that, look, perhaps you need to look at taxing AI-linked profits to actually deal with the issue of job displacement, etc. And I was wondering if you had a thought on that.
No, I honestly have not been able to get my arms around to say, how will you do that? I think, and deregulation, ease of doing business and taxing AI profits, don't go hand in hand. I'll have to say that. So it's very difficult because AI's application is now happening in every process, every system, in a way to make your business more efficient. And so I think that'll be difficult. But I absolutely take the point. I think it is something, Shireen, that it is on the top of the mind of policymakers. It's on the top of the mind of every business.
That is the view there from industry as we count down to budget 2025, what they take away from the economic survey. Gentlemen, we will see you bright and early at the CNBC-TV18 budget headquarters. As always, it will be, it's going to be an exciting day, as it always promises to be on budget day. So look forward to hearing more from you as we analyze the budget fine print. Of course, the wish list, the time for the wish list is over. It will be down to the real thing tomorrow. Sanjeev Puri, Rajiv Memani and Chandrajit Banerjee. Always a pleasure. Appreciate you joining us here on CNBC TV 18. We will take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment with more.
Sounds simple, well, not quite. A lot of jargon there. What does it actually mean? Let's help you break this down to understand what really has transpired with this announcement being coming from Ashwini Vaishnav. Now, let's assume, and I'll explain that with the help of an analogy, the analogy of the humble tea, the common denominator between 2.8 billion Indian and Chinese. Now, let's assume that DeepSeek is this Chinese tea in this cup of tea. Now, what's important is that this is an open source AI model. What that effectively means is that the core code, which is the heart of the model, which is the recipe of the Chinese tea, is publicly available. So what the Indian government is proposing is that we'll use this recipe of the Chinese tea and replicate it here on Indian shores, on Indian servers, and have exactly the same model here present in India for Indian users. But that's not all. Let's bear in mind, we like our masala chai, like most things in life, we like a little tadka in our life. So we'll add a little input to this. We'll add some components. We'll add some sugar. We like some sugar in our tea. We'll definitely add some ginger. We like ginger as well. And let's not forget the milk in the Indian tea. And having done that, we'll come to the finished product, which of course is a humble masala chai, is a humble cutting chai. So why are we doing all of this? Why is Ashwini Vaishnav doing all of this? Well, the long and short is, number one, let's not forget the obvious out of the way, which is the masala chai tastes a lot better. But having addressed with the obvious, the other two key components why the Indian government is doing is number one, all the components that we added, the sugar, the ginger, the milk, what that essentially represents are tweaks that Indian engineers will be able to do on Indian servers to this DeepSeek model. Now, why would we want to do that? Well, let's bear in mind there were niggles with DeepSeek when it initially came out. It wouldn't accurately answer questions about, say, the 1962 war or the status of Arunachal Pradesh. So this masala chai, with all these components, represents tweaks that the Indian engineers will be able to do on the Indian servers so that it becomes slightly more comprehensive. But the second and perhaps a larger concern that the government has is that the government doesn't want you sipping tea from the Chinese cup of tea, as that will leave your imprint, and by your imprint I mean your data with the Chinese servers. What the Indian government is essentially saying, let it come here and have a cup of tea from the Indian cup of tea, the Indian server, so that your imprint, your data stays safe within Indian shores. So this chai pa chacha is the long and short of why the Indian government is bringing DeepSeek on Indian servers to Indian shores.
इसके लागू होने से प्रदेश में सच्चे अर्थों में सशक्तिकरण भी होगा, सुरक्षा भी होगी। इसके द्वारा जो कुछ कुरीतियां हैं, अब हलाला, इद्दत, बहुविवाह, बाल विवाह, 3 तलाक आदि जो कुप्रथाएं हैं, उन पर पूरी तरह से रोक लगाई जा सकेगी।
Hello and welcome to this special show, the Budget Town Hall. I'm Prashant Nair. The FY26 Union Budget will require the government to attain a tough balance between fiscal consolidation, Capex-led growth and a boost to consumption. While everyone recognizes the importance of continued fiscal consolidation, the demand for some measures aimed at arresting the current cyclical slowdown is also there. The stock market, which has been correcting for a while and has been a creator of such powerful wealth effect over the last few years, has also been falling. The Nifty is down some 13% from its all-time highs. The Bank Nifty is down 12%. The mid-cap and small-cap indices have come off between 15 and 17% from their respective all-time highs. Stocks, of course, have fallen anywhere between 30 and 40%, depending on what you look at. Real estate companies have started to wonder if the urban slowdown will start affecting home sales now. Can the government somehow put more money in the hands of the middle-class consumer? Can the government use the budget to turn sentiments around? That's essentially the question we will try and discuss and debate here with three sort of market men who really need no introduction. Anish Tawakle is with us, Pankaj Tibrewal is with us, and so is Harish Krishnan. Gentlemen, great to have all of you here. Thank you very much.
Thank you.
So once again, we find ourselves at the cusp of the union budget, and expectations usually run high, but I have to say that this time it's a little subdued. I mean, I don't see anything big in terms of expectations out there at all. Pankaj, why don't you begin? What should we really expect at a high level, top down?
So, Prashant, I think we need to address three things. I think as a country, we are too obsessed by expenditure side. Though fiscal is very important, I'm not denying that fact. But over the last 3 years, our tax collections have stagnated between 8.8 to 9.2%. We got a tailwind when COVID hit. But after that, tax collections has been virtually stagnant. Elasticity is not being seen. So I think we have to start thinking about
on the
growth.
corporate tax side.
On the corporate tax side.
Personal income tax is
personal income. I'll come to that.
Yeah.
That the reason we are seeing personal income tax growth is largely because of the capital gains in STT. Our estimate is that 5 years back that number was virtually negligible, 18-20,000 crore. This year we are looking at a number of 2.5 lakh crores. So that's linked to markets. So if market doesn't do well, that collection will not be as buoyant as we have seen. My only thought is that at 4.5, mathematically, if you look at if we are at 16 lakh crores of fiscal deficit and economy grows at 9.5, 10%, that 4.5, 4.6% will be achieved any which ways. So rather than getting obsessed further to take it to 3.5 and 3% as FRBM, we should cap at some point and start to think about the fiscal space and growth. And I think if government starts to think in that manner, that absolute debt to GDP is also very important, rather than only the fiscal deficit number. I think you will see growth coming back from a very different animal.
You're saying cap the target to about 4.5?
4.5, just do it for the time being.
But that is where it is now, right?
It will be.
So FY26 is 4.5.
Your budgeted number or FRBM targets.
Yeah, correct. But if we don't know whether they will put out a roadmap
for that part.
I mean, it's possible.
So my wish list would be cap it at certain percentage, focus on growth, get the pie bigger, so that your expenditures are taken up, because 75-80% of your expenditures are sticky in nature, any which ways, which is interest, wages, pensions, all those things. So you need to get the pie bigger.
Okay, let me ask you whether some help is needed, not whether it can be done now, immediately in the budget.
Two things you can do it.
Yeah.
So one, I think we have not done a great job on disinvestment. We have seen the...
No, I'll come to this. I'm saying from a spending perspective. Do we need some help?
Yes, we need some help. Okay. I'll tell you why. Yeah. If you go into the details of the Capex, the 11.5 lakh crores, 1/3 of that Capex has a lower multiplier. Let's look at the four heads. One is 65-70,000 crores has been parked with DEA, Department of Economic Affairs. I don't know why is it that, but that number is there. Then you have that number on the Home Ministry for upgradation of police. That is parked in the Capex side. Then you have the defense, which globally has a multiplier of 0.6 to 1. Roads, infra, others have a multiplier of 1.5.
Sure.
And then you have the telecom, which is 85,000 crores, where you funded BSNL and others, which hardly has any multiplier effect. So I think 1/3 of that Capex, if it start to put in higher productive use, you suddenly see that multiplier effect playing out. 11 lakh crores plus state of 6-7 lakh crores is not a small number, plus private sector Capex. So I think we need to think about the Capex part in greater detail and then also look at disinvestment, which has been very, very smaller.
Harish, your thoughts? First of all, do we need help? And will it come from the fiscal side or from the government? Yeah.
So I think let's look at budget as a policy making, or let's say Modi 2.0 and of course the last budget as well. I think there's been a marked shift towards supply side reform as the key tenet of budget policy making, right? So be it in terms of announcements of PLI, corporate tax cuts, various logistic initiatives, everything that aids productivity is what's primarily found mentioned in terms of the budget. To our mind, therefore, demand side is something which is kind of gone a bit out of sight from the budget as a process. Possibly the government believes that they can do it in other measures. It need not necessarily be in the part of the budget. The second, and I think something which is very timely for us to assess at this point of time, is that we had in May of 2024 S&P putting us on a watch list as far as a rating upgrade potentiality is coming through. And they had very clearly articulated, among many things, two clear identifiers or markers that they are going to monitor. One is the fiscal glide path, a combined fiscal deficit of 7%, and then the credibility of the RBI to maintain inflation in its band. These were the two key things. And this, to my mind, has kind of created a kind of a counter-cyclical policy response over the course of the last 12 months, wherein you've seen tightness both from the fiscal side and you've seen tightness both from the monetary side. Now, having got into the watch list as late as, say, about 9 months ago, and S&P says that they take a decision between 6 and 24 months, I would think that the government may not necessarily use the budget to make a big shift moving to demand side creation. However, given that there's been a change in the governor, at RBI, we think that the monetary policy opens up a range of possibilities. And it's just not about rates. There's been a whole amount of measures that may have signaled to various lenders about, wanting to cut down on credit growth. And one could see varying signaling instruments that can kind of, remove these layers out, which can help create the velocity. And therefore, possibly, I would suspect that while demand side boost is necessary, I still think that it may come potentially outside the ambit of the budget. While, of course, there will be some relief to the lower sections of the society, there would be some relief to the lower middle class, maybe the new tax regime, etc. But the big heavy lifting of demand side, I think potentially outside.
So you're not expecting anything big? Let me put it that way. It's nicely contextualized, but from a budget, from how relevant it is for the market, for stock markets, you don't think...
I think staying the course is actually a very big positive. And I think there's no shame in admitting that we've got a very good fiscal prudent budget. I think it also has to be seen in a relative context. Across the world, you're seeing governments going haywire with very high debt to GDP. And mounting further, there are economies...
No, in the context of we've got a bit of a slowdown at our hands. So in that context, we probably need something, and you're saying it'll come from outside the budget?
I think the easier bullet to fire would come from the monetary side rather than necessarily from the fiscal side.
Anish?
So, to answer your question, do we need a stimulus? I would think the answer is clearly yes. But I would agree with Harish that if you were to choose between a monetary stimulus and a fiscal stimulus, I would prefer a monetary stimulus. See, the advantage with a monetary stimulus is that it can be reversed once the economy picks up. Whereas a fiscal stimulus tends to become entrenched and it becomes very difficult to then reverse it. If you look at sort of history, right, and if you saw what happened in the GFC, things are nowhere near as bad as the GFC, but let's look at what happened there, right? We got a big fiscal and a monetary stimulus. The economy recovered very quickly. And that was very good. But the mistake that happened was that we didn't pull back the fiscal stimulus after the economy recovered. And then we got overheating. So if you were to choose between a fiscal and a monetary stimulus, I would definitely go with a monetary stimulus. To the extent that we are using fiscal, I would love to see something more on urban infrastructure, particularly metro development, because I do think housing is fundamental.
It's been a long-standing
view of mine. And if you saw that, like, even when the economy picked up momentum over the last 3 years, housing was a big driver of that. So I do think a combination of monetary easing and, some little bit of stimulus on the urban infrastructure side would go a long way in addressing the current soft patch that the economy has hit.
And relative on the urban infrastructure side, I mean, relative to what we've seen, does it need a big pickup or more spending? I mean, just in terms of
I think
specifics?
the monetary easing would also help, right?
Not monetary easing. I'm saying in the budget, spending on urban infrastructure.
Yeah.
I mean, do we need a big
I think
step up jump in allocation or something, or what are you expecting?
No, I'm not expecting. I wouldn't say I'm expecting. I'm saying that would be the most, in my view, the best use of resources to the extent that they have the resources and they're willing to spend it. But, on urban infrastructure, I think there is, as far as the need is concerned, it's phenomenal, right? So I don't think that I would ever say, oh, they've spent too much on urban infrastructure. I mean, the more metros we have, the more housing development we can spur. It would be a good thing. But having said that, I agree with Harish that there is no need we are not at that alarmist stage of the economy where we need to abandon fiscal prudence. And therefore, I would expect a little bit of help on I would like a little bit of help on urban infrastructure and a lot more room on
from the monetary side.
Yeah.
Okay, let's just, since expectations are generally, all three of you would agree, running low. So let's use our time the best. One or two sort of pointed things from the budget which kind of links back to the market in specific ways that you think are meaningful. I think, as Anish said, urban infrastructure is one. Pankaj, what would be?
My sense is that this investment has been a very big spoil sport. We have been able to do only 22% of our targets in the last 5 years in a market which has been super buoyant. And 66 CPSEs are listed.
The CPC index is lost 0.25% of its value.
So now the market cap, which was 37 lakh crores, probably would be lower. Can we generate that non-tax revenue part and fund it to the Capex? If overall your tax collection is not going up, can we use the non-tax part? I think that will be something which we will work out very, very closely. And that's one thing which I would expect. Second is the granularity in the Capex side, which I said. More projects which could have multiplier, as Anish mentioned. Urban, unfortunately, is a state subject. Can you have a model where center can support the state in developing that urban infrastructure? It may take some time, but I think that can be a great model over a longer periods of time. So if you start doing and thinking about growth in that aspect, I think markets will respond automatically over a period of time. And no tinkering on capital gains from a market perspective. I think that's the worry which most of the market...
Is there a worry this time at all? Or because I think last time...
You never know, because there is a worry that alignment of long-term, short-term across asset classes has to be there. So there is speculation in the market that can this time around be 12.5, be 15, and so on and so forth. So I think doing nothing will be a good thing because the sentiments right now are very fragile. Corporate earnings growth is not keeping pace with the expectation, and that's been reflected in the market itself. So I think keep a status quo budget. The speech will make a lot of difference in my view in terms of what we are thinking about in the next 12 to 18 months from an economic standpoint of view.
Harish?
So I would say that continue with the corporate tax cut for new manufacturing. I know that
we reported that for new manufacturing units,
that's
the 15, it may not be 15%, but 18%. I mean, but
no, I think it's still worth persisting with that. I know that private capex has been a lot lesser than what any of us anticipated, and definitely lesser than what the government expected. But we do see a two-track investment cycle happening, wherein we are seeing, at least on the conglomerate side, there are about 30 large business houses which are actually starting to re-leverage. So if I were to give an analogy of a car, they have moved from the first gear to the second and third gear. The vast swathe of rest of companies are still in the first gear. And I think we need somehow to create a payback period for this Capex, a success story for the rest of them also to join into the bandwagon. So because at this point of time, maybe corporates have become a bit too obsessed with ROE and ROC. These are all great things. Nobody is saying that we should abandon them. But
fund manager complaining about corporates obsessing about ROE.
Yeah, but I was just saying.
No, I could take your point. I'm just joking. Please.
Yeah, but if all decisions are by the head, okay, then possibly you won't get the right decision, right? There are some decisions that need to be taken from the heart. And when I say that, a Capex decision, if it is left to, say, the CFO, okay, typically comes from a logical, and we love that. As money managers, risk managers, we like that. But there needs to be some decisions that need to come from the heart, and that needs to come from the entrepreneur, the promoter. And I think it's still time to persist with giving them that glide path that, hey, invest in India. This is the best economic prospects that you have, and we'll continue to keep supporting. So I think even though it may be seen as, favoring the capitalist class again, but I think that would be a great thing. The second thing, if I may, would be, if at all you're doing something on the demand side, do it also for the old tax regime. Just don't keep it with the new tax regime. I think this tax forgoness is of course, is a true statement of what the government loses out. But in terms of its ability to signal sentiment change, is a lot lesser. And when actually people see that there is a difference across the board, that is when I think it'll start spurring. So if you're doing that route, keep it for both. Those would be my two.
Okay, I have to take a quick commercial break, gentlemen. So let me do that. We come back and continue this conversation with our market experts, budget, FY26, what to expect. And of course, we'll talk about markets as well, which are kind of precariously poised right now. Stay with us. Welcome back. You're still watching Market Special Budget Town Hall, and we are sort of debating, discussing what can be done, what should be done, and what will be allowed to be done as far as the budget is concerned. This 1st of February on Saturday. Anish, Pankaj, and Harish are with us, and we are talking to them. Gentlemen, thank you very much for waiting. So, one thing which which everybody recognizes we need to kind of focus on is jobs in a very big way, and how do we get there? Harish, you believe that maybe focus on what kind of sectors? What should be the focus really? Because I think I know where Anish stands. It's housing is a pet kind of sort of subject close to his heart. Construction. Harish, what about you?
These are low value add jobs, but there is a path to potential productivity benefits over a period of time, and we have to start somewhere. So I would say that even the gig economy is possibly a good way in which a lot of this shadow labor, which otherwise is not finding jobs anywhere else, can get through. So I think more and more of these is possibly a solution rather than worrying about them whether they are adding value to the economy. So therefore, directives which help them flourish, I would say would be far, far more welcome, which the government in its wisdom maintains that and is continuing to persist with.
Pankaj, the electronics components PLI, I mean, I think we'll hear about it in the budget. You think that's, we need more of it, or you think the direction is largely set? To say does, wherever the PLI schemes are required, I mean, it's been kind of announced and they need to be expanded, maybe the scope needs to be expanded like in the case of EMS. What are your thoughts?
I think we need to make the PLI work more effectively. Let me share a data point with you. So about 1.9 lakh crores is the total outlay by the government today. But we have only disbursed about 12,000 crores. So the schemes overall in spirit is looking great, but the execution in many sectors is missing. Except electronics and mobiles, which have been at the forefront of PLI implementation, many sectors have struggled to implement PLI. Also, I believe that auto industry is one of the largest employment generators, and it has a huge multiplier impact. Can we think about implementing effectively the PLI in the auto? And if we can do that, you will see huge investments coming in.
Which means that the PLI needs to be changed. I mean,
tweak it, make it more effective, implement it. Otherwise, becoming a manufacturing base will be only a dream. We probably cannot achieve that. And mobiles have shown that we can do it if you really implement it well. Electronics, entire ecosystem is showing that. Semiconductor entire ecosystem has started to buzz. So I think if we can do that repeatedly in many other sectors, I think that could be a great opportunity for us from an employment generation perspective as well as growth perspective. And this is at a time when, you know, the entire world is in a volatile environment. You don't know what Trump will do next to China, Vietnam, Mexico. So we have a great opportunity out here. And only the implementation is something which we need to be laser focused. I would have been really happy if I would have seen a large amount on the PLI had been dispersed.
Which has not happened so far.
Which has not happened so far right now.
So let me turn that around, right? If there is a great opportunity, why do we need PLI? That's a simple question, right? Markets should fund that opportunity. You know, and I find the market's response to PLI also a bit odd. A company gets a PLI of 1,000 crores. Its market cap goes up by 20,000 crores. That is saying we in the financial markets are so short-sighted, so myopic, and so lacking in understanding of business that, hey, there was an opportunity to spend 1,000 crores and create 20,000 crores of value. But with all the mutual funds of the world here, with all the private equity investors of the world here, we could not spot this opportunity. I don't agree with that. So my point is, look, ultimately manufacturing will follow if there is demand. The demand can come from two sources, either exports or domestic. Exports, why do we need exports? To pay for our imports. Our current account is already fine, right? There is no problem in the current account. So if we can meet our current account needs with services exports, I don't see any reason to push manufacturing exports, right? There is no inherent virtue in manufacturing.
Jobs, maybe.
Let me come to that, right? If you want to attract foreign capital into the country, right? You want a capital account inflow. By definition, you will have a current account deficit. There is, right? There is no two ways about it. A foreign capital inflow is a mirror image of a current account deficit. So my point is our external account is fine. Now, what do we need for domestic manufacturing? I've always argued that you need construction and housing, and domestic manufacturing will follow. If people have houses, all demand for durable goods depends on the size of your house. You will not have demand for lighting, you will not have demand for ACs, you will not have demand for anything, even clothes, right? You need a wardrobe to store clothes. If 5 people are living in a slum, they won't demand. So I think construction and housing is fundamental for creating. I'm not against manufacturing, don't get me wrong. I'm saying manufacturing will automatically follow construction if we get construction right. And if we don't get construction right, I mean, we cannot be attracting more capital inflows and saying we don't like a current account deficit. That's pointless, right? So I'm saying PLI is relevant for sectors that are inherently unviable but are needed for strategic objectives, right? If you say there's a defense sector which is inherently unviable and needs support because it's strategic, then you should give a PLI. But I don't see why, if there is a great opportunity, we need a PLI.
All right, I think I'm being told to wrap on this program. More questions, but out of time. Anish, Harish and Pankaj, thank you very much, all of you, for joining us. We don't have to wait very long to find out what the budget throws our way. Well, thank you very much for staying with us here on this special budget town hall. Programming continues on the other side of this break. Thanks for staying with us.
History as the first woman finance minister to present her 8th consecutive union budget. From replacing the colonial era briefcase with the Bahi Khata to delivering the longest budget speech in history, her tenure has been marked by milestones and transformative policies that have shaped the nation's economic journey. Her maiden budget speech in 2019 set the tone for bold reforms, and she has since introduced several initiatives that left lasting impact on India's economic policy. Let's dive into the landmark schemes and key tax reforms introduced under her leadership. Now, Sitharaman's budgets have introduced numerous initiatives aimed at driving inclusive growth, like the PM Suryodaya Yojana in 2021. Announced in the budget 2021-22, this initiative aimed to provide solar energy to villages that lacked grid connectivity. It was a step towards clean and sustainable energy, empowering rural communities while promoting renewable energy adoption. The Credit Guarantee Scheme for MSMEs was another such scheme. Revamped in budget 2024-25, this scheme provides collateral-free loans with a guarantee cover up to 100 crore rupees, addressing financing challenges faced by MSMEs. PM Vishwakarma Yojana is another such scheme. Announced in the budget 23-24, this initiative supports artisans and craftspeople with collateral-free credit up to 2 lakh rupees, toolkit initiatives, skill training and marketing assistance, helping preserve traditional crafts. The Vivad Se Vishwas scheme is another such milestone. Launched to resolve pending tax disputes, this scheme offers taxpayers a chance to settle cases by paying only tax amount with penalties and interest waived. PM Gati Shakti Master Plan in 2021. Now, a 100 lakh crore initiative focused on integrated infrastructure development, enhancing connectivity and reducing logistic costs. The Atmanirbhar packages in 2020 during the COVID-19 pandemic. A range of measures supporting MSMEs and businesses were introduced under this initiative during the pandemic, emphasizing self-reliance and domestic manufacturing. Now, the tax reforms on the taxation front have also been big. Sitharaman's budgets have implemented sweeping reforms to streamline the system and enhance fairness. Like the corporate tax reduction in 2019, the corporate tax rates were slashed to 22% for existing companies and 15% for new manufacturing firms, making India an attractive destination for global investments. The optional personal tax regime, or the new tax regime in 2020, a simplified system with lower tax rates but no exemptions would.
On the eve of the budget, the economic survey projects sluggish growth next year, pegs FY26 GDP growth rate between 6.3 to 6.8%. Growth rate for the current financial year estimated at 6.4%, the slowest in 4 years. The economic survey warns India Inc. of wage growth moderation when corporate profits are at a 15-year high. Says it is in the enlightened self-interest of corporates to take job creation seriously. The survey also says the private sector needs to do more to boost consumption.
So deregulation is not just about ease of doing business, it is a pathway to employment generation.
The chief economic advisor makes a big pitch for deregulation, asks governments to get out of the way and allow businesses to focus on their core mission, says governments must stop micromanaging economic activity. The economic survey warns of a churn in the labour market due to the rise of artificial intelligence, as the problem is magnified for India given its size and relatively low per capita income. The budget session of Parliament kicks off with the President's address. The government has listed 16 bills besides the financial legislations related to the budget. Opposition sharpens the knives, calls for a debate on the economy and the Kumbh Mela tragedy, among other issues. Well, those are the headlines from Parliament as the budget session begins. Thanks very much for joining us on Business 360. I'm Shireen Bhatt, but the other big stories we're tracking for you this evening. Stock markets perk up ahead of the budget. The Sensex gains over 700 points. The Nifty reclaims 23,500. Both indices up 2% this week, snapping a 3-week losing streak.
My response to competitors is I think they celebrated too soon. Yeah. Right? Let them bring their response to our announcements today, and we'll see. Market mein milenge unse.
Competitors celebrated too soon. It's game on, says Ola Electric's Bhavish Agarwal. The company launches 4 new electric scooters with a starting price of 80,000 rupees. Apple's revenue rises 4% in the December quarter, but iPhone sales failed to meet expectations. Tim Cook says the company is particularly keen on India as sales hit a record high. Nestle India meets estimates in Q3. Volume growth at 3% beats estimates, making it the first major FMCG company to deliver higher growth in this quarter.
मां लक्ष्मी से प्रार्थना करता हूं कि देश के हर गरीब एवं मध्यम वर्ग समुदाय पर मां लक्ष्मी की विशेष कृपा रहे।
भारत की विकास यात्रा के इस अमृतकाल को आज मेरी सरकार अभूतपूर्व उपलब्धियों के माध्यम से नई ऊर्जा दे रही है। तीसरे कार्यकाल में 3 गुना तेज गति से काम हो रहा है। आज देश बड़े निर्णयों और नीतियों को असाधारण गति से लागू होते देख रहा है।
False promise.
Boring. No comment.
No, the president was getting very tired by the end.
Repeating the same thing again
No,
and
she
again.
could hardly speak, poor thing.
It's the eve of the union budget. The government has tabled the economic survey projecting FY26 GDP growth at between 6.3 to 6.8% for the financial year. It has been estimated at 6.4%, the slowest in 4 years. With growth slowing down, the chief economic advisor sent out a clear message to corporate India. The baton on capital expenditure needs to pass on to the government, and India Inc. needs to do more. The CA points that corporate profits are at a 15-year high, but wage growth is moderating. The CA says, and I quote, "It is in the enlightened self-interest of corporates who are swimming in profits to take job creation seriously," end of quote. But not just corporate India. The economic survey also has a word of advice for the government, and that is get out of the way. Allow businesses to focus on their core mission. Deregulation clearly has been the big central theme of the economic survey. It says the government must stop micromanaging economic activity. And it's not just deregulation that the government has pitchforked as an idea. The survey also warns India Inc. not to ignore the impact of artificial intelligence. Over the next few minutes, our team of reporters will decode the key commentaries from the survey. But first, listen in to the chief economic advisor who, without mincing words, said the private sector needs to do more to boost consumption.
The growth in profitability and the growth in employment expenses, which is a combination of hiring and compensation, there is a huge disparity between the two, which has been highlighted by several private sector players themselves in the last few months. And this happened even as Indian corporate sector profitability hit a 15-year high in March 2024. And some of you may have heard that when in the 1960s, when Henry Ford raised the minimum wages for his car workers, he said, otherwise, there will not be enough people to buy the cars the Ford Motors produces. So in some sense, raising wage and salary growth for workers is also a source for aggregate demand for businesses in the medium run as well. So it is both, it is enlightened self-interest rather than being seen only from a moral prism as well.
The government can continue to take policy actions as it has been doing with respect to PLI schemes on labor-intensive sectors. And also in terms of the deregulation action, that is the government's, not just the union government, but the state governments and local governments' contribution to employment generation is by reducing the fixed cost of doing business so that firms can raise the variable cost by hiring more people. Beyond that, I think not everything needs a policy tweak or a policy intervention. Some of it is in the natural self-interest of businesses to be able to find this balance. And that is why I gave the example of Mr. Henry Ford. Recommendation which is made not just to the union government, but to governments around the country is actually a step to boosting employment, income generation, and therefore consumption. This is about deregulation, is exactly towards that. It is not a recommendation only to the union government. So by simplifying regulations and by looking into the nuts and bolts of regulations that affect small businesses, we are lowering the cost of doing business for them, therefore opening up the space for them to hire more, which will lead to income growth and therefore better consumption. That is the very precise recommendation that the economic survey is making to governments all around the country.
Well, that's the message to governments across the country from the Chief Economic Advisor. But let's focus on the growth outlook. The economic survey expects growth for the next fiscal between 6.3 and 6.8%. It mentions elevated geopolitical and trade uncertainties and the possible commodity price shocks as key headwinds. Sapna joins us now. Sapna, the survey projecting growth pangs are likely to continue, and of course, a realistic assumption there on the numbers.
Absolutely. In fact, the survey has borrowed heavily also from the IMF outlook as well as the World Economic Outlook. So keeping that in mind, first in terms of the nominal GDP for the next 5 odd years, the survey says that, as predicted by the other agencies, around 10.2% in USD, in US dollar terms is what India's nominal GDP could be, and 10.7% in INR terms. Also in the US dollar terms, our CAD could be around, it may rise very gently and in a very calibrated manner over the next 5 odd years, around 2.2% of the GDP. But this is actually in dollar terms. In terms of the growth numbers, it says very clearly that the 6.3 to 6.8% assessment for FY26 is also based on the IMF's growth assessment of 6.5%. Starting, FY25 onwards, from the current financial year onwards. So basically, this range of 6.3, 6.8 actually hinges on the IMF's, estimate of around 6.5% growth for India over the next 5 odd years. Now, the CA, the economic survey also mentions very clearly that even if these variables India is able to achieve over the next, 3 to 4 odd years, it's a very good scenario for us because looking at the global context and the global situation at the moment. So, no doomsday indications that, we are down and out. In fact, the commentary, the narrative is extremely positive. And as you have heard, what really is required going forward may not be that much in terms of economic reforms per se. Like somebody asked the CA, what about the employment sector or rather the labor sector, and what further tweaks are required. So he indicated that look, in terms of the employment schemes and skill sets that have been announced in the previous budget, these are policy actions in course, in practice, ongoing at the moment. So I think what the hint over here is that instead of economic reforms, we should be looking actually at business reforms, where the industry, the state governments and academia particularly need to come together and figure out what needs to be done, how those basic bottlenecks need to be removed so that the growth momentum is maintained at the moment, and also whatever we are predicting is achieved and maybe even higher than that. But it's a challenging situation globally. He has also spoken about the China factor very clearly, both in terms of the energy transition, China being the single sole major supplier of critical ingredients for a lot of sectors, also for the technological sectors. So, the elephant and the dragon in the room is the exact phrase used in the economic survey, and this is something that we'll have to be very, very mindful over the next 1 to 2 odd years. In fact, even 3 to 4 odd.
All right. All right, Sapna, many thanks for joining us. And the survey has also raised the alarm over disproportionate rise in corporate profits, while wage growth has not grown significantly. In fact, it has remained stagnant. Shivani's here with more on what the survey says. Shivani.
India Inc. is witnessing a record surge in corporate profitability. According to the economic survey, corporate profits hit a 15-year high in FY24, with Nifty 500 firms' profit to GDP ratio climbing to 4.8%, the highest since FY08. This boom was driven by strong performances in financials, energy and automobiles. Large corporations, particularly non-financial sectors, significantly outperformed smaller firms in profitability. However, despite profits rising by 22%, employment grew only by 1.5%. Highlighting a sharp disparity. The survey also highlights an analysis of 4,000 listed firms found that while revenue grew by 6%, companies focused on cost cutting, with employee expenses rising just 13%, down from 17% in FY23. The survey flags wage stagnation, especially at the entry-level IT positions, despite stable EBITDA margins of 22% over the last 4 years. While labor share in gross value added has slightly improved, the disproportionate rise in corporate profits, especially among large firms, raises concerns over income inequality and its impact on consumer demand. The warning is clear: for sustained economic growth, wage growth must align with corporate profitability. Without higher employment incomes, consumer spending could slow, impacting future investments and economic expansion. The survey underscores the need for a fair distribution of corporate earnings between capital and labor to ensure long-term sustainability and stability. Back to you.
All right, Shivani, many thanks for joining us. Deregulation, that's been the central theme of the economic survey. The survey asked governments to get out of the way and allow businesses to focus on their core mission. It says governments must stop micromanaging economic activity. The word regulation and deregulation together has been mentioned close to 350 times. Pariksha joins us now with more. Pariksha, the CA urging the government to pull out all levers of deregulation.
Economic Survey 2025 has given a clarion call for deregulation and getting out of the way. The CA has gone on to say that the future of reforms and economic policy must now be on systematic deregulation. India needs to go all out to reduce compliance costs, administrative costs and minimize controls. We need accelerated deregulation to attract, promote and facilitate domestic and foreign investments. The get out of the way theme also stood out, with the CA saying that the government should not micromanage the private sector and drop the principle of guilty until proven innocent, and rather follow the principle that says one is innocent until proven guilty. The survey says that India is overly dependent on China for critical components, minerals and other electronic equipment, and if the China challenge is big for Europe, then it's equally serious for India as well. The only way for India to reduce overdependence on China is through deregulation. The survey also said that deregulation is more critical for MSME growth than large enterprises. The survey also says that reduction in tariffs and fees, digitization of systems, setting legal safeguards for enforcement and risk-based regulation are all ways through which deregulations can take place in the next few years.
Parikshit, many thanks. The survey has also warned of a churn in the labour market due to the rise of artificial intelligence. Ashmit is here with more on that. Ashmit, what has the survey said on AI and possible job losses and what it prescribes as a possible intervention?
Well, two key themes to what the economic survey is saying. One, that it may be costly if you underestimate the risk coming in from AI replacing jobs. That's one. The second is there's also perhaps a case to be made for taxation of profits made from replacing jobs with technology, with AI. That's the twin theme. The economic survey begins by saying that the impact of AI in terms of job losses will be magnified here in India due to the large scale of the market here. And number two, the low per capita income that we have, saying that there are already churns being seen as far as the labor market is concerned in anticipation of this technology that is coming. Then going on to say that we need to guard against any form of complacency. There's a low probability, but we still need to guard against it. There needs to be a constant state of vigil. And then finally going on to urge the industry that there needs to be a staggered approach in which this technology is adopted. There needs to be a sensitive approach to adopting this technology. And then going on to say there are already conversations being had in international circles at forums like the IMF that there is perhaps a case to be made for taxation of profits that are made from replacing humans with upcoming, technologies. And finally, going on to say that there is perhaps a 3-point agenda that we need to follow. Number one, having institutional readiness, ensuring that our institutions are geared for this change. Number two, ensuring that there is a regulatory framework in place to push the technology in one specific direction. And finally, going on to say that there is also a need to structurally change the skilling framework that we have to make sure that children are ready, are geared for the future.
And the survey highlights the progress of the industrial sector and measures taken by the government to boost the sector. Timsy standing by with more on that. Timsy.
Well, that's right. The economic survey has laid out some key challenges and some positives when it comes to the industrial reforms. The survey says that India's industrial sector has seen a growth of 6.2% in FY25. Especially when it comes to the strong growth it is seeing from electricity and construction growth. It also lays out that the industrial growth, which had slowed down to 3.6% in the second quarter due to weak exports, monsoon impact and festival timing, seems to be easing in the latter half of the fiscal. It also says that the manufacturing exports are hit by global economic slowdown and rising trade competition. But yes, heavy monsoons, which were slowing sectors like mining, construction and manufacturing, are also to be seen. But yes, also to be noted is that this heavy monsoon is actually giving a boost to agriculture. The festival timing shift led to a second quarter decline in the growth, but consumer demand is slowly picking up since October. The reforms also laid out in the survey say that the state level industrial growth varies, especially there is a scope for further expansion across various regions, and now states need to do some bit of heavy lifting there to boost industrial growth. Also, it says that the government focus on R&D and MSMEs and capital goods to boost long-term industrial growth are yielding some benefits, and that is also going to be the thrust that the government is going to focus on. So let's see what are the policy measures that the government announces, because survey says that many policy measures are under the review to address export challenges and strengthening the domestic manufacturing. And yes, the upcoming budget and the next fiscal is something where government will keep on intervening whenever required to give the industrial reforms a boost, something that we'll have to see.
Timsy, many thanks. The survey also highlights that India's external sector showed resilience amidst global headwinds and uncertainties in economic and trade policies. Abhimanyu is here to detail more. Abhimanyu.
India's current account deficit had moderated to 1.2% of the GDP in the Q2 of FY25 compared to 1.3% in the corresponding period in the previous financial year. Also, the economic survey indicated that India's forex reserves were sufficient to cover 90% of the external debt as on September 2024. Also, uncertainty in the global markets and profit-taking by foreign portfolio investors had led to capital outflows. The survey further observed that the gross FDI inflows had shown signs of revival in the first 8 months of FY25. Also, several non-tariff barriers had been erected by developed countries, including EUDR and CBAM, which may impact India's exports in the years to come.
Abhimanyu, many thanks. Up next, Ola Electric's Bhavish Agarwal dares rivals, saying competitors celebrated too soon and that it is game on. Stay tuned for that and more when we return.
Giving taxpayers the flexibility to choose between the old and the new regimes. Another such initiative was the capital gains reform of 2023. The government removed the indexation benefit from the debt mutual funds, bringing all asset classes, including equities, debt funds and fixed deposits, under the same tax regime. While this reform created parity in taxation, it also drew mixed reactions as it increased the tax burden on long-term equity investments. The abolition of angel tax was another such initiative for all classes of investors. In 2024, in the budget of 24-25, Sitharaman proposed abolition of the controversial angel tax for all categories of investors. This move was expected to bolster the Indian startup ecosystem, boost entrepreneurial spirit and foster innovation across sectors. Now, Nirmala Sitharaman's budgets have been a mix of bold reforms and targeted policies, be it support for MSMEs, sustainable energy or comprehensive tax reforms. As she gears up to present her 8th budget, expectations are high for announcement that she will steer India's next phase of growth.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable?
Well, let's talk about the market action. The markets going into the budget strong. The Sensex gained over 700 points. The Nifty reclaiming the 25,300 mark. Financials, though, marginally underperformed the blue chips, with the Nifty Bank closing about 0.5% higher. Midcaps closing almost 2% higher today. It's a 1,000-point rally there as far as the Midcap index is concerned. But Trump's tariff threats pushing gold prices to a record high today. This after investors flocked to the safe haven metal. The yellow metal is now on track for a 5th consecutive weekly gain. This also marks gold's best monthly performance since 2024. Competitors celebrated too soon. It's game on. That's the word coming in from Ola Electric's Bhavish Agarwal. His comments come months after Bajaj Auto MD Rajiv Bajaj took a jibe at e-scooter maker at CNBC-TV18's India Business Leader Awards. Agarwal was speaking at the launch event of 4 new electric scooters. The Gen 3 models, as Ola calls it, start at an introductory price of 79,999. He added the company had enough headroom for aggressive pricing.
Gen 3 allows us to reduce the cost of manufacturing while improving performance. That's because, again, technology allows us to deliver better in lower cost. So we have that benefit, and Gen 3 gross margin benefit starts now, doesn't end now. Through the year, I had again last quarter said that through the year we'll keep getting benefits from the Gen 3 platform as we add more and more technologies into the Gen 3 platform through this calendar year. So all of that said gives us more headroom in the gross margin. Market pricing will be opportunistic and tactical depending on how competition is evolving, depending on how our market share strategies are evolving. So time by time, period by period, festive season, that will keep evolving the pricing strategies. Sure. But our leadership on cost of manufacturing actually enhances with Gen 3 significantly. So 30-35% is what I'm continuing to guide the street on. And if you see the last 2 weeks in January, we've actually been in that zone on a weekly level. We've been in the 30+ zone on a weekly market share level. And I think with all the new products, with the 12 products that we have now and the pricing, we should get there. And, if competition is aggressive on pricing, we have enough headroom to be aggressive on pricing.
I don't know if you heard Mr. Rajiv Bajaj at the CNBC-TV18 event saying, Ola to Ola hai, but Chetak to Shola hai. But the gap between you and your competitors right now is also very close. So what gives you the confidence you'll be able to, bridge this sort of in the coming months?
See, my response to competitors is I think they celebrated too soon.
Yeah.
Right? Let them bring their response to our announcements today. And we'll see. Market mein milenge unse. Market mein mil hi rahe hain, and we are back to number 1. Yeah. And we have all these products, the technology. The incumbent ICE companies had a one-time advantage of distribution scale, which we have nullified now. And the product advantage was always with us. It has enhanced with our Gen 3 portfolio. And the pricing advantage also with our better cost structure is also with us. So I think game on.
Well, that's Ola Electric's Bhavish Agarwal. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment.
From the market masters, macro pundits and chart wizards. Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
I am thinking that since the chatter is there and it is logical that the government has given some incentive to the corporate sector through lower taxes in 2019, and they've done something for the lower this thing in terms of giving food and subsidy, and the states are giving, that you might do something for the middle class or for the taxpayer. And that also is coming now, but I've been saying it for the last 30, 40 days, that, there is some scope, maybe $4-5 billion, say 30, 40,000 crores. But if you divide that by number of people who may get it, say, 2 crore or 3 crore taxpayers, it'll come to 8-10,000 rupees or something like that per annum. So you can get that much. I think it's possible to make it a little fair. I don't think it'll matter because it's let us say in a family you're getting 600-700 rupees per month. Okay. Now, what will you do with it? Because inflation is there. Secondly, the basket of people have changed. Will they order one more time Zomato, or will they change or buy an extra lipstick? Who knows? Because in the olden days, these things were much simpler to do. Or maybe there'll be a telecom price hike after a few days and some of this money would have gone away or whatever, 600, 700, 300, 200, whatever. So the point is, you don't exactly know what to do if the amounts are otherwise small, and nowadays the basket is a bit wide. So you will say good and thank you and on behalf of everybody, and it'll help the consumer sector. But now which stock will they go to McDonald's more? Where, by the way, I own that stock also, which has been a dud for 2-3 years, but before that was good. So will you go one more time to Westlife? Who knows? I don't consider Zomato as a discretionary stock in the sense it is.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. On the eve of the budget, the economic survey projects sluggish growth conditions next year, pegs FY26 GDP growth rate between 6.3% to 6.8%. Growth rate for the current financial year estimated at 6.4%, the slowest in 4 years.
Economic survey highlights reforms to strengthen startup ecosystem, including angel tax abolition and tax cuts, while noting women as key beneficiaries, with 73,151 startups having at least one woman director and 3,100 crore rupees invested in women-led ventures.
The economic survey warns of a churn in the labour market due to the rise of artificial intelligence, says the problem is magnified for India given its size and its relatively low per capita income, suggests that government tax profits generated from the replacement of labour with AI, also argues that the labour augmenting potential of AI should also not be ignored.
Ola Electric Bhavish Agarwal takes a dig at competition, says they celebrated too soon, adds the game is on and dares competition to meet him in the market. That's a CNBC-TV18 exclusive.
Apple's revenues rose 4% in December quarter, but iPhone sales failed to meet market expectations. Despite weakness in China, Apple bets big on emerging markets. As India sets a record in December quarter, the company plans to open 4 new stores in India. Well, those were the headlines we've been tracking for you this evening. The economic survey has highlighted key reforms aimed at boosting India's startup ecosystem, including the abolition of angel tax, expanded safe harbour rules, and streamlined transfer pricing assessments. Now, these measures, alongside tax deductions for e-commerce and data center reports, are expected to enhance India's global competitiveness, attract more investments, and ease business operations for startups across industries. Women entrepreneurship found a big mention in the survey, as it noted that the segment has seen significant growth, with nearly 73,151 startups having at least one woman director as of October 2024. Now, government-led initiatives like the Startup India Seed Fund Scheme and the Credit Guarantee Scheme have provided crucial financial support, noted the survey, with over 3,100 crore rupees invested in women-led startups. In fact, as much as 3,10,711 crore rupees has been invested in 149 women-led startups through alternative investment funds, or AIFs. However, the survey warned that women still face barriers, with only 22% of MSMEs owned by women, and that initiatives such as the Women Entrepreneurship Platform and WeHub are helping bridge these gaps, fostering a more inclusive and empowering environment for women entrepreneurs. Let's take a look at what startups want from Budget 2025.
As we are approaching budget, what are some of the key asks from your perspective?
So, I think policy initiatives can come in the budget, or they can come anywhere, any time of the year, not outside the budget. But 2 or 3 things that I think are very useful. Of course, we would like a top up to the fund of funds for startups, which is managed by SIDBI. That's useful and important. I would like to see ESOP taxation get more employee friendly. I think that's important for startups to be, to be able to attract and retain good talent, because they don't have a lot of cash to give, but they can give ESOPs. I think something that will encourage independent directors to join startup boards for better governance of startups. So you need better quality independence. Until about 2010, independent directors are allowed to get ESOP in unlisted companies. I think that has been stopped. Maybe that can be reintroduced, or at least be considered. There are 2 or 3 things I can think of.
I think this is a very, very critical budget, right? Especially it's coming after Donald J. Trump is now in power. I think we really would like to see a more focused on the startup ecosystem. We want to see much more focus on the AIF ecosystem as well. I think there's just too many different regulations that are getting mixed up with mutual fund regulations and with private equity regulations, and it's causing a lot of havoc. We already have to deal with a market that innovates and moves very quickly. And we need to move ourselves as quickly as well. So definitely, maybe a renewing of that 10,000 crore commitment that had come to SIDBI, possibly making that 20,000 crores. See, that 10,000 crores, by the way, led to 1 lakh crore worth of investing. It was just 10% of the capital that moved this market. If we can renew that commitment and have specific allocations even for space tech, have specific allocations for fintech, these are places where we need to move very, very quickly.
Right.
and would love to see what the government is going to do now with this AI, the 10,000 crores that was allocated for AI. Where are we going with that? It probably need to make it that from 10,000 crores closer to 50,000 crores to 1 lakh crores.
Some degree of simplification, and in terms of, I think the policy intents are good. I think the translation of policy intents into actual practice, I think that, to my mind, would be something big. And the way that can be done is that any tax claim made by any tax officer, which is then subsequently overturned by the courts, I think that tax officer should be held accountable for it. Right? And I think that if that discipline is brought in, see, with the cash system of accounting that the government follows, it is in, there is a lot of pressure, and the easiest thing for a tax officer to do is to put claims which will later on be turned over. But to contest a claim, you have to deposit X percentage of money. So a lot of, I would say, claims happen on companies and businesses across the country, which the tax officer fully knows will get overturned, but he's met his budget because of the cash system of accounting. So if the government were to change to an accrual system of accounting at one level, and two, people were to track in the IT department what percentage of persons' tax collections have actually been overturned subsequently, I think this might reform the system.
Ola Electric launched its new Gen 3 electric scooter range with prices starting at 79,999 rupees, going all the way up to 1,69,999 rupees. In a freewheeling chat with CNBC-TV18's Ritu Singh, Ola Electric founder and CMD Bhavish Agarwal spoke about the pricing strategy on gaining market share and also his budget expectations. Take a look.
I'm personally very excited. I think with Gen 3, we take the industry to the next level. And then the event was also titled Next Level. So it's truly, in 3 years that Ola Electric has existed, Gen 1 was started January 2022, Gen 2 was August 2023, and now Gen 3. Every 18 months, we've changed the paradigm. So we're going next level in everything, in terms of performance, higher power, range. Most importantly, range. We have done a lot of technology innovations which are possible only because of our vertical integrated strategy. Everything that we do in-house, we have actually increased range on the same battery capacity by 20%, right, because of all the technologies, and we've brought in our own cell into the Gen 3 product. So all of these combined really improve performance, really improve safety. We've increased the product breadth. We go from 69,000 rupees all the way to 169,000 rupees. So that's a very wide portfolio of 12 products that we have now. And our strategy remains clear: make all Indians access an EV of their choice. If somebody wants a lower priced one, we also have the Gen 2 products which are continuing. If somebody wants the best in class, the Pro Plus, which is the best scooter reimagined again, the Pro becomes Pro Plus. People get whatever they want.
Speaking of market share, you've gone from under 19% in December to nearly 25% as per the latest data. What has caused that kind of a turnaround with the kind of spiral down that we've been seeing for the last couple of months?
See, there were two things that really contributed to us getting back the market share, and not just market share, we're back to number one. We're back to where we belong, and our competition, in my view, thoda jaldi khush ho gaye wo. But competition is good. Healthy competition is good for the country, good for the consumer, and I welcome it. I love the competition, and I love the fact that others are bringing new products, and we will outcompete them on product, on innovation, on manufacturing costs, everything. We are there to compete and outcompete everybody. What has played in our favor in the last 3 months or so, right? Firstly, the service challenges are behind us, and all the issues are solved. And the consumer brand challenges are also solved. Now, consumers earlier were thinking, oh, Ola has a service challenge. Now, all of that has gone. So, and the customers are voting with their purchases again. And you saw that through January, our volumes increase. Second, also what has happened is we were actually lagging behind in distribution expansion. The incumbent competition had opened up their entire distribution to their EV products, and we had only 800 stores till November end. Now we have up to 4,000, and all of that also through January you saw them getting impact on our volumes. And the store expansion actually takes a few months for a new store to stabilize. So over the next few months, we actually expect continuing benefit on volumes from the new stores.
You've said before that your target sort of market share range is 30 to 35%. You're still at 25%. How soon before you get back to that? And will this discount strategy sort of continue to gain share?
So our pricing is actually very thoughtful. If you see, we have both the products available. Gen 3 whole line of products, and Gen 2 whole line of products. And I wouldn't classify it as a discount because Gen 3 actually is very rightly priced. The pricing has been thought of with a balance of both affordability for the customer as well as margins for us. And our cost of production comes down with Gen 3, so that allows us to be more aggressive on pricing. Gen 2 we are positioning as those who want an EV, but we're a little more holding back because of the price. Gen 2 will bring that audience in. So we think Gen 2 will increase penetration of EV in the scooter space. So it's actually an ice killer in that sense. So 30-35% is what I'm continuing to guide the street on. And if you see the last 2 weeks in January, we've actually been in that zone on a weekly level. We've been in the 30+ zone on a weekly market share level. And I think with all the new products, with the 12 products that we have now and the pricing, we should get there. And if competition is aggressive on pricing, we have enough headroom to be aggressive on pricing.
I don't know if you heard Mr. Rajiv Bajaj at the CNBC-TV18 event saying, Ola to Ola hai, but Chetak to Shola hai. But the gap between you and your competitors right now is also very close. So what gives you the confidence you'll be able to, bridge this sort of in the coming months?
See, my response to competitors is I think they celebrated too soon. Right? Let them bring their response to our announcements today, and we'll see. Market mein milenge unse. Market mein mil hi rahe hain, and we are back to number one. And we have all these products, the technology. The incumbent ICE companies had a one-time advantage of distribution scale, which we have nullified now. And the product advantage was always with us. It has enhanced with our Gen 3 portfolio. And the pricing advantage also with our better cost structure is also with us. So I think game on.
All right, it's game on, says Bhavish Agarwal. Moving on, AI-powered MSP startup SuperOps announced a Series C round of funding totaling $25 million. The round was led by March Capital with participation from existing investors like Z47 and Addition, and brings the startup's total funding to $54 million over 3 rounds. SuperOps co-founder and CEO Arvind Parthiban caught up with CNBC-TV18's Jude Sanat to chat about entering new markets and how hard it's been for the SaaS market to raise funds. Here's a slice of that conversation.
One of the external investor was interested and they was trying to invest in us. March did a small round last year. They put in a 4 million check last year. And this year, the moment everything was going well, we got our product market fit. We had some good traction in the SMB market, and we saw some good traction in the mid market as well. The moment these two engines started working well, March internal investors had the confidence. They didn't want an external new investor to come on board, so they basically said they will want to double down and invest in this.
Right.
So that's
and look how that panned out. It's your largest round till date, and at 25 million, it's no mean feat, no doubt. But moving on, Arvind, could you help us break down in terms of what this funding will be used for at the get-go? What are your priority areas, and where do you go from here really in terms of investing this money in which space?
Yeah, so our biggest priority this year is we cracked inbound and SMB engine very, very well. There is really good growth, like world-class numbers over there. Our idea is to go up market, cracking the mid market, which will essentially help us in growing in the global markets.
Right.
So we want to expand in different regions. Right now, if you see, majority of our customers come from North America and UK. We want to be in the rest of the world. We want to make our presence. So that would be the first one. And second is, goes without saying, everybody are talking about AI. We did launch our Monica AI last year, but we want to go deeper and how this is going to completely change the MSP industry. So we're going to heavily invest in the AI. And third is also we are launching a new product, IT endpoint management software, where we want to enter into this market and go deeper into serving in that market as well. These are the 3 key areas.
In this climate, with regard to a lot of uncertainties and funding slowdown, if I may use the word, where do you see the SaaS market growing from here? If I were to ask you to hazard a guess, what is that overall growth projection to be for the SaaS market at large?
See, definitely SaaS market is going to grow significantly. Yes, in recession, the great companies are built. What I would say is we have to invest in the right area. Are you building and solving a right problem? Are you investing in right technology? That is AI. AI is actually level set the field. Now that DeepSense announcement has also happened, it's not only for the big companies. Any company can actually challenge any large companies you will be able to solve the problem better with AI if you invest in technology and build the right problems. SaaS is definitely going to grow, but it's an opportunity.
What do you think?
Again, like the way technology changes every year, right? I can say how much we can grow.
Yeah.
You would definitely want to grow at least 200 to 300% in the next 1 or 2 years. Every year we want to grow at a 200 to 300%. Opportunity is there, but we just have to make sure we solve the right problem. Right?
Okay, so 2x, 3x growth in the near to medium term, very achievable for you?
I'm hoping for a 3x growth this year.
Okay.
And probably 2x the year after.
On that note, it is time for us to head into a short break. But coming up next, Minto, a merchant SaaS platform, has bagged 71 crore rupees in a secondary funding round led by Z3 Partners. A conversation with the CEO and co-founder Raman Kanduja. On the other side, stay tuned.
What you were doing, which is why we like those kind of stocks where you are not trying to say that the customer has to spend more money. It is just reorienting. That's why we like the quick commerce. He's not spending extra money. He's just making it convenient for him to buy this via this channel versus that channel. I don't like the consumer staple because I think that the consumer basket has expanded to beyond just upgrading a soap or something because monsoon has come, which was the old formula. In the old formula, when I was in Alliance Worli, we would see if there's rain outside our window in Bombay, and then you would go and buy levers and you'll make some 5-10% in 6 months. So those days are gone. Now you don't know. There are private labels. And then the customer himself or the consumer himself has or herself may want to buy something which they can show on social media or in a photograph or in a selfie. Some of these things, who knows?
Well, here's a fallout of the DeepSeek phenomena. The Indian IT Minister Ashwini Vaishnav making the big announcement that the Chinese large language open source model DeepSeek will be brought to Indian servers, will be brought to Indian shores so that it becomes available to Indian users. Sounds simple? Well, not quite. A lot of jargon there. What does it actually mean? Let's help you break this down to understand what really has transpired with this announcement being coming from Ashwini Vaishnav. Now, let's assume, and I'll explain that with the help of an analogy, the analogy of the humble tea, the common denominator between 2.8 billion Indian and Chinese. Now, let's assume that DeepSeek is this Chinese tea in this cup of tea. Now, what's important is that this is an open source AI model. What that effectively means is that the core code, which is the heart of the model, which is the recipe of the Chinese tea, is publicly available. So what the Indian government is proposing is that we'll use this recipe of the Chinese tea and replicate it here on Indian shores, on Indian servers, and have exactly the same model here present in India for Indian users. But that's not all. Let's bear in mind, we like our masala chai. Like most things in life, we like a little tadka in our life. So we'll add a little input to this. We'll add some components. We'll add some sugar. We like some sugar in our tea. We'll definitely add some ginger. We like ginger as well. And let's not forget the milk in the Indian tea. And having done that, we'll come to the finished product, which of course is a humble masala chai, is a humble cutting chai. So why are we doing all of this? Why is Ashwini Vaishnav doing all of this? Well, the long and short is, number one, let's not forget the obvious out of the way, which is the masala chai tastes a lot better. But having addressed with the obvious, the other two key components why the Indian government is doing is number one, all the components that we added, the sugar, the ginger, the milk, what that essentially represents are tweaks that Indian engineers will be able to do on Indian servers to this DeepSeek model. Now, why would we want to do that? Well, let's bear it.
Welcome back. It's with us on Startup Street. Minto, a merchant SaaS platform catering to banks and merchant acquirers, has bagged 71 crore rupees in a secondary funding round led by Z3 Partners. As part of this transaction, Z3 Partners will acquire a minority stake from some of Minto's early institutional investors. In February 2023, the Mumbai-based startup had raised $20 million in its Series A funding round led by PayPal Ventures and others. Joining me now to discuss this further is Raman Kanduja, the CEO and co-founder of Minto. Also with me is my colleague Shruti. Raman, thank you so much for taking time out and being here with us on Startup Street. You know, the last time we spoke, you had raised funds last year in February. Take us through what the growth has been for your products in the last year. What are the kind of efficiencies you've brought for your clients since then?
Interesting question. When we last time raised funds, that was Jan of 23. That was when PayPal Ventures and British International Investments, along with HDFC and Pravega, invested. This time, incidentally, it's a secondary round where the money is not coming into the company, but some of our initial investors are cashing out a small part of the stake. From the last time, which is Jan 23 to now, our merchant base has grown almost 3 times. We are now 3 million plus merchants. That time, we were working with HDFC and SBI was just starting. Now we have Axis Bank, Yes Bank live, and we have a few more in the pipeline. Today, that time we were working with the largest merchant acquirers in India. Today we are supporting the largest merchant acquirer in the UAE as well, which is Network International. And we have presence with 3 clients in the Middle East and 2 in Africa.
Hi, Raman. This is Shruti quickly stepping in. Like you mentioned, you've raised 71 crore rupees in a secondary funding round that is led by Z3 Partners. Can you take us through how you plan to deploy these funds and any new offerings in the pipeline?
So, interestingly, this money is going to our existing investors, not to us. It's a secondary round. So, Arundhati, we have been now profitable for the last 3 years at a PAT level. In fact, we've not even touched the money that we have raised in the last 2 rounds. And we are adding to it. The idea is we want to accelerate our growth, and we are actively looking out for some inorganic or M&A opportunities, which is where we plan to utilize what we raised in the last 2 rounds. Specific to this round, as I said, it's a happy situation for us because some of our early backers are cashing a very small part of their stake, and there's a decent upside they're getting. That's my definition of value creation for my stakeholders.
So creating value there for your stakeholders. But you know, Raman, as you just pointed out, you haven't touched the funds from your previous fundraise as well. So, you know, you're clearly well capitalized and you're looking for some inorganic growth opportunities. Can you take us through who you're in talks with and the kind of companies you're looking to buy?
Payments is something that connects all SMEs. Payments is now digital. Can we build other digital services on top of payments? For example, this SME needs to pay bills multiple times a month. That's an adjacency. We don't have expertise, so we are looking at some options in the bill payment space. And similarly, outside India, India has today become, when it comes to digital payments, India has become the playbook for a lot of countries in emerging markets. And banks everywhere are in a similar situation. They're struggling with tech. And what we built for banks in India is resonating with